SMA. If you continue to rely on these things, you will not be successful. You will not be successful on the charts. You have to understand that the charts can only go one of two ways, up or down. Okay? The candlestick. I want you guys to understand that these candlesticks can only move in two directions, up or down. And everything is based off of levels. Why do you think you see price reacting at the same area? For example, say you have market going in an uptrend, okay? And market found an area of resistance, okay? So an area of resistance is going to be an area where people decide to sell at, okay? So you're going to have sellers here. If price decides to come back up, price has a good chance to short at that same area, okay, of resistance. Since people sold there the first time, has a good chance to sell there the second time, okay? And then you're going to have areas of support. And these are going to indicate buying zones, okay? And even if it doesn't congruently happen like this, a setup can commonly look like this. I call it the support mirror, resistance mirror, or the stack mode mirrors, okay? So you might see a setup that looks similar to price might come up, it might rally past the resistance, you know, come back down, and then mirror the resistance, you know? Very common. You have setups like this for a downtrend type of setup. And then for an uptrend type of setup, could definitely look like this. Price might bounce here. And then price might come back up and then validate it again. So even though it invalidated at this area here, it decided to come back up over here and then go in an upwards direction. Okay. So we have to understand the market is a vertical chart. You're looking at a vertical chart. That's why I do not want you guys to fall into the indicators traps. Okay. Now, there are going to be some pretty good indicators. Okay. Volume. Okay. A lot of people don't even know what volume is. What is volume? Volume is going to be the amount of orders placed at a specific area or time. So volume is the amount of orders placed at a specific area or time. That's going to be volume. So that's the term you always hear. So you want to be buying at key areas of support, okay, because it's going to have most of the volume there. You want to be selling at key areas of resistance because most of the volume is going to be there. Now, let me go ahead and give you guys some secret sauce here. Way more powerful than indicators. Okay, understand that sometimes in the market, resistance can be broken and turned into support. Okay, resistance can be broken and turned into support, and then price can bounce in an upwards direction. Just the same way, support can be broken and turned into resistance. Okay, so resistance can be broken and turned into support, and support can be broken and turned into resistance. Even if it doesn't happen this cleanly, it can happen something like this. And price might run through there, come back up, turn this resistance here into the support later on. Okay, go to the support area, support, say price decides to run under here, come above it, and then come up again, boom. This area of support made this area of resistance created here. Okay. So I make it simple for you guys, man. I do not want you guys to be struggling. Okay. There's going to be times life is going to be hard. The charts are going to be hard. People are going to be doubting you. People are going to be hating you. And there's going to be times you might not even believe in yourself. And all that doubt has to be killed. Okay. And indicators equal doubt. If you have to rely on indicators to trade, then you can't be a profitable trader. Okay, if you can't just look at the chart and be like, oh, okay, I see why price bounced here, 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 and here, then you cannot be a profitable or successful trader. You will continue to struggle. You will continue to go through hard times. Okay, and it's going to be very, very hard for you to elevate. And the indicators are what's holding you back. So I want you guys to do this. Okay, for a year, no indicators. Okay, no indicators. Just read the candlestick chart clearly. Read it raw. Read it raw. Okay. That's what I need you guys to do. So for a year, no indicators. And I want you guys to just go hard, man. Go hard. Put in 16, 20-hour study sessions. Live on these charts. Understand every single micro reaction. Understand why price bounced at every single area that it did. Understand why price sold off at every area that it did. We have to get the full congruent picture. We want to get to the next level and we're pushing harder than ever. We're not stopping for nothing. Okay, this is real therapy for me, guys. Just sitting here teaching you guys these charts. I'm so passionate about this. You know, I live for God and I live to just get people out of financial poverty. I don't want to see anyone struggling. I don't want to see you guys blowing up your accounts or committing suicide over the markets or just going through any financial hardships. I want you guys to be successful. I want you to get to the next level. And I want you to win. Okay? And I want you to win. And best way to win on the charts, okay, is you have to have your setup. Okay. Follow your heart. Okay. If God put it in you to trade, trade. Don't let anyone stop you. Don't let anyone stop you. You have to trade. Okay. Whatever's inside of your heart, you got to go with that. You got to do that. It's going to be times you're going to be feeling doubt. It's going to be times you're going to feel like, oh, it's not for me. I don't know. But God put it inside of you for a reason. So go hard. Okay. Follow your heart and follow your setup. Okay. You tell yourself, I'm only going to play break and retest. Okay. If you're a break and retest trader, why are you trading anything else other than break and retest? Why? If you're a mirror trader, okay, someone who trades resistance or support mirrors, okay, why are you playing anything else other than mirrors? You need to, if you're a trend line trader, okay, why are you playing anything else other than trend lines? Okay, that's the things. You have to follow your heart and follow your setup, and most importantly, follow God. Okay, you can get successful. Investing, it's important in this world. Okay, the more shares that we buy, the more companies that we can help, the more that we can help each other on this earth. Okay, faster healthcare products, more communication so we can communicate with our parents, grandparents around the world, etc. Okay, investing in the stock market is crucial. It's important, and don't let anyone else stop you guys from doing it. I'm very, very passionate about teaching this, and if you want to learn more about it, and if you want to get a free stock watch list, I should see you at stackmode.net. Say prayer to God, keep grinding. Catch you in the next one. Peace. Alright guys, this is Stackmode Cursor. Today we're going to be talking about the cover calls in the Iron Condor. We're going to understand how these market structures work. We're going to deconstruct the mechanics and the risk profile of the cover call. We're going to analyze the structure, profitability, and adjustment techniques for the Iron Condor and determine the appropriate market environments for deploying each strategy. Okay, let's go and let's jump straight into it. So, The covered call is perhaps the most fundamental income generating option strategy. It involves holding a long position in an asset, like 100 shares of stock, for example, and simultaneously selling a call option against that same stock. The term covered is the key, as your long stock position acts as the collateral. And the goal of it is to generate premium income, right? To generate some cash flow against a long stock position, essentially lowering your net cost basis in shares. And it performs best in neutral or slightly bullish markets in general. So let's talk about the two-part mechanics, right? It's a two-part trade. So leg one of the trade is, let's say you're long. So you would have to buy at least 100 shares of the underlying stock, okay? Whatever that you wanted. And then leg two, you would short. Then you could sell one call option contract, which represents 100 shares. So a call option contract represents 100 shares. Same thing with the put option. It represents 100 shares per contract against the long shares. So we'll talk about the strike price and expiration. So the call option is typically sold out of the money, meaning that the strike price is above the current strike price. So it usually has an expiration date between 30 and 60 days out, and this balances the maximum time decay benefits while minimizing the chance of early assignment. So the key concept of it, right, is capping the upside. So by selling the call, you're going to be granting someone else the right to buy your shares at the strike price in exchange for the premium. So you agree to cap your potential upside profit at that strike price if the stock rallies significantly. So understanding the payoff structure is going to be vital for proper application. So the premium received shifts the entire risk reward profile. So it turns a traditional stock holding into a defined risk income vehicle. So let's talk about the max profit, right? So the max profit. This is realized if the stock closes exactly at or above the strike price at expiration. And the break-even point is the original stock purchase point. So the premium acts as a buffer against the decline in the stock's price. Okay? And as far as the risk involved into it, right? So the core risk is that the stock rallies past the strike, right? Let's say in hindsight, that would lead to your shares being called away, a sign at the strike price, forcing you to sell them and forego further upside. So as far as downside exposure, the strategy still retains the full downside risk of owning the stock, minus the small premium collected. If the stock falls drastically, then the loss would be significant. And if the stock price So if the stock price approaches or crosses the strike, a common adjustment is to roll the option. And this means buying back the currently sold call, right, for closing it, and selling a new call with a later expiration date and or a higher strike price. And this action can often be done for a net credit, extending the trade and potentially capturing more upside while avoiding immediate assignment in general. So the iron condor, it's a sophisticated non-directional strategy and is designed to profit from a stock remaining within a defined price range over a specified time period. And unlike the covered call, the iron condor defines both maximum profit and a maximum loss at the outset, making it a pure defined risk trade. So as far as the market view, right, strictly neutral or low volatility, and you're betting that the market will not keep that in mind, you're betting that the market will not move significantly in either direction, up or down before expiration. You're thinking that the market's going to remain pretty flat. So structure, an iron condor is essentially two separate credit spreads combined on the same underlying asset. So a bear call spread, right, for upside defense, okay, because you sold out the money calls, plus you bought further out the money calls, okay? So you could do things like that. And let's say a bull put spread, okay, for downside descent. Let's say you sold out the money puts, plus you bought further out the money puts, okay? Building that defense, building that buffer. So the goal is to maximize the premium received from selling two inner options, right? It's the body of the iron condor. And it's minimizing the cost of the two outer options, right? It's the wings, which define the maximum risk in general. And let's talk about the power of time decay, theta. So if you're an options trader, you guys may have gotten destroyed by theta before. You might have been up some good profit at a point of time, and then your trade just absolutely plummeted down to the ground because you didn't close at a certain point of time, right? And that's because of theta. Theta is going to be part of the Greeks in options, and it can be something that can make or break a really, really good trade. So keep that in mind and make sure you guys are buying months out whenever you're buying options, at least months out to years out. And the strategy thrives on the erosion of option value due to the passage of time. And since you're a net seller of options, okay, since you're a seller of options where you're collecting the premium, you benefit directly from theta decay, which is accelerated in the last few weeks before expiration. So if you're selling options, then I recommend you guys have lower expiration dates, okay, because you're betting for people to take wild bets and for them to lose. But if you're buying the options on speculation, I recommend you guys buy many, many, many months out, okay? So this is the reason why it works, okay? Because people who don't know that, who don't know about theta, you're pretty much taking gamblers' money. So anybody who wants to gamble and bet market in wild ways and wild numbers, okay, with wild expiration dates that are really close, you would go ahead and exchange money with them fairly. And to fairly grasp the iron corridor, you must see it as 4 distinct transactions working together to create a single bounded payoff zone. And each leg is going to be crucial for defining risk and maximizing credit. So let's talk about the call side, right? The bear call spread. So a short call, it sells premium and initiates the upside profit boundary. And a long call, it buys cheaper premium and it defines the maximum loss on the upside. And the purpose of it protects against a large move up, defining the risk to the upside. And let's talk about the put side, right? Puts is going to be if price is going in a downwards direction. Calls is going to be if market wants to go in an upwards direction. So short put is where you sell premium and initiates the downside profit boundary. And a long put is where you buy cheaper premium and it defines the maximum loss on the downside. And the purpose of it protects against a large move down, defining the risk to the downside, preparing yourself. So max profit condition. So the maximum profit is simply net credit received when initiating all 4 legs. And this maximum profit is achieved if the underlying stock price closes between the 2 short stock prices. All right, so the short call and short put at expiration. And in this scenario, all 4 options expire worthless and you keep the initial premium collected. So the iron condor's defining feature is that the risk is fixed and known before the trade is placed. And this is fundamental to professional portfolio management. So the max loss calculation. The maximum possible loss is determined by the width of one of the credit spreads, and a call spread width or put spread width minus the net credit received. So for example, if the call spread width is $5 and you receive a $1.50 credit, right, the max loss would be $5 minus $1.50. So that would equal $3.50 per share, or $350 per contract. Because remember, for options, whenever you have decimal numbers, you gotta multiply them by 100. So that's just doing the math by that. And the upside break even, let's talk about. So short call strike price plus the net premium received. If the stock closes above this point, then the trade would lose money. And downside break even, right? Short put strike price minus the net premium received. If the stock closes below this point, then the trade would lose money. And the safe zone, the profit tent is going to be the area defined between 2 break-even points. And the wider the distance between your sold strikes, the wider the tent. Compared to the width of your protected wings, the larger your potential profit, but the lower of your probability of success. Okay, so keep that in mind. So both strategies are going to be crucial for a well-rounded option trader, but they're going to go ahead and serve entirely different purposes and thrive in different market cycles. So we'll talk about the iron condor versus the covered call. Okay, for the market bias. Okay. Neutral to slightly bullish. Okay. And iron condor, strictly neutral. Okay. Risk for covered call. Okay, the stock downside is going to be uncapped. But for an iron condor, the risk is going to be defined and limited. Big, 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 big upside here. And the max upside capped at call strike price. But the iron condor is going to be capped at the net premium received. And the primary benefit for the covered call is going to be for consistent cash flow for a low cost basis. But the iron condor is going to be a high probability of small profit, building a consistent, more stackable window. And by combining these strategies, you can equip yourself with the tools to generate income and profit from the consolidation, okay? Covering a much wider range of market behaviors and profiting from the market. So we've explored the mechanics, the risks, the benefits, how the iron condor works, how the covered call works. If you want to learn more about options, head over to stackmode.net. Stay prayed to God. Keep grinding. Catch you in the next one. Class, let's talk about crypto arbitrage trading, the pursuit of risk-free profit in digital markets. Welcome to the lecture. Welcome to Stackmode, and let's jump into it. So the essence of arbitrage. Arbitrage is fundamentally the practice of simultaneously buying and selling an asset in different markets to profit from a temporary difference in price. It's the closest thing to a risk-free profit and opportunity in finance. And in the cryptocurrency space, this occurs because the global market is highly fragmented, with hundreds of independent exchanges that are not perfectly synchronized their prices in real time. This creates transient imbalances within the cryptocurrency community. So arbitrage is not about predicting the future prices, right? That's going to be speculation. It's about capitalizing on the current now price discrepancies for the same asset at the exact same time. So why do discrepancies exist in cryptocurrency in the first place? So latency and speed. Network delays mean that a price change on one major exchange may take a few milliseconds to reflect on a smaller, slower exchange. And this tiny window is the opportunity that people use in order to capitalize on some profits. So let's talk about some regulatory and geographic factors. Differences in regulatory frameworks or capital controls in various countries can cause persistent price differences. The community premium is a classic example. And liquidity differences. Exchanges with low trading volume might have larger bid-ask spreads, leading to minor price offsets compared to high volume exchanges. And we'll talk about transfer fees and withdrawal delays. The cost and time associated with moving capital between exchanges also contribute to price gaps that need to be larger to be profitable. So the foundation. Let's talk about simple exchange arbitrage. So the two exchange model. And this is the most straightforward form, involving just two exchanges and one asset. For example, Bitcoin, also known as BTC, BTC USD. The goal is to exploit a direct price difference. So step one, right? So this is how you do it. For example, you would buy low and simultaneously place a market order to buy one Bitcoin on exchange A, where the price would be $50,000, for example. And then step two, you would sell at high. At the exact same moment, you would place a market order to sell one Bitcoin on exchange B, where the price is $50,050. And result, a gross profit of $50, okay, and less trading fees and withdrawal costs, okay? So, capital allocation challenge. For this strategy to work instantaneously, an arbitrage must have the capital prepositions on both exchanges. This is known as a capital risk or funding issue. So the required capital setup. You must have the fiat currency, for example, USD, okay, dollars, stable coins, etc., ready on exchange A to buy, and the asset, for example, let's say you're buying Bitcoin, ready on exchange B to sell. If you have to transfer the asset after buying, the price gap will likely close, and the opportunity will most likely vanish. And due to razor-thin margins, the speed required, this strategy is almost exclusively executed by automated trading bots that operate in milliseconds. So the advanced strategy, right? Triangular arbitrage. So 3-act cycle. Triangular arbitrage all occurs on a single exchange and exploits inconsistent pricing between 3 different currency pairs, creating a closed loop trade with a net profit. The core idea is that the implicit exchange rate calculated from 2 pairs does not match the exchange rate of the third pair. And the path. Example, using USD, Bitcoin, and Ethereum, and trade 1 to start it. Okay, so you would start by converting your crypto currency. Let's say, for example, let's say your starting currency would be USD to Bitcoin. Okay, so turn your fiat currency into cryptocurrency. Okay, so via the BTC USD pair. Okay, you could also turn your cryptocurrency into cash as well too, and do the same thing by whatever asset you want. Let's say you wanted to do Ethereum too. Okay, and the midpoint, you would convert the final asset, all right, or the first asset, that would be Bitcoin, to the second asset, for example, Ethereum, okay, via the ETH BTC pair. Okay, so you can use a cryptocurrency to swap it to different cryptocurrency pairs as well, or use your cash to do cryptocurrency and then buy the pair that you want. And you convert the second asset, such as Ethereum, back to your starting currency for your USD via the Ethereum USD pair. So the margin requirement and the speed of this. For the trade to be profitable, the final USD amount must be greater than the initial USD amount after all 3 trades and associated fees are deducted. And why this is faster? Since all 3 transactions happen on the exchange, the trade can be processed much faster than moving assets between exchanges. And this makes it a primary focus for institutional high-frequency trading. Okay, which can be a good thing and a bad thing because that can bring up bots as well. And this strategy is highly dependent on sufficient liquidity for all 3 legs of the trade to ensure that the bot can execute its large volume orders without slippage, which is the change in price due to the order execution itself. So the frontier, right? DeFi arbitrage and flash loans. So let's talk about DeFi pools and dexes. Decentralized finance, which is DeFi arbitrage, involves capitalizing on price differences between different automated market makers, also known as AMMs, like Uniswap and SushiSwap, or between a DEX and a traditional central exchange, okay, also known as a CEX. And let's talk about the liquidity pool inefficiencies. Prices on DEXs are determined by the ratio of tokens in liquidity pool. And when a large trade happens on one DEX, the ratio shifts, creating a temporary price difference relative to other platforms. And there's going to be a gas war, right? So gas in the cryptocurrency world equals fees. So when you see the word gas, think of fees. So a gas war. A significant risk here is the cost of gas, right? The network transaction fees. And arbitrage. Bots must bid high gas fees to ensure the transaction is included in the next block faster than their competitors, okay? And nice writing here. And the game changer, right? Flash loans. So flash loans are a novel decentralized finance concept that allow a user to borrow any amount of uncollateralized assets, provided liquidity is available, so long as the funds are borrowed and repaid within the same blockchain transaction. So let's talk about some zero capital arbitrage. Flash loans enable an arbitrator to perform a large-scale arbitrage without needing any initial capital. The bot executes the buy low, sell high sequence, and then repays the loan plus a small fee, all in one automatic transaction, okay? And if the transaction fails for any reason, for example, as part of the move, the loan is automatically reverted, eliminating execution risk. So the automated life cycle of an arbitrage trade. So opportunity scanning, right? We can go watch it. So the bot, right? Having a bot, especially as AI progresses and things like that, the bot continuously monitors real-time price feeds across dozens of exchanges, calculating the net profit after all fees for every possible pair or triangle. And it seeks a spread that's going to be wider than the combined cost of trading and transferring the funds. 2, trade evaluation and execution, the trigger. Once a qualifying spread is identified, the bot initiates the simultaneous execution. And for interchange arbitrage, this means sending API calls to both exchanges at the same moment. And the execution must be extremely fast to beat other bots. And let's talk about the settlement and rebalancing, right? The closer. So after the trade fails, the arbitrage now has an imbalance of assets. For example, more Bitcoin on exchange A or less on exchange B. And the final step is often transferring the net profit back to the seller account and rebalancing the capital for the next opportunity, which incurs more fees. So the necessity of automation for arbitrage, the bot stack. Manual arbitrage is essentially impossible in modern markets. An entire process relies on sophisticated low latency software, written primarily in languages like Python or C++, and the API integration. Bots communicate directly with exchange APIs, application programming interfaces, right? That's what API stands for, to retrieve real-time order book data and submit orders. This bypasses the slow web interface entirely. And collocation. Professional arbitrage often host their bots physically close to the exchange servers, known as collocation, and to shave precious milliseconds off their network latency. And high-frequency data. The bot must process tens of thousands of market data updates per second to stay. And algorithmic sophistication, the net profit calculation. A good bot doesn't just look at the price gap and must factor in variable market maker fees, taker fees, slippage estimates, and potential withdrawal transfer fees to calculate the true expected net profit before initiating trade to make sure that's worth it. And the competitive landscape is going to be fear as more capital flows into arbitrage and the profit margins are driven closer and closer to zero. And this creates an arms race of technology and speed and execution efficiency. So One, the execution risk, right? The closure. So this is the biggest threat. The arbitrage opportunity often disappears before the second leg of the trade is filled. If you buy low on exchange A, but the price on exchange B drops before your sell order executes, you are now holding the asset at a loss. This intended simultaneous nature of the trade has been filled. So two, slippage in the costs, right? Arbitrage profits are often less than 0.5%. If an exchange increases the trading fees or if a large order causes slippage, just filling at a worse than expected price, the small profit can instantly turn into a loss. And arbitrageurs must strictly track their trading tiers and fee schedules to make sure that the trade is going to be worth it before they put on some size. So, withdrawal and funding risk, right? The weight. For inter-exchange arbitrage, the capital needed to rebalance the accounts, right? So moving the final asset back to the original exchange can be tied for minutes or hours due to blockchain confirmation times or exchange enforced withdrawal limits. This is known as going to be opportunity cost. So, walking through a hypothetical Bitcoin trade, right? Let's say on exchange A, you bought low. Yeah, let's say the Bitcoin USD price, 60,000, you have 100K available, $100,000 available. USD, fiat currency. Okay, on exchange B, you would sell high. Okay, on exchange B, the Bitcoin USD price is 60,050. Okay, and you have one Bitcoin available. And for the fees and the spread, for the trading fee on the each side, right? So trading fee, 0.1%, and the gross spread would be $50, right? So the buy cost on A, be buying one Bitcoin for $6,000, okay? Take the trading fee times 0.001, okay? So 60. Sell one Bitcoin for 60,050, okay? And then same thing with the other trading fee, that'd be 60.05, okay? 60.05 plus 60 is 120.05 gross profit, okay? And that's just gonna be the total fees paid, okay? So that's the calculations you do to get the fees, and then your gross profit would be $50, okay? The gross profit minus the fees, then boom. You see the arbitrage fail due to fees, making the trade not worth it. So sometimes fees can destroy your profit. So keep it in mind about that. Even if you're a day trader, spamming trade and stuff like that, especially if you're losing, can increase your losses. And certain fees depend on certain brokers or exchanges. So check them out, depending on whatever you trade on. It's not going to be the same everywhere. And arbitrage is only profitable when the gross spread significantly outweighs the total cost, right? The fees and the slippage, and the threshold must be met first, okay? So the evolving landscape and the challenges ahead. So the market efficiency. The long-term impact of successful arbitrage is the increase of market efficiency. Arbitrageurs in the pursuit of profit automatically correct the price imbalances, forcing the market to converge on a single fair price, okay? So reduce volatility. By buying low and selling high, arbitrage stabilizes prices and reduces unnecessary volatility caused by large temporary discrepancies. And fair pricing is involved. And ensures that retail traders, which means just non-bank traders, just individual traders pretty much, are less likely to buy or sell at an artificially poor price. And the competition and innovation. From HVT to MEV, the focus has shifted from simple inter-exchange arbitrage to complex, low latency strategies like miners plus maximal extractable value, right? MEV arbitrage on the blockchain networks. Blockchain is going to be the cryptocurrency network where people can go ahead and trade. Okay, it's going to go and check all the transactions and manage everything via smart contracts. Okay, so unlike a bank system where money goes from person to the bank where they confirm it, and then the person, cryptocurrency, happens to work on a person-to-person system, okay, making it one of the most dominant systems in order to send money or receive money. And as global crypto markets mature and become more interconnected, traditional arbitrage opportunities are shrinking, and success now requires cutting-edge technology, faster network access, and highly sophisticated risk management algorithms. And the race for speed continues to define who profits and who loses in the zero-sum game of crypto arbitrage. So summary of arbitrage trading, right? Arbitrage is the simultaneous trading of an asset to exploit temporary price differences for risk-free profit. It's not speculation, but rather a corrective mechanism for market inefficiencies. If you have enough capital, then inshallah it'll be profitable. And types and methods. Okay, so we covered inter-exchange markets, right? That's the two markets, triangular, three pairs, okay, and one market, and DeFi, which stands for decentralized finance, using flash loans. And they're all highly dependent on extreme speed and technological automations. And the reality of risk. While theoretically it's risk-free, execution risk, high transaction fees, and slippage can easily eliminate the tiny profit margin, turning a potential gain into a guaranteed loss. And automation would be mandatory for success most of the time, inshallah. Okay, so I pray to God, keep grinding. If you want to learn how to trade cryptocurrency, head over to stackmode.net. Peace. Let's go. We're going to be talking about how whales manipulate the crypto market within the first place. So whales are going to be cryptocurrency players that have tons of money, for example. Okay, so if you ever see an order come in for like $1 million plus, that's going to go ahead and be a whale. And sometimes whales can go ahead and control a lot of the markets, especially if something doesn't have a high market cap, which is going to equal the value of something. So for instance, if someone purchases $5 million worth of Bitcoin, it won't really move the market much due to the fact that Bitcoin has $1 trillion market cap. So it's extremely valuable and a lot of people are investing into it. So it's not going to move the market much. But for instance, say somebody invested $5 million into whale coin, okay, some random meme coin that just dropped. Okay, they pretty much now own all of Whalecoin. Okay, they bought all the shares pretty much since they invested $5 million. Okay, due to that fact, if any time Whalecoin goes up, since they're a majority holder, as soon as Whalecoin decides to go up, they can go ahead and sell. And since they're a large majority of the shareholder, the price is going to go ahead and tank with it since they hold a large majority of the value. Okay, so that's what a whale is. A whale can affect your trading in different ways. Let's go and let's talk about what we can do and how we can trade with the whales in order to make sure we're making profitable trades, inshallah. Let's go. So what's a whale in the first place? So in the world of cryptocurrency, a whale is an individualized or entity that holds an immense amount of our particular digital asset. And due to the decentralized and often less regulated nature of the market, the actions of these whales can have a disproportionate impact on price, liquidity, and overall market sentiment. And their large transactions can single-handedly trigger significant price swings, whether in a positive direction or negative direction, creating both opportunities and risk for smaller investors. So the market influence that whale has. So whales are not just big investors, they're market movers. Their buying and selling can create price momentum that a typical trader can't due to the fact that they own such a large percentage of the value that's being traded into it since they have such a large percentage of it. Okay. And concentrated ownership. The concentration of wealth in the hands of few people, entities, individuals, or hedge funds included. So a few whales means that they control a large percentage of a token supply, giving them significant control over its price. Okay. And it has a large psychological impact. When a whale makes a move, other traders take notice. And this can trigger a chain reaction of buying, okay, which is FOMO, or panic selling, and as others try to follow or get out the way. So the psychology of manipulation. Whales don't just move the markets with their money. They exploit human emotions. They understand that FUD, okay, FUD stands for fear, uncertainty, and doubt. All things that are banned because we trust God, we trust our plan, and we're not here to fail. And FOMO, okay, and we don't trade with FOMO, okay, FOMO is banned too, because we trade with logic behind our trades, okay? We know what our entry is, we know what our exit is, and we know what our stop loss is way ahead of time, okay? We're strategic, logical traders. We're not falling into any type of FOMO, so we're good off that. But these are psychological triggers. And a whale's goal is to not just profit from the price change, okay? But it's to get other traders to do the heavy lifting for them by creating a narrative that encourages mass buying or selling. So strategic moves that whales do. Whales make calculated moves, not emotional ones. And they plan their actions to maximize their profit by preying on the emotional reactions of others. So this is the illusion of momentum it creates. A whale's large buy order can give the illusion of a strong market momentum, drawing in retail investors who fear missing a rally. Okay, because people might see like, oh man, the price is deciding to go up, but it could go ahead and be overextended, for example. And whales and their affiliates can use social media, okay, and other news outlets to spread stories that justify their market movements. Like for some reason, people like to go ahead and tweet certain things like, oh, the market made this much today, it lost this much today. Market's gonna always fluctuate. Just pay attention to the chart and put everything together. Okay. So don't be manipulated by what you see on social media. Okay. Take actual education, implement it into your trade, do your research, and take your time. So for example, the fake sell wall. So if a whale places a massive sell order at a slightly higher price than the current market price, this sell wall is going to create the illusion that a strong resistance wants to be created there. And that can scare other traders into selling their holdings at a lower discounted price. And once the price drops, the whale can cancel their fake order and buy it right back in at the discount. And some common manipulation tactics. Understanding these tactics are going to be your first line of defense in order to avoid fake outs, things like that. And they're designed to be subtle, but they can be identified with some careful observation. So we'll talk about pump and dumps. Okay, so a group of whales can buy a large amount of low cap coins. Okay, so for example, if they bought whale coin, okay, and let's say a group of individuals in a Discord, it's the real thing, real people, things I've seen myself. Okay, group of people in a Discord come together. Let's say they own 60% of the coin. Okay, they're going to be in from the lows. They're then going to go ahead and push ads, social media advertisements, pay social media influencers or hack social media influencers to push the meme coin that pretty much has no intrinsic value for the future. Okay, and since they own a large majority of it, by the time the stock starts going up, starts getting hype from the internet, they're going to go ahead and sell. Since they're in at the bottom, they're going to make millions of dollars. Since it's trading, okay, you make money when someone's losing, and when you lose, someone's making money. So since they're in at the bottom, they're going to go ahead and sell. And since they own 60% of it, the market will go ahead and crash. Okay, so that's what a pump and dump is, and don't get manipulated by that. Okay, take your time. So wash trading. Okay, and this involves when an individual or group simultaneously buys or sells an asset to create fake trading volume in hindsight. And this makes the asset appear more popular in liquidity than it actually is, attracting legitimate traders. So a lot of meme coin traders started creating their own tokens, do that. So check out the flow, okay, and the flow is going to give you the ability to see all the orders coming in, okay, and see where the transactions are coming from. Is it a diverse flow coming in from a bunch of different addresses, which is going to indicate it's a bunch of different people investing in it, which is going to indicate it actually has value? Or is it just one address buying over and over again, which is going to indicate a whale, okay, one person buying large quantities of something? And a whale places a large order on one side of the order book, okay, and this is using the buy or sell. Okay, so order book shows you who's buying and selling, okay, and they use one side of the order book, okay, to trick others into believing that there's strong market interest. Then they can cancel the order before it can be filled, and often at the same time they execute a real order on the opposite side to profit from the price shift. So since people are looking at the flow so heavily instead of looking at the chart, they end up getting faked out and they end up just losing a trade. Okay, so make sure you're taking a look at your TA, okay, your technical analysis, take a look at your chart movements, and look at the flow too if you want to. Make sure everything lines up and correlates. So here's how to spot a whale's footprints. So while you can't read their minds, you can track their movements. So some tools give on-chain analysis, and they can go and reveal suspicious activities, and they can help you avoid being a victim of manipulation. And some unusual volume spikes. So you can go ahead and look for sudden inexplicable spikes in trading volume, okay? So that means a large amount of people are getting in a certain direction that are not tied to any major news or fundamental developments. And some on-chain analysis. You can use blockchain explorers to track large funds who are transferring to and from exchange wallets, okay? So you can see what type of cryptocurrencies are getting withdrawn the most. And a massive amount of a token being moved to an exchange could indicate an upcoming sell-off. So order book analysis. Pay close attention to the order book and be wary of a thin order book that suddenly gets massive. A single buy or sell order placed on it. And what you can do to protect yourself. You can't stop a whale from manipulating the market, but you can build strong defense against it. One, okay, just master the charts. Okay, master your technical analysis. Make sure you're understanding what you're looking at, and you might even be able to buy when the whales are going to be buying within a positive direction. Okay, just trust God. Okay, keep studying the market, and once you're buying when the whales are buying, that's actually definitely when you're going to be profitable, inshallah. So your best protection is about not outsmarting them, but sticking to a disciplined strategy and buying at levels to where you're actually going to participate where the whales are going to be buying at too. So key levels are going to be important. Okay, so if you're looking for an area of resistance to be broken, if it turns to support, then it looks like people want to go ahead and buy it there. It wants to hold there, and market might want to continue in an upwards direction from that level. Okay, so some things you can also do to protect yourself, just in trading in general. Never invest more than you can lose. Okay, no trading with rent, no trading with important bail money or anything. Okay, and this golden rule of crypto trading reduces the emotional pressure that makes you vulnerable to manipulation. And you can also diversify your portfolio. Don't put all your eggs in one basket. Okay, spreading out your investments across multiple assets can reduce the impact of a single asset being manipulated, and you're not just going to be hoping the whole time that one thing sweeps while everything else is going in an upwards direction, whatever direction you want. Stop loss. Okay, set your stop loss. Okay, stop losses automatically sell your asset if it falls to a certain price. So if your broker supports stop loss, go ahead and use it in case it's like 3 a.m. Okay, and price starts dumping and you're in a long trade. Okay, and it passes a certain area, then you're more comfortable than losing with. You can go ahead and set your stop loss, and it'll go ahead and close you automatically. Okay, that's the key function of it, is that it closes you automatically. So while you're doing something, driving, the gym, whatever, okay, your trades will go ahead and do its thing. Okay, you can set your take profits, which is a limit order. That'll go ahead and make your trades close automatically. And then you can set a stop order, okay, which will go ahead and cancel out your trade if it hits a certain price threshold that you don't want it to, causing you not to lose all of your money, but just some amount of money that you're comfortable with. And I can't stress it enough. Please do your own research. Okay? Do your own research. Don't take anyone else's trades that you just see, okay, unless you're trying to actually study and understand the market. Okay, do your research, and knowledge is going to be power. Okay, and in the end, the crypto market is really just a game of psychology. Okay, as a lot of people have made a lot of money. Okay, I've made a lot of money just buying and holding. Okay, just simply buying and holding. Okay, people are millionaires who don't look at the charts. Okay, but just buying and holding. So ideally, that's just going to be the main concept of it. Buy the dips. Okay, if you want to learn how to buy the dips, head over to Stackmode.net. Okay, so buy the dips, buy certain low points. Don't buy at all-time highs. Okay, that's also going to be a big thing too to succeeding. And try and follow what the whales are doing. Try and buy at key levels. Okay, buying at key levels is going to be a good way to go ahead and make some profit as well too, inshallah. Okay, buy key levels. Okay, key levels are going to be areas where everyone wants to buy at. Okay, an area where everyone wants to buy at is going to go ahead and attract whales. Okay, wherever the money's moving, you should be moving to within the market. Okay, so by arming yourself with knowledge, getting more informed, heading over to Stackmode.net for mentorship, getting a free trading mentorship call, and maintaining a disciplined strategy, resisting emotional trading, you can navigate these volatile waters safely. And your goal isn't to beat the whales, and it's to avoid being their meat, also known as liquidity. Okay, liquidity is pretty much people who are just losing, and you don't want to be ammo connected and collected in order for the real trade to actually happen. Okay. Stay prayed to God, keep running. Catch you in the next one. Peace. Okay. So this is going to be the best time in order to take profit. Okay, so we're just going to be talking about taking our money off the table at certain key areas. Okay, so let's go ahead and let's talk about certain examples in the first place. Okay, so one, let's say we're in a long trade, right? Okay, let's say we're anticipating price to break an area of resistance, right? So ideally, if I'm trading a resistance breakout, okay, and resistance is going to be in a key area where sellers are going to be stepping in. So price is going to head in a downwards direction. Okay, this is the left to right chart. So people are still going to be invested in. A lot of times way lower. Okay, so someone's going to be in the chart way over here. So eventually they're going to take profit, and that's what resistance is going to go ahead and be. Okay, so say an area of resistance decides to get created. Okay, if price decided to break out, okay, and you took a resistance breakout entry, your take profit would be A, at an area of resistance above current price, okay, because resistances can go ahead and fall at the same place as each other. Okay, resistances can go ahead and mirror everything that one other resistance can do potentially. Okay, and that's going to be the same thing for supports. Okay, so an area of support can go ahead and mirror another area of support. Okay, so it's about really paying attention what we're doing as far as the reversals. So it's know that two areas of support can go ahead and reverse at the same place, even if price decides to do something like this. Okay, even if price say shoots underneath it, okay, comes back up, price could potentially still mirror the support from the left to the right. Okay, and then let's say price decides to blast up. Okay, then my take profit would still be the resistance above here. Okay, so no matter how I take my setup, if I'm taking a long trade, okay, or even if I'm waiting for an area of resistance to turn into support, okay, if I'm taking a long trade, my take profit is going to be an area of resistance above current price, or it's going to be an area of support above current price. Okay, and that's due to the fact that support has a chance to turn into resistance. So we know that price could potentially reverse there too. Okay, and we want to be closing before price reverses. Okay, so once again, you want to close before price reverses. That's going to be a big thing. Okay, so price could go ahead and break that area of resistance. Once again, take profit will go ahead and be at the area of resistance here. Okay, or price can go ahead and do something like this. Okay, and just run up to the area of support, and this could go ahead and be a trade in itself, even if it doesn't run through it. Okay, and the price could potentially do that, and you close then. Okay, so knowing that how the chart works is going to be imperative to knowing how to read when to close. Okay, so resistances will try and mirror each other, and let me go ahead and show you an example here. So check this out. So looking here on a video, if I go ahead and start off on my daily time frame, okay, I like to start off on my daily time frame. Gives me my bird's eye view, lets me see all the price action I need to see in one screen. Okay, I'm gonna go ahead and zoom in. I can see here at these all-time highs, price is deciding to fall pretty much in the same exact zone. Okay, so after my daily time frame, okay, and especially if I'm looking at the stocks or crypto market, I know that price is trying to chase and break resistances. Okay, because price cannot go in an upwards direction until resistances are broken or a support above current price gets broken. Okay, so one of the two things have to happen in order for price to go in an upwards direction. And people are working hard at these companies, they're grinding, and they're definitely trying to increase the profitability of the companies. Okay, so you can see here on the daily, price decided to fall at the same area once, twice, and 3 times here. Okay, so if I go to my 4-hour time frame, we can see price decided to fall down here. Okay, 1 area, 2 areas, 3, 4 times. Okay, and even 5 over here. Okay, so in the gray box, price decided to fall down in the same area over and over again. And that's because price is always trying to meet up with areas of resistances, especially in the long scenario. Okay, so your take profit area, if you're looking for price to go in an upwards direction, would be in an area of resistance above current price or support. Okay, so this is why I don't personally like to trade I don't like to trade past all-time highs. Why? Because there's no structure above me. Okay, so I have no areas of resistance or support above me at all-time highs. Okay, so personally, what I would do is I'll buy a pullback. So I'll wait for price to come down to potentially this area of support right here. Okay, or maybe this area of support here. Okay, or maybe try and bounce at an area of resistance or something like that. Okay, maybe right here. Okay, and then I'll see if price wants to go ahead and mirror something. Okay, maybe this area right here. Okay, we'll try and mirror with this area right here. Okay, and then maybe price will try and go ahead and dip down. Okay, but if price doesn't give me a bounce at any of these three levels, okay, I can try an even lower level. Okay, maybe even this one down here. Okay, and then from there, I can go ahead and see if price wants to sweep up to there. Either try here, or try here. Okay. I'm working on my levels below me, trying to catch the entire sweep up. Okay, and I'm going to be using my daily and then going down to my 4-hour. And it's just about paying attention to the key areas and just knowing that resistances are always trying to meet and be broken, okay? Because that's how price continues in upwards direction, okay? All the time. And price can also do things like hunt downwards to areas of support to try and see if it wants to bounce up. But if support gets broken, then price can try and bounce at areas of resistances, okay? Because we know resistance can be broken and turn into support. Okay, so price can come down, turn old resistance, it can be turned into support. Okay, and price can try and come up, and wherever we would close would be either the all-time highs or wherever the resistance area decided to stop. Okay, so or I could close at this area of support right here. Okay, so either one. So if I didn't want to close up here, I could easily close at this area of support here too. So if price gives me a bounce at this blue line down here, okay, I could go ahead and catch a sweep from 242 to 246 on Google if I wanted to, okay, if it did what I needed it to do. So it's just about taking your time, okay, reading the price action and going over the flow, okay. So let me go ahead and go over a crypto example here. So crypto charts is going to be the same way too. Just using our daily time frame, using our 4-hour time frame, taking our time and just reading everything. So let's start off with some Ethereum. So I'll go to my daily time frame here. Okay, I'm going to zoom all the way out. I love to zoom all the way out to just see where price action is. Okay, and I can see price decided to kind of short from the same place that all-time high shorted at before. Okay, so all-time highs is the highest point of resistance. You can see in 2021, Ethereum created a high of 4,868. Okay, and then we touched the high as of August 2025. Okay, and price decided to push past it a tiny bit, but price decided to pretty much short from the same place. So you know that price is trying to break past the black line now. Okay, it's trying to break past the area of resistance. It already got met. Okay, it got created here. Then price swept all the way down. Okay, swept all the way down to this low down here near 861. Okay, then after that, started trickling way up, doing its thing. Okay, and then price decided to make a high of 4,868. Okay, or around the 4,900s. Okay, so yeah, Ethereum decided to sweep all the way, and as you can see, it met up with the areas of resistance. Okay, it swept the whole time. Yes, it took some time, but it happened. Okay, catching a sweep is going to be extremely, extremely nice to your P&L, your bank account, and it should help you a lot, set you really, really nice bundle of money, and especially when you catch the right trades. Okay, so we can check here. So the daily time frame, I can clearly see price wants to try and reach this level here, all-time highs. Okay, so we have this previous level here from 2021. And a level from 2021 is being reacted off of in 2025. Okay, so we know that up here, the black line is to take profit, right? So let's say I bought a pullback. Okay, so let's say price decided to go to our time frame. Okay, so as you can see, price is trying to bounce, okay, from this area of support right here potentially. Okay, so I can see here, price decided to create an area of resistance here. Okay, you can see this area of resistance being created here on the 4-hour time frame. Okay, and then price decided to break above it and continue upward, but then price broke the resistance here and turned it into support, and then price decided to go up in upwards direction. Okay, so we'll see if price wants to hold this little zone down here. Okay. And we'll see what it wants to do. Okay. And one way to tell is if we're getting daily closes. Okay. So we have 2 daily closes. Okay. Which means we have 2 daily candlesticks that aren't the first candlestick where it touched in the zone. So as soon as the candlestick touches the zone, I'm not feeding to get in. I like to see if the price actually wants to reverse. So if I see second candlesticks or third candlesticks, also known as candlestick closes, okay, showing me that price wants to continue potentially, okay, especially if it's going from red to green from a certain area, okay, then price could be like, you know what, this could be a decent area where I want to go ahead and buy. Okay. And take profit will go ahead and be the area of resistance, okay? And even if I'm shorting, okay, let's go over a short example, for example. Okay. Even if I'm shorting, okay, I'm going to go to my 4-hour time frame. I would take an area of support, okay, mark it out, okay, and I can clearly see here this area of resistance turn into support. Okay, if I see an area of resistance, okay, to the left of an area of support being broken and then turn into resistance, that's going to be really good. Okay, so for instance, I have this area of resistance right here, okay, created at this 964 level. Price decided to break out, okay, and then price came down, turned the area of resistance into support, and then created the high up here, okay, and price is trying to go ahead and sweep up here and fill this gap, okay, so this whole gap here from here to here, okay, it's trying to go ahead and fill that. So by doing that, we can go ahead and check something else out, okay, so knowing that that's trying to fill, okay, we can be like, okay, this low is extremely strong. So we can determine whether or not we ever want to short this low. Okay, so if price decides to break the support, turn it into resistance, you could take it down. Okay, but the take profit for shorting, okay, would either be at another level of support, okay, and especially for stocks and crypto, I wouldn't make your take profit too far or too big or too hefty. This is why I personally don't really short too much, because it's just riskier and you can't really hold as long compared to holding to the upside, where price is always trying to go to a higher price. Okay, that's just how the human eye works. People want to see their favorite stocks, favorite cryptocurrencies at high prices, and they'll do anything to get it there. Okay, and so yeah, so when you short, close at areas of support, or you can close at areas of resistances below current price too. Okay, because you know resistance can turn into support. So that's why shorting can just be a little tricky sometimes too. But when you're using your high time frames, you can catch some pretty solid setups, make some money. Okay, but a lot of the times, especially when it comes to the crypto and stock market, we want to just be playing to the point to where we can catch long trades. Okay, catch long trades because we are playing a bullish market. Okay, if you pull up any half decent cryptocurrency or stock, if you go to the left, to the right, the left is going to be nowhere near where it's at today. So in 2020, crypto was just starting to bubble. People weren't really investing into it. Okay, and then 2022, etc., started progressing. So we can see over here that price started at around $17 a share as of 2020, and price is now at 1,025. Okay, for BNB USD crypto token. Okay, so it really just depends on when you get in, and holding for years is also going to have some benefits too. Okay, so when you hold for years, there's going to be a lot of long-term tax benefits, and you're pretty much just going to always be able to sit on money here. Okay, so let's go and let's check out Microsoft. So I like to start on my daily here, and I always know that price is trying to chase an area of resistance above current price. Okay, so I can see that price is trying to chase this area of resistance, this area of resistance potentially, this area potentially, this area potentially, and then all-time highs. And then I'm going to go to my 4-hour time frame and verify everything. Okay, check it out. So I have this area of resistance here, recently created. Then I have this area of resistance here, okay, with 2 taps. Okay, 2 taps of resistance at an area. It lets me know that's definitely a strong area. Okay, and then I have this area of resistance up here. Okay, where price is falling down. Price falling down. I have another area of resistance up here. Okay, 537.73, 532.01, 524.94, and 519.34. Okay, and I'm also going to have an area of resistance marked up here at 559.02. Okay, so I have all these areas of resistance marked. Okay, so even if I didn't want to catch a pullback, right, because I'm scared of a falling knife, let's say, then you could go ahead and catch a continuation trade. Okay, you can go ahead and catch a resistance breakout, wait for it to turn into support, and take it up to the next level, okay, of either support or resistance, okay, close there, or you can hold for the whole sweep, all-time highs, depending on how much capital risk you're ready to put down, how much time decay you have too, okay, if you're, especially if you're on options or you're a shareholder, okay. So it's just about taking our time and really making sure we're putting down good trades. So check this out right here too. So I can see here on Walmart, price is deciding to give me some break and retest. Okay, so check out this area of resistance here, being reacted with this area of support here. We're going to 4 hour. Okay, we got resistance right here, resistance being broken and turn into support. Okay, and I can see price wants to go ahead and push up and potentially try meet up with this resistance, meet up with this resistance, okay, or just straight to all-time highs, honestly. Okay, and then maybe up here. So yeah, making your trader agent is really going to be just imperative to your success. So just put down logical formations and just know what type of setups that you want to take. Okay, so if you're going to take a long trade, okay, and if you want to wait for an area of resistance to be broken, okay, you could take it up to the next area of resistance or support above current price, or you could wait for the area of resistance to hit the area of support. Okay, you could short if you wanted to. Okay, so it just really depends whatever you want it to do, how flexible you are. But as long as you have your levels on your screen and you could just wait to see if your levels even get reacted to in the first place, and then you can go ahead and assess, do your information, and make your trade based off of those factors. Because then from there, it's going to be simple in order to be like, you know what, I know what I'm doing, I do this consistently, and then you're going to be able to hunt down and find profitable trades pretty quickly. Okay, and try to stay away from things that are all-time highs. Okay, we can't really do too much when stuff is at all-time highs. Okay, so what we need to do is wait for a pullback. Okay, we need to wait for a pullback. We need to wait for price to go in a downwards direction. Okay, so Google, for example, all-time highs, no resistance above it. We gotta wait for price to go down before we buy it again. Okay, because you don't want to buy all the way up there, whether it be on options, calls, or shares, and then lose because you just didn't wait for a pullback. Okay, so even this area here on Palantir, so this area here is being reacted off of right now. Okay, and I could wait for price to break under this level if I wanted to, turn it into resistance, and take a short down to this level right here if I wanted to. Okay, so it gives you the flexibility to trade how you want. Okay, trade how you want, and as long as your risk is in place, your parameters are in place, you can do your thing. Okay, same thing right here on Costco. I can see above current price, we have an area of support right here with an area of support. Okay, so we got two areas of support here. Okay, so both these areas of support here are going to be important. Okay, so if price decides to turn these areas of support into resistance, then price could fall down, or it could run through it and then go ahead and try and fill these resistance gaps all the way up here. So then price could try and go ahead and continue within an upwards direction. Okay, so it's just about really taking our time, knowing what we're investing in, playing with the trend, or just trading pullbacks. Okay, so doing either or is really just going to be absolutely imperative. Okay, so head over to Stackmode Network for all trading education. Stay preemptive, God. Keep grinding. Peace.
All right, let's talk about what liquidity is in crypto. Let's make it easy. Liquidity refers to the ease to which an asset can be bought or sold in a market without significantly affecting its price. And in crypto, it's critical due to the market's volatility and decentralized nature. Volatility means quick price action. Crypto is always going 24/7, so the market never slows down. There's going to be spikes that can happen in the middle of the night while you might be asleep, stuff like that. And it's also decentralized, meaning that everything is done on the peer-to-peer transaction system. Okay, and there's going to be no middlemen involved, no banks involved, and no one to approve whether or not yes or no the transaction is going to go through. Just as soon as it goes through, everything's automatically done via the smart contracts, and then the cryptocurrency can be sent from one party to the other very, very successfully, inshallah. So trading volume. Higher volume indicates better liquidity, okay, and volume is pretty much going to indicate money. Okay, so the higher volume something has, the more money something has, which is going to equal the more people playing it a lot of the times. And major coins like Bitcoin and Ethereum are more liquid than small cap tokens due to the fact that they have more money involved in them since more people trade them, and there's going to be big companies, governments, and hedge funds putting money into it. Okay, big whales. Whales are going to be people who have large amounts of money, and when you have whales investing into something, something's going to have way more liquidity than other things, depending on how popular it is and how heavily invested something is into. And centralized, it's going to be Binance, and something decentralized is something like Uniswap, and the type of exchanges impact the liquidity. For example, Bitcoin on Binance has a high liquidity due to its large order book, allowing large trades with minimal price impact. So why does liquidity matter in the first place? Liquidity affects trading efficiency, cost, and strategy. Low liquidity can lead to significant price swings and higher cost. Price stability. High liquidity reduces volatility for large trades, meaning that if someone puts on a long, prices are going to burst into oblivion, or if someone puts in a sell, prices are going to dump down into the ground. Okay. And execution speed. Liquid markets allow for faster trade execution. Since there's going to be more people trading, there's going to be more of that asset, whatever you're trying to trade, available. Okay, so the more volume means the quicker you're going to be able to get filled, and the faster you're going to be able to trade. And lower cost. Tight bid. Okay, a lot of the time the bid is going to be what you sell at, and the ask is going to be what you buy at a lot of the times. Tight bid and ask spreads in liquid markets reduce trading fees. Okay, so you want your bid and ask spreads to be as close as possible. Okay, you don't want your bid to be way like lower than your ask and stuff like that, vice versa. Okay, because you don't want to buy something with a high ask and then you try to sell it and then the bid is super duper low because there's not enough liquidity. Okay. And risk management. Liquidity ensures that you can exit your positions quickly. So I'm not too sure if you've entered into something with low liquidity, but if you ever tried to sell and price is just pausing, not selling, not doing what you want it to do, that's most likely because the liquidity is low. Okay. So when you're trading things with high liquidity, you get to avoid that and you get to really just trade how you want quickly and almost instantaneously. For example, Bitcoin versus a low cap token. Trading 100K of Bitcoin on Coinbase has minimal price impact, okay, because there's so many people with millions of dollars worth of Bitcoin. While the same trade in a low cap token on a DEX might move the price 10%, okay, because you're going to be a lot of the liquidity, you're going to be a lot of the volume, you're going to have a lot of the money controlled in it, you're going to be one of the largest investors. So what you do can move the market, okay, but when you invest in things with high volume, okay, it's not going to have big impact because as it's going to be other whales too. So understanding slippage in the first place. Slippage is the difference between the expected price of a trade and the actual executed price, often due to low liquidity or market volatility. And what impacts slippage? Large orders in low liquidity markets cause significant slippage. Okay, so that means that when you try to sell, there's going to be no one to fill you. Say you buy like 60% of a random coin, who are you going to sell it to? You own majority of it. Okay, so it can be a little difficult sometimes when you own a majority of it. And yeah, timing. Slippage increases during volatile periods like the news events. Okay, and order types. Market orders face more slippage than limit orders, and you could still own, like, it's a little bit different between the stock. Okay, because there's going to be a lot of legal processes and stuff in place to have shareholders buy like all the stocks on the back end and stuff like that. I'm going to make sure I detail how stock shares work and stuff like that more in depth again and again. But cryptocurrency, you can pretty much be centralized by owning a large percentage of it and just being a large investor. Okay. And automated market makers, AMMS, like Uniswap, can calculate slippage based on the pool swap. So on Uniswap, swapping $10,000 in a small pool might cause 5% slippage, meaning you get 5% less value than expected in the first place. And how does liquidity affect slippage? Liquidity and slippage are inversely related, and higher liquidity means lower slippage due to the fact that there's more orders, okay? So when there's more orders, there's gonna be less slippage, okay? Liquidity pools. In DeFi, larger pools, okay? USDT, Ethereum, for example, they have lower slippage, okay? Due to the fact that they're very popular. Market participation. More traders increase liquidity, which stabilizes prices. In thin markets, low liquidity tokens can see 20% plus slippage on moderate trades, okay, due to the fact that there's not enough orders, once again. And a 1 million USDC ETH pool on Uniswap has low slippage, okay, for a $1,000 trade. But a 10K pool for a small token might see 10% slippage, okay, which means you're gonna go ahead and receive less money when you sell, and yeah, it's pretty much what it's gonna mean. And factors influencing crypto liquidity. Several factors determine liquidity in crypto markets, impacting strategies. So think of slippage kind of like fees. So exchange type. Centralized exchanges often have high liquidity than DEXs, and high market cap coins often attract more traders due to the fact that people know it's going to be a solid value investment, okay, and they can go ahead and get some APY, some annual percentage yield returns on their dollar, which means that year after year they expect their dollar to go ahead and increase by just buying and holding in something with value. And trading volume. Higher volume correlates with better liquidity as well too. And market maker activity. Bots and institutions provide liquidity on major platforms, which help move the market. And 24/7 is how the crypto market moves. And the markets enhance liquidity, but they vary by region. For instance, Binance's Bitcoin USDT pair has a high liquidity due to its global user base and market maker activity. And let's talk about managing slippage in trading. Traders can minimize slippage through strategic approaches and tools. Using limit orders. Limit orders specify your price to unavoid expected limits, and with limit orders, you won't get your price filled until price comes in contact wherever you have your limit order. Check the liquidity. Review order books or pool sizes before trading and check out the volume. Make sure it's decent. Okay, don't be trading small stuff and then you have a large percentage of it you try to sell and then you can't get out. That goes for the same thing with options too. And smaller trades. Break large orders into smaller chunks to reduce the price impact. Okay. And timing. Trade during high volume periods to leverage better liquidity. And on an example, on PancakeSwap, setting a 0.5% slippage tolerance for a $500 trade ensures you don't lose more than $2.50 to slippage. So some tools for assessing liquidity. You can use CoinMarketCap, CoinGecko, okay, to check the trading volume and the market depth. TradingView shows you as well too, whatever you want to use. Check out the order book. Platforms like Binance show you the bid-ask spreads and what whales are doing and stuff like that too. You're going to be able to see some programs where you can check to see how large amounts of money are flowing in whatever token that you're researching. And the DeFi Pulse. It tracks liquidity in DeFi protocols, as well as DEX analytics, like Dune analytics to show pool liquidity. Okay. And we're not going to forget that. And Dune analytics can reveal a Uniswap's pool liquidity depth, helping you predict slippage for a $10,000 trade, for example. So low liquidity tokens on Uniswap saw 20% slippage during hype-driven trading, costing trader thousands of dollars in fees kind of for no reason. And high liquidity during the 2023 rally allowed $1 million in trade with 0.1% slippage, showcasing centralized exchange efficiency. So things with higher market caps, okay, are going to go ahead and have less slippage a lot of the times since there's enough orders, value, and enough back end, okay. and liquidity in centralized versus decentralized exchanges. Centralized and decentralized exchanges handle liquidity different, impacting slippages. CEX, is centralized, is high liquidity via order books and market makers. Okay, for example, Kraken's BTC slash USDT pair, okay, or ETH slash USDT, okay, something like that. And a DEX. And liquidity pools vary by size, and they have small pools to increase slippage. And trade-offs. CEXs offer lower slippage, but they require trust. And DEXs are trustless, but riskier for low liquidity tokens. For example, $50,000 on Binance has less slippage than a small Uniswap pool. So monitor the volume, use stop loss limits so you know when it's time to close your trades. Make sure you're doing your research on what you're investing into. Okay, batch your trades, split large orders to minimize price impact. Okay, and for instance, splitting a $100,000 trade into 10 $10,000 trades on Uniswap can reduce the slippage from 5% to 1%, for example. So little tools and tricks you can use to go ahead and reduce your slippage fees. And exercises for understanding liquidity and slippage. You can check the BTC, USDT liquidity on Binance, okay, for 30 minutes, okay, just study the charts, okay. You can simulate a $1,000 trade on a DEX and calculate the slippage, and you can analyze the low liquidity tokens, order book on CoinGecko as well too. And go ahead and check out the trading forums, Reddit and stuff like that, and just do your research. And comment below, how have liquidity and slippage affected your trades? Did you lose any money to it? Talk to me about it in the comments below. What strategies do you also want me to cover? Head over to Stackmode.net. Catch you guys in the next one. Step right up to God. Keep grounding. Catch you in the next one. Peace.
When the dollar starts becoming worth less, people start running to assets such as real estate, gold, and silver. Today, we're going to talk about how to invest into gold and silver, why you should invest in the gold and silver, and what inflation is, and why people run to asset classes in the first place because the dollar starts failing. Let's jump into it, inshallah. So gold and silver are going to be hard assets that are going to be pretty safe to invest in, especially in an inflationary world where things just get more expensive over time due to the fact that more currency just gets generated over time. So the currency devaluation. So purchasing power is melting over time. So inflation isn't just about prices going up over time. It's about the value of the currency going down. So prices go up to correlate with that. So governments print money to service debt, which dilutes your savings over time. This is why I tell you guys all the time about the asset river. Okay. You want to always try and have your assets and your money flowing in your river. If things logically get more expensive year after year after year after year, then you have to have your assets flowing in a way that your money is always making you more money. Okay. So once again, I'm going to repeat, your money should always be making you more money. Okay. Don't get outplayed by the certain calculations that just debase in the world normally. If things get more expensive over time, then logically, in order to counteract that, in order to feed yourself and your family, your money should always be making you more money. So we'll talk about the 1971 shift. So that's when Nixon ended the gold standard. And since then, the US dollar has lost over 85% of its purchasing power. And the hidden tax. Inflation helps debtors, which is pretty much just the governments, but it hurts savers. Anybody just stacking up cash in your bank account. If you have just a whole bunch of cash stacked up in your bank account, it's actually doing nothing but hurting you. Okay, even if you've worked overtime for a job before, okay, you might have seen that you've actually had to pay more in taxes. Okay, the more cash that you have just stacked up stationary, the more that it hurts you. And it transfers wealth from you to the state, which goes back to the government. So in 1920, 1 ounce of gold bought a high-end suite. And today, 1 ounce of gold would be about $2,600. Okay, so it still buys a high-end suite. And the gold stayed constant and the dollar collapsed. Okay, so keep that in mind. The gold stayed constant while the dollar collapsed. So that means that having your money parked in an asset class like real estate, people are always going to need houses. Gold, people are always going to be wearing jewelry. And other asset classes that stay constant and only rise up while the dollar collapses are going to be the asset classes that you want to focus on for the most part. So gold, people call it the ultimate hedge. A lot of the times, if you pull up the chart,
you'll see gold year after year after year after year heading in an upwards direction. Okay, it's not stopping, and due to the fact that something has to counteract the dollar. So gold is going to be the human standard that people just use whenever the dollar is crashing or the economy isn't in a good place. So here's why central banks buy it. And central banks are going to be the banks where me and you bank at. Okay, the banks that hold our fiat currency, where we can go pull out our money to pay our bills, go to the ATM, etc. And the fear trade. So gold performs best when real interest rates are negative, and that's when inflation is higher than bond yields. Okay, and central bank demand. So in recent years, China, Russia, and India have been buying record amounts of gold to de-dollarize their reserves. Okay, so they're trying to de-dollarize their reserves in a significant manner. Okay, buying less time storage for their fiat currency and buying more time on their actual currency by investing into assets. Okay, you're doing nothing but losing time if you have more fiat currency. So fiat currency needs to be thrown into the river immediately. Otherwise, you're wasting time. Think of theta on options, if you're familiar with that. Over time, on a stock options contract, the options expires. Okay, think of your fiat currency the same way. Okay, if rent over year after year after year after year gets more expensive, if 1 year a house cost $200,000, but then 5 years later it costs $500,000, that means that your asset class has to be in a constant river, each in every single one of them. Okay, all your businesses, your profit has to be being reinvested into that. More stocks, more shares, more cryptocurrency. Okay, buying more houses if you're in real estate, etc. Okay, buying more land, and you could do whatever you want with the land. You could farm on the land, pay people to host ATMs on the land. Okay, people could build stores on your land. People could build antennas, cell towers, etc. But when you own assets and you keep stacking up your assets, it gives you a multitude of opportunities to be presented in front of you for your money to just make you more money because you invested in the right things. So volatility. So gold is slow, and it's not for getting rich. It's for staying rich, and it's wealth insurance, not a lottery ticket. Okay, so stacking up gold over time. A lot of people might buy certain jewelry. Okay, go smelt it, take it to the jeweler, whatever, and either the jeweler will give them an exchange rate for the gold. So you're going to have multiple ways to invest in the gold too, which we're going to talk about. If you don't want to go the actual physical gold route, you're also going to have the ability to buy things like shares, etc. So let's jump into it. So silver is going to be the industrial hybrid. So it's the green energy paradox. So silver is unique, and it acts like money during crisis, but trades like a commodity during booms due to massive industrial use. So as far as conductivity, silver is the most conductive metal on Earth, and it's essential for electronics, 5G, and EVs. So for modern technology, silver is going to be needed. So silver is also going to be something you could invest to too. If you ever see a pullback on the charts or anything like that, silver is going to be an asset class that goes up year after year after year after year very confidently, especially while the dollar is collapsing. And let's talk about the solar boom. So photovoltaic cells, okay, solar panels, consume massive amounts of silver. As the world goes green, demand explodes. Okay, so photovoltaic, okay, that's just solar panels. Solar companies are booming all over America, all over the world, and other countries as well too. Okay, especially countries with less green, less trees, taking advantage of that solar energy. So seeing silver going in an upwards direction year after year after year would make sense. Try to plant your seeds with things that make sense with the future, whether it being putting smiles on people's faces or helping people work throughout the day by day. Silver is needed in absolutely everything. And let's talk about the gold to silver ratio. So it's historically about 15-1. So 15 ounces of silver will give you 1 ounce of gold. And today it's often 80-1. And many argue that silver is undervalued relative to gold. And we'll see how that starts changing, especially during the AI era. When we start seeing robots and certain things start getting developed, the use of silver could go up in an industrial rate. So there's going to be 2 ways to invest. So you could either have a bunch of bars, whether it be silver bars or gold bars, stacked up. Some people do that, put it in a safe or leave it with the bank, etc. Some people also have jewelry. Buy Rolexes, Audemars Piguets, Patek's, certain chains, real Cuban links, whether be it bracelets, chains, etc. And some people take it to the smelter, melt down the gold, take that to the jeweler, and then you can go ahead and get some money for that. Or you're going to have the digital way, which is going to be via stocks and ETFs. So you could buy shares that represent gold. So in the stock world, it's going to be the GLD. So if you want to buy gold shares, you'd have to look up GLD. You could also buy gold options as well too. I have some recaps posted on my channel of some wins I've taken on that. Used to trade that a long time ago. And SLV is going to be for silver. And then for miners, as far as the mining industry, in order to mine the asset classes of gold and silver, you can look up GDX. And the pros of them have very high liquidity. A lot of people trade gold, from forex traders to stock traders, options traders to futures traders. Golden is extremely popular asset class that's traded. It's low fees. It's easy to hold in the Roth IRA as well too if you just want to buy shares and hold. And the cons, you don't own the actual metal. So if the fund fails, then you have a paper claim, not actual gold. And as far as investing in the miners, it gives you leverage. So if gold is up 10%, miners might go up 30%, but they have risk as far as fuel costs, strikes, etc. And the physical side of everything, you have no counterparty risk, total privacy, and it's useful in extreme disasters. That can be true and also not true. Your house could burn down, etc., and then it could be hard to get to the gold bars. The gold could maybe survive depending on how long it's in the fire, but still, that could be relative to a lot of cases. And cons, you got to worry about security. You can't be letting everyone know that you got a whole bunch of gold bars stacked up. That's not going to be ideal. You got to keep that very private between just you and your family. And storage issues too. When you start stacking up more gold bars, having a safe might be hard if you're trying to move houses or something like that, etc. And it can be hard to sell quickly. You got to go to the smelter, melt it down, and then go to the jeweler, get an exchange rate on that. And they might give you a lower price than you might actually should get because they're trying to make some money too. You know, it's the world. We're all trying to make some money. And tax. So it's often taxed as collectibles too, which is a 28% capital gains in the United States rather than stocks. So the strategic allocation. So how much is going to be enough? So most financial advisors suggest precious metals should be a hedge, not your whole entire piece of the pie. So be conservative, 5%. Okay, it gives you just enough insurance to sleep at night. If you want to have a couple of gold bars in real life, then that would be fine too. And just keeping your asset classes divided in certain scenarios could really help you, especially during hard times. You might not have access to the internet, and you might need to go take the gold bar to someone who could exchange it for either some fiat currency or a car or just an item that you need. So having multiple sources of backup plans for your income is really going to help you. And gold pays no dividends if you do just have the actual gold bars. It just sits there. So try not to just invest 100% of your money into gold, or you're going to miss out on compound interest. And not even interest, but just compound equity curve just in general. Whether you invest it into a stock that goes up year after year after year due to the fact that it's just making tons of profitable decisions, then you don't want to miss out on that. If you have one gold bar, 10 years later, if you don't do anything, if you don't get up and keep grinding and keep hustling, you're not going to have any more gold bars. But if you invest and put $1,000 into a stock, 10 years later, you could have did nothing and come out with $100,000. Okay, so having your asset classes divided is really going to help you. But there could be a time where you need to pull all your money out of your stock account and you have gold bars and you can exchange that, put it right back in your stock account. So there's going to be different scenarios and different floats, especially jewelry too. If you have any real gold jewelry that you don't care about, I would think about smelting it. Gold is extremely valuable, and just keep that in consideration. So is it a good hedge? I'm going to go ahead and say yes, but here's to clarify your goal. If you want to get rich, then focus on stocks, business, crypto. And if you want to stay rich and have protection over your purchasing power over decades, gold is going to be an extremely good standard. And if you want a speculative play to invest into, you could play gold futures Gold is on Forex. Gold has stocks and shares you could trade. And same thing with silver too. So you could just make your decision in order to protect you over time. Take a look at the chart before you trade. If you're struggling with what to invest in, head over to stackmode.net. Stay productive to God. Keep grinding. Catch you guys in the next one.
So this is going to be the full guide on how to trade options leaps, how to pretty much make options income so you can make a living off of it and just make some great extra income. I'm going to talk about from A to Z, what we need to do, the contracts we need to buy, and the type of setups we got to be taking. Okay, so let's go and let's jump into it. So one, okay, we're on the stock market. Okay, so options give you access to pretty much 100 shares. Okay, so once again, options give you access to about 100 shares. So that means that it's a leverage product, kind of. Okay, and the only thing that we fight against is time. Okay, so it pretty much gives you 100 shares per one contract to play with. So 100 shares with time added to it equals one option. Okay, so a contract is going to give you 100 shares and it's going to have time added to it. Okay, so now that we know this, okay, we're going to go ahead and put everything into perspective. So time is going to be really important. Okay, so let's talk about how we can outplay the time and how we can pretty much progress with options. Let's jump into it. So once again, we're going to be playing the stock market. Options gives you access to play 100 shares worth of value, okay, bundled up in one, okay? But the only thing you're fighting against is time. So I'm going to talk to you guys about how to outplay that. But let's understand the logical process of what we're playing first. So we're playing the stock market, okay? The goal of the stock market is to go in an upwards direction. And let's talk about why, okay? Why is it going in an upwards direction in the first place? What's the point of buying options and why do we think price is going to go in an upwards direction? One, okay, I can get on my weekly time frame here and zoom out and I can see this company, for example, okay? It's a profitable company since the shares go up year after year after year after year after year after year, okay? So whenever you see year after year after year after year after year progress and chart going in an upwards direction, that generally means that that's a good buy. That's a profitable company and they're doing their thing, okay? So that's gonna be a company that we would ideally wanna pay attention to. So after I see market trending like this in an upwards line, I can put into conclusion, okay, why is it going in an upwards direction? One, these stocks aren't just stocks on the internet, okay? These stocks are real jobs, okay? Real jobs that you might have even worked at in real life. Okay, so these jobs employ people. Okay, so these stocks aren't just random stocks trying to go up for no reason. They employ people, okay, which helps the economy. Okay, companies like Microsoft, Google, definitely Amazon, okay, creating jobs for people so people can protect and provide for their families. So these stocks, they're doing something big. Okay, they have a big weight attached to them. They help out the economy. They employ people. Okay, and the company investors are competitive. Okay, they're in competition. So if this is a bank stock, they want to outperform every other bank stock by having the higher share value to prove to investors that whatever they're investing in, and that if they invest in their company, they're going to have the most profitable stock, pretty much. Okay, so there's going to be incentives behind it too. It's going to be really competitive. So the competitiveness behind it makes investors invest into certain companies. Okay, a bank wants to be the best bank. A broker wants to be the best broker. Tech company wants to be the best tech company. Okay. And the best way to compete or show competition and show value is going to be via the stock market share price. If one share price is higher than another company's, that just means that one company is just more valuable than the other. And that's just flat out what it means. Okay, so companies are trying to compete. Okay,
because the share value being in an upwards direction shows how much it's actually affecting the economy. Okay, so that's going to go ahead and be that. So let's jump into it. Okay, so options in stocks have a reason to go in an upwards direction. And the reason why I'm focusing on an upwards direction is because that's the goal of it. Okay, once again, more jobs are going to be created. And the whole reason stocks put themselves on the stock market in general is so they can raise money. Okay, they want our money to put into their company so then they can turn our money into more money by investing into business manufacturers, getting better or more employees, etc., doing whatever they need to do with our money invested into it. Then that's why companies that are profitable pay what's called dividends out. Okay, they pay dividends out since the company's making so much money. Anybody who's holding shares, they're like, you know what, here's some money back. Thank you. Thank you for participating and helping us grow. So dividends, they're pretty much going to be a big thank you. Okay. So dividends are a thank you. If you see a company paying out dividends and not splitting them, not reducing the dividends, so you can see this dividend amount was 0.30 back here in 2023, and now it's about 0.40. Okay, that means that they increase the amount of money that they're paying out to people. If they can increase the amount of money that they're paying out to people, they're not struggling. Okay. But when you're penny pinching, okay, I'm sure we've all had times where we're penny pinching down bad. Okay. When we're doing that, then you don't have no money to pay people. Okay. But when you have surplus to pay people out extras more than normal, then you know you're in a good position. Okay. So that's what's going to determine if a company's in a good position or not. If their dividends are increasing and what their earnings is going to be looking like. Okay. So keep those two things in mind before we invest into anything. Now, let's talk about the actual chart itself, how we find it set up, and some stuff we need to do. So the time frames we got to focus on, okay, is our higher time frames. So you can look at your weekly time frame. Your weekly time frame, that's really going to help you put everything into perspective. Okay, your weekly time frame is going to help you see absolutely everything. Okay, it's going to be your eyes. It's going to help you see everything you need to see. Okay, and you're going to get all of your price action viewed. Then after the weekly, you can scale down to your daily. And then after the daily, go down to your 4 hour. Okay, when you're on the 4 hour time frame, let's go to the bottom right and make sure extended trading hours is going to be on. Okay, because what you're going to notice when you're on the daily and the weekly, and then you go to something like the 4 hour, which has extended trading hours, you're going to notice a little bit of differences in candles. So to see the exact candlestick wicks you need to see, do all of your higher time frame analysis, and then go down to the 4 hour time frame lastly. Okay, so once again, I'm going to go for my weekly, see the whole overall price action view, and then I'm going to go to my daily, and then I'm going to go to my 4 hour time frame. So let's talk about two things here. So this is going to be current price. Wherever I see the dotted line at is going to be where current price is. Right now, current price is at all-time highs. Okay, so if I'm playing a market that I'm expecting it to go up and it's already at max height, I don't want to buy there. Okay, I don't want to buy at max height. Okay, I can't go any higher than that. Okay, I don't know how high price wants to go up. I want to take a trade where I have resistance above current price, so price has something to travel to, or support needs to be above current price, so price has something to travel to. Okay, so what resistance is, it's an area where price decides to fall in a downwards direction. And this is a left to right chart. Okay, so resistance happens because if people bought way down here, of course they have to sell. So whenever and people bought way back here, so of course we're going to have sharp areas of correction. Okay, whenever we see market big sharp points and then falling in a downwards direction, that's going to signify an area of resistance. Okay, even right here, we're going to see price decide to create this top, and then it fell in a downwards direction. Okay, downwards direction. Same thing up here. Price creating resistance here, and then price fell in a downwards direction. Okay, very simple. Okay, And it's just not making it hard, making it very, very, very simple. So whenever you see market making downwards corrections, that's going to signify resistance. And once again, we want to be looking at resistance, etc., and stuff on our higher time frames. That's all we want to be looking at. Our weekly, daily, and 4-hour. Okay, we don't care about 15-minute resistance, none of that. We're looking at our higher time frames. The higher time frames are the levels that the institutions are playing with. Okay, so whether it be at hedge funds, banks, institutions, okay, everyone is looking at the higher time frames. And trading is not like business where you want to be unique. Okay, in trading, you want to be a sheep. Okay, whatever everyone else is doing, that's what you want to be doing too. That's going to be the right thing. If price is going in upwards direction and blasting, you don't want to be the one selling. Okay. Now, if price made a low and found support, which let's talk about that. If price makes support, which is going to be a low, and then price bounces in an upwards direction, then you can go ahead and purchase there too. So even if price is going down, if you see price make a low and then start bouncing in an upwards direction, you can go ahead and purchase that too. Okay. So support, once again, it's going to be an area where people are going to be buying at. Okay. It's going to signify demand. So buyers are at the areas of support. And then the opposite of that is going to be resistance. Resistance means there's too much supply. And that's going to signify that sellers are stepping in. Okay, so that's the difference between the two. So we have support, price bouncing in an upwards direction, resistance, price bouncing in a downwards direction. They both correlate with each other. Price can only go two ways, up or down. Okay, so they both work together. Okay, so check it. And this is going to be an area of resistance over here as well too. Okay, and then something like this over here would be an area of support. Okay. See price making this low and then bouncing in a upwards direction. I'm looking at this on my weekly time frame first, okay, just so I can go ahead and see absolutely everything. Now, for this trade, for example, Wells Fargo, okay, I wouldn't not take this trade because one, we are at all-time highs, okay, and just like I spoke about right here, okay, I like to either have resistance above current price, because price always wants to meet up with an area of resistance. So this brings me back to the competitive logic. Okay, so bringing back the market logic into the charts. If the company is trying to be the most competitive and show that they're the best, which is one of the ways they can do that is by having one of the highest share prices compared to the competitors, then price has to break resistances then. Price can't stay at all-time highs. They can't keep dumping down. That means it has to break resistances. So price is always going to be chasing all-time highs. No matter how low we dip down, okay, I don't care if price dips down all the way down here. As you can see, price still broke this area of resistance right here and then bounced in an upwards direction, okay? Price is bouncing up, going up, okay? So it's going in an upwards direction, okay? No matter how low price dips, it always wants to break all-time highs. Not saying it always will, depending on some companies, but it wants to. It wants to go back up. Okay, there's people behind these companies. There's people working behind these companies. They don't just want to be working for a failing company that's not paying any out good dividends. That's not logical. Okay, so that's why I'm going to personally ignore things at all-time highs, because if something's at all-time highs, yes, it could burst a little bit higher up, but for the most part, all it can do is fall down. Okay, so what I like to do is wait for good opportunities. So take this Amazon opportunity here, for example. All right, let's say Amazon wants to actually bounce at this area here, right? Okay. So we have this area here on Amazon, okay? So I have this area of support being reacted off of. We got one candle, two candles here, and then I have one candle here. Okay, let me go to my daily time frame here. Okay, I got a double bottom here at this blue line. Okay, and I can see over here, price made resistance over here too. So might want to break it and retest off of this area here. And then right here too, the support decided to work. Okay, so let's say price decided to bounce up this blue line right, and go in an upwards direction. So if price wants to find a specific low here, okay, and one thing I like to go do is get on my daily time frame, okay, look at the low zone. Okay, price is either going to bounce two ways, and we only want to be purchasing call options. Okay, we're going to be purchasing call options only due to the fact that it's a stock market. Okay, there's people working behind these companies. They're way more likely to go up than down. There's also laws in place, such as the short share restriction, to prevent things from dumping to zero. These companies employ people and run the entire economy. They're not just stocks on the internet. So call options are going to be all that we're purchasing. And we want to be purchasing any contract between, honestly, 1 month is too short for certain take profits. So you want to be purchasing a contract between, I'll say 3 months to 2 years out. So you want to buy at least 3 months to 2 years out. Okay, so what that means is on the Amazon contract dates, for example, here, if I wanted to trade this is October, as of when I'm recording this, October 2025. So it's going to show me the most recent options contracts here. Okay, what I'm going to do is go all the way over to the right. Okay, and let's say it's 2025. So let's say I want to buy 2027. Okay, I'm going to buy a whole year out. And the reason why I'm buying so far out is because I'm using my higher time frames. I'm using my daily and my weekly. Okay, I know price wants to hunt these areas, inshallah, but we have to give time for a trade to cook. So, and the contract that you're going to buy is really easy. So if current price, like we can see here in the middle for Amazon, is at 215, okay, all you're going to do, the contract that you want to purchase is going to be the one above wherever the current price is. All right, so if your contract is at 215.57 and you buy a year out, whatever the option above the current price number is, okay, the first option above the current price is going to be the best contract to buy. So in this instance, it would be this call 220s, since that's the first option above this 215 here. And I will buy a year out, okay, and then let the whole thing work. And this is also going to be a really good indicator to let me know if a trade is going to be good too. So I can see here all the price action here on the Amazon price chart. Okay. So this is where it was up here at January 2025. Okay, I can see price made this ultimate low here. Okay, and now it's trying to make some progress. Okay, so price is trying to mirror this low over here. Okay, and go in an upwards direction. So we have this support low over here for price bounced, and then we have price trying to mirror it again. Okay, price potentially, especially if I get one more daily close, if I get one more daily candle above the zone, I like to wait for a daily close above the zone too. I never buy whenever price is in the zone. So right now the wick is still in the zone. This candlestick is in the zone. Now, if I get another candlestick up here above the zone, I'm buying that. Okay, that's something I want to buy because it shows me that the zone is holding. So I never buy the first wick in the zone. I never do that. Okay, I just want to see if the zone wants to work out. And how I'm going to do that is get on my daily time frame, and I'm going to look for a candlestick outside of the zone. I should see a candlestick above the zone. If I see a candlestick above the zone, I'm good. Okay. If I see a candlestick above the zone, I'm going to be good. I'm never going to want to buy in the zone. Why? Because price, if it wants to, could dump further. Okay. But if I see price give me another candlestick, it's going to show me that that area of support was valid like I thought. And instead of me getting burned and just losing, okay, by buying at the zone, trying to buy too fast, I'm going to wait for price to confirm itself. Okay, so waiting for confirmation can be really strong. Okay, waiting for confirmation is something that more people just need to do. Okay, so when you wait for confirmation, you can sense out your setup. Okay, you know what type of setup you want to take. Okay, you're like, okay, hold on, this is working out because of X, Y, and Z. Price is holding this area of support here. Okay, so keep that all in mind. All right, keep it all in mind. All of it's going to be very, 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 very useful to keep in mind when it comes to taking your trades. Now, just like I spoke about again too, I like to play trades when there's resistances above current price, just like I talked about. Okay, so I have this area of resistance up here above current price. Okay, So I know price is something to travel to. I could see price reverse here once, reverse here twice. Okay. So price wants to come up here and try and break it. Okay. It doesn't want to keep reversing at the same area over and over again. And if it does reverse at this area 60 times, just the fact that it's trying to break this area, we use that as our profit window. Okay. So the whole gap until the area of the resistance is the money that we're trying to make. Okay. That's a whole bunch of money that we can make right there. So once we see the support being confirmed, we take it up to the heaviest area of resistance. Gotcha, my bad. So yeah, we'll take it up to the next heavy area of resistance. Okay. So it's gonna go ahead and be that. All right. And then from there, let's go and let's jump into another setup here. Okay. So that'll be that. Price doesn't want to keep reversing at this area here over and over and over and over and over and over again. Eventually, it's going to want to try and break this area here. Okay. So keeping that in mind at all times, it's going to be really, really, really important and imperative. Okay. So if I go ahead and I pull up another stock, for example, okay, let's say Apple. Okay. Actually, yeah, you know, let's say Apple. Okay. Even Apple right here, okay. I can see Apple created this area of support down here. Okay. This area of support looks like it wants to be held due to the fact that on my daily time frame, I have some candlesticks that decide to push an upwards direction from there. Okay. So I can assume that price wants to at least fill in this gap up here. So I know price wants to fill in the rest of this gap for resistance here. Okay, since we're going upwards direction, it's not going up for no reason. It wants to go to a certain place. Up. Okay, so we have about 10 points left and it's heading to the resistance. And they'll try and reverse here or break it and maybe retest, continue. So once you see a support area confirmed, I look at it, be like, okay, why does price want to bounce at this area here? Once you see why price is bouncing in a certain place, it's going to be a lot easier to go ahead and take the setup from there. Okay. So let me pull up something like a Google, for example. Okay. Same thing with Google here. I could see price decided to meet up with this area of support once. Okay. And then I also have the area of support being reacted off of twice. So I got two areas of support here being reacted off of. And I can see here, day after day after day after day, price is filling in this gap here to the area of resistance up here. Okay, price is trying to fill up the area of resistance up here. So even if I wanted to get in right here, I'd still have about 5 points of price action left until I hit the resistance. Okay, so even if price were to whiplash all the way down, okay, up here still might take profit. Okay, so this is why on options 2, our contract is going to be our stop loss. So if the contract costs $200, we're okay with losing $200. Okay, so your options is your contract that you purchase is going to be your stop loss. So you can start off by playing cheaper stocks too if your portfolio isn't just booted up enough to play certain contracts that are just too short. Okay, so even on a cheaper stock like this, right, I can see price making this ultimate low on this base down here, right? So you have this heavy area of support down here. Price decided to make this area of support start going in an upwards direction. Okay, we can clearly see price curling up. Okay, and I know we're curling up to a certain place. We're not just curling up for no reason. We're trying to break these areas of resistance. It's resistance for a reason, okay, because price is trying to break the last point of fill out. So we could see we got this area 1 here, and then we have this area right here. So we got 2 areas where price decided to fall in a downwards direction at, okay, 2 places. So we know price wants to at least try and touch this area of resistance. So this is all I would do. Okay, I can see that the support area already got confirmed. And even if I just wanted to buy right here, this would still be a good buy. Okay, I can get on my ruler here, and when I close, it's just going to be important. And how much time I have too. Okay, so there's about 6.56 points left. Okay, so from there, I would be able to click on options in the top left, and I could buy a year out or 2 years out if I wanted to. Okay, and my take profit is going to be 17.43. But to make the most money, I'm just going to go ahead and buy the contract one above the current price. So if current price is at 10.85 and I want to buy two years out, for example, then I'm going to go ahead and just buy the contract one above, and I'm going to go ahead and buy that. Okay. And then from there, I can go ahead and just hold the trade for just an extremely long time and just sit on it and set alerts and wait for take profit to get hit. Okay. And we're going to just rinse and repeat until we find good trades. So this is going to be a trade that I marked out here too for students. So I could see here, price decided to do something what's called break retest. So after areas of resistances are broken, they can sometimes turn into support. And that's going to be called break and retest. Whenever you see price doing that, it's also a high conviction that price wants to continue in an upwards direction. So I could see price made this extremely heavy area of resistance right here. Fell down, okay, and then price decided to make this ultimate low. Okay, so there's going to be two setups you're always going to be playing. You're either going to wait for resistance to be broken and wait for price to come down and turn it into support, just like this. You're going to wait for the resistance to be created and then wait for the resistance to be broken and then wait for price to turn the resistance into support. And then if you start seeing bounce rate action out the zone, you're going to be good. So you're either going to wait for resistance to turn into support, or you're going to wait for an area right here to be reacted off of. You're just going to wait for an area of support to be bounced off. Okay. Even if price doesn't cleanly mirror the supports like this, okay, one level after the other. Okay, just like right here, one level of support immediately right after the other. Okay. Sometimes you're going to have an instance like this, though, that still works. Sometimes you're going to have an instance of support like this. Price might break down below the support, and then it might come back above it, and then it might bounce again. Okay, so you could just ignore this, but just the fact that it wants to mirror the original bounce and try it again, okay, is a really, really, really strong and good sign. Okay, so that's what you're going to be looking for. Okay, either support bounces or prices bouncing in the same area of support, giving you daily closes outside of the zone. Okay, so I would never trade in this gray box, okay, because I can see prices wicking here. I would wait for a candlestick to get on the daily above the gray box, and then I'm going to go ahead and take the candlesticks above the gray box. Okay, I want to just use my low as confirmation. Okay, and then even right here, price broke above this area of resistance, turned into support, and then went up to the next area of resistance all the way up here. And guess what? Resistance got broken again and turned into support. So resistance got broken and turned into support again. Okay. Keeping markets simple, playing trendy. Okay. We're just going to be trading with the trend is all we're doing. Focusing on lows and focusing on where we need to close. Okay. So I'm going to always start off on my weekly time frame. It's just personally what I like to do. Let's say this instance here, I'm going to go ahead and put a zone at this all-time highs. Start off on my weekly. Let me go to my daily. Okay, we could see price trying to make a lower here. Okay, and then I'm going to my 4 hour. And this is why we go to our 4 hour time frame, because you can see here on the daily time frame, this is the bottom of the wick. But then I go to my 4 hour time frame, the bottom of the wick is going to be down below down here. Ooh, guess what? Extremely, extremely nice. So I have area support over here being reacted off of with this area of support over here. I love it. Price came all the way back down to this area of support, which I assume came from this area of resistance right here. So break and retest will a lot of the time it'll happen once real quick, create the strong area of resistance, and then price has a chance again to come back all the way down, turn into support and bounce again. And we can see the support areas are mirroring each other. Okay, one area of support, two areas of support. The support areas here are once again mirroring each other. Okay, so if the support areas are mirroring each other, that means that it's a significant place that we want to just be purchasing at. Okay, they're mirroring each other at these places. But price isn't just doing anything, it's playing logically. Okay, so if I see price bouncing at the same place, I would assume that price wants to fill in the rest of this area of resistance up here. Okay, and price will either try and reverse at the resistance, break above it, I don't care. All I know is, even if price wants to reverse at the resistance, it wants to at least touch it. Okay? It wants to at least touch it. So we'll go to my options. And I would go ahead and be able to buy. Let me see, if my take profit was about 2 months ago or about a month ago, then I could easily buy 3 months to 2 years out. The further out, the better. The further out, the better, just because you want to give your trade the most time. So take profit up here is 50. Okay, take profit was there about a month ago. So if I wanted to, I could do like January 2027. Okay, and then I'll be able to purchase this contract very cheap for $240. I could buy a contract that lasts me about a year. Okay, so I have a whole year to go up 3 points. That's extremely likely. It's extremely likely. So what you're doing is you're outplaying the options formula. Okay, you're taking the perspective of option sellers where they're like, you know what, people are going to purchase this contract because they're going to want to be cheap. They're going to not have enough time on this, and price most likely will not do it in a short amount of time. Okay, so when you buy time on your contracts, you give yourself time. Okay, give your contracts time to breathe and do its thing. It's going to be big. Okay, and you can stack up on what's called leaps too. Okay, you can just buy a bunch of good setups that have like 1 to 2 years out and just sit on them. Sit on them. Wait for take profit to get hit. Find your take profit on your weekly and your daily and wait for them to get hit. A lot of the time too on your price chart, this is not going to be the definitive every time, but a lot of the time on your price chart, if you have resistance above current price, you're in a good area. Okay, resistance above current price is going to be a really good sign. Okay. Once again, resistance above current price on your price chart too is going to be a good sign. You can see the price chart has a place to travel to. Okay. It's about taking our time. Okay. So the weekly here, I would start off, I just go through my pairs. I can see this is at all-time highs. I'm cool off this. Okay. If I wanted to trade this, I would need price to pull back to a certain level. Okay. I can see price here decided to turn this area of resistance into support. Okay, and then it took off. Now, if price decides to come back, hold this area again and bounce, I'm cool. I'll take that. Okay, but buying all the way up here, I'm not gonna do that. That's not something that I want to do. Okay, so let's take this stock for example here. Okay, even right here on this stock. Okay, I could see price trying to make a certain low here. Okay, I always just pay attention. Is price bouncing in an area? If so, I'm gonna check it out. Okay, I can see price made this area of resistance over here. This area of resistance turned into support. And this area of support is now being bounced at again. Okay, and I also have a daily candlestick above the zone. All parameters I like personally. Okay, price bouncing in the same zone. I see some break and retest over there. So if I wanted to, I could easily take my take profit to the area of resistance up here and then all the way up here. And then you're gonna wait for price to fill in the gap. It might fall down here and then come up, maybe retest, and then back up through here. Okay, so I can see the support here being confirmed. Okay, price really likes the support here. So I'm gonna take my chances here, and you can see the rest of the bars is about 20 points worth of price action. Okay, take profit was hit about a couple months ago. So I would do the same thing on this. I would go options. Okay, I would go like a year out. Okay, I would just make it easy for myself, buy the one right above. I can see on my price chart here, I have resistance above current price. And this is just simple, okay? And I can see price even on the price chart here, kind of wants to confirm. When my price chart reflects my actual chart, that's gonna be a really good sign, okay? So you want the price chart to be reflecting kind of the actual chart, okay?
So I can see price bouncing in that same low here, and it looks like it wants to trickle up and fill the rest of this area up here. Okay, so we have about $1,900 worth of profit up here to be made in between here. Okay. In options, it can be kind of hard to calculate every single thing. It's not an indicator, it's just a price chart. So every options contract has its own chart. Even here too, take this stock here. Okay, once again, all I do is just eyeball, okay? I just eyeball. I can see price made a low, and I see a green candle after price dumped. I see green candles looking like it wants to trickle up, okay? So you could just eyeball the chart, and this is why we just buy time. There's millionaires for people who don't even look at the chart, okay? People who forgot about the plays they've been in and opened their broker one day and just closed the position and enjoyed their life. Okay? So that just shows that buying and holding is what we're going to be doing. Okay, so even right here, you can see price bouncing at that certain low over here. Okay, price decided to make this low right here based off of the resistance right here. So resistance got broken and price decided to turn it into support. And then price decided to bounce at the same area of support again. Okay. And once again, I have a daily candlestick outside of the zone. I have a daily candlestick way above the zone. So I'm good. I'm never going to buy a candlestick in the zone. I like to see if my zone is created though. Okay. Then from there, I can go ahead and see price wants to try and meet up with this area of resistance. Okay. It'll try and either reverse at this area or break above it, or both. Okay. So we'll go ahead and go to options, go a year out, buy the one right above, and guess what? Price chart has resistance above current price. So when your price chart looks like your setup, that's a really good sign. Okay, this is going to be some secret sauce right here. So when your price chart looks like your setup, that's really, 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 really secret sauce. Okay, and then personally, I would just be waiting for market to go ahead and do its thing up there. Okay, I would wait for price to curl up and meet up with the area of resistance up here. Okay, and catch the whole remainder of this price action up here. Okay, so it's about taking our time, making sure we're finding good profitable setups. Okay, even right here, take Hewlett Packard, right? We have this area of resistance here. Okay, price decided to just meet up with this area of resistance. Okay. And price decided to make a low. Okay, made a low off of this support right here and decided to bounce in upwards direction. Now price is meeting up with this area of resistance, and we're going to try and break this area of resistance. Now, if this area of resistance gets broken out of, then I know we want to at least try and meet up with this area of resistance up here. Okay, go to my daily time frame. Okay, I could see this area of resistance created up here. So if price decides to run past this area of resistance, maybe turn into support, I know we want to go ahead and try and trickle up here. Okay. Or even if I just deleted everything, marked out this area of resistance up here. Okay, I could see price hit this area of resistance this year. Could see price decided to make this recent low. Okay, and I could just wait for price to fill in this gap up here. And then I could go ahead and go to my option contract, buy a year out, 30, and I could see resistance above current price on the price chart. So if I see price already made a certain low on the price chart, that's going to let me know that that's really good. Price already redipped the zone multiple times, even on the price chart. Okay, so price looks like it just wants to curl in an upwards direction now, inshallah. Okay, so your setups look like your price chart, and the whole remainder of this gap here is going to be all just money we can get, all money we can make. I'm just buy a year out and just set my alerts at the take profit all the way up here, and I'm going to let the whole trade just ride out. Okay, I'm going to let the trade just do its thing, collect my profit, and just ride it out. And I'm just going to ride out the trade.
Okay, and just make it as easy as possible for us. Okay, same thing with Kroger here. Okay, I can see price confirm this low down here already. Okay, you can see price confirm the low down here. Okay, it likes this area. Now I can see price wants to potentially try and meet up with this area up here. Let me go to my daily. Okay, and I can see this whole area of resistance clearly wants to be filled. Okay, filling this whole gap of the area here. Okay, even if I got on my 4-hour here, even if I closed up here. Okay, Kroger, boom. Could go a year out, go one above, and as I can see, resistance above current price on the price chart. Price decided to make a low already on the price chart, and price looks like it wants to fill in the gap to the area of resistance and curl within a upwards manner. Okay, so that's going to be how to trade leaps, how to make income from options, and how to trade.
So if you've ever seen your portfolio down and noticed gas, groceries, etc. getting more expensive, what's the cause of everything? It's going to be inflation. It's the silent thief. And most people think that inflation just means prices go up, but it really means that your money is worth less and it's going down. The 7% inflation each year turns $100 that you own into just $93 of real buying power, even if your account balance haven't moved an inch. And when inflation spikes, the market reacts like a toddler with no nap. Growth stocks drop, companies can't hike prices fast enough, and profit margins get squeezed. And suddenly those charts are nothing but red candles heading in a downwards direction. But here's the part that nobody talks about. Inflation doesn't destroy every portfolio equally. It's about what you're invested in. Some assets actually thrive in the chaos. Commodities, real estate, energy plays, and even those born dividend giants that simply pass rising costs straight to consumers. I'm going to go ahead and break down exactly what inflation is, and let's understand it, class, inshallah. So, the term inflation, you guys might have heard of it in school, around, you might have heard your parents talking about it, seen it on the news, etc. We're going to want to break down exactly how it causes other prices to go up, whether be it on goods, etc., and how it affects stocks and stuff like that as well too, and how it can affect your portfolio. So, what is inflation in the first place? So, too much money and too few goods. So, in life, things work off of two things: supply versus demand. So that's how things become valuable. So if there's a lot more demand than supply, then that means that something is going to be valuable because people want whatever it is, which is why it's in demand, but there's not a lot of supply of it. Why? Because people are buying up all of it. Okay, so supply and demand are going to be the two factors that come into play when we're looking at inflation, or even just understanding how humans trade or economies work in general. So too much money, but too few goods. Okay, so inflation is the rate at which purchasing power drops. It means that your dollar, so your US dollar, buys less today than it did yesterday. Okay, so whatever your fiat currency is, whether you're using the euro, US dollar, etc., inflation is the rate at which the purchasing power drops, meaning that your $100 might not buy you the same amount of goods as it did 10 years ago. Okay, so the demand pool. So everyone has cash and wants to buy the same limited items. Okay, so that's why prices go in an upward direction. And cost pushes. So let's say materials, right, such as oil and wood, they get expensive. So companies raise prices in order to survive. And the result that comes out of play is that, let's say you'll need $1.05 today to buy what cost $1 last year. And then year after year after year, it keeps going up. So it might start off as $1.05 today, but then 5 years from now, that same item could be $2. Okay. So if you're buying an item for $2, which you did for $1 just a couple of years ago, okay, you're now paying double the price. Okay. So unless you doubled your income, then you have to be ready to, one, subside your income for certain scenarios too. So if goods are getting more expensive, but your income hasn't increased, you either got to A, increase your income, or learn how to rebudget your current income. Okay, that's just how inflation works. So for example, just to break it down, in 1950s, let's say a burger, right? Let's say it was 10 cents. Okay, and then today, 2025, 2024-ish, okay, let's say something's $8. That's happening because more dollars have been printed. The more dollars that get printed and created, the less valuable it becomes. Okay, the reason why diamonds, gold, or even take Bitcoin example, are going to be valuable resources is because they are limited. But take the dollar, all they have to do is go up to the printer and keep on clicking print, and dollars will continue to spawn. So yes, we need dollars in order for the economy to flourish and for us to barter at a successful rate. But if humans continue to lead by their flesh and think that printing more dollars will solve everything, then humans will continue to pay certain consequences, such as dealing with more mental stress for having higher real estate prices, higher grocery prices, higher gas prices, etc. So how do we measure inflation in the first place? We got to take a look at the economic news event results. So let's go and let's jump into it. So let's talk about CPI. CPI is going to stand for Consumer Price Index. So for example, let's take a hypothetical basket of goods: eggs, gas, rent, and clothes, right? The government is then going to check the price of the basket of assets that people need in order to see if it got heavier. Okay, so that's what the CPI report is going to measure. A lot of the times after the CPI report occurs, you'll see a substantial move within every single market, whether it be at the crypto markets or the stock market. Okay, and then we're going to have PPI. Okay, PPI is also going to be very important. PPI is going to stand for Producer Price Index, and it's inflation for factories. So for example, if it cost Apple more to make an iPhone, okay, then that means the PPI would be up, okay, and they will eventually charge you more, okay, which means that the CPI, Consumer Price Index, would be up, okay. So if it costs Apple more to make an iPhone, the Producer Price Index would be up. Why? Because Apple is the producer. Now, if they're charging us, the consumers, more, then the Consumer Price Index, the CPI, would go in an upwards direction. Okay, so core inflation at the baked center of everything. So CPI minus food and energy, right? Consumer Price Index. So why? Because food and gas prices swing wildly, okay? And the Fed prefers core to see the real trend. Okay, so looking at the core inflation of everything is really going to be a much better statistic to look at when it comes to how the economy is actually doing within the full broad picture. But looking at every single news event, such as the rate changes, etc., are really going to help you, give you a good measure of how the economy is standing up and a direction of which the market could potentially head to. All right, let's talk about the melting ice cube with everything. So cash is a liability. Okay, so cash is a liability. Okay, this is Stackmode Chris talking to you guys right now on some personal stuff. Okay, ignore the presentation for just a second. You guys should not be spending your cash. Okay, you need to be spending your cash to pay off credit. That way you're going to be able to get more credit and you're going to be able to spend that. Okay, you need to be investing all of your cash. Okay, you should not be spending your cash. Okay, you have to understand that it's a trap. Even when it comes to certain things like taxes, even if when you start touching M's, 6 figures, 5 figures, etc. Okay, if you just save your money and just sit on it and don't invest your money into something that's going to be bringing you into more income, okay, you're going to be getting destroyed on taxes. Why? Because you're just holding more still cash. You're not benefiting the economy and you'll get punished for that. Okay, so please, cash is a liability. The only reason you should use cash is to clear your credit and to build wealth. Don't hoard cash. Don't hoard cash in your walls. Don't hoard cash in your bank account. Okay, your checking account should be pretty much empty. Okay, because why aren't you invested in assets? Okay, you should have your life together. You should have your credit card. Okay, you should be able to survive off of that. Okay, when it's time to pay off your credit card, take your assets. Okay, when you have your profit, take some off the top. Okay, and you're going to be able to pay off your credit card and keep that cycle and flow going, so your money is infinitely going to be flowing in a river. Okay, the moment you pause your money, okay, the moment struggle starts to seep in. So I'm telling you, keep your money flowing on a river at all times. So a lot of people think hoarding cash is the play. Okay, and I know I'm Stackmode Chris, but I'm telling you guys, if you're going to stack up into investments. Put your cash into investments. Don't just sit on your cash. Don't be having your money on just to put the money phone up to your ear and post on the gram. Oh, that's corny. Okay, put all your cash into straight assets. I don't care if you do real estate, Bitcoin, stocks, doesn't matter. Some of you dividend ETFs. Okay, so many different avenues, whatever you're comfortable with. But I'm telling you, if you want to help your family, even if you die right now, you still want to be making sure some money is being generated. But you can't do that if you just have 100,000 pause in your bank. Okay, but if you have 100,000 in an asset, your family could eat forever off of that. You have 100,000 parked in a dividend, your family could eat forever off that monthly income. But if you have 100,000 parked within a Chase account, Chase is just going to take that money and go trade with it themselves. Okay, so understand that cash is going to be a liability under every single scenario. Cash should be used to pay off credit and invest into assets. Don't get trapped. Okay. So let's say, for example, right? And this is why God says interest is haram in the first place. It's pretty much useless. Okay. So try to invest your money into things that are going to give you a positive equity for curve, because things like a 2% APY, APY stands for annual percentage yield. Okay. So trying to put your money into a account that gives you 2% per year, 3% per year, 4% per year, it's pretty much going to be all of your time, especially when inflation comes into play. You have to learn how to increase your income, especially if you're going to plant your income, at least plan it into something that's going to give you a much higher percentage yield at the end of the year. Okay. So any type of small percentage APY account, personally, I'm going to tell you, it's just not worth it, truthfully. Okay. So for example, let's say you had a saving account giving you 4% APY, right? And inflation is hitting at -6% each year. Okay. The real return is going to give you -2%. You're poor. Okay. You're poor in every scenario. So I'm telling you, keeping your cash inside of your bank account is a trap. I'm telling you in every single scenario. If you don't believe me, you can go look at your own economic data. But the fact that things only get more expensive means that you need to up your income. Okay, you need to up your income, and in order to do that, your cash needs to always be moving in the river. If you want to have your cash inside of the desert field, that can be you. But if you want to have an easy time in life, I really recommend you guys put your cash inside the river. You must invest in assets that grow faster than inflation to break even and to even see any type of profit for yourself, your kids, or your family. So get in your bag and use your cash, throw it into assets. Don't keep it still. So let's talk about the Fed's brake pedal. So fighting fire with ice. So when inflation gets hot, the Federal Reserve raises interest rates, right? Which means borrowing gets more expensive, mortgages go up, credit cards start going up, okay? And spending starts slowing down. People start buying fewer houses and cars, which means that demand drops, okay? Prices start cooling down. And in the long run, if people aren't buying products, then these products that are created by companies that are listed as IPOs on the stock market would not be benefited from that. Okay, the more products that are being bought for a company means that higher earnings reports are going to go ahead and be reported for those companies. Better earnings reports, a lot of the chances it is for that company to keep breaking into new all-time highs repeatedly, causing it to go in an upwards direction. But if people aren't buying any items from these companies and people aren't being consumers, then the stock market could head within a downturn due to the fact that the money is not flowing in the ecosystem as rapidly as it should be. Okay, so as soon as consumerism slows down, then the stock market within the short term becomes affected by that. So let's talk about impact on tech versus value, right? So growth stocks, let's talk about tech. So a bad effect, right? So these companies promise money 10 years from now. So when inflation is high, money in the future is considered kind of worthless almost compared to money now. Okay, so investors sell tech. Okay, but then you're gonna have like value stocks. Okay, companies that sell certain boring things make cash now, so they perform better when rates rise because they have pricing power. Okay, so it really depends too. When certain economic data reports come out, certain stocks are gonna get a lot more affected than others. Okay, take like a Build-A-Bear, for example. Okay, that's a very consistent stock that goes up year after year after year after year. Okay, and it's not really based off of the future value. Okay, it's just people going to the mall and building cute bears, couples, kids, etc. Okay, but tech stocks, they are focused and based off of intrinsic value due to the fact of what they do for the future and how they innovate the future. Okay, so not saying either one's going to be better than the other to invest in, but when it comes to certain periods of inflation, if no one has enough money to buy certain expensive pieces of technology, etc., then a lot of companies will suffer. But then companies who just sell certain things like food might progress during periods of inflation. So it really depends on what time period you're in, which is what's going to determine what batch of stocks are going to be performing the heaviest. So you might ask me, Chris, how do we avoid inflation? Okay, what do we do? So commodities, real estate, and things like Bitcoin are going to be a really, really good way in order to park your money due to the fact that these things are going to be worthwhile and useful a lot of the times. People are always going to need a house. Okay. The reason why people invest into Bitcoin is because it gives you borderless transactions. And especially now, as times start progressing a lot more, especially US Americans are more open to traveling to other countries. So instead of having to take their US dollar and put it through transfers, just being able to spend that Bitcoin all around the world gives us a lot better suitability as humans. And then we're going to have commodities. You're going to have energy, gold, silver, copper, etc. Physical things that people are going to be able to buy. So let's break down what these all mean. So commodities, right? So commodities. So if the price of stuff is going up, then owning the companies that produce the stuff is going to be a direct hedge. Okay. So any type of gold mining companies, etc., especially, okay, because gold is going to be a asset that especially goes up when economy is in inflation. Okay, due to the fact that it's something that's going to always be useful and it's a limited resource. Okay. Now let's talk about banks. So banks can charge higher interest rates on loans when the Fed raises rates, which potentially increases their profit margin. So be aware of that. Okay, and real estate. So rents tends to rise with inflation, and fixed rate debt gets inflated away. So your mortgage payment stays the same, but your income usually rises. Okay, so keep all of that in mind too. So pricing power is going to be the secret weapon for everything, honestly. So can they raise prices? So the ultimate stock market defense is holding companies that can pass costs to customers. So people buy iPhones even if they cost $50 more, right? Due to the fact that it has a high pricing power. Okay, or take a commodity product. Okay, if brand A raises the price of white t-shirts, then you would buy brand B, okay, giving it no pricing power. Okay, but when you're investing into certain companies that have exclusivity, okay, certain companies that only do what they do and puts a smile on many humans' faces, then even if inflation were to recur, a lot of people would just see that as an opportunity to buy as the market going downwards. Okay, so especially certain tech stocks too that still have a lot of future value and have a lot of expectations to change a lot of things in a lot of ways. If they're going in a downwards direction, people are going to look at that more of an opportunity rather than, oh, the stock market is failing, etc. So the bottom line for everything, just wake up, pray to God, be a disciplined person. I want you guys to look in the mirror, feel confident, feel proud of yourself for what you got put up. Okay, feel proud of yourself knowing that you can handle your responsibilities, knowing that you can help your family if things come into play. Okay, don't let your cash melt and don't let it freeze in your bank account either. Okay, own productive assets. I don't care if it's real estate, crypto, shares, dividends, whatever. Find your bread and butter. And if you're struggling to see what you want to invest in, head over to stackmode.net. Stay prayed up to God, keep grinding. I'll catch you guys in the next one. Peace.
What's going on, class? We're going to be talking about Forex trading fundamentals. We're going to be understanding what a pip is, what a lot is, and how Forex leverage works, and what leverage is in the first place. These are going to be the 3 pillars of position sizing and risk management. Welcome to the class. Let's jump into it. So let's understand what a pip is. A pip stands for percentage in point. Okay. So that's what pip is short for. PIP stands for percentage in point, and it's the smallest standard unit of price movement. So the definition, a pip is the standard unit used to express the change in value between 2 currencies. For most currency pairs, a pip is equivalent to the 4th decimal place. Okay, so for example, dollar 0.000 and then the 4th decimal place, so then 1. Okay, so for example, and a currency pair is going to be something like USD JPY, for example. Okay, something like that. That's going to be referred to as a Forex pair. And many brokers now quote prices to a 5th decimal place. And this fractional pip is often called a pipette or a fractional pip, allowing for tighter spreads and more precise execution. And calculating the pip value, USD quote currency. Okay. And the monetary value of a pip depends on 2 factors. The currency pair, just like we talked about, this is the currency pair, USD, JPY, etc. And the size of your trade, and that's going to be the lot size. That's going to be the amount of money you have allocated into the trade, whether you want to be at $10 worth of size or $100 worth of size. Okay. So for example, let's say you're trading Euro, USD. Okay, let's say you're trading this pair. if Euro USD moves from 1.0001, let's say Euro USD is at that price, okay, to 1.10002, okay, that's a 1 pip movement, okay? So the fourth decimal place changed from 1 to 2. That's going to be +1, so that would be a 1 pip movement, okay? And 1 pip is equal to 0.0001 per unit of base currency. And an exception, pairs involving the Japanese yen, okay, JPY, are typically quoted only 2 decimal places. For example, a USD JPY, a movement from, let's say, 150 to 150.1 is going to be 1 pip. Okay, so instead of the 4th decimal place, it would be just the sen. Okay, so which would be the 2nd decimal place. So the concept of a lot, what is a lot in the first place? So this is going to determine what the trade size is going to be, how much money you're going to be putting into the trade. And it's the volume that determines the profit and your loss scale. And a lot defines the currency units that you're trading. And since currency moves in tiny pips, large volumes are necessary to generate meaningful profit or loss. And the 3 standard lot sizes, okay, a standard lot, okay, it's going to be 100,000 units of base currency. And let's say, for example, be $10 per pip, okay, a mini lot, okay, 10,000 units of currency, okay, and let's say it'll go ahead and be, for USD pairs, $1 per pip. And for a micro lot, let's say 1,000 units of base currency, okay, and it'll cost you 10 cents per pip, okay, of USD fiat. So the fractional representation used in trading platforms is 1.0 equals standard lot, okay, and 0.10 equals mini lot, and micro lot equals 0.01. That's a micro lot. And beginners should start with micro lots, 0.01, to manage the risk. And the importance of lot size. A 50-pip move in your favor is $500 profit with a standard lot, but only $5 profit with the micro lot. And choosing the lot size correctly is the first step in risk management. So I'm going to give you a deep dive into what leverage is in the first place. So it's going to be margin trading. Margin trading is when the broker is pretty much going to let you have a minimum amount of money, okay? And then you can go ahead and trade pretty much with over that. And it could be a double-edged sword of buying power. So here's the definition. So leverage is the ratio of the capital used in a trade to the amount of money required to open that position, which is called margin. And common ratios are going to be like 1 to 50, okay, where it's going to be have like a 50x multiplier, okay, on your currency, okay, 1 to 100 or 1 to 500. And this is the required amount, okay? And the required amount is going to be margin. And that's a collateral amount that your broker temporarily locks up from your account to maintain the leverage position. So let's say you want to trade with $5,000, okay, in hindsight, worth of leverage, right? But you would have to have a minimum of $500 in your account, okay? And let's say you go under that. Let's say you go to 480, right? Then if you don't have that full 400, you don't have that $500 minimum, right? And you go down to the 400s, then your account can be wiped down to 0 and liquidated. And depending on how quick the price move that happened, that puts you underneath the minimum, okay, you could potentially owe the broker money and go into the negatives. So be careful. Margin can be a lot of power, but it could also bring a lot of destruction. You don't want to go into debt and stuff like that for no reason, okay? Something I've struggled with for making just bad decisions. I don't want you guys to go through it. So power and peril. So the power of leverage. With 1 to 100 leverage, a trader can control 100,000 standard lot position by only pulling up $1,000 of their own capital. So, and leverage is going to come with this. And if that 100,000 position loses, let's say 100 pips, okay, $1,000, the entire margin, instead of $1,000, for example, is going to be instantly wiped off, leading to a margin call or automatic stop out by the broker, okay, causing you to either A, owe the broker money, or just set your balance to 0 sometimes. And higher leverage means smaller required margin. but drastically increases the risk of rapidly depleting your account balance. So don't trade close to margin. Make sure you guys have way more money than the margin requirement. This way you guys can trade without even having to worry about this. So here's an example, the trade calculation. Let's combine a pip, lot, and leverage in a single trade. So let's say we have a $5,000 account. Okay, let's say God bless us with a $5,000 account. Okay, and the leverage we're going to be trading with is 1 to 200. Okay, let's say we're trading USD, CAD. And the volume we're going to be trading with for this example is going to be 0.5 lots. Okay, so that's going to be a mini. So calculate the position size and the margin. So the trade units, okay, so I'm trading with 0.5 lots. So I'm going to go ahead and take the 0.5, okay, and I'm going to go ahead and know, okay, so take that into 50,000 units, okay, and then from there, I'm going to take that 50,000, okay, and I can go ahead and take that by the 200, okay, and I got the 200 from the leverage amount, okay, and that's going to go ahead and give me $250. Okay, so 50,000 divided by 200 is $250. Okay, and for the pip value, okay, I'll take that 50,000, okay, that I got from that 0.5 times 100,000. That's where I originally got that 50,000 from. Okay, then I take that, divide it by whatever the leverage is. Okay, that's 250. So then I'm going to take the pip value. Okay, so for the pip value, I'm going to go ahead and put that as 50,000. Okay, because 0.5 times 100,000. It's going to go ahead and be 50,000, okay, and times 0.00001, okay, equals 5 units of CAD, for example, okay, and the value is going to always be in the quote currency. And for USD value, if the CAD USD exchange rate is 0.75, for example, the pip value is 5 CAD, so times 0.75, okay, so it's approximately 3.75 USD per pip, okay, and if the trade moves 20 pips in your favor, then you can go ahead and determine if you're going to be profitable or not, okay, by just keep on calculating certain costs, or you can go ahead and put it into a profit or loss calculator. A lot of brokers too will show you if you put down a take profit limit order, okay, you can go ahead and see how much you're going to make on certain areas too. So risk management, the crucial connection. So use pips and lots to control exposure. Effective forex trading is not about predicting the market. It's about controlling your risk. And this is achieved by linking lot size volume to your tolerance for pip loss, and the 1% rule in lot pricing. And the golden rule, never risk more than 1% of your total trading capital in any single trade. And for a $10,000 account, your max risk should be $100, for example, or $1,000, okay? Once you start getting better, you can trade between 1 to 10% of your account. And assume your strategy requires a stop loss, okay, especially on forex and futures, since you're going to be trading with leverage a lot of the time. You don't want to get margin called, so make sure your stop loss is going to be at a place that's going to be before you get margin called, okay, so you don't lose your money for no reason. And calculating the max pick value, so put it in forex calculators, and understanding the math is really going to help you put your risk management into place. So the risk adjusted lot size. So let's say a micro lot is 10 cents a pip and a mini lot is $1 a pip. To achieve the $2.50 pip required value, you would open a 0.25 lot position, okay, which is 25,000 units, which is 2 standard lots plus 5 mini lots. And responsible trading reverses the calculation. Determine your risk percentage and your stop loss, okay, then calculate the correct lot size, and never choose the lot size arbitrarily, okay. Do your math, put everything in calculators online. Okay, stay productive to God, keep grinding, and that's what a pip is, and I pray that it helped. Head over to Stackmode.net if you want to learn how to trade Forex, crypto, anything. Catch you in the next one. Peace. I'm going to go ahead and break it down and make it easy. So what exactly is trading volume in the first place? So volume is pretty much going to be the amount of people and the amount of money being flowed into a cryptocurrency token, stock, or whatever. So whenever you hear the term volume, just think about the amount of money that's being flowed into or out of something, as well as the amount of people that's trading it. So it's a fundamental metric that represents the total number of units of a cryptocurrency, for example, in this case, that have been traded over a specific period. And it's a simple yet profound measure of market activity and liquidity. And think of it as the heartbeat of the market. And the high volume indicates a strong, healthy pulse, while low volume can signal a weakening or stagnant market. And encompasses both buy and sell orders that have been executed, reflecting the total flow of capital into and out of a particular asset. So let's talk about the total transacted value. So volume is often reported in both the base currency, for example, Bitcoin, Ethereum, for example, and the quote currency, aka USD, USDT. A volume of 10,000 Ethereum on a given day means that 10,000 Ethereum coins were exchanged between buyers and sellers. There's also going to be time-specific measurements involved too, and volume is always measured over a defined time frame, such as 24 hours, 1 week, or even a single minute. And this temporal context is vital for analysis, as a sudden spike in a 15-minute period can signify certain sudden movements within price, even if the daily volume remains average. So if you see a bunch of volume coming in within like a 15-minute time period, then you know lots of flow coming in. Maybe a whale might be purchasing, okay, somebody putting in a large amount of orders, okay, or a large amount of orders being flowed into a specific direction. Okay, that's going to be volume. Whenever you see price action being flowed into, whether it be it on the flow chart or via the order book, okay, you're going to be able to see all the transactions happening, and the more transactions you see, the higher the volume. So let's talk about liquidity indicator. So a high trading volume is a direct proxy for liquidity. An asset with high liquidity is easy to buy or sell without causing significant change in its price. And this is crucial for large-scale traders and institutions who need to enter or exit positions without a large price impact, also known as slippage. So slippage is pretty much where you're not going to be getting all the money that you're intending to receive. So say you sell for a profit of $500, okay, you're expecting to get all that $500. But depending on your broker, depending on the fees, also known as gas, etc., stuff like that, okay, then you're going to be able to calculate the amount of slippage that you may have to pay for. Okay, and slippage is pretty much going to associate itself with fees. So slippage, say you make $500, okay, you might withdraw $480, okay, due to the fact that the other $20 would have to go to the slippage. Okay, so that's slippage, for example. So why is volume crucial in the first place? So for crypto traders, volume isn't just a number. It's a validation signal that confirms the strength of a price move. So for instance, if you see on the order flow chart or the flow chart in general, and you're intending to play within a bullish direction, right? You're intending to long the market, and you start seeing a bunch of buying coming in, then you could kind of put together with your technical analysis along with the flow chart. Okay, if you start seeing volume, especially buying volume coming in, then you can go ahead and be like, all right, you know what, I might be right, and go ahead and take a trade based off of that. So it can be some good validation to come in because you're going to see other people making trades. Okay, so it's going to be a level maybe everyone might be waiting for. And if you see a bunch of volume price coming in in your intended direction, then it could mean that that's a good level and you're most likely right. So price increase or decrease is far more meaningful when it's accompanied by high volume. Without this confirmation, a price change could be fluke or the result of a single large transaction, also known as a pump. So that can be unsustainable, and certain high volume tokens grow year after year after year after year. But if you just see a bunch of selling coming in, for example, on like a meme coin stock, then that's what certain coins, like such as the pump and dump or rug pull coins, that's where those terms come from. Okay, so volume gives us a window into the market consensus and what's going on. So give us an example here. So the bull trap. So imagine Bitcoin price rises 5% in 1 hour, but the trading volume is unusually low for that time of day. A savvy trader would be cautious, and this low volume price surge could be a bull trap, and a false signal is designed to lure buyers before the price collapses. The lack of the significant volume indicates that not many people are participating in this price move, suggesting it lacks genuine market support. So volume can help you with confirming certain price trends. Okay, so a strong upward trend is going to be confirmed by increasing volume on up days and decreasing volume on down days. And this shows that the buying pressure is strong and consistent. Conversely, a downtrend is confirmed by high volume during price drops, indicating strong selling pressure, for example. So volume can also help you identify reversals. So when a market has been in a long downtrend, a sudden spike in volume as the price starts to rise can signal a potential reversal. And this is often the first sign of institutional or smart money entering the market, absorbing all of the selling pressure. And it can help you validate breakouts too. This is also going to be something I've talked about quite a bit on my channel as well too, when it comes to breakouts or certain levels. Confirming it with volume, confirming it using the order flow chart is really going to go ahead and help you out. Okay, you can also look at your order book tape, whatever you want to look at. And volume can help you validate breakouts. And a breakout is going to be when price moves outside of a defined resistance or support level. And a breakout with high volume, which means a bunch of people are intending to trade in that place too. So a breakout with high volume is considered a genuine and sustainable move, while a low volume breakout is often considered a fake out or false breakout, likely to reverse quickly. So if you don't see tape going crazy, order flow going crazy, whenever price hits a certain breakout level, it's most likely not going to happen. Okay, so that's one of the main things that people use in order to trade breakout levels. So analyzing volume in practice. So understanding trading volume isn't just looking at a single number. It's about interpreting its relationship with price and other technical indicators. And traders often use visual tools like volume bars on a chart to identify patterns and anomalies. And this allows them to see how volume is distributed across different price levels and time frames. So volume profile. Volume profile is an advanced tool that shows the total volume traded at each specific price level rather than over a period. And it helps identify areas of strong support and resistance where a lot of trading activity has occurred. Okay, so it's going to be a bunch of lines, and it's going to be showing you longer lines, okay, and short lines where there's low volumes. Okay, so on the volume profile, if you turn it on, trading view, wherever you want to turn it on, it doesn't matter. Okay, the shorter lines that you see is going to indicate low volume. When you see those long giant lines on the volume profile, that's going to indicate high volume. A lot of people are trying to get it right there. Okay, it's a very probable area, and it's a successful area. So on balance volume, OBV, the technical indicator that adds or subtracts daily volume based on whether the price has moved up or down. And a rising OBV alongside a stagnant price can signal hidden accumulation by large players, and that's a bullish sign. And volume price divergence. This is a powerful signal. If an asset's price is making new highs but the volume is declining, it's a bearish divergence, suggesting that the uptrend is losing steam, people are selling off, and a reversal may be near. The opposite is true for a bullish divergence. So for example, here's how to use divergence to predict a reversal in hindsight, inshallah. So a trader notices that Ethereum's price has been steadily climbing for weeks, right? Or, you know, we'll say Stackmode stock. So a trader notices that the Stackmode stock has been steadily climbing for weeks, reaching new all-time highs. Let's say the Stackmode stock is at $800 a share, okay? However, they observe that the daily trading volume has been consistently lower with each new high. Okay, so investors are starting to sell off. So the trader then recognizes this volume price divergence, okay, and anticipates that the upward momentum is weakening and that they might decide to reduce their position as well. Okay, just like the big investors, they're starting to slow down their positions, trim off, okay, sell off. No one's about to hold infinitely, okay, take off some money. And they also might decide to reduce their position or set a tight stop loss order or trailing stop loss order, correctly anticipating a potential price correction. Okay, so if you're anticipating that Stackmode stock has hit the top and that volume is deciding to slow down, aka meaning that buying is slowing down, okay, so volume can increase to the selling side, okay, and then you could go ahead and trim off your stock, trail your stop, and do what you need to do depending on your certain parameters. You should know your entry, exit, take profit, and stop loss before you put a single dime into the market. Don't do anything related to gambling. Make sure you're extremely informed of what you're doing. So the dangers of playing things with low volume. One, slippage. Okay, trading things with low volume, you could potentially buy all the crypto coins. If you have enough money, you could definitely buy like all of a meme coin or something like that. And if people aren't investing to it, it's going to be hard to sell off their remaining shares, and it's going to be a lot of slippage involved in that too. So low volume, you might not get your orders filled. And trading in a low volume market carries significant risk, and a lack of liquidity can make it difficult to enter as well too. So not only can it make it difficult to exit, like I just spoke about, but even to enter. So you might be like, why am I not getting filled? AKA, like, why am I putting my money in and I'm not getting my asset? Okay, that's because there's not a lot of orders available. So volume is going to be a good thing to look at before we throw our money at something, okay? Because you might buy all of something and you might not be able to trade. Say stock options, for example. You can buy all of a stock options contract, and if there's not enough volume, there's going to be almost no one to sell it to, okay? And you're going to be stuck with contracts. So something that I've gone through before, okay? And I then had to understand that's why people buy shares. So there's going to be times where you buy shares, and there's going to be time where you trade options, for example, okay? So try to trade things with high and decent volume. So let's talk about slippage in the first place. Let me break it down. So slippage in a low volume environment, placing a large market can eat up all the available orders on the order book at a certain price level, forcing your trade to be executed at a worse, higher price. Okay. And this difference is slippage. Okay. So pretty much you're gonna be paying more money for something. So you're gonna be losing money at the end of the day. And that's not what we want. So slippage is gonna be a frustrating thing, and to avoid it, try to play things with decent or high volume. So price manipulation. A single large buy order in a low volume market can cause a massive price spike. So once again, the rug pull scam, for example, or pump and dumps. Okay. People have Discord chats. Okay. They run ads, they do whatever. And then from there, they own a large majority of the meme coin, for example. Okay. Let's say they own 70% of it. And these are things you can go and check on certain brokers as well too, where you can see who owns a percentage of a lot of the meme coins. So let's say they got it at the bottom, okay? And they own 70% of it. So they own majority of the volume. It's already not worth anything. So they own majority of the volume. So they start posting ads, they start paying influencers, maybe hacking influencers, doing what they need to do. Okay, it starts getting some popularity. People start investing into it, thinking that they're about to make some big money in something that has no future context, isn't helping anybody, isn't putting a smile on anyone's face. But for some people, they want to come into the market thinking that it's a get rich quick scheme, and you're going to go ahead and get your bread snatched just like that. So while people are fiending, excited, thinking that they're about to make some money, the people who created the meme coin are in at the bottom, hold 70% of the share. And by the time it starts getting popular, by the time people start investing in, starts going in an upwards direction, they're going to go ahead and take that profit. Their profit's going to be disgusting because they already have a large majority of it. And it's kind of like a reversal IPO. So if this is like how the stock market works, let me go ahead and break it down. So before the stock market can even hit the public, someone has to buy all of the shares in private. And crypto is subject to a lot of manipulation because you don't have to do that. Okay, so the creator can be a participant. And same thing for the normal stock market too, but it's a lot less manipulation involved because someone has to buy all the shares prior to it being available to the public. So you can't get robbed as easily as you can someone just creating a meme coin and saying it's going to be the best thing of all time. So be careful following anybody too. All right, be careful following anybody. We're all human beings. Okay, a lot of people are flawed. I'm flawed. Okay, so whenever people are trying to prospect something, study it. Okay, see if it's putting a smile on people's face, see if it's making money. Okay, if it's not something that's going to be here for decade after decade, something that's bringing future value, something that's progressing the world, whether it be at a human level or at a physical level, okay, or transactional level, just forget it. It's not worth it. Okay, investing in Pepe, the fraud coin, is not going to make you a billionaire. Okay, there are billionaires from people who trade United States stock market, who trade consistently, who trade at a disciplined high level. Okay, so when you're trading sheep coin on Phantom, expecting to make some M's, and then you come to me saying, Chris, I'm trying to make some M's trading meme coins, I'm gonna yell at you. Okay, there's no billionaires trading meme coins. You invest in things that have value. Okay, even when I was horrible, I was still able to make money due to the fact that I was investing with things that have value. Okay, there's millionaires who don't even look at the chart due to the fact that they plant their money into things that have value. Okay, instead of spending it at the store, okay, spending it on unnecessary things, you invest, stay down, let your money make your money, and then you can live in overly leisure. Okay, making money in your sleep, making it when you're waking up, making it while you're eating, making it while you're making money. Okay, so put all this together into your trading plan. So technical analysis, right? Technical analysis relies on a broad market participation. In low volume assets, chart patterns and indicators can often be unreliable because the chart is going to be so skewed. A lot of the time in a low volume environment, the market's not even going to look how a high volume market would look. Okay, the candlesticks are going to be all skewed, it's going to be all over the place, and it's going to be something you just don't even really want to be touching for the most part. And they can easily be distorted by a few individuals, which is why sometimes you'll see huge giant like 1 minute candles, or candles that just don't really make sense, for example, especially with something that has no earnings involved. So stay away from certain manipulation, don't get robbed. Okay, and it's a general rule of thumb to avoid trading assets with extremely low volume. And unless you have a deep understanding of the market and its participants, then high volume is going to really provide a more stable and predictable environment for trading. You can still try to catch something at its lows if it has future value. Okay, I'm not saying you can't catch something at the low and catch the whole sweep up. Okay, I really pray you catch that move, but don't be buying sheep coin and thinking that it's going to be the best thing of all time and be profitable. Okay, don't try to compare it to something like Bitcoin or Ethereum that has real world uses. Okay. So trading volume is not just an extra data point. It's a critical component of any comprehensive data strategy and acts as a powerful confirmation tool, helping to distinguish between the genuine market trends and false signals. And by incorporating volume analysis into your decision making, you can enhance your ability to identify strong trends, spot reversals, and avoid risky low liquidity assets and taking unnecessary trades you don't need to be taking. I don't want you guys to be losing money unnecessarily like I went through for a long time. Okay, I want you guys to just start off profitable, and it's really refreshing. It's a real blessing to start off my students and they don't even lose money. Okay, my students, they start off instantly start making money, alhamdulillah. Okay, so do your research, get educated before you put a dime into the market. Okay, and you're gonna save yourself from a lot of struggle. So always check your volume alongside your price action. Okay, look for high volume to confirm breakouts and strong trends. Be wary of low volume price surges. Okay, that can indicate certain things like rug pulls, for example. If you just see like one giant order coming out of nowhere and then the whole market moves, be careful about stuff like that. Okay, low volume stuff can be subject to manipulation. Say for futures, for example, if you're trading crude oil, let me tell you guys about a story. Okay, on my futures account, okay, was growing it very consistently. And I've always been good at making money within the market, but one thing I was horrible at was keeping the money within the market. Okay, my first couple of trades I've ever taken were $600 trades and stuff like that. Didn't withdraw, didn't know what I was doing. Always been good at making bands within the market. Was always horrible at keeping the money or consistently growing it. Okay, and that's what I realized. I had to humble myself, you know, really had to turn to God. I had a lot of ego problems. Okay, I never thought it was enough. Even when I would make $100, $1,000, anything like that, didn't think it was enough. Was always just chasing that M, always chasing the billion, always thinking of the next thing instead of just being focused on my discipline, my process, my consistency. Okay, and then starting 2025, 2024 as well too, just had an extremely consistent year. Focused on a lot of day trading and once again, just making really good money. Okay, but then really had to just think about something. You know, there's people who are once again millionaires without even looking at the charts. So I had to understand that trading is really about a long-term perspective. It's about planning in the future. It's about holding these trades for years and years and years on ends. And there's a reason why there's tax benefits for holding trades for years and years on ends too. Now, day trading is still amazing. I still love day trading. I still love taking like a couple week swings and stuff like that. Still give signals for that. Okay, but instead of me taking that bread, right, instead of me taking that money and going on vacation like I was doing, instead of me taking that money and stupidly going to LV instead of it buying shoes, stupid things like that, right? I could have been reinvesting. Okay, and by that time, and by this time, could have easily been a millionaire. Okay, so this is the whole point of why I created Stackmode. Okay, because I realized if you don't stay down, if you don't hold yourself back from certain things, put yourself in position to be a boss. Okay, and a boss is really staying down and grinding. You don't get that bag and go blow it. You get that bag, you stay down. You don't even think about it. Keep it in the stash and you keep working. You keep praying, you keep working. Okay, I was a kid, was very foolish. Okay, and God humbled me many times, and I'm very thankful because I got to come back stronger and I was able to make the money back 10x. Okay, and was able to keep my account healthy. And now that I know how to grow my account, it's really nice to see my students growing their account, coming back to me with results. Okay, so I just know that my struggle is not for nothing. So thank God. And avoid assets that have consistently low volume, guys. Okay, don't want you guys losing your money. Okay, I know you guys work hard. Okay, frustrating days, frustrating nights. Okay, just keep going, keep pushing, keep investing, keep staying down. I promise you, you're gonna catch the right play. Okay, stay prayed up to God, keep grinding. Head over to Stackmode.net for all trading education. I'll catch you in the next one. Class, today we're gonna be talking about passive income. Let's talk about ETFs. They stand for exchange traded funds. Extremely useful to just go ahead and invest in a safe manner. Let's talk about how we can go ahead and invest and how we can build some long-term financial success. Inshallah, let's go. So what exactly is an ETF in the first place? An exchange traded fund is essentially a basket of securities, like a stock, bond, or commodities that trade on a stock exchange, like a single stock. They combine the diversification benefits of mutual funds with the liquidity of common stocks. So what liquidity is pretty much going to mean the price action, the volume that common stocks have, but it's going to trade safely like a mutual fund. So instant diversification. Buying a single share of an ETF often gives you exposure to hundreds or thousands of underlying assets. For example, a single S&P 500 ETF share grants exposure to 500 of the largest US companies. So as soon as you buy one share of the S&P 500 or one share of QQQ, which is going to expose you to 100 of the tech companies, then you're going to be able to go ahead and invest and diversify yourself off of one singular company investment or an ETF investment. So intraday liquidity. Unlike traditional mutual funds, which are only priced and traded once per day after the market closes, ETFs can be bought and sold throughout the trading day at market prices. And there's going to be lower crosses for expense ratios. Most ETFs, particularly passive index funds, boast extremely low expense ratios for annual fees, making them significantly cheaper than actively managed mutual funds. And this cost saving compounds drastically over the decades. So the concept of instant diversification is central to modern portfolio theory, allowing investors to manage unisystem risks effectively. So if you don't know what companies to invest in, you could just purchase an ETF, which is going to go ahead and instantly diversify you in a whole sector or in a whole sector of companies. So navigating the core ETF universe. So ETFs are categorized based on what they hold and their investment mandate. And choosing the right type is going to be the first step toward aligning your investments with your goal. So we'll talk about passive index equity ETFs, and they track major indexes. So for example, S&P 500, QQQ, YM, and the goal is to really match the market's return, okay? And it's best for core holdings, long-term wealth accumulation, and it's pretty good as far as tax efficiency as well too. When you're also holding positions for over a year, you get a lot of long-term tax benefits too. So keep that in mind whenever you're holding your positions. So as far as fixed income, okay, we'll talk about bonds. So you can hold various bonds, government, corporate, or municipal bonds, which are used to reduce portfolio volatility and provide income, which are most likely best for safer traders, okay, and safe long-term investing. And it's best for capital preservation and retired investors. You can also ETF invest based on certain sectors. So let's say you believe in Bitcoin, okay, there's going to be some ETFs like BTSE, okay, for example, which you're going to be able to invest in, or BTCI, okay. And those ETFs you can invest in if you believe in Bitcoin, for example, and it's going to go ahead and follow that. There's going to be some ETFs that follow gold, for example, okay. So each ETF is going to have its own sector and track its own theoretic things. So it's going to focus on a specific industry if you're going to choose a sector ETF. For example, semiconductor ETFs, renewable energy ETFs, or megatrend. Okay. And it's best for tactical bets, satellite holdings, and investors with high conviction in specific areas. So if you believe that Bitcoin, for example, will be the future, then you could look into crypto or Bitcoin ETFs. If you believe in Ethereum or power grid or AI will be the future, then there'll be ETFs involving strictly technology and AI stocks. So you could choose whatever sector you believe in and invest on that, and look what type of dividends they pay out. Dividends are going to be quarterly income that the ETF is going to pay out back to you, because the more that you're invested into it, let's say you're invested about $1.5 million in SCHD, okay, then you'll get around $60,000 in yearly income, okay, and that's more than the average bachelor's degree job for the most part, okay, so you're going to pretty much be able to live on $5K a month for the rest of your life, okay? And by the time you have that much invested, your house should be paid off, should have no debt, so you're going to pretty much be able to live for free forever just by putting your money in the stash or investing into a certain ETF. So you can select stocks based on specific criteria and different factors like value, momentum, or low volatility, aiming to outperform traditional market cap weighting, and it's best for sophisticated investors seeking risk-adjusted returns. So for example, we'll talk about diversification. So instead of trying to pick the next Apple or the next best stock, an investor can buy a single total stock market ETF, okay, which is a passive index, and automatically own a small piece of virtually every publicly traded US company, diversifying away single stock risk, and you can trade with the whole sector if you just believe in the whole sector, okay? If you believe in the healthcare sector going up, you could trade healthcare ETFs, etc. And it really just puts power back in the trader's hands and lets you diversify your portfolio, but stick within a single area. So defining goals and assessing the risk. So your time horizon and comfort level with market drops are the ultimate deterrents of your ETF allocation. An investment plan without defined goals is merely just speculation. And goal horizon and asset allocation. So for the most part, be looking to trade forever, okay? You're not in this to get into the market, make a bag and hop off, okay? It's not what it is. Business doesn't work that way. The market doesn't work that way. You got to really plant your seed, plant it in the ground, water it day by day. You got to get some sun, okay? Keep stacking cash into whatever you believe in, whatever ETF that you like, okay? Doesn't matter. I'm not going to tell you guys the best one to invest in because there is no best one to invest in. It's whatever you personally believe in, okay? Focus on your investment and keep stacking cash, okay? And you guys can head over to Stackmode.net if you want to learn how to, one, decrease any type of unnecessary finances that you're expending, and two, how you can invest into ETFs and build some passive income for yourself. And this is actually passive income because it's income you don't have to do anything for. You're just stacking cash in a certain area and they pay you out money for that. Because the fact that you're stacking cash in their area, they're going to pay you for that. So instead of a traditional bank taking your money and doing what they want with it, okay, let's say you have 100K in your bank. You can't go to the bank and get 100K in cash. Why? Because the bank most likely isn't going to have that. They're most likely going to only have 20K cash at their location, okay? So the fact that that's in a factor is going to let us know that, okay, what is the bank doing with that money? Why can't they immediately give it to us? They have it invested. So you need to be doing the same thing. So instead of keeping all of your money in the bank, where the bank's just going to invest your money anyways, banks aren't just opening banks to help people out and keep people's money. Okay, they don't, world is not that friendly. Okay, most of the time someone's getting something out of something. Okay, so that's what banks are getting. They're getting capital allocation and pretty much taking your funds and trading with it on the side. So that's why you can't immediately wire transfer out all your funds. That's why on Zelle, there's certain daily limits. That's why you can't immediately send $1 million to someone instantly. This is why something like crypto, right, is becoming so popular, because it takes that centralized power away. You can instantly send however much you want from one person to the next instantaneously without anything stopping it. Just person-to-person transaction, bringing it back to like a traditional barter system, taking the power away from the centralized control. Okay. So make sure you guys are having a balanced approach to clear your debt, okay, pay all your bills, do what you need to do, and then whatever you have left, invest and stay down. Okay, live way below your means. Try to do it for at least 1 to 5 years and stack cash. Okay, it doesn't matter your age. Never think you're too late either. I don't care if you guys are 40 watching this. I have some mentorship students that are as of old age, have kids that are teenagers, etc. Okay, and still just getting into investing now. So it doesn't matter your age. Start today. Start today. Start planting your seed. Okay, if you want to be someone who's chilling in the long run with your family, having money in your bank account, having money in case your kids, your grandkids, or someone needs any type of funds, because life happens. Okay, let's say someone's house blows up or something like that. You know, instead of them being out and down, you could be able to help them out. Okay, just because of the fact that you invested. And let's say your play hit 500%. Okay, you just be able to take some of that profit and help out your family, help out yourself, and really have an emergency fund for yourself. Okay, your profits is really, really going to be helpful, because whatever you want to spend, it's pretty much going to be canceled out. So the more you invest, it's compounded based upon that. Okay, so the more you invest $1,000, $1,000, it's not just $1,000 being put up like in a savings account, especially when you're in a profitable sector that you're investing in. It's going to constantly compound, and you could see 100% returns. Okay, so $1,000 will quickly turn into $100,000, especially if you keep stacking, investing in something that's profitable. It's investing in an ETF that goes in an upwards direction for the most part, and that pays out pretty good dividends. You're going to be like, okay, cool. And then you're going to start making passive income from the dividends as well too on the side of that. Okay, so make sure you take care of your taxes and just keep reinvesting your profit, keep growing it, and then you guys are going to be able to stop work. Okay, so if you ever actually wanted to stop work, you need enough seeds planted. Plant all your seeds today. Okay, if you ever want to retire successfully, not have to come back, not have to worry about putting in 60-hour weeks, 40-hour weeks, 80-hour weeks, okay, invest today. So let's say, for example, if your first 10,000 is in an S&P 500, for example. Okay, so that's going to give you access to 500 stocks, pretty much just put into jumbled up into one big compound, and that's an ETF. So let's say it dropped to $6,000 during a recession. Okay, you still don't panic sell. Okay, sit on your portfolio. Understand that the goal of these markets are to go in an upwards direction. You shouldn't be trading with money that you're scared to lose. So that's the big reason why people aren't successful in trading too, because they cut their losses. So even if your 10K goes down to 6K, you still shouldn't sell. Okay, you still shouldn't sell due to the fact that, one, you should be comfortable with holding your position for ample months, ample years. You have to know that wherever you bought at, price will most likely blast way past that. Okay, this is why I personally don't like buying all-time highs for a lot of things. Okay, so learn how to read the chart before you just invest if you don't want to get pulled back on. Okay, but I can almost assure you, no matter how much the chart pulls back, I can promise you, inshallah, 99.9% of the time, especially when it's a good ETF that people invest in, price will sweep back up and will break those highs, and it will continue in an upwards direction. Okay, you can check most ETFs, they most go in an upwards direction. Okay, so don't panic sell and lose bread for no reason. And you can lose a lot of money for no reason, just closing early. Okay, you shouldn't even be staring at the charts like that. Go work on your business, go do something, go just improve yourself any type of way. Okay, go get more money so you can come back to the market and keep stacking cash, keep putting into your investment, keep growing your ETF portfolio. So once you know the type of ETF that you need, you got to evaluate the specific product. So performance is going to be imperative and important, but these three metrics are non-negotiable for long-term success. So understand the ER, expense ratio. So this is the annual fee that you pay, and it's expressed as a percentage of your total investment to the fund manager. And lower expense ratio is always going to be better. So a 0.50% ER versus a 0.03% ER can cost you tens of thousands of dollars in loss, compounding over a 30-year period. Why? Because of 0.50% ER significantly higher than a 0.03% ER. Okay, so once again, the lower the percentage, the better. So tracking errors in holdings. So tracking error. It measures how closely the ETF's performance mirrors its stated benchmark index. A high tracking error means the manager is either doing a poor job or taking unexpected risk. And aim for an error close to zero, so you guys can get the most stable tracking of whatever stocks or sector that you're trying to invest into. And underlying holdings. Always check the ETF prospects. So does a global technology ETF contain the companies you expect? Does it have big dogs that move the market? Or is it overly concentrated into one stock? Okay, look at the top 10 holdings to understand the actual exposure of what the ETF is investing in before you put your money into it. And liquidity and assets under management, AUM. While ETFs are generally liquid, smaller new ETFs pose risk and prefer ETFs with high AUM, assets under management. So for example, 1 billion plus and high average daily trading volume. So you know people are going to be constantly investing into it, lots of flow being put into it, lots of money being put into it. And this ensures that you can buy and sell easily and that the fund is unlikely to close down. And it's a process that can be costly and inconvenient. So building a robust portfolio utilizes the core satellite approach and incorporates global exposure to maximize diversification and capture returns from different economic cycles. So the core, 70-90%. So this is going to be the foundation consisting of low-cost, broadly diversified, passive index ETFs. Okay, so a lot of the times, okay, even for my day traders, let me talk to y'all real quick. So even for my day traders, if you check your max at the end of the year, even if you're really good at day trading, a lot of the times it's harder to perform or outperform somebody that's just stacking cash in an ETF. Okay, so really take that into account. All the losses you have to take into account, the emotional imbalances, the swings, the anxiety. So think about it like, okay, is it really worth it? And you have to really put into a chart, look at your max, be realistic with yourself. And if you think that passive long-term investing is going to be a better way to become more profitable, and that's what you need to swap to. Day trading is not working out. It's time to swap it up and take the risk off, and let's actually make some cash. So the satellite, 10 to 30%. So this is where you introduce higher risk, potentially higher reward ETFs, like factors, smart beta ETFs, or crypto ETFs. And you could also buy sector ETFs too, like technology ETFs, for example, or biotech ETFs. and these allow for calculated tails without compromising the portfolio stability. And global exposure, developed versus emerging markets, and don't limit yourself to US and domestic ETFs only. A fully diversified portfolio includes international exposure if you would like, which historically does not move in lockstep with the US market, offering critical diversification benefits. So you can also invest in other countries' ETFs like Japan, Europe, Canada, Brazil, China, India, etc. Okay. And this way, in case the US dollar becomes worthless and the US stock market starts suffering, then you can be invested into a whole other country's ETF. Or if you believe in a country's development, like let's say a lot of countries in Africa, for example, are starting to be powered super heavily by a lot of China's development. So ETFs for Africa, for example, might go up in an upwards direction since the economy is going to be looking in a bullish scenario. So section 6, all right, practical allocation in the final checklist. So putting it all together. All right, let's talk about these two examples here. So let's say a young investor, right? Say they're around 25, okay? They're looking to invest long-term, okay? Let's say they have 60% in core equity ETFs, okay? So they have QQQ, okay? They have 60% in QQQ. They got 20% and some international equity, okay? Let's say they have it in some China ETF, okay? Because they believe in their economy. Then core bonds, okay? Or some crypto ETFs, okay? So you can go ahead and invest like that too. Now, dividends, especially as you get older, because one, you can't expend as much as your energy for money. So as you get older, I really, really highly recommend you guys start looking into dividends. Do your research on that and do your research on dividend ETFs that pay well and are stable, okay? Because the ones that pay well and are stable is what you're going to want to be looking towards, especially as you get to the ages like 50, 60, 40 and stuff like that. You can't work all the time. Okay, it's not realistic. Your kids are going to be doing stuff, okay? Family's going to be doing stuff. And even if you don't have a family, okay, your body is not going to be able to handle the amount of turmoil, stress, and fatigue that you were when you were younger. Okay, so you got to make sure your income's making you income. Just prepare for the future. Okay, your older self is really going to thank you for doing the work today. So ask yourself, does the ETF align with your time horizon? Okay, do you want to invest in that ETF for decades? Okay, is this something you want to be in for a couple of years, take some profit? Okay, ask yourself. And is the expense ratio below 0.10%, okay, for broad index funds? And does it have high AUM? Okay, over $500 million is going to be a pretty good value to look at for a daily trading volume, at least. And does the tracking area demonstrate a tight correlation with the benchmark? And do I understand all the underlying holdings, okay, with no hidden surprises, no downturns, and just making sure that it's a consistent ETF I can invest in and safely keep my money in. All right, if you want to learn more about ETFs, diversification, and investing, head over to stackmode.net. Stay prayed to God, keep running. Catch you guys in the next one.
Whoa! Another episode of Coop Talk. It's cold like Minnesota outside. May God bless y'all. I pray y'all are doing straight. Want to talk to y'all about a very sensitive topic. What are you trading for? Are you trading for family? Are you trading to just ball? Are you trading to clear your debt? Because there's different styles of trading and investing for everything. But at the end of the day, you're looking for income, I assume. Okay? We're all in the markets trying to make some income. But the income is not going to be the end all be all. You don't just get that income and ball out and that's life. You know, yes, balling out is amazing, but don't lose your family values. Don't lose yourself as a person. When you start touching the income that you want to be touching, it's really important to stay intact with yourself. Okay. What are you trading for? Are you trying to own a bunch of real estate? Whether it be duplexes, multiplexes, multifamilies. Excuse me. Ask yourself, why? Why are you trying to run up these bands? Why are you trying to run up a surplus amount of income? Because it has to be channeled. It has to be channeled. Okay, right now, for example, right, God forbid, let's say you're a drug addict. If you're a drug addict, right, and you're a heavy drug addict, once you start getting more income, what do you think your money is probably going to be directed towards? More drugs. If you're addicted to buying clothes, what do you think your money is going to be directed towards once you get more money? You're going to start buying more clothes. So if you're an investor, you're going to call yourself an investor, you need to focus on keeping your money in an asset river. Okay, once you touch that big bag from the markets, what are you going to do with it? Do you want to buy real estate? You want to buy yourself a house? Do you want to pay your mom's bills? Pay your loved ones' bills off? So you got to really have a talk with God and talk with yourself. Because I'm telling you, when you start touching the money, it's different. You know, yes, you're going to be able to live in peace, but don't forget you also have to pay taxes. But when you start touching the money, it's really important to not lose yourself. Okay, direct your focus and your income will flow in that direction. Okay, if you're really into fitness, you could potentially build gyms if that's what you want to do, or build yourself your own personal gym in your house. Okay, put a sauna in your house. Don't indulge in sin when you start touching the money. I'm talking to my younger crowd for sure. I've done it, living the high-rise lifestyle. I did it for a couple of months. And I'm going to tell you right now, if you're a God-fearing person, if you're a grinder, someone who's just focused on their work, you just wake up, pray, you grind, take care of your loved ones, you really hold it down, focus on bettering yourself, improvement, and being a provider. Environments like that where you're around partying, drugs, sin, infidelity, etc., it's not going to be really positive for your mind frame. Okay? So if you touch the big bag, even if, let's say if you're in your hood right now, right? Even if you're in the hood, right, and you're looking on YouTube, you're seeing people in Miami, you're seeing people on the boats do this, whoop-de-whoop. Take a vacation, experience it first. But don't overly glorify that lifestyle. Take a Lamborghini, for example, seeing the guy with the lamb. You don't see underlying issues. There's tons of stress I go through outside of finances, okay? So you don't see underlying issues when it comes to social media and certain things like that. So when you touch the big bag that you want to touch, when you start making the income that you want to make, it's really important to, one, stay focused on God. I'm not just talking about God for no reason. It's because, one, I've made mistakes in the past, right? And I pray God can forgive me. And I don't want you guys to go through those same mistakes. And I don't want you guys to go through mental spirals of, whoa, this isn't really what I thought it was. You might want to go towards maybe some farm life. Just a calmer, more decent life. You can still go nice car, get you a Porsche, just something chill. But you don't gotta have 10 cars. You don't gotta have 5 Ferraris, 3 SRTs, 2 Bentleys, and the Lamb. Like, you don't have to have that. You know what I'm saying? And then a Benz, and then 5 Maybachs. That's not what you want in your life, ideally, stress-wise. It may look good, but who really cares what people think? You got to stop caring what people think, too. When you touch that big bag, please do not do things to pop it, to flex, because of people. I don't care if it's old people in the past, old friends, whatever. Oh, I'm going to go ahead and run up this money and pop it on them. I did it when I was 18. Okay? I went through it. My first car was an Audi. It was an Audi A4. 2014, something like that. 13 maybe. And someone crashed into it while it was parked. Thank God, that taught me a lesson. But during that time, it made me very arrogant, and I repented to God. But, just after all the years of getting bullied and stuff like that, finally be able to have something and people look towards, me for some type of motivation. But I realized it's not about the materialism. Even if you do pop up nice car, try and give some game. Try and give some game so they can get one too. Don't put yourself over people because you have more materialistic items. This is a fleeting world, and we'll all be judged as human beings by God. Okay. So just because you caught the lamb, don't start popping it on people that you used to know. Don't start poo-pooing on people. Don't start treating people bad. Don't start putting yourself in a negative mind frame too. Like, oh, this lamb isn't good enough. I've gone through that. You know, even with the coupe I'm in right now, I'm in the Mustang coupe. You know, it's cool. It's cool. It's stay down. After the Audi, I decided, you know what, I'm going to go ahead and downgrade a little bit, pay a little bit less insurance, and not really care what people think. And the kids still smile when they see this car. I think it's pretty cool. My wife thinks it's cool. My family thinks it's cool. So I'm not tripping. But I'm not over here posting every little thing, posting my car all the time. You know, even inshallah, if God wills, if I do cop a better car, like a Benz or a Maybach or something like that, the whole channel is not about to be back about the Maybach. I'm not about to make my whole life about the materialistic item that someone could crash into and it could be gone in 2 seconds. Okay. Is it nice to have? Is it a blessing? Absolutely. All credit to God. Thank God we have the wisdom and the strength to be able to enjoy this world. Okay. Especially as we grind, get more resources, work harder, hit more trades, stack up more income, and invest. We'll be able to do more. Okay. But don't lose yourself when you touch that big bag. Please. 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 It's really important. Keep God first. Okay. Even when you start touching 5 figures a month, 6 figures a month, don't forget about taxes too. But keep yourself mentally focused. Do not lose yourself in sin. Do not start living in a super unrighteous lifestyle. For example, you know, I'm not better than anybody, but I don't drink alcohol, for example. Okay. And just being around people who constantly drink alcohol, it's not for me. It's not for me. And if you're someone who likes to be focused, if you're thinking about moving to a high-rise city type of life, and right now you're maybe in like the suburbs or more of a rural-ish area, what you have is a blessing. Please understand that. I just moved to Las Vegas, and I tried out the city of Atlanta. And I still like living in rural areas more. Okay. I tried the city life, guys. It's not for me. It's not for me. And for a lot of you guys who are just focused, tunnel vision, focused on providing for your family, focused on God, don't think that type of lifestyle is going to be for you guys either. Trying to have 5 cars just to post on social media. Whole time you got 5 insurances. You got 5 different people who could break into 5 different cars, or someone could try and break into all your cars. You got items to keep up with in all your cars. You got people asking to borrow, yo, can I drive this today? Yo, I got this. Yo, oh, you're not letting me drive the car today? You could fall out with your family. A lot of this comes with underlying stress. So I just want to keep it real with you guys. Okay, please. Just wake up, pray to God, work out. Working out really helps you channel your energy, your direction, especially so you're not talking to your loved ones or anyone disrespectfully. Let's say you have a bad trading day. Let's say you lose like 5K in a day or something like that. You don't want to be storming around the house grouchy, everything about money all the time. You're treating your family bad because you just lost. Chill. Don't lose yourself. Relax. Okay, you could lose all account. Don't crash out on your family or yourself. Don't put yourself into mental desperation. Please don't commit suicide. Okay. And please just try and keep yourself focused on God. Don't grieve your spirit so you don't go through depression. Because this money stuff can get deep. Especially when you start balling and then whoosh, God takes it all. Okay, because if you fall into sin, you will get the results you deserve. Okay, anytime I fell into sin, God forgive me, I got the results I deserve. Cars taken away from me, luxuries taken away from me. And thank God I was able to be focused and get it back. Okay, all credit to God, alhamdulillah. So this journey is going to be a long, beautiful one, but I just want you guys to be conscious of what can happen when you do start touching certain levels of income. Don't change yourself. Don't lose yourself. And don't let the income affect your life to the point where you just don't even know. Okay? Got a call there. My fault, guys. But the income, don't let it make you. You make the income. Okay? Take care of your family. Take care of yourself. Okay? Especially if you're a provider. Let me talk to you guys about this too. If you're a provider, let's say you're someone who takes care of your family and yourself, etc. Have some time for you. Do the things that you like to do. Take care of your mental health. Because especially as a provider, you can really lose yourself and everyone else, making sure everyone else is okay. Make sure you're okay. Okay, take care of you. You ball out. Okay? Don't overly pop it and lose all your money. You know what I'm saying? But get yourself a nice meal. Get yourself some new clothes. You know what I'm saying? Cut your hair. Get your hair done. You know what I'm saying? Do your thing. Do yourself. We're human beings. You know, life is, you know what I'm saying? It's more than just money, 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 money. So don't lose yourself. Yes, we're getting this income to make sure we're good. Make sure we can chill out, do what we want to do. Thank God. But at the end of the day, take care of yourself. I've lost myself a few times in the grind. I'm not going to lie, guys. I've lost myself a few times in the grind. Was my work always consistent for the most part? Yes. I'll say that. Was my income always consistent and going in an upwards direction? Yes. But was my mental health always in the right place? No. Was my physical health, you know, I was in shape weight-wise, but as far as my other external factors or internal factors, like my kidneys and stuff like that, not drinking enough water, I had to quit soda, a lot of certain things, you know. So just maturing and growing up is really just teaching me a lot of lessons, and I just want to come on here and just give you guys some just warnings and just let you know what I've gone through, just so you guys don't go through any hardships and any hard times. Just stay focused on your family, your loved ones, and most definitely God. And I promise you'll probably have a good life. Yeah. I love you guys so much. Catch you in the next one. Head over to stackmode.net. Peace.
What's going on, class? Today we're going to be talking about flash loans in decentralized finance. That's what DeFi stands for, if you're curious. What they are and how they work. Let's jump into a deep dive into decentralized finance's most atomic primitive. So, defining the flash loan primitive, the power of atomic transactions. Some key characteristics. So, it's based off of atomic execution. The entire process, borrow, use, repay, must happen in one single non-divisible blockchain. Transaction block. If any step fails, the entire transaction is reverted as if it never happened. It's also going to have a zero collateral requirement. And unlike traditional or most decentralized finance loans, no upfront collateral is required, making them accessible to anyone with sufficient gas. And gas is going to stand for fees within the crypto world, if you ever see the term gas. To execute the smart contract is going to be an autonomous contract in which the crypto system works off of. So instead of having middlemen like the bank systems confirming whether or not transactions can approve or decline transactions, the cryptocurrency system runs off of autonomous contracts that work automatically, calculate transactions, and confirm them on the blockchain as well too. An instantaneous repayment. The loan tenor is less than 15 seconds. The time it takes for a block to be mined on Ethereum. Okay, so it's going to take 15 seconds to mine a block of Ethereum. And the borrowed funds must be returned within the same block. And citing the source, flash loans were popularized by protocols like AV, formerly ETHLend, and DIDEX, and the mechanism relies entirely on the deterministic nature on Ethereum's virtual machine, okay, also known as EVM, and transaction automacy. And the mechanics, how a smart contract manages payment and repayment. So the borrow, execute, repay sequence. So the code execution is handled by a sophisticated smart contract deployed by the user. So this is going to be the back end of how certain cryptocurrency structures are going to be ran. This is going to be the code and calculations behind everything, which is called the flash loan pool contract. So the 3 stages within one block. So this is going to be for the borrowing call. The user's contract call is the lending pool, okay, requesting X amount of dollars in assets, okay, for example, DAI, for example. And then the execution phase to get an example, okay. And the lending pool transfers the dollar amount to the user's contract and simultaneously calls the user's contract defined function, okay. For example, execute operation, parentheses, okay. And this is where the user's logic runs, okay. For example, arbitrage swap, okay. And repayment check. Once the user's logic completes, the lending pool check its balance and it must have received the original dollar amount plus a small fee, okay. Typically a 0.9% back, okay. And the reversion guardrail. If the repayment check in stage 3 fails, aka an insufficient funds return, for example, the entire transaction, including stage 1, 2, and 3, is going to be reverted by the EVM, the Ethereum virtual machine, and the state of the blockchain remains unchanged. And the automaticity is the security feature that prevents lender loss. So a primary use case, decentralized arbitrage and capitalizing on price inefficiencies across DEXs, okay. So DEXs is going to stand for decentralized exchanges, if you're curious what DEXs stand for. So arbitrage is commonly and one of the most intendedly used things within the decentralized exchange space. And flash loans provide the instantaneous, enormous capital required to exploit tiny temporary price differences across decentralized exchanges. So here's an example of some arbitrage for a single transaction. So let's say you borrow 10 million, okay, in USDC. Okay, USDC is going to be a stable coin based off the fiat currency in the US, okay, and the US uses the US dollar, so that's where USDC is going to be based off of from, okay. And the stable coin's purpose is pretty much to be like the fiat currency's version of cryptocurrency's reserve, okay. So yeah, cryptocurrency is pretty much just trying to make its own stable dollar that doesn't change and fluctuate too much, unlike other cryptocurrencies. So, for example, let's say the pair USDC / Ethereum, okay, is 3K on Uniswap, okay. So that's DEX A. Then I'm gonna go ahead and say USDC is $3,005 on SushiSwap. All right, so that's gonna be $5 more, okay? And we're here to invest, so we're here to make money. So we want to be getting the cheapest prices possible, inshallah. So let's say that's DEX B. So execution 1. So you can use 10 million USDC to buy Ethereum on Uniswap, okay? That's gonna be DEX A for $3,000. And then execution 2, you can immediately sell the acquired Ethereum for USDC on SushiSwap, DEX B, netting a profit. Okay, so you want to make sure that you're buying on the cheaper broker, okay, and then you could sell on the most expensive broker, and you could go ahead and make a profit. And if you want to make a certain amount of profit, let's say 10 million, for example, okay, let's say you take 3,000, okay, 5, okay, and then take that by the 3,000, okay, minus the 10 million, and it's going to give you a 16,666 gross profit, okay, and repay the $10 million USDC plus the fee, okay. So for example, $9,000 to have, okay, the original place where you bought the USDC from or borrowed it from in the first place, and the remaining profit, okay. So you have to take whatever you locked in minus the fees. So that's going to be the 16,000 number minus the 9,000. Okay. And then that's going to go ahead and be your net profit. So if successful, the block is mined. And the speed and scale of the flash loan execute the trade so fast that the price gap cannot close before the profit is secured. And it's a feat impossible with traditional capital. So advanced use case. Okay, collateral swapping and refinancing. So managing risk and optimizing debt positions. So beyond simple profit making, flash loans are crucial infrastructure tools for managing complex DeFi debt positions and risk. So collateral swapping, risk mitigation. So a certain scenario here. Let's say a user has a loan collateralized by Ethereum, but expects the price of Ethereum to drop sharply. Okay, let's say Ethereum's at 5K, and they think it's going to drop down to 3K. And the user can flash loan the debt amount, okay, pay off the original loan, withdraw the Ethereum collateral, swap the Ethereum for a stable collateral like DAI, for example, and then repay the flash loan and recollateralize the loan with the new stable asset, all in one transaction. The user can mitigate liquidation risk by swapping volatile collateral that fluctuates a lot for stable collateral without ever needing to close their debt position entirely, making your profit being able to be there, and then your profit's not going to be moving much afterwards, inshallah, because you're going to be investing in something stable. So refinancing, so rate optimization. So users can use a flash loan to instantaneously repay an existing loan on protocol A, which has a high interest rate, and immediately take out on an equivalent new loan on protocol B, which has a lower interest rate, all while preserving the original collateral. And this is known as debt migration. And the dark side, flash loan attacks and exploits, the vulnerability of price oracle manipulation. So while the flash loan contract itself is secure, the lender funds are protected by reversion, and the ability to access massive temporary capital exposed other protocols to sophisticated attack vectors, primarily through price manipulation. And how flash loan attacks work. So target vulnerability. The attack exploits a protocol that relies on a single low liquidity DEX or an easily manipulated on-chain mechanism to determine the price of an asset, okay, the price oracle. And the capital injection. The attacker uses a flash loan to buy or borrow a huge sum of the token. Okay, let's say for example 50 million. Okay, so just like we talked about, you could borrow 10 million of USDC. Let's say they try to get 50 million, okay, for a flash loan, and then price pump. The attacker dumps the 50 million loan worth of the token, okay, into the DEX, dramatically inflating the price of the token, okay, which the vulnerable protocol uses as its price oracle. Okay, so they're gonna go ahead and dump 50 million into token X, and that's gonna inflate the price of token Y. And the attacker then uses the artificially high price of token Y to borrow massive amounts of other assets from the vulnerable protocol, often exceeding the value of their collateral based on the manipulated price. And repayment and profit. The attacker repays the initial flash loan plus fee and keeps the huge surplus borrowed from the now drained victim protocol. And defense. Protocols have largely countered this by adopting robust, time-weighted average price, also known as TWAP, oracles that are resistant to single transaction price swings. So summary and future outlook, okay? Jump into it. So here's a quick summary of flash loans. Flash loans are not inherently good or bad. They're powerful, neutral financial tool built on the unique properties of blockchain atomicity. Some key takeaways for the class. An uncollateralized loan that exists only for the duration of a single atomic block transaction, okay, and has security mechanisms. The lender is protected by the Ethereum virtual machine's atomic transaction reversion if repayment plus the fee fails. And some legitimate uses: arbitrage, debt refinancing, collateral swaps, and self-liquidation mechanisms are all going to be some uses for flash loans. And vulnerability is also going to be subject to play. They expose protocols with weak price oracles to manipulate and exploitation, so be careful. So the future of atomic finance. Flash loans have paved the way for meta transactions and complex financial maneuvers that treat multiple DeFi operations as a single unit. And their continued presence is essential for maintaining liquidity and efficiency in decentralized markets. Stay ready to keep grounding. Head over to Stackmode.net for all trading education. I'll catch you in the next one. Peace. What's going on, class? Today we're going to be talking about dividend ETFs, and this is going to be a way to passively generate income every single month if done correctly. This is going to be the guide to unlocking consistent cash flow through exchange traded funds, also known as, once again, ETFs. Let's jump into it. So how do dividend ETFs function in the first place? So the collection and distribution process. So let's define the roles of each thing. So the individual stocks, companies like Coca-Cola or Verizon, for example, pay dividends, okay, which is quarterly money that's paid out to people who own a good percentage of shares, which is going to be something purchasable in order for you to be part of the company's infrastructure. Okay, so the more shares that you own, the more power that you'll have within the company, okay, whether it become voting rights or the dividends that they pay out to you. And usually quarterly dividends are paid out to their shareholders from their profits, because the people who bought the stock in the first place helped the stock go up, so they get some money back. That's pretty much how it works. So the whole point of stocks going on the stock market in the first place is so stocks can generate more income and advance the company, and then people can get paid for that. Okay, so the ETF manager holds shares of these individual stocks, and the fund receives dividend payments throughout the year. And the ETF collects all these payments and distributes them to ETF unit holders. And they often smooth out the quarterly payments they receive into more consistent monthly payments for the investor. So the passive advantage, the index following. So class, most dividend ETFs are passive, meaning they track an index, also known as an index of dividend aristocrats. Okay, so for example of that, this drastically reduces management fees and risk of human error compared to actively managed funds. So for example, the ETF receives $1 a share from, let's say, stock A. Okay, stock A is going to be Stackmode. Okay, so let's say Stackmode stock is going to be stock number A in January, and $2 a share from stock B. Okay, let's say stock B is Ben Corporation. Okay, in February. Instead of passing on $3 in March, the ETF might distribute $1.50 in February and $1.50 in March for better cash flow consistency. Instead of you getting paid different amounts every single time, it spreads it out quarterly, so then your earnings is going to go ahead and be paid out within a more spread and even amount. So advantages for passive income investing. Okay, diversification is going to be a big one. Okay, you might be in crypto, other stocks, or you might be a day trader. Okay, well, putting your money into passive income is going to be the goal. Money's a tool. Don't forget, it needs to be used to be making more money at all times. Stay down, stack up, don't buy anything you don't need to be buying, and invest. It's time to get rich. It's time to get wealthy. And dividend ETFs solve several key problems faced by individual dividend stock pickers, making them ideal for long-term, low-maintenance portfolios. And core benefits: instant diversification. A single purchase provides exposure to dozens of companies across multiple sectors. For example, utilities, consumer staples, and finance sectors. And if one company cuts its dividend, the overall ETF payout is barely affected. And ETFs trade like stocks on major exchanges, offering high liquidity, which means there's going to be a lot of people trading them, lots of volume, okay, lots of money being flowed in and out of them, and you can buy one share as little as $50 to $100 and immediately be diversified, unlike mutual funds that often require high initial investments. And investors can utilize a dividend reinvestment plan, okay, to automatically purchase more fractional shares of the ETF with every dividend payout, accelerating growth through compounding. And ETFs require virtually no maintenance. You don't need to monitor the financial health of the 50 different companies. The fund manager handles the portfolio selection and balancing for you. So classification of dividend ETFs: high yield versus dividend growth strategies. Dividend ETFs generally follow one of the two investment philosophies, catering to different investor needs: income now versus income later. So let's jump into high yield ETFs class. So the goal: so maximizing current cash flow typically offers the highest dividend yield. Okay. And holdings: often composed of real estate investment trust, master limited partnerships, and high dividend utilities or finance stocks. And trade-offs: high yield ETFs, which are more income focused, have a lower potential for stock price appreciation and often higher sensitivity to interest rate changes. So here's the difference between that and dividend growth ETFs, with total return focus. So the goal of them is to find companies that consistently increase their dividend payouts year after year, which means that the company is making more money year after year, and they want to pay out more of that money to their shareholders to just show that the company is healthy. And holdings, okay? So often financial stable, blue chip companies with durable competitive advantages, okay, for example, dividend aristocrats. and the trade-offs for dividend growth ETFs. Okay, lower starting yield, okay, often less than 3%, but it has better long-term total returns due to the price appreciation. And a lot of times you want to be trading on the point of where you're not trying to lose money, okay? So you want to be trading the safest options possible. And the choice depends on your investment stage. And retired income investors usually prefer high yield, and younger investors prefer dividend growth. So crucial metrics and risk, and understanding yield, fees, and market volatility. So successful dividend investing requires looking beyond just the headline yield number. So some key metrics to evaluate: dividend yield, the annual dividend yield payments per share divided by the current share price. And a yield above 6% is often a warning sign of potential future dividend cuts. And the expense ratio, also known as ER, the annual fee that's charged by the fund manager expressed as a percentage of the assets under the management. So class, so you can look for ERs below 0.20 cents, okay, and 0.20% for passive funds. And the fee is always automatically deducted. And the day you must own the ETF share by the entitled time is going to be the time you're going to be able to receive the next distribution payment. Okay, so you must own the ETF shares to be entitled to receive the next distribution payment. And some principal risks. Interest rate sensitivity is going to be something to think about. So there can be a bond equivalent trap sometimes. And when interest rates rise, set by central banks, okay, many yield dividend sectors like utilities, REITs, and telecommunications become less attractive because safer assets like bonds begin offering competitive yields. And this causes the price of the ETF shares to fall, even if the dividend remains steady. And portfolio integration and tax implications, where dividend income fits in your overall strategy. Understanding where to hold these funds and how the income is taxed is essential for maximizing your net return. And tax advantage accounts, let's say Roth IRAs or 401k. And this is the ideal place for dividend ETFs, and all distribution are reinvested or paid out tax-free until withdrawal for traditional or permanently tax-free for Roth, maximizing the effect of compounding. So you can put them in those, but keep in mind that you can't really withdraw your money freely without getting hit by certain penalties. So tax accountable brokerage, and that's just for Roth IRAs and 401ks. So tax accounts, okay, for brokerage, and if held in the brokerage accounts, you must pay taxes annually on the dividend income, even if you reinvest it, okay, to phantom income. And this is necessary if you need the monthly cash flow to supplement living expenses. So tax treatment of distributions. So qualified versus ordinary dividends. If the ETF holds U.S. common stocks for a sufficient holding period, the dividends are often treated as a qualified dividends. Okay. That's the term. And those are taxed at a lower long-term capital gains rate. However, income from REITs, MLPs, and some international holdings are generally taxed as ordinary income. And that's at your higher income tax bracket. And always check the fund-specific tax reporting. And dividend ETFs provide the best blend of income and diversification for the passive investor. All right, step right up to God, keep grinding. If you guys want to learn more about passive investing, you guys can book a free call with me at Stackmode.net. I'm going to catch you guys in the next one. Peace. Cool. So yeah, let's go over some 930 setup. Let's go and let's check it out here. Okay, so we had Uber. See, price went up here on Friday. Had a 4-hour close above it. Okay, so that's extremely nice. I think we might definitely push up to this area of resistance up here. Okay. So with this area here, okay, this was cool. Could see price here. Decided to pass this 930 area of resistance here. Okay, 930 resistance. Price even retested off of it here. We can see on the 5-minute, we had one of these candles here. Okay, price retested off of it. I believe we're definitely going to go ahead and try and fill up to the next area of resistance at the very top here. Okay. So very extremely easy here. Okay, this is going to be like a day trading setup. We're holding these trades for like a couple of days. Okay, we're still going to buy like weeks, months out just for the contract and just in case. Well, a lot of the times these will hit take profit within a couple of days or weeks. Okay, so indicators, we're going to start off with the market open maker. Okay, and we're just focusing on these 930 levels. Okay, that's what really we're going to be focusing on. So Got a 930 level right here. Okay. Another one right here. And one up here, if I'm not mistaken. One down here. Okay. So all of these levels here are going to be 930 levels. Right here. And right here. Okay. Then I can go to my 4-hour time frame. Okay. And that's why we lock the lines. But if I wanted to, I could definitely wait for price to pull back to any one of these levels. Okay. And see if price will go ahead and give me a buy entry. Okay. So I just look below current price. Okay. Set all the 930 entries that I saw. Okay. And if I see price come to this level, give me a bounce up. Okay. That'll potentially be a valid entry. Okay. Same thing with this entry here. Could potentially be valid. Same thing down here. Could potentially be valid. Okay, and if you get a 4-hour close and a sweep up from these areas, then that's definitely going to go ahead and be that. Okay, so just be aware before you just instantly buy. Don't just buy the first wick. Okay, make sure you take your time. Be like, okay, I know what I'm doing. I know what I'm buying. I know what I'm looking at. Okay, so your 930 levels are really going to show you everything that you need to see. Okay, so let's go over another 930 example here. And this is really going to help you trade with the trend, whether it is a pullback scenario or an above current price scenario. Okay, so let's take this stock for example here, bam. So I'll go to my 30-minute time frame, look above current price. And let me go ahead and just start marking out areas where I see 930 reactions. So I'm going to take my line here and mark it at the 930 reaction here too. I'm going to put one above current price at this 930 level here. And this one up here as well. Okay, as well as this 930 up here. Okay, all the reactions I'm going to go ahead and put in. Just so we know where price is heavily reacting off of the most, as these are going to be the highest volume levels. And volume is going to be the amount of people that are trading. Okay, so when 930, which is when the stock market opens, okay, hits, the bell rings, people are going to be frantic, okay, putting in trades and stuff like that. Everyone's excited. So wherever market decides to open up from these levels are going to be really important. So that's a really good way to find the best pullback levels, see how price wants to react. Okay, so just going from left to right, okay, even checking out this area here at 930, for example. Okay, if I wanted to, from there, I could easily go to like my 15-minute or 5-minute time frame. Okay, wait for price to break and retest from any of these levels above. Yeah. Okay, so if I see break and retest on any of these levels, I can easily go ahead and take the trade from these 930 levels. Okay. Resistance right here, 930 resistance up here, 930 right here, 930 right here. That's going to show you where the best levels are. It's going to be extreme cheat code. It's going to make it simple. Let's go over another example here. All right, we have MDLZ. So let me go to my 30. Okay. And just check it out. Okay. Ideally, I like to start off with my daily too. Make sure I see the full price action. So I can see a super low was created at the bottom down here. I can see price wants to try and meet this resistance up here that came in July. Okay, so I'm going to go to my 4-hour too, see everything from closer perspective, and the resistance up here. Okay, sometimes the daily can not show you everything you see. And then I'm going to go to my 30-minute time frame, and we can go ahead and find pullback levels or price levels above current price in order to trade like a direction flow. Okay, so right here, it's going to be pullback level there. Okay, wherever these green lines are on my screen is going to be exactly where markets decide to open up. So we have a level here, got a level here. Okay, as we can see, the 930 levels are correlating with each other. We got one here, and then this one is going to line up with this one. Okay, And then this one is going to line up with this one. Okay, so it's always going to always line up for the most part too. The more taps that you see in a certain area, the more powerful of an area it is that you should be playing there. Okay, even 930 area right here. 930 area right here. Okay. Finding the key levels here, taking our time. Okay, and that's all below current price. Okay, so as price goes into progress, if I see price pull back to any of these levels, give me a 4-hour close, then I'm gonna be cool to go ahead and take it. That's the whole sweep back up. Okay, if it breaks this level, it's okay. You could try this one. If it breaks this one, that's fine. You could try this one. Okay, as soon as you get your 4-hour close though, you know you're gonna be good to go ahead and kiss the sweep, inshallah. And above current price too. So it's going to be trading with the trend. It's going to be a simple way to make profit as well too. Okay. So you can get on your 30-minute time frame, look for areas of resistance. For example, if I'm taking it long, above current price, gonna wait for it to get above current price and take this area of resistance right here and turn it to support and just take it back up, okay, from the original breakout. So you don't have to take the original breakout, could let price break out, do its thing. Wherever the breakout closes from, price has a chance to retrace, turn the resistance to support. If it does that and you get a 4-hour close, go ahead and get in. And that's a good trade as well, trading with the trend. It's very safe. So let me see here. You can get in here too. And you can get in up here. Okay. So any of these levels of resistance or even support above current price are going to be good levels to go ahead and look for a break and retest. Okay. So even levels of support can go ahead and be mirrored too. So even if price were to go up past this level of support, okay, it can kind of inverse retest and mirror that level of support and go up too. Okay. So that's also going to be part of the breakout model. Okay. And certain things with high liquidity are going to have a little cleaner levels, okay, compared to smaller stocks, but even smaller stocks, you're still going to be able to find good trades. Okay. So for instance, a price break and retest here could take it up to the next level up here. You could just keep going, doing all your levels and just playing your chart like a staircase. So that's pretty much all it is. It's just a big giant staircase. We'll check out Wells Fargo, for example. Hop on my daily. I can see that we're all-time highs. We can't touch this. Okay, there's nothing we can do here. Okay, personally, right now. Okay, we can't trade a resistance breakout to all-time highs. So what we have to do is wait for price to come back down so we can buy it back up. So here's how to find the pullback level. So now that I see the data on my daily, I see what's going on. Let me go down to my 30-minute. So I'm on my 30-minute time frame. And I'm going to look below current price logically. I want price to touch one of the levels below current price and sweep back up. Okay. So that's going to be the goal and objective. So let me go ahead and get the line tool here. Okay. And I can go ahead and put prices down at the 930 doubles. So let me go ahead and put a line price here, line price here, down here. And I can go ahead and see the prices of the lines completely to the far right in black. Okay, so if price comes down to any of these levels, gives me a 4-hour close and bounce, I'm gonna be good, inshallah. Okay. It's about taking the right trades, okay, taking informed trades. Okay, this is gonna be a low right here too. Okay, and you can see some of these lows are gonna mirror each other. Okay, this low is matched with another low over here to the right. Okay, and then we have this resistance up here too, which matters. Okay. And then down here, boom, area of support down there too. Have another one too. Okay. Just mark out your clean levels, okay? You don't gotta make it difficult. Just play what needs to be played. Okay, so if price comes down to any of these levels, it gives me a 4-hour close, I'm not gonna play the first tap. Okay, if price comes down to any of these levels, gives me a 4-hour close, I'm gonna be good to go ahead and take the pull back up. Confidently. Okay, these are 930 levels where market wants to open up at, okay, and just burst in the upwards direction a lot of the times. So a lot of the times market will mirror what it's done in the past. So it could definitely do it again for sure. So we'll go over PayPal here. I'll start off on my daily time frame, get the bigger picture. I can see price made this low right here. I can see price at least wants to come test this resistance area up here. Okay, so I'll get on my 30-minute time frame. Okay, and I'll look for a pullback area to see if we can go ahead and catch it back up to this area of resistance right here. So let me get on my 15-minute or my 30. I'll do the 15 for this example. And I'm going to go ahead and look at the key areas. Okay, I have this area right here. 930 is clean. Keep finding the best areas, all I'm focused on. Okay, right here. That's the ultimate low that was created. Okay. You can also lock your lines too if you notice your lines moving too much. Okay, up here, price decided to short downward. Even up here. Shorted downward. Okay, and as you can see, a lot of these are just correlating. A lot of these lines of levels are correlating with each other. Yeah, a lot of these 930 levels are going to be solid. Yeah, we can definitely trust a lot of these levels for sure. Okay, so that's going to go ahead and be PayPal. So I can go ahead and see this area here. This area of resistance clearly above me. Okay, I can wait for price to either break here, retest off of this area, or I can try this area up here. Okay. Or if it doesn't work here, I could try this area here. So it's all about patience. Like, you can win the trade if you truly want to. It's just about waiting to see, like, okay, will my trade do what I need it to do? Okay, and even for a pullback level, if I see price try to dump down to here, okay, turn this area of support into resistance and then fall down, which it could potentially do, and meet up with this low, then that's going to be in probability too. So bread is everywhere. Bread is all over the place. It's just depending on how patient you want to be, what type of setups you take. And just because there's bread everywhere doesn't mean you should be taking a short and then taking a long and then taking a short and then taking a long. Like, your trade frequency and how much money exposure you have in the market is going to depict like how profitable you are really. So it's like, yeah, you can see everything, but just take the trades as data. So yeah, if you see a profitable trade, you can either take it as data or take it. But if you take it, I advise you stick to that model. Okay, so if this is break and retest and you're a break and retest trader, you see support getting broken, turn into resistance, then okay, it could be potentially a decent trade down to the next level. Okay, but if you're a breakout trader, this is something that might not work out for you, okay, depending on certain situations and your criteria, for example. Okay, but you do have a 4-hour close underneath the level, so even a breakout trader here would potentially be able to take this too. Okay, so focus on your criteria, focus how you trade. Okay, and it's not always going to work on all markets. Like, Forex made shorting really popular because the chart is a lot more sideways, but when it comes to stocks of crypto, stock pretty much just goes up in straight line over the years, okay, in the long-term scenario. So it's a lot different, but both the technicals and all technicals work on all charts. So that's the cool thing. So once you learn once, you can apply it to any market that you understand or want to get into. So we'll talk about Cisco here. Okay, we'll restart from scratch. So Cisco here, I can easily just see, okay. So I know on the stock market too, price is trying to go in an upwards direction, and crypto, because people are working hard to increase the value of their company or make cryptocurrency more useful, whether it be just innovating new technologies or etc. Okay, so they want their value and their shares to go up, so they get paid more on dividends and stuff like that, and share exits. So even the normal workers, like for NVIDIA, for example, a lot of people who just worked in NVIDIA past 10 years just became millionaires because and we're able to retire early because the company blew up. Okay, so if you work for a company and it blows up and they give you shares, it's going to be a really good way to retire early. So it's showing you that trading is going to be a really quick way if you want to retire early, as long as you invest your money correctly, you get in at certain lows, and you invest into the future. Okay. So know that price is always going to try and chase resistances for the most part. Always, always, always. Okay, because it's trying to break out into new highs. Okay, people are trying to get paid more for their shares, so price is trying to chase new highs. Okay, and the richest traders are going to be the U.S. stock market traders, so it's one of the most important markets. Okay, so price is always chasing higher resistances. Always. Okay, it's always looking to break into new all-time highs for the most part. No company wants their stock to be going down. It's not beneficial for them. Okay. So I'm going to go ahead and start off my 30-minute here. I'll go in my 15 here, and I'll look below current price and above. We'll do both. Okay. So for this candle here, it's 930 candle. I'll put go and delete everything. Put this level here. Get back on my daily. You can see price wants to at least come up here. So price is always going to be hunting either an area of resistance above current price, or if an area of resistance is too far, like all the way up here, okay, it's still going to be aiming for all-time highs ultimately. But depending on your expiration dates and something like that, okay, then closing in an area of support above current price is going to be solid too, because we know that just like we saw, support can be broken and turned into support. So put everything logically, you put it together like a puzzle piece. So if I get on my 15-minute here, and see the structure and everything closely, you can see price wants to bounce from this low here. Okay. Price bounce from this low here. Price bounce from this low here. All I got to do is focus on 930 levels. I don't really have to focus on anything else. Okay, as far as the stock market. There you go. And this level too. Okay. And then a lot of these levels too are going to be related to each other. So a lot of the times you'll see a lot of levels working at the same areas over and over again. Okay. And right here. All right, boom. So let's say we have all these levels, for example, okay, that I think are going to be solid, good levels. Okay. This level here. Okay, let's say I go to the far right on Cisco. Okay, I can go ahead and just see certain things. Okay. So I know that price is trying to at least chase this resistance up here. Okay, I can go to my 30-minute and see everything cleanly. Okay, I can just wait for either a pullback or resistance breakout how I want. Okay, I can see at this level I already got a pullback. So price decides to fall all the way down, come up, and then pull back to this level right here. Okay, and we just did all the 930 levels. Okay, then it's not okay. This level is important. So if I wanted to, really, I could delete this one. And because we have all the data to the left verifying that this low is valid, okay, and I have a 4-hour close verifying that the pullback is valid, I can easily go ahead and take this up to the next area, like up here, for example, okay, and see if this area up here wants to turn it into resistance. Okay, so you can use certain different scenarios to make bread, just about thinking how logically you want to play. Okay, it's a big puzzle piece, and if you play logically, there's going to be money everywhere. Okay, which is why people just make money by just buying and holding. Okay, because it truly can be that simple. So let me check out here. Okay. Even right here on Pfizer, okay, I expect price to come up to this area of resistance up here. Okay. I'm sure I could go to the left and find some good levels for reasons why. Price wants to react the way it does. So we have a low right here. I have one right here. We have another one down here. Okay, go ahead and go to my current price. So I know if price pulls back to any of these black lines, it's going to be effective for me to go ahead and get in at those positions. 930 low right here too. Okay. The further we go back, the more data we're going to collect. See if everything that we're doing makes sense and correlates. Got one up here. Got one here. All right, and then we go ahead and go to my current price. And guess what? So you can see here that this line that I just went ahead and drew from all the way to the left correlates. Okay, so correlates with this line right here, verifying this low with a push up here. Okay, so on fives are here. This trade goes ahead and makes sense too. Okay, you can easily go ahead and potentially take it up to the next black line up here. Okay, so many different ways you can go ahead and take a trade. Okay, many different formations, and it's just going to depend on what way you're looking at the market and how you want to take your setups. Okay, so let me take you through another example here. So let me go ahead and pull up a high liquidity stock. We'll go over NVIDIA, for example. Let me start off on my daily. Okay, logically thinking, I know that the stock market wants to go up, so my take profit is going to be these all-time highs up here, for example. Okay, let me go to my 15-minute time frame. Let me go ahead and start marking my levels. So I'll do levels below current price and above current price. So I got support below current price right here. And you can see which direction these 930 candles are moving in by just seeing how the flow works. So if you clearly see a top resistance wick and then price falling down, then you know price reacted off of the top resistance wick here, not the bottom. Okay, so just check out the flow. You can easily see which direction the price is moving in. Okay, we got a 930 level here. Got one up here. We got one up here. And let's say we got one here. Got it's precision scrolling and it's taking our time on these setups. Yeah, 930 resistance right there too. 930 support. Price shorted down from here, 930 support here. Okay, and you see everything correlating as well too. 930 support here too. Then we got some down here. Okay, and then once you have your levels, you're good. Okay, you have your data here. You know how to play your reactions. You know what you're looking for. You're not going to be playing without any data or information on your screen. You know exactly what you're going to be looking for. So let's say price decided to go in upwards direction here. Price went up right here. And then we got right here too. These are going to be all the best levels. Anything with the 930 reaction is going to be the best level supply. Okay, let's say we stop there. So I can go to my 4-hour time frame here, just analyze everything. Okay, I can still see that price wants to go ahead and try and at least touch the black line all the way up here. Okay, and as we can see, we got price shorting at this black line here, but we do have a pullback at this level here that did work. So if price pulls back, holds this level here, could potentially be good. Okay, take this up, point there. Okay, maybe break and retest here, potentially break and retest here. Okay. Or price can potentially short from these areas too. Okay, resistance mirrors, and these are going to be the cleanest levels to play a lot of the times. So it's about taking your time, analyzing what works, analyzing the cleanest levels, and playing with potentially just needs to be played. Okay, so even right here, we have this area of resistance. So right here, Okay, so yeah, price reacting with this area of resistance too. So break and retest can happen at any of these areas. Okay, and a lot of these areas are going to be about 1 point per. Okay, so it's going to be good money even if you day trade just these small zones in between. Okay, so break and retest, they should work all between these areas. And it's going to be an easier way to just catch your day trade flow. Okay, so if you want to make some money multiple times during the week, okay, just boot up your account, mark out all your levels, and then you can catch your flow. Okay, be responsible with your trades. Okay, and be ready to just close relatively quickly. You can't really cook your trades like this, especially when you're trading on a smaller time frame basis. So even right here, let me go ahead and do all the levels. Starting off on Walmart here, get on my daily. Okay, this price actually already hit all-time highs here. So let's find a pullback level. It's good. So we know that price wants to at least touch this resistance up here. Yeah. So let's find a pullback level below current price. So let me get on my 15-minute time frame. Just pay attention to the dotted line here. Okay, and I'm looking at all levels below current price. So we got this level down here, 930. Got some 930 support down here. Some more 930 support here. Got down here. Okay, just about marking the best levels that we can find here. One right here. Got one right here. Down here. Okay, this is the bottom wick because price is going up. This is the top wick because you can see price going down afterward. Okay, read the flow. That's how you can determine what candlestick it is. And sometimes it can be easier to detect than others, but for the most part, you're going to be able to get it. In here. Okay. Zooming out. Then we got this area here too. Okay. So just finding the best areas below current price, waiting for price to give us a 4-hour close and pull back to these areas. This area down here still. And up here. Here. Okay. And now you have the cleanest levels. Okay, so you can see here in Walmart, if I get on my 4-hour time frame, see all the areas where price wants to dip down to. Okay, so price comes down to any of these areas below current price, gives me a 4-hour close, I'm going to be good. Okay, I can clearly see that price wants to short down to this level here too. So even if I wanted to take a short, I can clearly see that price wants to short down to this level here on the black. Okay, it's already more than halfway done, and yeah, price definitely wants to make its way here. Okay. And then after price gets here, if it decides to want to bounce here, it's going to be another question. Okay. If it decides to break this level, even after a small bounce, that's fine. You try this level. Try this one. Okay, try this one. Okay, you'll know the pullback area as long as you have your levels down. Then you can go ahead and buy months out, buy some years out, catch the whole sweep back up. Okay, that's going to be a lot more profitable than just catching a tiny burst move. Okay, you know exactly where you're trying to buy. Go grind real life, stay down. Okay, keep grinding bread, keep putting that bread away, and then when the play comes, you can catch the whole move. You can buy the contract that you want, and your money's going to be able to 10x. Okay. So once you have your levels here, just be grateful for bear markets too. If markets ever dipping down, have all your levels placed down. Okay, especially on the stock market, you can take serious advantage of the 930 manipulation, and you can see the best levels. And go ahead and buy certain amount of shares or buy months out or years out for options and stuff like that. And just let your bread make bread, okay? Catch the whole sweeps back up. So this is going to be one of the best ways to do it and to see which levels are going to be clean to play to the downside. Okay. So if price is going to the downside and you're like, okay, where's the bottom? So these are going to be potential bottoms, and wait for your 4-hour close. Don't buy on the first wick. Buying on the first wick can really get you destroyed and you might get irritated. Okay. So just don't get irritated and stick to a plan that's logical. So even for Apple here, I can see it bursting all the way up. Even if I wanted to take a pullback trade, I could easily go ahead and do something like this. Mark this level here. This one here. This one here. This one here. Okay, all the data is going to be here for us, okay? Literally all the data is here for us. Everything that we need. Okay, 930 level right here too. Another one right here. All the information that we need. Every ounce of it on the screen. Okay, all the levels that we need right here. Price decided to bounce upward. Okay, sometimes price is going to go ahead and mirror certain transactions. Okay, price decided to short from here twice. Okay, so resistance once and then resistance twice. So sometimes 930 is just going to mirror level that happened to the left. Okay, right here, price decided to bounce upward. Price decided to short. Actually, no, price decided to long. Okay, it's about just being precise for what we're looking at. Right here. And then right here. Yeah, a lot of times if there's a lot of lines in one area too, that area could be potential good zone as well too. Okay, potentially right here. Potentially right here. Okay, right here. Okay, so cool. Yeah, these are going to be just the cleanest levels I can find here. So then from there, I'm going to be able to go to my 4-hour time frame. Okay, and I can look below current price. Okay, if I see price pull back to any of these levels and give me a 4-hour pullback, then I know, okay, inshallah, I'm going to go ahead and be able to get in and catch the whole sweep back up. Okay, so I'm only looking at 930 levels personally, waiting for pullbacks and catching the whole sweep back up. Okay, so that's how you trade if you see something bursting up. Okay, and don't buy things when they're overextended. Okay, wait for price to come back to these levels and catch it back up. Promise you it's going to be a lot more worth it on your risk to reward and on your P&L. Okay.
So imagine waking up in an economy where money can appear out of thin air, or one where every coin is locked behind an unbreakable vault. And that's the clash we're diving into today. Let's talk about quantitative easing versus Bitcoin's fixed supply. And it's a true economic showdown to be talked about. So in one corner, you've got quantitative easing. It's the central bank's money creation lever. And when the economy slows, they print even more, inject more, push more, and it can rescue markets. But it can also quietly stretch your dollars thinner over time. And in the other corner to fight against it, you have Bitcoin. It's a digital asset that refuses to bend, and only 21 million will ever exist. No printing press, no emergency button, just a having driven drip of new supply that's immune to human panic. So let's go and listen to a class, inshallah, if God wills. All right, so let's go and listen about the economic showdown. So Bitcoin has scarcity involved within it. There's a limited amount of Bitcoin available. 21 million Bitcoin exist. But versus fiat currency, the traditional fiat currency, such as the US dollar, there's an unlimited supply, okay? But with that unlimited supply, things catch up over time. So let's go and let's talk about exactly what I mean. So mechanism, quantitative easing, right? So the term QE, let's talk about it. So QE stands for quantitative, Q stands for quantitative, okay? And E stands for easing.
Okay, and here's how it actually works. So it's not just printing cash. Okay, it's an asset swap. So step number 1, the central bank creates digital reserve, okay, out of nothing. And they use these reserves to buy treasuries and mortgage-backed securities from commercial banks, okay? And now banks now have the cash reserves and are incentivized to lend it out to companies and people. And in result of all of this, the central bank balance sheet then explodes, okay? And the Fed's balance sheet grew from 4 trillion, okay, to 9 trillion during 2020 through 2022, okay? So let's go and let's break down the further logic of what this all means, because there's definitely going to be consequences for everything that we just spoke about. And let's talk about it. The Cantillon effect. So who gets the money first? So new money doesn't reach everyone at the same time. It flows just like a river does, okay? And one, the insiders, okay, banks, okay, / government, they get the money first at near zero interest, okay, and they buy assets for cheap, okay, they buy it for a low price, okay. God says no interest anyway, so they finesse the whole system. So the asset owners, right? Let's talk about the rich people. So stock and house prices rise due to the influx of cheap capital, okay? And let's talk about the wage earner, okay? By the time money reaches you, prices for food, okay, just a basic item, let's say like a piece of chicken, for example, okay, or macaroni, okay, 1 year you might be paying $5, okay, for a chicken sandwich. Next year you might be paying $7, okay. 5 years down the line, you might be paying $13, okay. You went from paying $5 a chicken sandwich to $13, okay. Yes, we can print infinite currency, right? But there's going to be consequences to everything, okay? It's going to be supply and demand, equal opposite forces in everything, okay? So understand that the fact that infinite money gets printed means that over time things have to get more expensive in order to compensate, because people are going to start just having more money, okay? And there's going to be more money flowing in the river, so the numbers have to balance out logically, okay? So knowing this, we have to understand that your income has to catch up. So let's focus on point number 2 here, okay? So point number 2, the asset owners and the rich. So stock and house prices rise due to the influx of cheap capital, okay? So they go up due to the influx of cheap capital. We need to think about this logically, okay? So while food, rent, and stuff is getting more expensive, okay, stock and housing prices are also rising. You guys should be trying your hardest to stack as much assets as possible. If you don't know what an asset is, that's going to be anything that's pretty much going to turn your money into more money, okay? Whether it be real estate, okay? You could do stocks, okay? Cryptocurrency, so many different avenues, okay? Business, pay for ads and start you a digital business or physical business, whatever, okay? Just whatever is turning your money into more money, that's going to be an asset. Because you have to understand that your income has to catch up. I don't want you guys to be struggling in society, okay? Your income has to catch up. And just like God says in Quran, we have to spend moderately, okay? We have to spend moderately. I'm really telling you guys, the key to life is just following what God says, okay? If you guys aren't religious, you need to go start reading the word, man, okay? It really helps a lot. It's a lot of psychology in there, okay? Especially as a trader, an investor, somebody trying to have their finances together, you need to definitely read Quran if you can, okay? So spending moderately. Okay, so stop being so much of a consumer if you realize, okay, there was times I was spending my whole bag on DoorDash, on this and that, okay, having no assets stacked, okay? And I'm not saying don't live life,
there's going to be times where we want to live it a little life. Okay, I understand. Okay, there's times, you know what I'm saying, I go out, you know what I'm saying, you might pop it a little bit. Live your life, do your thing. But that doesn't need to be a consistent every single week, every single day thing. Okay, save your money, invest your money. Okay, so when I say save your money, save it in some assets if you can. Okay, don't just have your money sitting in your bank account, because inflation, food, rent, etc. is rising. Okay, which means if you just have money sitting still, you're going to pay more taxes over time. Okay, so always try and keep your money flowing in the river. Okay, this way, by the time tax time comes, you're going to have an easy time paying it off. Inshallah, if God wills. Okay, so let's head over to the next slide. So the response, okay, absolute scarcity. Bitcoin, where my Bitcoiners at? All right. So Bitcoin, the 21 million hard cap. Okay, and this limit is not something that needs to be taken lightly. Okay, Bitcoin is gonna go away one day. Okay, Bitcoin is not infinite. Okay, it is not infinite. Okay, you need to understand that it's a resource that is going to expire. Okay, that in itself, that alone gives it value. Okay, so there's 21 million, okay, Bitcoin that has to be mined until it goes away. Okay, depending on when you're watching this video, you should be able to do a quick Google search to see how much Bitcoin is left. Okay, people are starting to buy hundreds of millions of dollars worth, including the US government. So check your watch, okay, because time is ticking. Okay, so this limit is not a promise, it's math. Okay, it's enforced by tens of thousands of nodes globally. To change it, you would need to convince the entire network to devalue their own wealth, which would be practically not something that people would be wanting to do. Okay, and there's a whole decentralized consensus behind it. So that word decentralized, okay, you might have heard of it. Let's talk about it. Decentralized means no banks, okay, control anything. Okay, no banks control anything. What it is all peer to peer, okay, which means person. Okay, so we got Joe, and then I'm gonna go ahead and we got Jack. Okay, so we got Joe and Jack. Okay, Joe lives in the US. Okay, and Jack lives in China. Okay, Joe hired Jack to do some work for him. Okay, Joe hired Jack to make some ads for him. Okay, for his company. Okay, but he's in China though. He's in China. Keep that in mind, guys. Okay, if you're trying to wire transfer some money to somebody in China, okay, or somebody in, let's say, Africa, okay, for example, okay, because I know China has some cryptocurrency laws and stuff like that. So let's say Jack is in Africa, okay. So Jack is in Africa, and you're trying to send some money to him, okay. He's making some ads for you. He's trying to get his paycheck. And what's a good way to pay him? Okay, might be a little difficult to use PayPal. Might pay a lot of transfer fees. Might pay a lot of this. Okay, but especially if you start trying to send large amounts of money, they might flag your account and be like, hold on, why are you trying to send so much money to somebody in another country? Okay, they might get questioned, and it's your money. Okay, not cool. This is where cryptocurrency comes in. God is the greatest. Okay, so thank God crypto exists now. Okay, if you want to send some money to somebody that you hired in another country, your family, whatever, however much you want, whenever you want, okay, you can instantly send your currency. And that's the decentralized network. Okay, that's the difference between centralized and decentralized. Decentralized, you can send it when you want, you can send it to who you want, and you can send it to where you want. Okay, whenever you want. Centralized, stuff works on times. Okay, I'm sure you guys know that direct deposit time. Okay, waiting for that 6 a.m., waiting for that check to hit. Okay, certain times like that. That's the whole centralized system. Okay, cryptocurrency strikes that out. Okay,
And let's talk about an immutable ledger. Okay. So once a block is confirmed, it is thermodynamically secured by energy. Okay. Rewriting the history would require more energy than a medium-sized country could consume. So once it's confirmed, once it's on the blockchain is going to be where all pretty much the cryptocurrency information lives. Okay. Once all the blockchain information has been confirmed, okay, and set in stone, shouldn't change. Okay. Inshallah, it shouldn't change. So that's what makes Bitcoin a big help in society, especially when we're just trying to live some life and do some things. Okay. We might have some family in other countries and we just want to live like people. Okay. Come on. Let's go to the next slide. So the supply shock. Okay. Let's go and let's talk about the halving. Okay. Halving. So half, as you guys know, 50%. Fraction is 1/2. Okay. Because 1 plus 1 is 2. Okay. So programmatic disinflation. So every 210,000 blocks, okay, which happens every 4 years, okay, which is, yeah, pretty much how often it happens, the issuance cut happens by 50%. And this creates a predictable supply shock. So let's break it down. So pre-2024, the Bitcoin inflation, okay, was around 1.7%. Okay. Post 2024, okay, inflation went down to 0.85%. Okay, which became scarcer than gold. Okay. And projections, if this math continues by 2028, we should have the inflation at 0.4%. And then 2140, when Bitcoin decides to go away, which is by the time when people calculate, inflation will be at 0.0%, of course. So while the fiat supply accelerates, right, exponentially to pay the debts, Bitcoin supply decelerates. Okay. You have to understand that it happens because it's a limited currency. Okay. It's limited. It's not something that's going to be here forever. Try and get it when you can. You don't want to be one of those people who regret it and be like, oh man, I should have bought some Bitcoin. And you just didn't. Okay. So make your decisions now. Put some money to the side. Okay. You don't need to be buying no clothes, McDonald's, no DoorDash, no right now. Buy some groceries. Okay. Buy some groceries and grind. Okay. Wake up, pray to God, grind, and stay down. Okay. Live a little life, of course. Take care of your mental health. But try and put some money away. Okay. We got to have this asset flowing. Okay. Let's get it. Inshallah. So the systematic comparison. So fiat currency, US dollar, man, cash, you know, good old dollars. Let's talk about it. So policy. Okay. It changes based on politics and crisis. Okay. If the US economy is doing well, then that means our dollar is going to be more valuable. If it's doing bad and we have a lot of debt, etc., the US dollar is not going to be as valuable. Okay. And that's just what it is. And people will want to run to other assets, which once again, assets are things that turn your money into more money. Okay. Because fiat currency, that money, is not as valuable. Okay. So they at least want to try and generate more, which makes logical sense. Defense, survival. Okay. So unlimited amount of fiat currency can be printed, press of a button. It's kind of just numbers on the screen. Even kind of same thing with credit too. And system. Okay. Permissioned. Banks control the access. Okay. They can tell you no. And they can tell you yes. Okay. And the outcome, right? Your savings lose value over time. Okay. Due to the fact that it's not growing in anything. Okay. It's not in the river. Okay. It's sitting still on the rocks. Okay. And let's talk about some Bitcoin. So policy. Okay. Set in stone with code. Okay. Can't be changed, which means Bitcoin is going to have the same intrinsic value baked into it a lot of the times. Okay. And of course, there's going to be chart depending on where the price is at, all-time highs versus a low, for example. Okay. But for the most part, with it having that fixed supply,
okay, it's going to remain valuable. Okay. Fiat currency, if the US started getting bombed right now, the US dollar probably wouldn't be as valuable. Okay. So certain things just are logical with that. So supply, okay, strictly capped, okay, 21 million, and it's very costly to mine. Okay, you can't just spawn Bitcoin at a press of a button. You actually have to have a whole logistical system. Okay, Bitcoin is created by proof of work. Okay, the computers have to show math. When your teacher asks you to show work, that's what the computers have to do. So it's pretty much a bunch of computers. Okay, or it might be one, however much the person has who's mining the Bitcoin. Okay, and what they're gonna go ahead and do is look for mathematical equal signs. Okay, they're trying to solve a code, okay, to give the hash. Okay, and in that, the computer has to keep solving these codes. Okay, and it has to show work. Okay, and that proof of work, and if it's correct, okay, then they're rewarded with a piece of Bitcoin. Okay, and then they keep doing that, and then every mathematical problem that's solved, then a Bitcoin gets created. Okay, and it's all solved by supercomputers. Okay, could be very, very expensive to run depending on your country. Okay, so before you just go try and boot it up, look into it. Please do your research. Pray to God on it. Take your time. Okay, and it's open to all. Anybody can buy Bitcoin. Okay, you can buy some Bitcoin right now if you want. I don't care if you got $2. Okay, get in that habit of buying assets. Try and keep yourself broke. Okay, because what do you have your cash in your bank account for? Go buy some assets, live off of credit if you can, and stay down. Okay, keep doing that. And then when it's time to pay your credit, boom, 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 and keep the money flowing. Keep it flowing. Okay, don't stop hustling. Okay, I know life happens. Don't get depressed. Keep your head on straight, man. Okay, there's gonna be things that go down in life. There's gonna be times your emotions are gonna be shook up. Okay, there's gonna be times where you can't stack up. Okay, your car might break down. Okay, things happen in life. Okay, you might have to pay rent. You might have to pay direct deposit on a new crib. Okay, and rent. Okay, depending on whatever it is, any situation, right? Hospital bills. Okay, just pray to God on it. Okay, pray to God on it and keep hustling. Okay, don't get in your head. Don't get poopy pants and don't get depressed because you got to get to this money. Okay, I'm telling you, when you pray on it, you keep going forward. You keep hustling. Things get easier. Okay, but you got to keep hustling. Okay, after you pray, you got to keep hustling. Okay, don't grieve. Okay, don't get sad. Just focus. Focus. Okay, don't take that money and indulge in food. No alcohol. Okay, if you're drinking, quit that. God says don't do it. It makes you weak. Okay, no alcohol. Take that money, buy some assets, buy some Bitcoin. Okay, change up your lifestyle. It's really deep. Okay, if you catch yourself buying certain kinds of food, ask yourself why. Okay, why? Why am I eating these Doritos? Why am I booting this up right now? Okay, when's the last time you had some vegetables, some fruit? Okay, you gotta change your lifestyle. You guys are so obsessed with investing and trading, but we all have to realize that we have to change our lifestyles. Okay, this stuff takes money. Okay, it takes money to invest. So if you want to invest, you need to change your lifestyle up. Okay, put some bread away. It's cool to stay down. Okay, it's cool to save some. Okay, wear the same clothes for weeks if you got to, but you know how much Bitcoin you have in the stash. You know how much assets you have stacked up. Who cares what anybody's saying? Okay, because if you want to get to this Bitcoin, it's gonna take a certain level of discipline. Okay, it's gonna take a certain level of staying focused. Okay, we can't be being lazy when we say we want to be stacking assets. You gotta choose. You gotta be relentless. You gotta be a dog. Okay. So, before Bitcoin expires, I don't want you guys to be like, man, I wish I bought Bitcoin. And it's like, that's not how you want to go out. Okay. Leave something for your family. Okay. And take care of yourself. Inshallah. So let's go. Let's head over to the next slide. So the hardness of money, right? Stock to flow. So why hardness matters in the first place? So money is a technology for storing time and energy. And hardness
measures how hard it is to produce more of it. So let's talk about the S to F ratio, okay? And existing supply, okay, divided by the annual production. So let's talk about the real estate, right? High S2F, okay? Because real estate is pretty hard to build, okay? You need a whole crew of people. Stuff could be changing now, though, because they do have houses that you can just drop on a plot of land, okay? That's like carried by a giant truck, okay? So it really depends. That could change as humans develop more innovative technology and ways to get housing quicker. But as for now, real estate is pretty hard to build. And let's talk about gold, right? So gold takes about 60 years to double supply, okay? And Bitcoin, okay, it's the hardest asset ever discovered, ever, okay? So gold has a 60 S2F, Bitcoin, as of 2025, has 120 S2F, okay? And if money is easy to produce, right, such as fiat currency, which is limited, people won't save it. They're just gonna go ahead and dump it and blow it, okay? And if money is hard, okay, Bitcoin, civilization can save for the future. Your Bitcoin is like your gold, okay? You should not be touching your Bitcoin. You should not be touching your Bitcoin. You should not be touching your Bitcoin. You should not be touching your Bitcoin, okay? Keep it in the stash. Keep it locked away. Keep those secret keys locked up, okay? Don't be touching that Coinbase card. Don't do it. It's not worth it, guys. Okay, so let's stack it up. Let's stay down. Okay, spend that credit. Okay, spend that credit and build it back up. Spend that credit, build it back up. Pay your bills, spend that credit, build it back up. Keep hustling, keep grinding. Okay, spend that credit. Credit. Fiat currency, unlimited, pretty much almost not real. But think something like Bitcoin, okay, something like real assets like gold, okay, that there's limited resources and actually exist, okay, whether you're buying the gold, ETF, etc., just understand that investing into assets that have value are going to be a lot more worthwhile than hoarding fiat currency for no reason. So let's jump into the next slide. So the verdict of everything, okay, we're witnessing a global competition between two monetary operating systems, okay? You got the debt path, okay? Fiat requires inflation to service global debt. So your savings are the fuel for the system, okay? Eating it all up. And then you got your true savings path, okay? Bitcoin, it's an exit valve, okay? A savings technology that cannot be debased by any central authority, okay? And this is not financial advice. Do your own research, okay? Do your own research, okay? I'm not saying go take all your money, dump it into Bitcoin, but do your research. Check it out, okay? Check it out and do your thing, okay? Stay prayed to God. Keep grounding. Head over to stackmode.net for all trading education. And I'm going to catch you guys in the next one. Peace.
Hey class, we're going to be talking about the future of cryptocurrency. Let's go ahead and let's break down Web3, AI, and the interoperability of the whole blockchain and decentralized technology space. Let's jump into it. So let's talk about Web3. It's the ownership revolution. So Web3 is the next evolution of the internet, and it's characterized by decentralization and user ownership of data and assets. And it's the big shift from renting to owning. So right now, we currently use the Web 2 system, and it's run on centralized platforms like Google and Meta, and they own your content and data, which is susceptible to hackers and certain things like that as well. But Web 3, what the future is going to go ahead and concur. The users own their identities, data, and digital assets via NFTs, tokens, and the blockchain decentralized system, which means that transactions have to operate via autonomous codes called smart contracts, instead of a centralized system like banks, where transactions have to be confirmed by a centralized intermediary. And the transition empowers individuals and reduces reliance on large tech intermediaries. So decentralized finance, also known as DeFi, it's financial service uses smart contracts systems without banks. Okay? And DAOs stands for decentralized autonomous organizations, and their governance run by code and token holders. So Web3 is a really, really big shift. It's putting power back in the people's hands So instead of having your money being declined, let's say for instance you wanted to send money to someone in a different country. Let's say they built your website, for example, and as online business increases, people from other countries are also going to be participating as well too. And quick way in order to send transactions, invoices, whatever, is cryptocurrency. Okay, without any intermediaries, no fees, no wire transfer fees, and no ability to get declined. You try to send like $1 million USD to someone in Thailand bot, right? It's going to be a lot different. Okay, you're going to run into fee issues. They might think that it's fraud, and it's a large chance that the transaction just won't go through. Okay, but whenever you're sending it via cryptocurrency on the smart chain system, it's not worried about that. Everything is automatically being run through. Think of it kind of like a vending machine. When you go up to the vending machine, you put in that dollar, you get what you want. Okay, that's how cryptocurrency works. But when you go to the drive-through, the person has to hand you the food. Okay, the person could drop the food. The person could do a lot of stuff to the food. Okay, they could crumble up the food and throw it away. There's a lot of stuff that can happen. Okay, but if you go up to the vending machine, you put in your dollar, you're gonna get that. Okay, so it's up to the person whether or not they really want to give you your food, even if you paid. So that's the traditional centralized system. But decentralized is going to be the vending machine system. If you put in that dollar, it's going to automatically give you whatever you selected. Okay, it's a lot more efficient, it's quicker, and no deception or human emotions can even cultivate in the existence of your transactions. Okay, and you're dealing with money. You're not trying to be worried about getting your transaction declined. Okay, you're a human being. You got stuff to do. You got bills to pay. I'm sure you have people to take care of. You're trying to get from A to B. Okay, so cryptocurrency is going to be a good place to run transactions and large invoices relatively quickly. So doing big deals via cryptocurrency is going to be a really good way to quickly do transactions without having to wait for banks to confirm it, freeze your account, etc. So interoperability. All right, let's go and let's talk about breaking down the walls. So blockchains currently exist as walled gardens, and the future requires them to talk seamlessly. So the problem fragmentation, a part of it. So assets and data are locked onto the native chain, so such as Ethereum and Solana. And high friction is involved when moving tokens between the chains, and developers are limited to one single ecosystem. Okay, but as time progresses, as more development and coders implement different types of technology in order to make things more efficient, I can see things changing within the future. And users have fragmented digital identities across different chains as well too, making it extremely secure. So the solution, crisscross communication, and protocols are building bridges and standardized layers, also known as layer zeros. And bridges allow asset transfers. Okay, so whenever you're trying to swap a meme coin, for example, let's say you hopped on Phantom Wallet, Coinbase, whatever. Okay, if you're gonna go ahead and get Pepe the Coin Frog, right, in order to purchase Pepe the Coin Frog coin, you need Solana first. Okay, so Solana is going to be the first asset you're going to need in order to buy a meme coin, for example, and that's going to be a bridge. And layer zero is going to be the infrastructure, like Cosmos or Polkadot, for example, and it's designed to connect independent chains. And the goal of it is to provide a single fluid digital economy where value can move instantly and people can get what they want. So let's say, for instance, if you wanted to exchange USD for, once again, Thailand's currency, right? Thailand's currency is going to be bot, for example. Okay, let's say Swiss, okay? Or if you wanted to exchange Thailand bot for the Swiss franc, okay? Say if you're swapping certain things like bot from USD currency, then the bridge is going to go ahead and what's to be allowable with the asset transfer class. And layer zero, that's going to be the infrastructure like Cosmos, Polkadot. And that's designed to connect the independent chains and link everything all together. And the goal is for really to provide a decentralized space where it's single, fluid, and it's a digital economy where value can move instantly and people can exchange for what they want. So if you're going to the currency exchange, it could take some time. There could be fees and quite some other things involved when exchanging one currency to the other. You're also going to need another bank account system, okay, in some cases too, if you're not getting all cash, and just a way to go ahead and spend that other currency as well too. Whether you're just getting a cryptocurrency card, you're going to be able to spend that all across the world as long as they take Visa, for example. Okay, so if you were to get like a Coinbase card that provides Visa or certain other brokers provide it too, then you could use that all over the world and use that to spend money. Okay. And AI and crypto. Okay, AI can monitor blockchain data for anomalies and instantly detect fraud or exploits of smart contracts. So certain things too, like bank hacks, can be susceptible due to certain errors, okay, and things like that. Certain transactions that could be completely legitimate could be declined, okay, due to human error as well too. But when everything is being dealt with via the smart contract system and AI, everything's going to be a lot more automatic, and things are going to be seamless, okay, transitional, and stuff is not going to be as barrier locked. And AI models manage vast liquidity pools, optimizing lending rates, and they execute complex low latency strategies, implementing quick transaction swapping too. Okay, so even if you do $1 billion transaction from one person to another, it's all going to be automatically calculated, and it should be in one person's wallet within a couple of minutes or hours. And autonomous DAOs, and AI can automate repetitive governance tasks, and it deals with the treasury management, proposal filtering, and it just makes DAOs more efficient. And AI becomes the intelligence layer running on the decentralized foundation of Web3 in general. And the converged ecosystem, so powering the future, and universal access. Let's talk about interoperability. Developers build once, deploy anywhere, and utilize liquidity and user base across every single chain. Okay, so whoever's developing a token or enhancing the Web3 space in general, everything is going to be seamless. Okay, and when it's on the decentralized space, it's power back to the people. Okay, once again, it's like we talked about. And DApps, they evolve their own functionality and security protocols based on real-time data analysis. And users can also retain sovereign control over assets which interact with intelligent cross-chain applications. And this trio of systems creates an internet that's smart, seamless, and owned by its users. Okay, so instead of transactions being declined, instead of superpower or someone being able to control a whole pot of the pie, everything is being dealt with power of the people. AI is really going to keep everything stable and safe, so no human superpower can take over one area of the finance space. Okay, so Web3 is going to bring fairness back to the global economy. And Web3 is the foundation, so the blockchain provides trustless ledger for ownership and transactions, and a safe place to keep your money stored as well too. And interoperability is scalability, and the ability for chains to connect determines the speed of adoption and utility in general. And the next generation of innovation lies at the intersection of decentralization and machine intelligence. So if you want to learn more about cryptocurrency or the whole decentralized finance, DeFi, or blockchain space, head over to stackmode.net. Step right up to God, keep grinding, and I'll catch you in the next one. Peace. So if you lost all your money, you're at zero. It's happened to pretty much almost every single trader before, okay? And I don't want it to happen to you again, okay? It's gonna be important to lower your ego, humble yourself. And this is why it's really important to get with God, okay? It's really gonna help us build consistency, waking up, praying every single day, okay? Let's wake up, let's work out every day, okay? And let's transmute this pain, and let's work harder, whether at work and or your business, okay? So you should either be having one job and working on your business, or you could have 2 jobs, okay? And then on the weekends, work on your business, okay? Do what you need to do to grind, run it back up, don't stop, keep pushing. No matter in any situation, you have to keep pushing. You can't stop, you can't let things get to you. You can't let things break you down within your mental, okay? If you say you want this, if you say you want to be a profitable trader, if you say you want to put your family in a better position, we got to lock in. We can't be getting broken down. We got to bounce back, inshallah, if God wills. Okay, so here's gonna be the full guide to financial and psychological recovery. We gotta keep pushing forward underneath any circumstance. We can't stop. We can't let our emotions break us down. That's all just the devil, okay? The devil doesn't want you to progress, but God wants you to progress. Alhamdulillah, okay? So turn to God, okay? Wake up every day, pray, get yourself right, lower your ego. This is why you're blowing up your account. Why can't you just accept the fact that you're losing? Okay, if you lost the trade, get off the charts. Why are you trading over and over and over and over and over again? There's no point to that. It's time to transmute all of that pain, okay? Put it into more work, put it into your business. Set your alerts at your key levels and go work on your work and your business, okay? Why are you sitting there trading over and over again? Why are you sitting there taking 10 trades in a day, blowing up your account? How do you expect to progress? Okay, take one trade, risk management, and have some long-term investments, okay? Invest in shares, okay? Cryptocurrency, some long-term investments so you don't have to sit there trying to day trade every single day. The reason why you guys are also blowing up your account so quickly is because you're trying to day trade. All the money you've been losing trying to day trade, one, you could have put it into mentorship. Stackmode.net, the first call is even free. Okay, so I give you guys a free first call. And on top of that, there's just no reason to be blowing up your account in the first place, okay? Because all that money you've spent trying to day trade, trying to make profit, you could have been putting in long-term investments, and your profit would most likely still be positive today, and you'd still have a large majority of it. And so you'd be up and you'd still have your money, okay? So focus on long-term trading too, okay? It's not just all about day trading, 0 DTE, futures, etc. Don't let that prop firm mindset destroy you. All right, let's go. So the immediate aftermath, the psychological toll, losing a significant amount of money in trading is more than just a financial event. It's a deep psychological blow, and you may experience a range of emotions, including shock, denial, regret, shame, and even a profound sense of failure. And it's crucial to understand that these feelings are normal and a part of the grieving process for your financial loss. Acknowledging this emotional state is the first critical step towards healing and recovery. So acknowledging the pain. Do not suppress your feelings. Allow yourself to process the loss without judgment. And this is a necessary emotional release that has to happen. And combat cognitive bias. Your mind might trick you into a get it back quick, okay? Get it back quick, okay? So pretty much if you lost some money, let's say you lost $200, okay? You might think, okay, I'm gonna go ahead and risk even more money so this way I can go ahead and get my $200 back and I can go ahead and end up profitable on the day. No, man, you lost. If you lost, you lost. You get off for the day. You plot out an even cleaner setup. You come back with even more logistical analysis and more of a good reason to put on a good trade. And until then, you're gonna wait. I don't care if it takes days, weeks, or months, okay? You wait for a good setup. Don't just come on here and burn your money trying to fiend for money, okay? Wait days, weeks, and months. It takes a long time to get profitable, okay? But it can happen now if you just plant yourself in the right positions, okay? Invest in things that have future value. Invest in things that put smiles on people's faces, okay? Some stocks just go up in a straight line year after year after year after year after year. You just have to do your research, okay? So don't get tricked within the get it back quick mindset, especially day traders. Day traders, you got to control your emotions. You got to think more long term. Even if you make some profit off a day trade, think about how you're going to reinvest that back into a long term play. And recognize that this is a cognitive bias, specifically the recency bias and loss aversion. And this resists the urge to jump back in. So conduct a brutally honest financial audit. So before you can rebuild, you must understand the full extent of the damage. This is not about self-blame, but about creating a clear picture of your current financial reality. And these detailed audit will be your map for the road ahead. So identify the full loss. Tally up every dollar lost. And this includes not only the principal, but also any fees, interest borrowed on funds, or opportunity cost. And categorize your remaining assets. List every single asset you still have, from checking account balance to the value of a car or your home, okay? Be meticulous. And document your debts. Don't run from your debt, okay? Don't run from your debt. You know you gotta pay it off, okay? Certain things that you might have piling off. I pray that you guys don't have any debt, but if you do, let's tackle that. Let's pay it off. Let's stay down. Let's get in stack mode. Okay, stay down, stack mode. Okay, get in stack mode for the rest of your life. Okay, only spending 50% of our income, keeping the other 50% in the stash. This way, after we pay taxes, we're still gonna have money left over in the stash, inshallah. So document your debts, create a comprehensive list of all your liabilities, credit card debt, personal loans, mortgages, etc. And after a $50,000 loss, for example, a trader might discover they only have $500 in their checking account and $2,000 in their savings account. They also find they have a $10K credit card debt occurred trying to recover the loss. Okay, so while they were just trying to make up for the money lost in cash, they were just spending money on their credit card debt. Okay, something that's happened to me, and I don't want you guys to go through that. It can be extremely daunting, extremely frustrating, and scary when you start seeing your debt pile up like that. So be financially responsible before you start trading, and don't trade with any money that you can't lose. So their audit reveals a negative net worth, but it also provides a clear starting point for a new financial plan. So focus exclusively on earning and saving. Stack mode, okay? Stack mode is about being a God-fearing, righteous individual, okay? And it's about staying down, okay? Saving up your money, because we got people that's protecting what we're ride for. We can't be spending all of our money on stupid stuff. We're gonna be investing smart, growing our money, and making sure our money is always making us more money. Money is gonna be a tool, okay? Don't use money just to consume. Use money as a tool in order to generate some more money. This way you can work, okay, less, okay? So as you get older, you're not going to be able to work the same, but you still gotta be generating some money. Inshallah, still gonna be people that need help, still might be family that need you, still might be people to take care of. So your money needs to always be making you money. So use it as a tool and set up your investments. So for now, all trading activity must cease. Okay, if you go broke, if you lose all of your money, trading is stopped. Okay, pause it. Your number one priority is to rebuild your financial foundation with stable, reliable income. And this is a period of accumulation, not speculation. So work on increasing your income. So every avenue that you can explore, whether it's working harder at your business, okay, trying to get monetized on certain things, okay, creating certain programs, lots of things you could do to generate wealth. Especially with AI, it's extremely simple to just choose a niche and jump straight into it and just work hard. Okay, so this can mean working more hours, okay, freelancing, certain businesses. Just do what you need to do to generate some more income. So create a strict budget. So develop no frills budget that prioritizes essential living expenses. So stack mode, right? So when you're in stack mode, you got to really be staying down. When you get older, you can't work 16, 18 hours a day. Okay, you're going to be too old, but you got to be using money as a tool still. You still got to be investing. You still have to be generating income. Okay, so this is why investing is going to be so important, inshallah. So while you're healthy, okay, invest your money so then when you get older and you can't work as long hours, you're still going to be able to survive. You're not going to be down bad. Okay, I don't want you guys to be broke, okay, with no options and just nothing to really just say that you did on this earth. Okay, so please save your money and get in stack mode. It's important. So every dollar should go towards building an emergency fund and paying down high interest debt, and eliminate high interest debt. So use strategies like the debt snowball or debt avalanche to aggressively pay down credit cards and personal loans, and this is a guaranteed return on investment. So a deep dive into education and risk management. So once your foundation is stable, okay, you started clearing your debt, you got your money back on track, it's time to re-educate yourself. Your previous approach failed, so a complete overhaul is necessary, okay? Lower your ego, and you have to completely change everything. Restart your mindset, restart how you think about everything, restart how you approach the charts in life, okay? Completely overhaul your mindset. Quit things that you used to do, okay? Start doing some new things, okay? And this step is about replacing reckless habits with a structured, disciplined methodology. Okay, so here's a market study. So dive into the market history, economic cycles, and different trading philosophies. You can go ahead and read books. I have so many videos too, okay? And you can go ahead and check out how to balance your account, okay? Do your research, okay? I also have an ebook as well too, free course, many free videos. Please just do your research before you hop onto the charts, trying to throw some money at it or trying to make some money, okay? Because you might just end up losing some money, and that's really gonna hurt. So do your research first, please. Master your risk management. This is a non-negotiable. Learn to calculate your position sizing, set your stop losses. That's an area where the price is gonna go ahead and close out your trade automatically if it hits that certain area, okay, causing you to only lose a certain amount of money. And never risk more than 1 to 2%, especially when you're a new trader. But as you get better, you can go ahead and bump that up to 1 to 10% of your account. And a well-defined plan is gonna be your roadmap for everything. It must include your entry and exit criteria, your risk-to-reward ratios, and a detailed list of rules that you're never going to break. So instead of day trading with leverage, for example, a recovered trader decides to focus on a long-term swing trading strategy in a single sector they've studied for months. Their new rule is to never risk more than 1% of their account on a trade, ensuring that a string of losses won't wipe them out again. Okay, you're coming onto the market to make some money. Or are you coming into the market and going back to zero? It's not making sense. So you need to be focusing on the trades that are going to keep your account alive, and not the account or not the trades that's just going to make your account money. Okay, money is not always everything. Focus on what's going to keep your account alive. Focus on the safety, okay, and that inshallah will transpire to profitability. So conquer your emotional demons. Okay, trading is going to be 80% of psychology. I've seen it firsthand. You can give someone the best levels and they don't close that take profit because they think it might go further. Okay, so psychology is going to be extremely important, and your perspective. So your biggest opponent is not the market, but it's going to be your own emotions. Okay, and a lot of times it's going to be the devil trying to attack you. So just pray to God, and just understand that it's just evil trying to decept you. Okay, anything that you guys might want to do to tempt you to do anything bad, it's all just evil. Okay, don't do it, because when you're crying afterward, when you're sad afterward, that just means that the devil got you. Okay, so don't be weak, be strong. Okay, and keep your head on. So you must learn to separate your personal feelings from your trading decisions too. Okay, so even if you take a big loss, even if you just went down to zero, don't treat people bad. Okay, don't treat people bad around you. Don't talk to anyone bad. Don't get emotional. Okay, I know there's some times when you take a loss, you can't even speak to anybody. Okay, I've had those days. I've definitely had those days, but you can't let the trading loss affects your real life. Okay, you have a whole life that God has blessed you with. Okay, there's still grass outside, you know, still fresh air, etc. Okay, so even if you lose all your money to trading, don't get depressed, don't spiral, and just manage your expectations. And understand that trading is going to involve periods of drawdown. Okay, especially when you're first starting. If you go down to zero, it's okay. Okay, many people fail with their businesses, have gone down to zero, failed businesses, and I wish you guys just know how much trial and error it takes to actually be successful. Okay, this is why God is important, so you don't go insane. Okay, it takes an extreme amount of trial and error. Okay, so winning every single trade, that's an illusion. Okay, in hindsight, kind of not really. You are gonna lose sometimes, but it depends what you're trading. You can win like 99% of your trades though. I can say that confidently. So focus on long-term probabilities of your edge, not the outcome of a single trade. So start a trading journal. Okay, document your trades on YouTube, Notion, Discord, whatever. Okay, coming out with the app, Stackmode app, where you guys can also track your profits and trades too. Okay, so document every single trade, your profit, your loss, your entry, your thought process, how you felt, and the outcome of it. This is going to help you identify recurring mistakes and any emotional triggers, and practice unwavering discipline. Stick to your plan no matter what, and do not chase trades, do not get greedy, and do not panic. Discipline is the bridge between your goals and your execution. So start with paper trading too. Okay, you can paper trade on TradingView. A lot of brokers too allow it. And don't jump back into the market with large sums of money. Wait. Okay, play with small percentages of your work check, your business check, whatever. Okay, pay your bills first, get some groceries, and then whatever you have left over, start investing with. Okay, let that grow over time. And by this whole time, while you're playing with small amounts of money, you're gaining info. Okay, so say your business, something like that blows up, when it's time for you to get into the big bucks, when it is time for you to throw it into the market, you're going to be well informed and you're going to be all good. Okay, so alhamdulillah. Okay, so it's a lot better being in this position versus being somebody who has a lot of money trying to come into the market with no education and then losing it. Okay, because that can hurt. And even if that has happened, it's fine. Just run it up again, inshallah. So start with the tiny account, scale it up. If you can't grow a small account to a big account, you can't grow a big account to a bigger account. That's just the truth. So increase your position size when your account grows through profitability. Okay, be disciplined and don't just keep adding more capital in your pocket whenever you're making bad decisions. Okay, you have to grow your account. Okay, let it grow through discipline. So losing money can be the most valuable lesson you'll ever learn. It's definitely taught me a whole bunch, got me closer to God, made me realize how unstable I was in certain emotional aspects. I realized I was extremely greedy. Okay, there'd be times I just wouldn't be satisfied with my profit. Okay, and that was leading me to spiral over and over and over and over again. Okay, leading me to take more trades than I need to, trying to chase more dollars, instead of just realizing if I would have just stayed disciplined, been consistent, then I would have gotten to the position of where I wanted to at the same pace anyways. So instead of trying to make $2,000 in one day, if you make $500 4 days separately, that's still the same amount. Okay, so just focus on the long-term vision. Okay, get rich slow, focus on the discipline, and confront your weaknesses. Okay, and rebuild your strength and your wisdom. Okay, God tells us to be reborn. And the journey back is not just about financial recovery, but it's all about personal transformation. And you're no longer the same trader who took on too much risk. You are a new, more disciplined, and more resilient individual. Okay, rebuild yourself back up and become a boss. Every boss has taken a major loss, and it's about bouncing back. Do you have that hustle in you? Okay, it's really gonna determine if you're built for this. Okay, if you have that hustle in you, you'll run it back up. All right, God got you. Don't give up. You got people to provide for. I love you so much. Head over to Stackmode Network for all trading and business education. Catch you in the next one. Peace.
If you're not familiar with cryptocurrency or how it works, let's fix that right now, because today you're getting the ultimate beginner-friendly guide to cryptocurrency that actually makes sense. No hype, no jargon, and just straight clarity. Crypto isn't just internet money. It's a digital system that lets you send, store, and grow value without needing a bank. And the best part, you don't need to be a tech genius to start. You just need the right roadmap, and I got you. Step 1, I'm going to teach you guys how to understand Bitcoin. It's the foundation. Think of it like a digital gold, and know the difference between coins and tokens. Coins run their own blockchains, and tokens live on blockchains. I want you guys to understand risk management, because new investors lose money because they skip this. Never invest based on hype. Always focus on projects with real utility and making sure that it's putting a smile on people's faces in the future. Let's go on, let's jump in, and let's understand what cryptocurrency is, inshallah. So let's go and let's do a deep dive onto crypto and let's understand it, inshallah, if God wills. So why does crypto matter in the first place? It solves the trust problem. So traditional money relies on banks, okay? So the money sits inside the centralized bank system, okay? And within that system, people can only make certain decisions with their money. If you have 100,000 parked in the bank, you can't go to the bank and pull all of it out immediately. Same thing with certain apps like Cash App, Zelle, etc. There's going to be withdrawal limits, and there's going to be deposit limits as well too. Okay, due to the fact that the bank has to centralize and control everything, so that on their end they have to have enough money to distribute to everybody. Okay, because the bank is using our money. So understand that if the bank freezes your account as well, then your money is going to be gone. Crypto solves all of this. It's censorship resistant. No government can stop a Bitcoin transaction, not a single one. You could be in any country in the world, and it makes it permissionless. That's the main reason why people fight so hard for cryptocurrency. It's because it's righteous. You know, everything doesn't need to be rat race and controlled, especially with other things being as controlled as they are. You know, you have to go pass emissions for your car before you can drive it and do certain things already. So the fact that we can't spend our money or withdraw our money how we want is a problem. It's a problem for me and a problem for many other people. And thank God we have the resolution for this. Cryptocurrency has come into play to solve this. Also, it becomes an inflation hedge too. So central banks continue to just keep on clicking print. Okay, they print money constantly, over and over and over and over again. Keep on clicking the print button. Okay, making it worth less. And Bitcoin has a fixed supply, which makes it scarce. Okay, and that scarcity has a lot of value built into it, just like gold, diamonds, etc. Anything that has less or has a strict supply, okay, is automatically going to go ahead and be valuable. Okay, anything that has less supply than something else will be more valuable a lot of the times. And cryptocurrency is giving you true ownership on your currency. Okay, you could be in any country in the entire world, as long as the country has a bank account system that lets you withdraw from certain brokers, okay, such as Coinbase, etc. You can take that money from your cryptocurrency, spend that anywhere in the world. You don't even have to transfer it to fiat currency if you don't want to. You could easily just get your cryptocurrency, spend it on like a Coinbase card, and you can easily just spend your cryptocurrency straight up without having to transfer it to a centralized bank. So you can be completely your own bank. You have total control and total responsibility for your money too. So there's also going to be a couple things that come into play with this. So say things like fraud. If you make a transaction on mistake, okay, for a bank, you could call them up and be like, hey, I did this on accident. Could this be reversed? And a lot of the time, since it is a controlled system and it is technically kind of their money also, so they have the ability to, you know, pause things, freeze things, and make certain transactions not go through in case ever needed. And that could be in a good thing or a bad way too. Because say for instance, you're trying to send some money to a family member in another country. They could also decline that wire transfer if they wanted to. Cryptocurrency, nobody can decline your transactions, okay? Nobody, okay? You are gonna be your own bank and everything works on autonomous smart contracts. So on a normal bank, if you wanted to send $10,000 to somebody, once again, the bank has the ability to say yes or say no, okay? It's gonna be completely up to them. But if you send it via cryptocurrency, instantly it'll go ahead and get sent over, okay? But that's also putting more responsibility in your hands too. So because of that, you have to be making sure that you're sending your cryptocurrency to the right addresses, and you have to making sure you're sending the right type of cryptocurrency and sending it via the right type of networks, okay? So because you're your own bank, you have total control, okay? But that also means a lot more responsibility. So before you send certain cryptocurrencies and stuff like that, etc., make sure you confirm every single address that you're looking at. This way, you'll be able to ensure secure transactions and making sure that you're getting your money and making sure that your transactions are hitting the way that they're supposed to. Inshallah. So under the hood of everything, right, let's go and let's talk about the blockchain. So miners and nodes. The blockchain is not magic. It's a global network of computers, okay? So nodes, let's talk about them. Nodes are computers that keep a copy of the ledger. Okay, they verify that you actually have the money that you're trying to spend in the first place. Okay, and let's talk about POW. POW is going to go ahead and stand for proof of work, and it's how Bitcoin is created. Okay, so specialized computers that secure the network using energies, and they compete to solve math puzzles and problems to add the next block. Okay, so what's happening is these computers are constantly running problems through it, okay, trying to figure out what is going to be the next block that needs to be added, okay, into the hash,
etc. Okay, and these computers take up a lot of power. Okay, so consensus of it: 51% of the network must agree on the truth. Okay, hacking it requires impossible amounts of energy that just doesn't exist, because it would have to go ahead and determine and calculate so many different type of numbers and transactions in order to see what next block would even have to be added into the equation. Okay, so mining is how Bitcoin is generated, okay, and not by pickaxe mining. Okay, so check it out. Just like we know diamonds and gold, you need like an actual pickaxe or a drill, etc. Okay, and then people go out there, find it in the caves. Bitcoin works a little different. Okay, the computers have very powerful graphics cards and intensive hardware inside of them. Okay, and what they're doing is that they're solving problems constantly. Okay, so it's answering like 2 + 2 and trying to find the equal sign. Okay, testing out every math puzzle. Okay, trying to find the next block. Okay, and when you do that, okay, you get rewarded with Bitcoin. So that's how Bitcoin is created. People have powerful computers that take up a bunch of energy, okay, which is why it can be expensive to mine Bitcoin as well too. And then those computers are trying to solve complex problems. Once those problems are solved, then the miner is then paid in Bitcoin. And that's just how it works, and that's how Bitcoin is created. So let's go over the big three, right? The big three. So the big three are going to be Bitcoin, okay? You're going to have your Ethereum and Solana, and then you're going to have your stable coin. So let's jump into each one of these and break it down. So you're going to have your Bitcoin, okay? Bitcoin is going to be the most valuable cryptocurrency as of today's date, due to the fact that it's not infinite, okay? There is a limited amount of Bitcoin. There's going to be 21 million Bitcoins available. It is not an infinite cryptocurrency such as Ethereum, Solana, etc. Okay, so that's why Bitcoin right now is the most valuable cryptocurrency. Okay, it's slow, secure, and most importantly, scarce, giving it baked value already. And it's not for buying coffee, okay, but you can if you want, but it's for preserving wealth over decades. Okay, so think of it as digital gold. So understand that Bitcoin is here to fight against inflation, because if these dollars keep going up, say 10 years ago, right? Say rent was $700 at one place, okay? And in today's day and age, say the rent is $1,400, okay? That means that the rent doubled, okay? But did people's income double? Okay, that might not always be the case. So when you park your money into an asset, something like cryptocurrency, okay, year after year after year, your money's going to grow just as inflation decides to grow too. So it's going to give you a hedge against inflation and being able to protect yourself from the economy going in a downwards direction, inshallah. So let's talk about the smart contracts. So just like we talked about, Bitcoin was created by computers that use power, okay, POW, proof of work, okay. Ethereum was created based off of staking, okay, POS, okay, which is going to be a lot less economy taxing system in order to create cryptocurrency. So pretty much Ethereum came out to prepare for when Bitcoin does go away, okay. So the computer, okay, it's programmable money, and apps like DeFi and NFTs are built on top of these, okay. Think iOS or Android. And for Solana, the reason why Solana is going to be really important too is because it's going to be used in order to trade meme coins, okay. I'm sure you guys have heard of that. And meme coins can't be traded until you have Solana first. And then you're going to have utility and stable coins, okay. So this is kind of going to be like the fiat currency version of cryptocurrency. So instead of parking your money into a token or coin or something like that expecting some profit returns, okay, stable coins such as USDC stay at $1, giving you a safe place in order to park your money in the cryptocurrency world without it fluctuating up and down all the time. So utility tokens like Link provide data feeds, and meme coins like Doge are communities built on certain factors, okay. So figure out what you want to invest in, figure out what works for you, and let's go and let's keep going. So whenever you start trading cryptocurrency and you generate a wallet on whatever broker you choose, okay, you're going to get a 12 to 24 word phrase. And this can be used to log into your account. So if you don't want to sign in with a usual email and password, because you know those can get hacked, etc., okay, you can use a seed phrase. Okay, it's going to give you 12 to 24 random words, and you can keep these words safe in order to get back into your account. So with cash, say the problem with that, you know, if you have a bunch of cash stashed in your house, it can get moldy, you can get robbed, the house can catch on fire, etc. A lot of things could happen to cash. Okay, but with your cryptocurrency, it's like keeping your cash but digital. Okay, and it's not behind a email and password, it's going to be behind your seed phrase. Okay, so you can write your seed phrase down. Okay, it's going to be 12 to 24 random words. Make sure you write them all in a row. Okay, they're going to be listed like 1, 2, 3, 4, 5 to 12 to 24, etc. Okay, so make sure you have the order correct, because that definitely does matter. Okay, try and write your seed phrase on a piece of paper, a notebook you have, whatever. Okay, and never screenshot it. Okay, never screenshot it. Okay, Apple, people can get into your iCloud, and then people can get access to all of your funds. Okay, try not to type it onto a online computer software, like no Google Docs or anything like that. If you do, try to just keep it on a flash drive. You can do like a notepad .txt file, something like that, and you can password protect it with 7-zip, WinRAR, anything like that too, if you want it as well. Just try to keep it as secure as possible. So if you lose this, your money is going to be gone forever. Okay, no support desk can help you. Okay, it's just going to be gone, out of existence. Okay, and it cannot be recovered. So make sure you guys are keeping your seed phrase secure. Keep it safe, because this is going to be your longevity. This is going to be your money, and this is what's going to take care of you. Okay, you guys don't want to be losing this. Okay, inshallah. So let's talk about the trade-off of everything. Okay, let's talk about CEX versus DEX. Okay, so CEX is going to be centralized. Okay, so whenever you're thinking CEX, think of the normal traditional bank system. Okay, so pros, right? You got some easy customer support. It's pretty easy to get your money back whenever things happen, but there's also going to be things that come into play. Okay, sometimes you might have random 3 a.m. maintenance. There's been times where my crypto had to come clutch because my centralized bank is doing maintenance. Okay, but my cryptocurrency was available, thank God. Okay, there's also been times where your funds can be frozen. Okay, and there's also going to be that Monday through Friday window in order to get paid. Okay, so times correlate versus when you get paid. On the decentralized network where cryptocurrency is traded, doesn't matter. Everything is based on the peer-to-peer transaction system. Okay, if I send 10K to somebody, it'll most likely be in their account within a couple, or their crypto wallet within a couple of minutes or hours. Okay, if I send someone 10K via wire transfer, okay, it would have to be via Monday through Friday. Okay, and it would have to hit at like 6 a.m. or like 9 a.m. or something, some time like that. And keep in mind, the centralized bank, if they wanted to, could completely decline the transaction. Okay, decentralized, everything is peer-to-peer. No one can decline anything, but no one can also recover your mistakes if you make any. So it's decentralized, okay, giving you total privacy, you keep custody, and instant swaps are going to be available. But understand that there's no customer support. Okay, if someone says, yo, send me 10K Bitcoin, and you send them Solana, that's it, man. Okay, you have to understand that that's it. So there's an extreme responsibility. So make sure you guys are staying humble. Make sure you guys are staying focused. Make sure you guys are waking up and praying to God, most importantly, and keeping your head on straight. Okay, you don't want to be having a moment of franticness or having bad mental health and making an accidental decision where you just lose all your cryptocurrency. Okay, please don't do that. And let's talk about what gas fees are. Okay, and I'm not talking about gas that you put in your whip. Gas fees are going to be every transaction that has a tiny fee attached to it. Okay, that's going to be a gas fee. Okay, any crypto transaction that has a fee attached to it is a gas fee. So on Ethereum, this can be like $5 to $50. On Solana, it could be like 0.0001. Okay, so your gas fees will go ahead and fluctuate depending on what asset you're buying and purchasing. So let's talk about the dangers of everything. Okay, we want to make sure we're being as safe as possible. So the fat finger error, this has happened to so many people. Okay, if you send Bitcoin, okay, but then they're asking for Ethereum, it's deleted forever, or some random person is going to go ahead and get the money. Okay, crypto transactions are completely irreversible. Always send a small test amount, especially if you're sending big amounts. Okay, if you're about to send 10K, see if $5 goes through first. Okay, if they get that, then go ahead and send it again. Okay, take your time. Do not make fast, overzealous decisions, because you can very quickly destroy and lose all your crypto value on accident too, is really the crazy thing. Okay, so if you want to trade cryptocurrency, you say you're ready to be your own boss, be ready to stand on business, CEO. Okay, you got it. I believe in you guys. Manage your currency well. And social engineering. So hackers won't break the blockchain. Okay, what they'll try to do is trick you. Okay, they pose as support agents or send fake website links. Okay, or what they'll try and do is be like, oh, here's a 12 to 24 seed phrase, word seed phrase, and you can come in and try to log in and you'll get all this money. What they want you to do is deposit into that account. They have access to it, and then they go ahead and clear the account. Okay, do not log into anybody else's crypto wallet. It's not worth it. Stay logged in on your wallet. Stay focused on your bag. Don't try to rob nobody. Don't try to get no money from nobody else. Stay focused on you and yours and what God has planned for you. And bear markets. So crypto sometimes has winter cycles, just like the stock market, where prices can drop 80% for certain cryptocurrencies, especially if they're not valuable, and stay down for years. So only invest money that you can afford to lock away for plenty of years. Okay, you should be on the brink of almost death before you pull out your money from your cryptocurrency wallet. Okay, try not to pull out your crypto wallet. Try to live off your credit card. Okay, and invest all your cash into assets if possible, inshallah. So the psychology behind everything. Okay, so time in the market, okay, is going to be a lot better than timing the market. Okay, so too many people are trying to time the market for exactly what it is every single time. But understand that sometimes you just gotta be in the trade for some time. Some of you guys are closing your trades way too early and wondering why you're not profitable at the end of the year. Okay, you need to have your life together outside of the markets so you can actually sit on your plays for some years and build some actual capital. So don't buy at the top. We're gonna go ahead and go over some chart work too at the end of the presentation, just so I can go and let you guys know some quick sauce. So try not to buy at the top of all-time highs. Okay, wait for market to dip down. Okay, and then catch the sweep back up. Okay, but do not buy at all-time highs, because a lot of the times you're just going to go ahead and eat a pullback straight down. So the DCA strategy, DCA stands for dollar cost average. Okay, so you can go ahead and set up an auto buy. You can set up a certain amount of money per week too, if you wanted to. And even if you did buy all-time highs, because your cryptocurrency is really going to be more like savings more than income. Yes, you're still going to be making great income after the years do pass, inshallah. But for the most part, it's really going to be more of your savings. So even if you did buy all-time highs, you can have that consistent amount that you're constantly investing in. Okay, I don't care if you do $50 a week, $20 a week, $500 a week. Just choose whatever's comfortable with you for your income level. Okay, and come back in 5 years. Okay, and I'm telling you, most long-term investors who don't even look at the charts outperform 99% of day traders. Okay, and that's a very, very, very true statistic. And you guys are going to be able to touch millions, okay, if God wills, without stressing yourself out, by just making the right play, by just watering your seeds today. Okay, so start growing your account, be patient, and keep going. So here's some golden rules for cryptocurrency. If it's not your keys, it's not your coins. Okay, if you have your cryptocurrency parked into a broker that's email password and doesn't have any recovery keys or secret keys, it's not really your cryptocurrency coins. If the broker shuts down, then boom, it's not really your true crypto in your hands. So I recommend like Phantom Wallet or anything like that, where you guys can digitally store your crypto very, very safe. You can also store them on a hardware physical device as well too, where it be the USB drive or whatever. And the golden rules of everything, right? Never share your seed phrase. Okay, your seed phrase is going to be that 12 to 24 word phrase. Okay, that's going to go ahead and keep your account locked. Okay, you do not want to be giving out your seed phrase. Okay, you lose your seed phrase, things can get difficult. Okay, no customer support you can call to just get your money back. So ignore direct messages. Don't log in with anyone 12 to 24 word seed phrase thinking that you're going to get money. Stop. Okay, purge any type of mindset where you're thinking about stealing or getting quick, easy money. Purge that. Okay, invest only what you can lose. Make sure you guys are paying your bills first. Don't think you're about to invest in a cryptocurrency and you can ignore all your bills because you're about to hit the best play ever. That's not how a real investor would play. Okay, structure your life, get it together, and then come onto the market. Okay, and do your own
research. Okay, don't just get in because your friend said, yo, this is going to be the best coin ever. Don't do that. Okay, because then you're not going to have enough conviction and confidence to hold through volatility. Okay, if this is the play you've been researching for weeks, month after month after month, if price dips, you're going to have so much conviction, and you might even re-add. Okay, so it's going to be a lot of things when it comes to buying cryptocurrency. So let's go in how to read the chart. So reading the chart is going to be quite simple. What we're going to do is focus on our higher time frames. Okay, so what I'd like to go ahead and do is go for my monthly time frame. Okay, then from there, I'm going to go to my weekly time frame, daily, and then 4 hour. Okay, so we're going to go from the monthly to the weekly to the daily to the 4 hour. Okay, and when we do this top-down analysis, we're going to be able to get the full bird's eye view of absolutely everything, just so we can see the full perspective of the market. So always start off on your highest time frame first, then scale down. Okay, and the smallest time frame I'm going to go to look at the cryptocurrency chart is going to be the 4 hour chart. Okay, because cryptocurrency, you want to be holding for weeks, months, and years. So focus on your higher time frames. There's no reason why you should be caught up on the 5 minute, 1 minute, 15 minute trying to trade cryptocurrency. It's not the wave. You need to have the full higher time frame picture so you know how many years, months, weeks to hold for, etc. Also, before we get into the chart, understand that cryptocurrency always wants to go in an upwards direction. Okay, most people can only buy, and this is the same thing for stocks too. Most people can only buy. Okay, most brokers don't let people short cryptocurrency, etc., unless they're trading crypto futures. So the fact that most people can only buy means that it's meant to go up year after year after year after year after year. Okay, so we do not want to be buying at all-time highs if possible. Okay, so what you want to do is wait for what's called a pullback. So pretty much buying anywhere other than all-time highs. So all-time highs is going to be up here at this current level of 126,000 right now at the time of this recording. I'm on my monthly time frame. I can see on the monthly time frame this chart goes up year after year after year after year after year. This is a bullish asset. So I'm going to go ahead and go to my weekly time frame. Okay, and I understand something about the market. I know market always wants to go in an upwards direction if the asset is going to be valuable. Okay, which means people are always going to be looking for an opportunity to buy. Okay, because they expect for it to go up year after year after year after year. So with that logic, I know that price always wants to go and head to break previous all-time highs. Okay, that way it can continue to keep going. Okay, you can see all price does is break all-time highs. Okay, and then it'll go ahead and fall below it. Okay, and then make some new all-time highs. Okay, we'll fall from there, and then one day, inshallah, we'll try and get above this all-time highs too. Okay, and then we continue to go in an upwards direction. But within the chart, we have to understand that price has to go up in order to go down, and price has to go down in order to come up. Okay, so price will always hunt an area of resistance above current price, or it's going to go ahead and hunt an area of support above current price. Okay, so always know that. Okay, price will always hunt an area of resistance above current price or an area of support above current price. So the strongest area of resistance on every chart is going to be all-time highs. Okay, so you want to also be focusing on things that trend too. So if I'm looking at Bitcoin here, okay, I can see Bitcoin goes up year after year after year after year after year. If it's not trending up year after year after year after year after year, it's a lot of the times it's going to be a lot more straining to make some profit within the decade's time span. Okay, so next thing you want to be looking for is the V structure. Okay, so all your setup should look like a V. So here's what I mean by this. So the reason why I say the V is because market will always make the left side of the V for you. Okay, the left side of the V is going to go ahead and be what's called resistance. Okay, so whenever you see market falling within a downwards direction, that's going to be called resistance. Okay, so market will always make the left side of the V. Okay, it'll always make the left side of the V, and it'll also make the bottom of the V. So many people try to predict where market wants to bottom out at, and here's how you know if a true area of support is real. Okay, make sure you're on your weekly or your daily time frame. Okay, and then from there, once you see market deciding to curl in an upwards direction after falling heavily, okay, how you confirm to see if the V is real. So here we have the left side of the V. Okay, we got market trying to make a bottom of the V here. Okay, but we want to see if the right side of the V is real. Okay, so the whole right side of the V, all this whole gap up here to the previous area of resistance is going to be money that we're just waiting to collect. Okay, all of this is just going to go ahead and be money. So all your setup should look like a V. Okay, try to buy when market is curling in a upwards V direction. Okay, all your setup should look like you catching the right side of the V. Okay, so that's how you know when it's time to buy. Try to buy at certain lows. Okay, let market make the left side of the V, and let market make the bottom of the V. Okay, let market make the left side of the V, and then let market make the bottom of the V. After you're on the daily, you start seeing like 2 to 5 candlesticks going in upwards direction. Okay, that's how you know the support is true. Okay, you don't want to just see one little wick, okay, and see it going up and be like, oh my gosh, it's going up from there. But if you see multiple days in a row, okay, price hitting an upwards direction, the chances of this support holding is going to be really, really high. Okay, especially after it dumped down for many, many, many days. Okay, so cool. So that's going to be the full guide on how to trade cryptocurrency. If you guys want some more one-on-one mentorship, head over to Stackmode.net. Come on and book a free call. Or you can check out my free course and ebook. Stay prayed to God. Keep grinding. I'm going to catch you guys in the next one. Let me know what you think in the comments below. Peace. Let's go ahead and talk about crypto wallets. So I want to go ahead and break down the difference between hot wallets and cold wallets, as well as keeping your crypto secure by making sure you guys lock down your seed phrase. So let's jump into exactly how we can secure our cryptocurrency. Inshallah, if God wills. Boom. Let's talk about how to secure your crypto like a pro. So if it's not your keys, it's not going to be your coins. I want you guys to understand the difference between ownership and just keeping your keys on a broker that if they get shut down or something like that, you won't have access to your crypto, or they could even limit how much crypto you could send, withdraw, deposit, etc. And that's not what you want. The whole reason we're trading crypto in the first place is so we can have some freedom over our money, inshallah. So let's talk about it. So hot versus cold wallets. So the vital distinction, understanding where your private keys live is going to be step one. Understanding where your private keys live is going to be step number one. So the hot wallet is going to be online. Apps on your phone or your computer, for example, Coinbase or MetaMask, keys are on a device connected to the internet. Convenient, but can be hackable. If people guess your Google or hack into your 2FA or multi-factor authentication, etc., then they're going to be able to have access to your crypto. Not what you want, because then they're going to have access to your money. So let's talk about what a cold wallet is. So a cold wallet could be like a USB drive, a little block device, etc. And it's going to be a physical device, and it's a hardware wallet that stores keys offline. And it never touches the internet, and it only signs transactions. So what you can do is buy your crypto on a hot wallet and then transfer it to a offline cold wallet. So it's kind of going to be like cash, but cryptocurrency. So you guys are going to be able to transfer it to hot wallets and transfer it to your bank if you ever need to, etc. So a cold wallet is pretty much going to be like cash, but for crypto. And a hot wallet is going to be like the online live store where you can purchase and store cryptocurrency as well too, but it comes with limitations. Let's continue on. So the seed phrase, also known as the recovery phrase, make sure you guys keep this safe. I don't care if you guys put it inside of a notebook, if you guys write down the keys on a piece of paper. A lot of the times it's going to be a 12 to 24 key word phrase, okay? And it's going to be random words like this. So for instance, like which, collapse, practice, feed, etc. And then 24, some brokers only do 12, okay? So when you create a wallet, you get 12 or 24 random words, and this is going to be the key to your vault, pretty much. If you lose the words, okay, then you cannot get access to your vault. Once again, if you lose the words, you're not going to be able to gain access to your vault. So never type it in on a computer unless it's somewhere where you feel it's secure and safe. Try not to take
photos of it because people can hack into your iCloud. I'm not too sure about Google. I haven't had a Samsung phone in a few years, but I'm sure there's going to be ways that people could access your photos too. And try to write it down on like a piece of paper, multiple piece of paper if you can. Store it somewhere, you know, in case paper gets burned, lost, wet, etc. And try and just store it password protected. If you do store it online, there's going to be ways to password protect your documents. You guys can put it inside of a WinRAR file. WinRAR is going to look like the stack of books. It's going to be an icon. And you should be able to put a .text file, .txt. And you could put it inside the WinRAR and then password protect it. And then you could upload it somewhere, wherever you want, because only you know the password at the end of the day. So keep these words secure and safe. Please, for the love of God, do not lose these words. And there's going to be a lot of phishing scams and stuff like that too. You're going to see online like, hey, I lost my account, and it's going to be a bunch of random words like this. They want you to log in, buy crypto, and they're going to try and take your money. So never try and take people's money. Never log into somebody else's wallet. Okay, be righteous, be focused on God, and be focused on your bag. Stay in your bag. Don't try and scam. Don't try and do little weird stuff trying to get some money real quick. Stop it. Okay, be genuine, work hard, and most importantly, pray every day. So keep these words secure, and you guys can also keep these words for your kids, your family down the line, etc. Just as long as you keep it secure. Stuff happens in life though. Once again, papers could get wet, fires, etc. A lot of stuff goes down. But if you write it down like some metal, keep it with you, and upload it to multiple sources with a password protected form, then you could have your money secure in a nice way. Let's continue on. So hardware wallets, okay, the standard. Boom. Physical security. To be a pro, you must move significant funds off exchanges such as Coinbase, okay? And how it works. The device generates keys internally, and the keys never leave the chip at all. And you must physically press buttons on the device to approve any outgoing money. So hackers cannot press the buttons remotely. You got to have the actual cold device in front of you. Now, you can't be running your mouth telling everyone on the block like, yo, I got 10,000, I got $1 million on my crypto wallet right now. You know what I'm saying? That's not playing a good game. Still, you got to be secure, just like if you have cash. You know, you got to worry about little security things. And for verification, you must physically press buttons on the device to approve anything. Okay, so unless somebody actually has it or robs you, God forbid, okay, keep it safe, keep it locked away, keep it inside of a safe, even if you got to, and just keep it secure. And some popular brands are going to go ahead and be Trezor, there's Ledger, Cold Card, and Bitbox. There's going to be some other ones as well too, and they pretty much just look like little USB devices. Now, let me go ahead and tell you guys about something. May God bless his soul. There is a guy who lost his hardware wallet, and he had a bunch of cryptocurrency on it. And he spent millions of dollars clearing a trash excavation site trying to look for it because he accidentally threw it away. So it just like cash, you got to take care of it. There's been times where I've had cash inside of my coat pocket and I accidentally put it inside of the washing machine. And thank God you could wash cash, so it was okay. But like little things like that, like you got to just be on top of it if you're going to have a cold wallet. So if you're lazy, if you're not consistent with your things, you know what I'm saying, things like that might got to change. Pray on it, get better, improve, and just understand that the hardware wallet and cold wallets, you got to take care of them. It's going to be secure, but you got to keep it secure yourself in real life. All right. And the passphrase, the 25th word, the hidden wallet. Advanced security feature supported by most hardware wallets. So the seed phrase plus the passphrase equals a totally new wallet. So if someone finds your 24 words, God forbid, they see wallet A, okay, and it's going to be more of a decoy, okay, a dummy, a fake, but your real money is going to be in your wallet B, which requires the extra word that you memorize. So if you forget the passphrase, then the funds are going to be lost forever. No recovery, there's no support you can go run to like, hey, I lost my money. Like, no, you want to play cryptocurrency, you want to invest in a cryptocurrency, you got to have the responsibility of pretty much being your own bank. Okay, you control when you send your transactions, you control how you store your transactions, and be on top of your stuff. Okay, just like if you're your own bank, you could choose between cash, digital currency, etc., whatever you want. Okay. Same thing with cryptocurrency. You can go hot wallets, cold wallets, find your sauce, do your thing, and do what feels right for you. Okay. If it feels right in your stomach, then that's just what it needs to be. Okay. So fire and flood protection. So paper burns. Psh. Writing your seed phrase on paper is going to be risky. Houses burn down, pipes burst, stuff could get wet. So you could use things like steel plates. Use a center punch, if you guys have ever seen that, kind of like the things that look like Braille. So you could use a center punch, or you could use tiles to record your seed words on a stainless steel or titanium surface. This way that if anything happens, such as a disaster, God forbid, as long as you don't lose it, it's going to go ahead and be indestructible for the most part. It can survive house fires up to 2,500 degrees Fahrenheit and corrosion, and as well as any water and things like that. And it's just a one-time cost, kind of like a safe if you wanted to keep your cash, jewelry, etc. safe. So it's a small price to pay to secure your life savings absolutely forever. So keep that in mind. There's going to be multiple things you could do, multiple ways you guys are going to be able to keep your money secure and safe. But keep your money to yourself. Okay, evil eye is going to be a very real thing in the world, sadly. So don't be running around telling everyone on the block where you have your cold wallet, where you have your phrase, etc. Okay, keep it just between you and your family, inshallah. So as far as the security checklist, right, let's ask ourselves, do we buy a hardware wallet? Okay, because if not, you could go ahead and invest into a Treasure, Ledger. There's going to be multiple ones you could check out. Hop on Amazon, eBay, the internet. There's going to be some hardware wallets you could check out. Okay, God wills. And write the seed phrase on steel. Try not to do it digitally just in case you ever get hacked, God forbid. And never type the seed phrase into a computer or a browser unless it's password protected. If it's password protected, okay. And try to use the extra passphrase for extreme large amounts in case somebody ever gets your 24 words. And always do a small test transaction first. Okay, you want to do a small test transaction first. So that's going to go ahead and be it. I love you guys so much. Stay prayed up to God. Keep grinding. Don't ever give up, even when things get hard. Pray to God every single day. Try to work out if you guys are feeling any type of anxiety or anything like that about your money. Keep it secure and don't be overly boastful. Okay, spend moderately, and catch you guys in the next one. Read Quran and listen to God. It's the easiest way to be successful. Catch you guys in the next one. Peace.
All right, class, we've all heard about passive investing, how we can live off our money, just making this money infinitely and forever. Let's talk about one of the most popular ways of how to invest and how to live off passive income through what's called dividend investing. Let's jump into it. So let's understand what the core is and what are dividends in the first place. So let's break down the definition and the mechanics of a dividend. So a dividend represents a distribution of a portion of a company's earnings decided upon by the board of directors to its shareholders. And it's essentially a reward for owning a piece of the business. So shareholders pretty much get rewarded for investing into whatever ETF they invested to, whether it be SCHD, BTIC, QQQY, any dividend that you invest to, which is going to be a bundle of stocks essentially. And instead of just investing into one stock individually, you could buy a ETF, which pays out dividends, and certain stocks pay out dividends as well too. And they pretty much give you your money back for investing it. They say, hey, thank you so much for investing into us. Here's some money back. Okay, so you can use that into an infinite loop and invest into that and live off the passive income. Okay, so it's essentially your reward for owning a piece of the business and the investment. So it's a source of income. So unlike capital gains, which is required when you're selling a stock or when you sell at the highs, dividends are going to be more of a direct cash flow, and they're often paid quarterly. And this creates an immediate tangible return on your investment. And they're on a fixed payment schedule. There's some dividends that pay annually, once a year, quarterly payments, which are going to be between January, April, July, and October. Okay. Some companies and ETFs pay monthly, and some pay semi-annually or annually. And the key is going to be consistency, depending on the type of income that you're looking for. Do your research before you invest in any type of dividend ETF or stock to see what type of cash flow you're going to be getting. Okay, you don't want to be investing in something and see one ETF or dividend pays out every month, and then you invest into something that pays out once a year, and you're not getting the cash flow you expected. All right, don't just ride somebody else's wave. Make sure you guys are doing your educated research. There's so much free information out there. Head over to Stackmode.net if you need some more investment education. So let's talk about some tax implications, right? So even though dividends can be reinvested, right? So let's say you are getting $5,000 a month from a dividend, right? That dividend money is still taxed. So even if you reinvest all $5,000 of it back into whatever stock or ETF you invested into to get the money in the first place, it's still going to be taxable. Okay, so keep that in mind. Break down your income. Make sure you guys are putting a percentage away of your dividend income away so you don't get taxed on Uncle Sam. You pay your taxes by the year. So let's talk about some declaring dividend dates, right? So the crucial dates include: 1, the declaration date. The declaration date is going to be when the board announces it, and the ex-dividend date. Okay, the cutoff to buy and receive the dividend. That's what that date is. And the record date. That's the shareholder list check. And then we're going to have the payment date, which we're all looking for. Okay, the payment date is going to be when the funds hit your account, and you can go pay your bills, pay your debt, or go ball out, take your family on the trip, do what you need to do. Okay, and you must own the stock or dividend ETF before the ex-dividend date to qualify for the payment in the first place. So the power of compounding, right? Your wealth engine. All right, so look, if you're in your bag for, say, a couple of years, you're grinding hard, okay? You're waking up, you're praying, you're working out, you're grinding your business. Say you run up a couple of M's within, I'll say 5 years, 1 to 5 years, you run up around 1 to 5 M's. You could put 2 of those M's into an ETF, stock, etc., and potentially live off of that passive income forever. You'll be getting around $5,000 to $10,000 a month. There's no reason to ball out, start spending $100K a month. There's no reason to live that, that crazy. Stay down, you can still take your nice trips, and you could pay all your bills and live in a pretty nice house for $10,000 a month. And that's just that income alone. Okay, so you can leave your business income alone, leave it for your kids, leave it for your family, your husband, wife, family, grandma, whatever. Okay, and then stay down, pay your bills, make sure you put in money away for taxes though, pay your bills, do what you need to do, pay your mortgage, rent, whatever, with that dividend income, okay? Because we're only getting older day by day. Tomorrow's not always promised, God forbid, there's gonna be things like sometimes people go disabled, So we wanna make sure we can still feed our family if any situation occurs. So what we're gonna do is plant these seeds now, today, okay? So even if you go disabled, even if you die, your family can still be eating, because of the fact that you planted your seeds. Okay, so stay down. You don't gotta pop it. Save, save a little bit. Sometimes it's not time to pop it. It's not time to be outside. Okay, if you work outside, eat at your job. Okay, if you can, any type of food court, try not to spend any type of external money. Okay, try and get what you can, any type of discounts, go back in the house. Okay, if you work in the house, no DoorDash, no Instacart, no, none of that right now. Okay, let's try and stay down. And if you are gonna DoorDash, don't DoorDash individual meals. It's something my wife really helped me out with. Okay, I was realizing how much money I was spending on individual meals, wasting my time, wasting my money, when that could have been going into some Bitcoin, going into some dividends, etc. Okay, making that income grow. Okay, get some groceries, buy 1 bundle of groceries. Okay, a couple times a month, and your income is gonna be spread out a lot more strategically. I promise you. All right, so think about it. Reinvest your dividends as well too. Okay, so once you start stacking up some cash flow, don't get fancy in life right away. Okay, that's something that could really hold you back. Okay, once you start getting financially free, once you clear that debt that's been haunting you down, as you guys been waking up praying to God to just go away so you can increase your income. All right, once you pay off that car, okay, once you get the debt off your back, please don't immediately go get fancy with your life and put yourself right back in the hole. Okay, use the dividend income and stack up. Okay, stack up, get some reserve for yourself. Okay, and take that dividend income and replace the bills, even if that's the case. Okay, even if you guys are getting $400, $300 a month from dividend income, that's your car note now taken off. Now you have $400 extra to either A, put it into some business. Okay, you can go donate, do what you need to do, take care of your mom, take care of your family, that's some more grocery money, or put it into some Bitcoin, options, futures, Forex, whatever you want to do. Okay, just the fact that you have that money stacked away though into something paying you out a consistent dividend, you're not going to get bills chopped off. The more bills you have chopped off, the more free cash you're going to have to play with. Okay, the more you can help your family out, do what you need to do, and just stand on business. Okay, if you want to go put some money into your business, do that. Okay, get some more income flowing, then take that income, increase your dividend income, and that way you guys can pretty much live off of doing nothing. Okay, if you have a month where you know what, say be like, I've been hustling hard, I just want to focus on myself, I just want to get closer to God, I want to work out. Okay, I want to start just working on myself. Okay, you guys can do that. Okay, you could take 3 months off because you're gonna be good. You planted your seeds in the dividend income. Okay, you're getting that money every single month. Okay, you could take time, get closer with your family if any situation happened. Okay, you guys are feeling like you're not as close as you need to be. You could take a break. Okay, you could pause, and rent's still gonna be paid, mortgage is still gonna be paid, and you're still gonna be putting money in the stash because of the fact that you had that money planted in the dividends. All right, so make your decisions. Okay, you guys want to go ball at the mall? Okay, or put that money into some dividends. Okay, I'm telling you, if the more you invest today, the more you stay down today, your future self is gonna thank you. Okay, because sometimes life's. Okay, God definitely throws some curveballs. Okay, there's gonna be times where, God forbid, people lose jobs. Okay, things like that, stuff happens. Okay, sometimes businesses crash, websites shut down, etc. Okay, certain TikTok bans, certain creators couldn't post then, and that was a big major source of income. So what we want to do is prepare for any type of situation so our family and ourselves are not in jeopardy if things hit the fan. Okay, so saving money and investing, it's not just trying to make money, it's survival. Okay, it's survival. Because not everyone has family they can depend on. Not everyone has people they can depend on to go to their house if something hits the fan, or if they happen to not have a place to stay. Okay, so what we want to do is always protect ourselves. All right, so money is going to be survival. Okay, don't just think of it as luxury and leisure items. Okay, protect yourself and protect your family. You don't want to have them starving or have them getting fed by somebody else's accord because you're not hustling, because you're not staying down. So be the one who stands on business. So dividends are also going to be extremely effective during flat or declining markets. And dividends provide a consistent positive return, and they help mitigate overall portfolio losses. And they offer psychological and financial cushion to keep you invested. So you guys can honestly just stay down, invest in the dividends, stack up your cash flow. Okay, if you feel like market's at all-time highs, you can buy some dividends. Okay, you can buy some dividends and you're still going to be stacking some type of cash flow essentially. Okay, and with the power of compounding, guys, I'm telling you, okay, the power of compounding is going to be extremely essential. Do something every single day, stack up those wins. Okay, and we're going to talk about drips, right? Drips are going to be extremely important, and that's pretty much just taking the dividends and reinvesting it back into the dividends. And they just automate the process of buying low, fostering consistent investments, and taking those dividends and reinvesting it back into those stocks, ETFs, whatever you bought. Okay. And the inflation hedge, right? So investing in companies that constantly raise their dividends, which means they're getting paid. Okay, if a company's raising their dividends, that means one, they're putting smiles on people's faces because one, people are using their products. So the more people that companies using their products, one, the more taxes that go to the government, the more the United States government benefits, the better. Okay, so everyone wins when these stocks go up in an upwards direction. Okay, don't just think, oh, stocks are just going up to go up. No. Okay, a lot of these companies, Amazon, for etc., okay, that you can go trade right now, employ hundreds of thousands of people, Microsoft, Google, etc. Okay, so these are really important companies that put food inside of people's stomachs. Okay, these companies pay people salaries, help them live. So think about that. Okay, that's also why we don't really want to ideally short the stock market in a lot of times. A lot of ETFs you'll see will be very consistent, especially if they pay out consistent dividends. Okay, they're going to consistently go up in an uptrend due to the fact that the economy is just a lot more beneficial as long as stocks are going in an upwards direction. That means more jobs for people, less homelessness, less government downfalls due to the fact that we don't have enough money to pay certain funding, things that need to be paid, such as government branches like the CDC, etc. Okay, which would mean less jobs. Okay, so the more money the government has, the better. Okay, because the less scientists we have, the worse for the world in general. Okay, we got to figure out what's going on. So understand that stocks, the higher they go up, the more it literally affects how the world functions. Okay, so thinking of things logically and extremely literally is really going to change your perspective. So evaluating your stocks, right? The essential dividend metrics. So how to determine health and sustainability beyond the yield? So before investing, you got to assess a company's ability and commitment to pay and grow its dividends. And these metrics are fundamental screening tools to avoid yield traps. All right. So dividend yield percentages, annual dividend per share / the current share price. So while it's tempting, never let your yield be your only factor. Don't just be only looking at it. Okay. You got to focus on, is it consistent? Okay. You can't just focus on how much it's paying out, because it could pay you out a lot in a 3-month span, and the next thing you know, it's gone. Okay. And then your reliable source of income is not dependable anymore. Okay. So high yields are often a warning signs. Careful. Focus on the payout ratio. That's going to be a big safety check. So automating growth, right? Dividend reinvestment plans. Let's talk about DRIPs again. So leveraging the power of zero cost reinvestment. A DRIP is a service offered by companies or brokerages that allow you to automatically reinvest your cash dividends back into the same stock. So you don't got to worry about nothing. Okay. Money's going to go right back into the dividends, making your cash flow infinite. And it's often commission free, including fractional shares. And let's talk about fractional shares, right? Maximize. So DRIPs ensure that every penny of your dividend is put to work immediately, maximizing compounding efficiency by buying tiny portions of shares you normally couldn't afford. And automated dollar cost averaging, right? DCA, dollar cost averaging, is really going to be just a good way to just stack cash, guys. Okay. Put a good amount away that you have after your bills, groceries, etc. Okay. And just keep stacking cash, keep dollar cost averaging, keep stacking up, get into stack mode. So since shares are bought at regular intervals, right? That's the payment date. Regardless of the price, DRIPs are automatically implemented into the dollar cost average, okay? Reducing the emotional risk of time in the market. So, you know how much you're going to invest, okay? Just put yourself on a consistent plan, because I promise you, a lot of the times within like a 5-year span, yeah, you'll see positive returns. Okay, now buying at all-time highs though can be a little bit different, but if your goal is just dividend incomes, then just keep reinvesting. So exponential share growth. The number of shares that you own grow exponentially over time, which in turn accelerate the growth of your dividend income stream. And you literally get paid to increase your ownership stake. Okay, so think about that. So most brokerages allow DRIP commissions fee. Go into the settings. They can be a little hidden sometimes, but you can find it, I believe me. And they make it a highly cost-effective way to build with over time compared to manual purchases. Okay. So instead of going back, depositing over and over and over, it'll just automatically put everything on cycle. So imagine you receive $50 in dividends, instead of taking the cash, right? Instead of having to have it settle, okay? Or if it goes automatically to a bank account and then deposit back into the broker, okay? Either way, the DRIP is just gonna go ahead and buy some more shares. And next quarter, you're gonna earn dividends on your original shares plus the new 0.5 shares, making your next payout slightly larger. And so the cycle repeats, and investing and increasing your base constantly. But please make sure you guys are looking out for your taxes. Okay, take care of that. Put some money away. Don't spend everything. So mitigate the risk, right? The downsides of dividend investing. Okay, so they can be dividend cuts sometimes. Okay, no investments can be without risk. And high dividend yields can be trapped sometimes. And tax implications must be understood to maximize the after-tax returns. We must be cautious investors, right? So the dividend cut is the ultimate risk. A dividend cut signals financial distress or a major strategy shift, often leading to a sharp decline in share price. Okay, that's why checking the payout ratio against the free cash flow is going to be essential, making sure it's profitable. And the yield, right? A very high yield, which is often above 8 to 10%. It's a pretty good range to check out, and it's frequently a sign that the stock price has collapsed and that the market expects a dividend cut. And when you buy the stock, the dividend is cut and you lose money on the stock price and the income stream, okay? And that could really hurt, okay? So keep that in mind. So opportunity costs. By focusing on only mature dividend payers, you might miss out on certain high growth companies, like many in tech, that reinvest all their earnings back into the business, leading to higher capital appreciation instead of income, okay? So they're focused on like the super end game plan, okay, which is ultimately the smarter plan. And there's gonna be sometimes some new ETFs that are dividends that you can invest to, instead of just focusing on the super old ones. So do your research, okay? Depending on any time period that you're watching this, okay? Some things are going to be more popular than others during certain time periods, and focus on whatever sector that's pushing the future forward is my best recommendation. So taxation, all right, understand the difference between the qualified low tax rate and the non-qualified ordinary income tax rate dividends. So use tax advantage accounts if you want to, like an IRA or 401k. Downsides of those though, they're capped out. So I believe 401k only holds around like $23,000 a year, and you could put way more money than that away, okay, in the stash, especially if you're in stack mode. And a Roth IRA, if I'm not mistaken, I believe it's $7,000, and then when you're 50, it goes up to $8,000. So that's not nearly enough money. You could put that money away in a single month. Okay, there's people who spend $50,000 a day on ads. Okay, so it really just depends. That's not enough money. Those can be traps, so don't really focus on those. Get in your bag and believe yourself. You can run up M's, I promise you, inshallah. So geographic risk. So international dividends often carry foreign withholding taxes, which can be partially or fully recovered, but add complexity and potential cost to tax filing. And they always investigate the specific tax treaties for international holdings, making sure that everything is proper before you just buy into something, okay? And you can construct your income portfolio, okay? So successful dividend portfolios, not just a collection of high yield stocks, but a balanced machine designed for stability and growth across various sectors and time horizons. So sector diversification, okay? Get some different sectors in there. If it's tech, maybe power, maybe healthcare, okay? Whatever is important within the time period you're watching this video, do your research first, okay? And go ahead and invest. Take your time. So spread your investments across stable sectors like utilities, consumer staples, healthcare, crypto, etc. Okay, there's gonna be a lot of different sectors you could check out. Okay, and strong industrial companies, etc. This ensures that if one sector struggles, another could be doing extremely well. Okay, or if the U.S. does a deal restructuring the power grids or something, then maybe power sectors might be doing well. Okay, things like that are going to be put into play depending on what's happening in the economy today. So apply what's happening in your current society and just go to the stock market and make the right decisions. And inshallah, you'll make some good money. So look for companies with high cash flow, low debt, consistent earnings growth, and a history of raising the dividend, not just paying it. And consistent growth is going to be your key to beating inflation. So the ETF, right, and mutual fund usage. So use dividend-focused exchange-traded funds like those tracking the dividend aristocrats. For example, Noble or high-yield funds. For example, VYM, to gain immediate diversification with minimal effort. And this can form the stable, low-maintenance core of your portfolio and your income calendar strategy. Okay. Strategically select companies with different payment months. Some pay in March, June, September, December, others in January, April, July, October. And this can smooth out your monthly income stream, giving you a more consistent passive income flow in general. So do your research, invest in the sector that's going to pay you out consistently and make you some good income. Okay. And cultivate passive wealth. So key takeaways. So dividend investment, it's not about getting rich overnight. It's about building, once again, passive income. But what people don't know about what's called passive income is you got to hustle for the income in the first place. Okay, so you got to be hustling for as much active income as possible. Then once you invest, then you earn passive income. Okay, everything in life has to be earned. Okay, you have to understand that there's no such thing as just chilling. No, you got to earn it and then you could chill. All right, so go hustle, go get some money on, then invest and you could chill, live off your passive income. Okay, but right now, you're in stack mode, you're staying down, you're grinding, get to it. So focus on safety and growth. So prioritize dividend growth and safety. Okay. So look for a low payout ratio and low debt. Okay. Especially after you just got in the stack mode for years, however long you just took grinding your company, okay, scaling up your job, doing whatever, okay, putting money away. You don't want to invest into a dividend that you expect to pay you out stably to just crash. Okay. So do your research. Make sure they don't have a lot of debt, okay? Even God talks about debt for a reason, okay? Debt can really be a sinkhole, okay? If you get into debt, it's like your money pretty much gets negated for no reason. You make money, but then it has to go to debt. So it's like you get nothing in your pockets. You can't put it into investments, and you're just in debt, okay? So debt is extremely trash, and it pretty much cancels out your money, okay? So focus and see, okay? Did the company pay it off yet? Okay, is the company drowning? Is it a fresh new company that just took a big loan from someone? Okay, and if they fail, then they're going to be drowning. Okay, that might not want to be something where you want to invest your hard-earned active income into. Okay, so take your time, do your research, and then hop into something. Okay, avoid Euro traps. Don't just focus on that. Okay, sometimes there's things way bigger than the direct active income. Focus on the stability. And you can use drips and monthly contributions to take advantage of compounding and other cost averaging automatically. Okay, pay your rent, groceries, do what you need to do, give your money to whoever you need to give. Okay, and then put some money away into your dividend investments. Okay, keep stacking cash and watch it grow quickly. And utilize tax advantage accounts if you want. If you have a job, then do a 401k. I don't recommend a Roth IRA, just do a normal tax account. Okay, once again, believe in yourself. You can do way more than $8,000 a year. Okay, putting away that money is something that everyone could do. And $8,000 a year, you can definitely put way more than that a year away. So do a normal account, individual, taxable, and just take care of your taxes. Not that bad. Okay, and your growth isn't going to be stopped. But if you have a job though, and they pay out 401ks, I would take advantage of that. Just put a piece of your check away, and then if you want, as soon as you're older, you have that money there, and then you can pull it out tax-free if you even want it. So you can maintain diversification like this too. Okay, you can invest into certain ETFs that have a bundle of stocks, so you don't have to just rely on single stocks. Okay, and you could use, once again, different ETFs to build a robust, diversified foundation. Okay, so that's how passive income is going to be formed. Stay prayed for God, keep running. Head over to Stackmode.net for all trading education. Mentorship slots, they're getting filled up. Class has been getting booked up. So yeah, if you want to book the next call, go ahead and book before all the slots are filled up. Peace. Hey, welcome to Stackmode.net. Two things I want to do. I want to put a smile on your face, and I want to help you make some money by trading. Okay, so here's an example of a trade that I gave in my Discord here. So all we're going to do is understand some logical processes here. I teach stocks, Forex, crypto, options, as well as futures. Okay, and trading each of them is going to be fairly similar, but different for each sector. So whatever you specialize in, I can help you. Let's say we're trading the stock market, for example. I know that stocks have an incentive to go in an upwards direction due to the fact that these companies employ people. Okay, these people then pay taxes to the government. Okay, so as long as these companies go upwards in an upwards direction, the richer they're going to get, which means they're going to expand further, which will lead to further opportunities to employ people. So let's say, for instance, I'm trading the stock market. I personally wouldn't short the stock market. I'm looking to play call options or buy shares, catching my V directional fill. So as you can see here, I have an area of resistance above current price here. And as you can see, I have just some empty space here. And price decided to blast straight through it and fill in this area. Let's talk about how I caught this setup here. So here I can identify two things. We're going to have areas of resistance. Areas of resistance are going to be areas where price decides to fall in a downwards direction. Okay, and then we're going to have areas of support. Support are going to be areas where price decides to bounce in a upwards direction. Okay, using support and resistance together can lead to some very nice setups. So as you can see, market can only go in two directions, either up, okay, and once again, if market's going to go from a upwards bounce direction, that's going to be called support, and if market's going to go in a downwards bounce direction, that's going to be called resistance. Okay, so let's understand some things. So resistance can be broken and turn into support. So here I have this area of resistance being created. As I can see, market's falling downward here. And once the area of resistance decided to get broken, it decided to turn into some support. And then price went in the upwards direction. Okay, and I know that price in the stock market at least wants to go to all-time highs. Okay, same thing for cryptocurrency. There's tons of coders behind these tokens, tons of people putting in a lot of effort, wanting to see the token or the stock succeed. So of course the share price or token price wants to go in an upwards direction. So I play until areas of resistances for my take profit. So as you can see, resistance got broken here, turned into support, and then price would have met with the area of resistance and decided to do it again. Resistance got broken, turned into support, and then looks like price wants to keep going in an upwards direction. I try and make trading as easy and simple as possible for you guys. You guys see all the reviews from my students. I try and make it simple for you, and I adapt to your life. Okay, here's how the class system works. So one, I offer 10 classes. Okay, these 10 classes can be stretchable however long that you want. Okay, it could be between 10 weeks, we could do 10 days, or a class every 2 weeks. Whatever your schedule is, we're going to be flexible, and I'm going to maintain a optimal workflow for whatever you trade, your schedule, and what type of person you are. Okay, so I'm going to catch you guys in the free call. Go ahead and book the calendar. Stay prayed up to God. Keep grinding. I'm going to catch you guys in the next one. Peace.
Welcome to the beginner-friendly guide to trading futures. I'm going to make it extremely simple for you guys. Futures might sound intimidating at first, but here's the truth. They're just contracts that let you trade the future price of things like oil, gold, and even like the S&P 500 or NASDAQ 100 without ever actually owning them physically. And the best part, you can start small, control big positions, and react fast to the market. And here's how it works. You pick an asset, whether an index, currency, or commodity, decide whether you think the price will rise or fall, and place your trade and let the market move. If you're right, you win profit. And if you're wrong, then you lose, but only what you put at risk. And it's that simple. And when you understand the rules, it all comes together over time. But here's the real secret. New traders really fail because they treat futures like gambling. Successful traders treat it like a business and a skill. They use levels, trends, risk management, and most importantly, have a trading plan every single time. Because the thing about futures compared to any other asset, you know exactly how much you're going to make and exactly how much you're going to lose per trade. So in this video, I'm going to break down the basics in the clearest way possible, showing you exactly how futures work, how to manage your risk, and how to avoid the biggest beginner mistakes so you can trade confidently. Let's jump into it, inshallah. All right, let's talk about trading futures. I'm going to make this guide extremely simple, okay? I'm not going to make it difficult. I'm going to keep it simple. I'm going to keep it easy, okay? I don't want you guys to be struggling. I don't want you guys to be going through hardship, okay? Futures is a way different game. Okay, the discipline required to trade futures is night and day compared to anything else. Okay, futures, you need that real hardcore discipline. High risk involved into it, but you get discipline. You learn how to control your flesh. There's a high reward involved into it. Okay, and you can make money very, very quickly. Okay, so let's go and let's jump into futures. So what is a futures contract in the first place? So let's talk about locking in the price. So a futures contract is simply an agreement to buy or sell something at a specific price on a specific date in the future. So let's say, for example, let's say a farmer grows corn, okay? And he's afraid that the price will drop before harvest. So he signs a contract today to sell his corn for $5 in December, okay? And no matter what happens, he gets $5, okay? He just traded a future, okay? Or a lot of people have been able to make money in instances like this. Say a price of something like eggs, okay, were to be increasing, okay? Some people were to buy futures and prepare for the increase and the cost of eggs, okay? So if you think the NASDAQ 100 is going to go up, the NQ, then you would go ahead and buy a long, okay? So a futures contract is being able to speculatively buy a directional bias and get paid based off of it. So you're buying whether or not if you want to buy a contract for buys, okay? Or you can buy if you think something's going to go down, okay? So it's going to be two ways you can be able to trade futures. You can buy contracts or you can sell contracts if you think things are going to go in a downwards direction, okay? So you can prepare for the future in whatever speculative direction. So what are we actually trading in the first place? So we're trading standardized contracts. So we rarely trade the actual physical corn or oil. We're trading the contracts and it's standardized. So every contract is identical, okay? Has the same size, same expiration date. And that's what makes futures so linear. On futures too, you know exactly how much you're going to make and exactly how much you're going to lose due to the fact that the tick sizes, okay, which is how much money a futures contract moves, okay, it's going to stay the same. Okay, only thing that's going to ever increase is the amount of contracts that you're playing with. Okay, but as far as your tick size and as far as the amount of money per tick, that is always going to remain the same per whatever contract you're looking at. Let's talk about liquidity. So you can buy and sell these contracts in milliseconds. Now, futures gives you a lot of control in your hand in 1 second. Okay, you can instantly click buy, and once again, it gives you the ability to buy or sell
and get some money based off a directional bias. Okay, so you have the ability to buy or sell and get some money based off a directional bias. Okay, so has a lot of self-discipline that comes into play when it comes to trading the futures asset. Okay, because you can instantly just get in and get out. Options, you got to go out, find the contract, etc. It's not that easy to just enter in a trade. Okay, but with futures, you can instantly just click buy or instantly click sell and be placed in a directional bias trade. Okay, so make sure that you know what you're trading, you understand margins. Okay, and what margins are is going to be the amount of money the futures contract is going to require. Okay, so say for instance you're trying to trade the S&P 500 futures contract, the ES. Okay, if you're trying to trade the ES, then you might need at least $500, okay, inside of your futures account in order to open the trade. Okay, so understand that all the tick amounts are going to be the same, and as well as the margin amounts. Please look at the margin amounts on your broker before you start trading futures. And traders usually close the contract before the date arrives, so they never have to store 1,000 barrels of oil in the first place. So a lot of times you're going to see an expiration date on futures contracts. Okay, so let's say for example you're trading the ES. Okay, you might see something like ESQ. Okay, and when you see letters, each one of the letters are going to represent different expiration dates. Okay, so let's go and jump into the next slide. And the main reason why people like futures in the first place is going to be the leverage. Okay, it's an extremely powerful asset class to be trading. Okay, but you can't blow the bag. You can't blow the bag. Okay, so you're going to be able to control more with less. Okay, so this is why traders really love futures. With other things, you got to deposit and it has more upfront cost in order for you to see some profitability. But with futures, you could really just deposit one time. Okay, you only need one small deposit, okay, to cover the margin. So make sure you look at it. It's going to differentiate per broker, so I can't just give you guys a solid answer. Okay, on the NASDAQ 100, in order to trade the NQ futures contract, one broker might require $1,000 in order to trade it. One broker might require $5,000 in order to trade it. Okay, so whatever broker you're trading on, make sure you're looking at your margin, okay, requirements, so you know how much money you need in order to trade in the first place. Okay, so here's an example. Okay, so let's say your contract, once again, okay, is requiring a $1,000 margin. Okay, let's say you're trying to trade gold. Okay, let's say you're trying to trade the GC futures. You're trying to trade some gold. Okay, and the margin for gold, okay, is going to be $1,000. That means you would need at least $1,000 in your account in order to trade this futures. If you have less than $1,000 in your account, then what's happened is your account has the chance to get what's called liquidated. Okay, so if you need $1,000 in order to trade the asset class, you cannot go underneath that. Otherwise, your account is what's going to be called liquidated. Yes, futures is a leveraged asset, but that comes at the cost. You have to have the bare minimum amount in order to trade with the leverage. Okay, that's the only reason why people trade things like prop firm and stuff like that, is because they don't have the capital for the margin up front right now. But be patient, stack up that capital, because trading on your own live account really does help, makes things a lot easier, and you have full control over your funds. So you could feed yourself and your family however you want. You don't have time to be playing on other people's rules. When you want to withdraw your money after you win a trade, you should be able to withdraw your money. So I really recommend live account. Okay, get your life together, grind hard. Okay, work on your business, work on your job, level up, get some money together, and boot up a live account. Okay, I don't recommend you guys try and rush and go the prop firm route just to go ahead and avoid the margin. Okay, take your time, learn the skills. Okay, pay for some mentorship first, or sign up with a free call at stackmode.net, and I'll teach you guys how we could trade futures before you just start trying to boot up a prop firm and trying to just take any type of ghetto weird trades. Okay, because there's a lot of things that come into the futures market. Okay, especially on a live account, your margin is going to be the most important thing. If gold says that they need $1,000 in order to trade gold, okay, you need $1,000, okay, in margin, okay, which is the bare minimum requirement in order to trade the asset class. If you go under that, your account could be zeroed out, okay, or your account could go into the negatives, okay, if price action moves too fast and clips past your stop loss, if you have one. Okay, And if it moves too fast and clips into the negatives, then you would have to owe the broker money, okay? And if you don't pay it back, then they could sue you, etc. Okay, so make sure that you're paying attention to the margin cost on whatever broker that you're trading on. Every broker is going to be different. Okay, gold might require $1,000 to trade on one broker, might require $5,000 to trade on one broker. Okay, check it out and make sure you're doing your research. Let's go to the next slide. So up or down. Okay, let's talk about long versus short. Okay, the difference between the two. So in stocks, shorting is when you're betting on the price direction to go down. Okay, shorting means down. Okay, and longing means you think price is going to go in an upwards direction. Okay, so if you're speculating that the NASDAQ 100, gold, or whatever asset class that you're looking to trade is going to go in an upwards direction, okay, then what you need to be looking at is looking to buy a long contract. Okay, so you're going to be buying, okay, and going long. Since you think price is going to go up, okay, then you need to be buying, and that's going to be the long direction. If you think price is going to go down, you'd be shorting, okay, and you'd have to go ahead and purchase a sell contract. Okay, so go long, you buy a contract, and you profit if price goes up. And going short means that you're selling a contract, okay, and you're profiting if price is going down. And that can be for anything. Okay, I don't care if you're trading egg futures. If you think the prices of eggs are going to go down and you buy a short contract in egg futures, then inshallah you would make some money. So that's just exactly how it works. So because it's just a contract, you can agree to sell at a high price today, even if you don't own the asset. Okay, so do your research, and when you guys start putting the economy and your technical analysis information together, okay, because your economy information is absolutely futile to be looking at. You have to be looking at it. It's essential. Okay, it's very, very important to be looking at your economy information, the CPI, PPI, inflation rates, etc. Okay, seeing what recent laws are getting passed. Okay, things like that have a big factor in where the market is and where it's going, most importantly. Okay, so put your economy factors and then get your technical side. Be like, you know what, are we at all-time highs right now? Okay, ask yourself some certain questions. Okay, am I ready to buy on this pullback? Okay, I'm going to wait market to go down, and then I'm going to buy it back up again. Okay, take your time and strategically plot and plan your trade before you make any rash, wild decisions. Let's head over to the next slide, class. So the danger zone, margin. Okay, just like we talked about, margin can be dangerous. I don't want you guys getting sued. Okay, I don't want you guys getting served court papers or anything like that because you owe some money to the broker. Okay, and understand that sometimes your stop loss, okay, stop loss, that's what SL is, stop loss. Sometimes, okay, let's say you have your stop loss set at a certain price. Okay, if price decides to run past your stop loss too fast, you could end up losing more than you thought. Okay, so if you have your stop loss set for $300, okay, and price action moves fast way past your stop loss, okay, you could end up losing like 380. Okay, and if that goes underneath your margin requirement, also known as your maintenance margin, okay, which is the minimum amount required to even have the trade open. Okay, so since you're using leverage, you must maintain the minimum maintenance margin. Okay, so if you're trading the NASDAQ 100 on a broker and it says it needs $1,000 in order for you to have one contract open, okay, then you need to have $1,000. If you go under that, then you're going to face what's called liquidation, which is pretty much account death. And once again, if price action happens too fast, past your stop loss or whatever, you could end up losing more than you actually expected, okay, and that could lead to, God forbid, a margin call. So if your trade goes against you and your account balance drops below the minimum, okay, the broker will automatically close your trades and take the rest of your money. Okay, so rule number one, never trade without a stop loss. Never trade without a stop loss. Okay, and it's very rare too that price decides to just clip way past it instantly and it fills you for a different number than what your stop loss was set for. But just know that it can happen. So it is good to have more money than your margin account. Okay, so if the margin or the maintenance margin requirements, so if the margin is asking for $1,000, okay, I would try and have like 2K. This way you guys can take some losses, etc., and you're not going to be panicking. So let's head over to the next slide. So the ticking clock. Okay. So unlike stocks, right, which you can hold forever, futures contracts actually expire. Okay. They have a time limit, and they're quarterly a lot of the times. So most of them expire in March, June, September, and then you got December. Okay. And then we have rollovers too. Let's talk about rollovers. You might have seen this on your broker asking you if it wants to roll over contracts, etc. So if you want to keep trading, you must close the old contract and open a new one before it expires. Okay. So don't forget too, if you hold oil futures to expiration, okay, you're legally asking for oil to be delivered to your house. Okay. And brokers a lot of the time usually prevent this. Okay. So if you're just trading for pure speculative reason, which means you're trading off pure technical analysis and the chart, okay, then make sure you guys are closing trades before expiration dates occur. Okay. Close the charts before the expiration dates occur. Makes it things a lot easier, and you're not gonna have to stress out about anything. Okay. Just keep your digital money and hop off. And then you could take that futures income and buy assets with it. Okay. Take that futures income, buy real estate, buy real life stuff. Do what you want. Okay. And cycle your money like that. So what can we trade in the first place on futures? So we got the big three. All right, the big three. You got the ES. Okay. The ES is going to go ahead and represent the S&P 500. Okay. And then we got the NQ. NQ is going to go ahead and stand for the NASDAQ. Okay. That's going to be the NASDAQ 100. Okay. Which is going to be the powerful batch of tech stocks. Okay. And then you're going to have the YM. Okay. And YM is going to be for Dow Jones, also known as US 30 for any Forex traders out there coming to futures. Okay. So you got the ES, that's the S&P 500. NQ is the NASDAQ 100. And you got the YM, that is the Dow Jones. Okay. So the big three, okay, those are really going to be the big three. And yeah, and then you're going to have things too, like crude oil. Okay. People trade oil as well too. And then you're going to have things as well like gold, okay, which is a precious metal. So beginners often start with micro contracts too. Okay, so starting with micro contracts change the whole ball game. It makes things a lot easier when you can scale down, okay, and risk less. When you risk less, you have a lot less anxiety per trade, and you could catch way bigger trades as well too, due to the fact that you don't have that fear of, oh, I gotta hop out the trade, I have so much size in right now. No, you can let the trade ride out, do its thing, and play properly. Okay, you can let market do its thing. Okay, you can let market actually cultivate itself, and most importantly, you could risk a little and catch a big move. Okay, and continue to keep yourself profitable and stress free, just like that. Inshallah. Let's over to the next slide. Breaking futures down, okay, from top to bottom is going to be extremely easy. Okay, so we're trading the U.S. stock market. The U.S. stock market, it's made to go in an upwards direction. Okay, and all of these stocks are put into one index, creating the futures indexes. Okay, so breaking everything down logically, if I head over to the stock screener, okay, and I have my market set to United States, okay, I can see the companies that are United States companies. I'm going to have companies such as Microsoft, Nvidia, Apple, Google, okay? The whole world is using iPhones. The whole world uses Google to search, okay? The whole world owns Microsoft products, okay? The whole world orders off Amazon, okay? And we have to also understand that these companies employ hundreds of thousands, if not millions of people, okay, all across the world. And these people are paying taxes. And the more taxes getting paid, the more beneficial it is for the United States government. So of course, the United States stock market would be made to go in an upwards direction. Okay. So forget getting lost deep in the technicals. Okay. Because market is pretty easy to understand technically. It's just support and resistance and understanding where market wants to go. But understanding where market wants to go and why is going to be a big part. When you're trading the United States stock market, Stocks are meant to go in an upwards direction year after year after year because that's the baseline of the company. America is built off of strong companies. Okay, so take this area for example. You're going to have areas where market decides to bounce from the bottom from. Okay, as you can see this area here, market decided to bounce twice from this area. Okay, and as we know, whenever we see market bouncing within an upwards direction, okay, that's going to indicate that, of course, buying is coming into place. Okay, and when buying steps into place, that's going to let us know that that's an area of support. Okay, and we want to be looking at everything on our higher time frames first. Okay, so doing top-down analysis and looking at your chart on your higher time frames is going to give you that real bigger picture for absolutely everything. Okay, so start on your weekly time frame and then head down to your daily, then your 4-hour, and then your 15-minute. Okay, your weekly time frame is going to be your bird's eye view. Okay, we need to zoom all the way out to see the true trend of the market, where stuff is heading to, okay, and how market wants to react on the higher time frame basis. Okay, the higher time frame is going to show us the true price action. It's going to show us where price truly wants to go, what it truly wants to do, and where the orders are truly being placed and stopped at. Okay, your daily time frame, okay, you're going to use just to see a little closer for take profits. Okay, and then your 4-hour. We know the 4-hour is going to be really important because on the weekly and the daily, you can't see everything you need to see. So you make sure that your electronic or extended trading hours is going to be enabled before you start trading futures. Okay, so now let me go ahead and pull up the futures chart once again. So now we understand what's inside of futures. Okay, we understand how it operates. Now let's talk about how to read the chart. Okay, so what I'm going to go ahead and do is start off on my highest time frame first. Okay, I'm on the weekly with it. Okay, so breaking down certain logical things. We know that market wants to go in an upwards direction due to the fact that it's the most beneficial for the United States economy. Okay, market wants to go in an upwards direction. Okay, it's the most beneficial for the economy. Okay, and the United States dollar is one of the most powerful currencies in the entire world. Okay, so our stock market is really, really important. We have innovative minds that build world-changing companies here. Okay, so putting that into perspective, we know that whenever we're trading the stock market or futures, as we can see on the weekly time frame, price is meant to go up year after year after year after year after year. Okay, regardless of how many new lows are being made, okay, we could still see price heading in an upwards direction year after year after year after year. That's because that's what it's made to do. The United States' backbone is built off of companies and work. Okay, so this is pretty much going to be looking at real life in chart form. Okay, so as more companies get created, as technology starts expanding, okay, etc., you could start seeing more money being pumped in to the economy. Okay, thus leading the index to go in an upwards direction year after year after year after year. Okay, so trading futures, a lot of the times you're going to be looking to trade longs. Okay, so what a long is means that you're going to be trading in the upwards direction. Okay, so futures, you get paid based off speculation, which means you get paid based off your directional bias. Okay, so primarily, since logically on the higher time frames, we see market going up year after year after year after year after year. Okay, we're going to go ahead and focus on buying up. Okay, since the market is made to go up, let's focus on the direction where the market is made. Okay, the reason why people short is Forex traders came on and influenced US traders, and people who are in the US are now trying to short. Okay, so you can see this is going to be the United States index, the NASDAQ 100, goes up year after year after year after year after year, almost undoubtedly. Now let me go and pull up some Forex. So I got Forex here. Okay, I can go back all the way back here on Forex. We can see that all-time highs is way higher than it is today. It does not work the same. Okay, the United States stock market is meant to go in an upwards direction. Forex is going to be a lot more sideways. So don't let Forex traders influence you if you're a United States stock market trader. Meaning if you trade options, if you trade futures or shares, understand that these companies are meant to go in an upwards direction. It is not sideways like Forex is. It is two completely different instrument and asset classes and has to be treated as such. Okay, now let's continue. Okay, so we know price is going to go ahead and hunt this all-time highs up here. Okay, price is hunting all-time highs. And let's talk about the V formation. Okay, so market will continue to head up in an upwards direction year after year after year after year. Once again, for the greater good of the world. Now, it's about knowing when to buy. So you don't want to buy when market is at all-time highs. Okay, because remember, we make money whenever we buy longs, which means we want market to go in an upwards direction. So in order to buy when and be profitable whenever market's going in an upwards direction, we can't buy at the tippity top, because then we're just going to eat the whole drawdown. Okay, so you never want to buy at all-time highs. Okay, never buy at all-time highs. Okay, so all-time highs is going to be the highest point into the market. Okay, you never want to buy at all-time highs. Not worth it. Okay, because then you're just going to get pulled back on. But understand that market always wants to try to make new all-time highs. Okay, so in that logic, let's put something together. That means that market will always want to hunt an area of resistance above current price. Okay, to try to meet it again and try to break it, or sometimes it might meet it again. Okay, and then price might decide to reverse hard. Okay, so this is why we want to go ahead and close at the area of resistance, okay, where market decided to fall down from in the first place at all times. Okay, all of our trades are going to look the same from now until we fall off the earth. Okay, until it's time to die, all your trades are going to look the exact same. Okay, we're going to focus on letting market make the top left of the V. Okay, that's going to indicate the area of resistance. We want market to fall down first. After market falls down, you want it to also make the bottom of the V. Okay, so you want market to do two things for you. Okay, you want it to make the left side of the V and the bottom of the V. Okay, the left side of the V is going to indicate where it decided to start falling down from. Okay, so the left side of the V indicates where market decided to start falling down from. And the bottom of the V is going to go ahead and indicate whenever price wanted to stop falling and catch itself. Okay, and whenever market stops falling and catches itself, okay, that's going to indicate an area of support. So support equals buying. Okay, support equals buys. And the top left of the V is going to go ahead and equal resistance. Okay, resistance is going to go ahead and equal selling. Okay, sells. Hence why market's going in a downwards direction. And then once people start buying, longing, okay, buying and longing is the same thing, then market's going to start going in an upwards direction. And understand that logically, okay, because market wants to try and always make new all-time highs, we can put some logical perspectives together. Okay, we can understand that wherever market decided to fall down from, market will eventually try and reach that area again to smash past it, or reverse from the area to try to smash past it again. Okay, so understand that wherever market decided to fall down from originally, okay, wherever market fell down from, it will try and recover too. I don't care what it is. Okay, wherever market fell down from, I don't care if you're looking at futures, stocks, options, whatever. Okay, wherever market fell down from, if it's a half decent asset that people invest into, it will try and recover and break past where it fell down from every single time, because that's the greater good for the economy. Okay, the stock market isn't just going up to go up for no reason. Okay, so I don't want you guys to just be faked out, and I'm not going to be just showing little 15-minute breakdowns of structure and this and that. Understanding the true logistics between everything is going to give you a lot less anxiety when you're in your setups. You're going to have so much conviction, you're going to have so much understanding, and understanding that, you know what, price has to go up. It's logically meant to go up. Price already sold off, buying has stepped in. Price is going to go ahead and meet up to the area where it sold off at to try and break into new all-time highs. And you continuously farm that logical structure. You continuously take the same setups. Okay, when you see the staircase stock chart emoji, okay, understand all you see is market going up, pulling back, going up, pulling back, going up, pulling back. Okay, and when you see market making these higher lows, okay, this low is higher than this low. Okay, this low is higher than this low. Okay, we got this low is higher than this low. Once you start seeing market making higher lows and breaking previous all-time highs, okay, you know you're trading a good asset class. Okay, that's going to be an asset class that you want to be focused on primarily, because all you have to do is wait for market to make these little pullbacks. Okay, please pay close attention to this drawing. Okay, that's exactly how market works. All market does is go up, come down, then go back up and break where it previously fell down at. Okay, and take advantage of that. Wherever market previously fell down at, it will almost always want to meet it, because it has to break it in order to make progress. So wherever market decides to fall down at is going to be your take profit. Okay. So your take profit, which is when you close and you get your money, that is going to be wherever market decided to fall downward at. Okay. Wherever the left side of the V was created is when you're going to take your profit. Because we don't know if market always wants to break into new all-time highs. Okay, market could easily come into the resistance again, okay, and fall down extremely hard, okay, and then break one day again. But still, you don't want to eat the whole fall down. Okay, just take advantage of the logic that's there. Understand that the right side of the V wants to be filled. Price wants to recover from where it fell down from. Okay, it may not want to break it immediately, but understand that a lot of the times it will want to at least recover from where it fell down from. And that window of price recovering to where it fell down from is our money window. Okay, that's going to be our money window. So using all of our time frames and seeing everything and doing our top-down analysis is going to help us put it all together so that we can make the right profitable decisions. Okay, so let's go and let's keep going here. So take here. Okay, even if I'm on here, let's say I start on my weekly. Okay, I know price wants to come up to this all-time highs. Okay, we just went ahead and broke down all the reasons why. Okay, I can see we're not at all-time highs right now. If you're not at all-time highs, okay, there could be a chance to get a trade in. If you're not at all-time highs, there could be a chance to get a trade in. If you're at all-time highs, you do not trade. Do not trade at all-time highs. Okay, we need market to make the left side of the V, let market pull back, okay, make the bottom of the V, form support, and then we catch the right side of the V right back to where it fell down from. Keep it simple. Keep it simple. Some of you guys are making market way too difficult. No need for all this weird stuff on the 1 minute. No weird terms like the silver bullet. Just understand that wherever market fell down from, if it's a profitable asset class, okay, and the whole United States runs off of these futures, okay, if you turn on the news and you look at the bottom left, you're going to go ahead and see it tracking futures, okay? The whole United States runs off of the stock market, okay? So understand that. Once you understand that, you can easily just start using your higher time frames and making a lot better decisions, okay? So even here on futures, if I wanted to do something like this, okay, you could easily make your trades, okay? You could easily put down a trade, okay, and just catch it all the way to all-time highs, okay, and catch the whole thing. You know price wants to go ahead and fill all the way up here, okay? But even if you didn't do that, say you didn't have enough margin, right, to hold overnight, right? Here's what you would do, okay? What you can do is hop on your daily, okay? If you wanted, you could put your, depending on how big of it is, depending on how big of a stop it is, saying have your stop loss set, okay? Find a good stop loss that works for you and your account. Okay. You can go to your 4-hour time frame after your daily, and you want to find yourself a support candle. Okay. Find yourself a support candle if you can. Okay. Whether it be this one. Okay. This one. This one. Okay. Try and find yourself support candles. Okay. Then from there, go ahead and just read the structure. Okay. So we can see market is making higher lows. Why? Because I'm looking at the support candles. Okay. So I'm seeing each of these support candle conjunction areas heading in an upwards direction. Okay. Time after time after time again. Okay. So it's letting me know that, okay, this asset class is definitely bullish. Okay. This low up here is higher than this low. Okay. This low up here is higher than this low. This low up here is higher than this low. This low up here is higher than this low. Okay. And you keep taking your formations like that. Okay. Now, I can go to my 15-minute time frame. Okay. And I can see everything more logically for what it is. Okay. So I can see here. Actually, I'll stay on my 4-hour for a second. Okay. We could see price decided to come in contact with this area here of resistance. Okay. We could see price wants to come up here first on the 4-hour. Okay. So what I'm going to do is go to my 15-minute. Okay. And I want price to show me bullish structure. Okay. So this is exactly what I mean. So price decided to make the left side of the V here on the 15-minute. Okay. And getting on the 15-minute is where it gets nitty gritty. Okay. It's really turning on your Sharingan, making sure you can see everything that you need to see, and putting that same higher time frame logic on the lower time frames is what's going to make the world of difference. Okay. So go ahead and get on your lower time frames after you've done your highest time frame analysis. Okay. I'm trying to make you guys the best traders in the entire world because it's not that difficult. Okay. After I touch 1 billion from this, so many free guys that's going to be out for you guys. Okay. Because it's not hard. It's just you have to get your psychology down packed, inshallah. So look, you could see market decided to make the left side of the V here on the 15-minute. Okay. So on the higher time frame, this is the ultimate beginning of the V is up here on the 4-hour. Okay. We can see market topped out right here before it decided to fall down. Okay. Market decided to fall down all the way down here. Okay. Found an area of support and then started to make some higher lows. Once I start seeing things like higher lows come into place, I'm like, oh yeah, we're trendy. Okay. Because market doesn't want to go past these supports. Okay. Look at this line right here. Okay. Let me go ahead and change the color of this. So if you look at the yellow line, you can see market has these 2 wicks that did not want to go beneath. Okay. Now we have this line up here. Did not want to go beneath. Okay. And then we have the support accumulation zone up here. Okay. And price looks like it wants to hold this area right here. Okay. Price looks like it wants to hold this area very, very confidently. Okay. Price looks like it found another area of support right here. Okay. So I can start seeing here, I have my 4-hour wick and I have a 4-hour close above the zone. Okay. So I like that. Okay. I have a 4-hour candlestick above the zone and I have a 15-minute candlestick above the zone. Okay. So I can see that market is trending. Okay. In an upwards direction. Market fell down and it looks like it's trying to make the V right here. So then it can go in an upwards direction from here. Okay. And at least hit this resistance. Okay. And this profit window is what we're going to use in order to make our trade. Okay. Then from there, you'd be able to pull out your risk to reward tool. Okay. This would be long position. Okay. You could put your stop loss below this area of support if you wanted, and then take profit would go ahead and be the area of resistance up here. And we play this for a 1 to 2 about. Okay. So you play this for about a 1 to 2, catch your trade and hop off. Okay. Or even if you wanted to play the take profit up here, you could play this one too. Or if you had multiple contracts, you could do it like that. Okay. But if you just wanted to play the first 15-minute V structure after the higher lows were created, then you could go ahead and get in just like that. Okay. So it's doing that top-down analysis, seeing everything. Okay. And then catching the V structure, even on the smaller time frames, breaking everything down and seeing it for exactly what it is really going to help you put things into logical perspective and help your trades over time. Okay, so we could see market decided to make the main V here. Okay, so starting off on the weekly, okay, we got all-time highs. Okay, I can see market decided to make some higher lows here, even on the weekly. Even on my daily here, I can see market made the top of this main V up here, all-time highs. Market fell all the way down and made the bottom of the V on the daily. Now I'm going to go to my 4-hour time frame, okay, and I can see market decided to do its thing. Okay, market's deciding to trend in an upwards direction, and I could see all the higher lows on a smaller time frame for exactly what it is. Okay, I could see that market decided to make this area of resistance here, fell down, but it's still trying to trend up to fill in this V right here. Okay, and ideally it wants to fill in the whole V. Okay, so what we can do, I could get on my 15-minute time frame here. Okay, and I can open my trade. Okay, catch my 1 to 2 and catch it up here, or I can move my take profit to up here if I wanted to as well. Okay, and keep my stop loss as this support right here. Okay, and have the take profit as the final V all the way up there. Okay, so it's just about knowing when to enter. Okay, so on your 15-minute, you want to make sure that you're seeing that recent support structure. Okay, and you want to make sure that you're buying when everyone else is buying. Once again, let me repeat that one more time. You want to make sure that you're buying when everyone else is buying. Okay, so if market right here just made the left side of the V, okay, and then the bottom side of the V already got made, so market already dumped down and it already made a bottom. Okay, what direction is it most likely going to go into from here? Buys. Okay, because people already sold. Okay, and the low already got formed again. Okay, and understand that this asset class also has laws in place to make sure it doesn't flash crash to zero, the short sale restriction. Okay, so don't expect more markets going in a downtrend for it to last too long. Okay, because people are going to be fiending to find a new low to buy it again because they know it's going to go up year after year after year. Okay, so on futures, primarily try and focus on the pullback formations. I'm going to go ahead and pull up the S&P 500 futures, known as the ES. Okay, let's go and let's cover this and break it down. So what I'm going to go ahead and do, just like we talked about, is I'm going to start on my weekly time frame first. Okay, then I'm going to go to my daily, then to my 4-hour, and then to my 15-minute. Okay, then to your 15-minute finally. Okay, so what I like to go ahead and do is ask myself, are we at all-time highs? We cannot trade if we're at all-time highs. Okay, we just can't. We want market to pull back first, and then we take it back up. Okay, don't trade at all-time highs. Don't do that. Don't do that. Don't short, don't long, don't do nothing. Wait for market to pull back and then take it back up. Okay, wait for market to form. If there's no resistance above current price, do not trade. Once again, if there is not resistance above current price, okay, if you can't get on your time frames in market area of resistance above current price, like right here, okay, then you shouldn't be trading. If market's way up here and there's no resistance above current price, you're gambling. Okay, you're not playing logically. Okay, market works in structured formations. Okay, you know market wants to come up and head to this area of resistance right here. As you can see, market decided to make this bottom right here. Price went all the way up from this bottom and stopped up here. Okay, after it stopped up here, it decided to make it flash down all the way to this low. Okay, so this is a pretty strong area of resistance. If it can make it flash for about a month downwards, okay, that's a strong area of resistance. Market wants to dust off its knees, throw on its gloves, and get ready to fight again. Okay, it doesn't want to lose at this area. Okay, so after it lost the fight once and it fell down, it's ready. You know, it's ready to go back up and fight again. So always think of market as a fighter. Okay, after it got knocked out, punched in the teeth, all their teeth on the ground. Okay, they come back, mouth guard in, gloves in, training sessions done, and it's ready to try and fight and break the new all-time highs again. Okay, so it's real life too. Okay, there's going to be seasons where you're dumb up, but when you fall down, are you going to panic? Okay, and trading's the same way. If you panic sell while market's falling in a downwards direction, okay, instead of just waiting for market to bounce at a certain low, and then by then you're going to get your results. Okay, so when you're drowning, you're falling down, you can't panic. Okay, you got to wait, catch yourself, and then go right back up. Okay, so right here, even logically, I know price wants to reach this area of resistance. Okay, price is upset that it fell down from here. It almost can't believe it that it lost. Okay, it lost at this area right here, and sellers stepped all the way in, stopped buying from here. Okay, and market's like, hold on, you know what? Who said sellers could step in right there? Okay, it doesn't like that. It's gonna try and break past that area and do it over and over and over again until we die. Okay, that's just how it's created. It's how it works. It's welfare sitting here for us, sitting here. Okay, all you have to do is plant your seeds. So boom. So market is going to go ahead and chase this main V up here. Okay, and I can know that because one, market decided to bottom out after making that heavy fall down. Okay, and we're almost fully recovered here too. But I can also see market making on my 4-hour higher lows. Okay, so I can see that this low is higher than this low. This low is higher than this low. Okay, and I can start seeing this low even here too. Okay, and then let me get on my 15-minute time frame. Let's check it out. Okay, so I'm on my 15-minute time frame. Let's see everything a little bit more logically. Okay, even right here, this is going to be an area of support here too. Okay, that's a very, very recent low. Okay, and we could see, okay, price decided to fall downwards recently. Okay, price recently fell down from this area of resistance here on the 15-minute. Okay, so what we need is to see market hold an area of support and see if it's really for true. Okay, so after market decided to fall down from this area right here, okay, it came down and it looks like it made this kind of candle right here of support. Okay, so after a heavy sell-off, you want to see, okay, did the market try and bounce from that at least? Okay, so we could see even right here for this top, okay, market decided to have a heavy sell-off, but it decided to find a low right here, correct? Okay, market decided to even come down and test it in the same area. Okay, so I want to see, okay, is this a higher low? Okay, this low right here. Okay, I want to see if this low is a higher low than this low for real. Okay, so what I want to be waiting for is I want more 15-minute candlesticks that are green filling in the right side. Okay, so I can see this low right here is real. Okay, you know this low is real because outside of the zone, okay, you start seeing green candlesticks heading up in an upwards direction, buying multiple green candlesticks in a row. Even down here with this low, okay, you know this low is real because you start seeing green candlesticks heading in an upwards direction, ready to fill in the resistance gap. Okay, but we could see here from this low, okay, it's just a wick. Okay, after this, it's red candlesticks, green, red, green, red, green, really choppy. Okay, really choppy. Hasn't started fully trending yet. Okay, has not started fully trending yet. Okay, after market found this low, green candle, green candle, green candle, green candle, you start seeing them rapidly success in a V direction. As you can see, it decided to kind of make this wick, but then a red candle, and then a green, but then a red dojis, and then not really consistent. So I don't even know if this low is real. Okay, so I'm not going to take the trade here yet. Okay, I'm going to wait for more 15-minute candlesticks to keep heading in an upwards direction. Okay, I want to see price fully give me that V curl. Okay, one thing too, especially when you first start off and it's helping you eyeball, you can draw trend lines too. Trend lines, like when you first start, could help you out too. Okay, it's really just knowing where the area of resistance is. Okay, so look at where price decided to start falling down in the first place. Okay, so price started falling down up there. Okay, in this area up here. Okay, from there, you could draw the trend line off of that. And a lot of the times, by the time the trend line gets broken, it'll let you know if the area of support is real for the most part. Okay, but that's why trend lines work, because price is confirmed. Okay, but you have to close at the area of resistance above current price. Otherwise, it's all going to be shambles. Okay, it's not going to work how you want it to. Okay. So, even with here, honestly, it's been a couple minutes, honestly. That's why I like to wait for multiple 15-minute candlesticks. So, you have this low, and then you have a bunch of candlesticks above the zone too that's closed. Okay. So you could either wait for the trend line to get broken and then enter, and then stop loss could be under the low and take it up to the high. Okay. And it's about knowing when to buy. You buy directionally. Okay. You want to buy after market sells. Okay. We just play logically. Buy after market sells. Okay, that's it. You buy after market sells, and that's literally how you trade. Okay, that's how you trade the United States stock market. Okay, is you buy after market sells off. Okay, after it sells off, then you buy. Okay. So even this here too, like, yeah, you could avoid a fake out if you wanted to just wait for the trend line, honestly. Or you could take your chance and see if this low is pretty real. We're starting to get some more 15-minute structure here that I like. Yeah, and we could either do that, or I really like this too, though. We have a kind of higher low being formed here on the 15-minute. So a lot of the times too, you see how this area of support got tested like twice. So sometimes it'll do that. Take like a price like right here. We got two 15-minute candlesticks stopping in the same place. Okay, after I see something like that, that's gonna let me know, okay, price doesn't want to break below the support. Okay, giving me way more conviction. Okay. Price would have broke below the support if it wanted to, not bounce at the same place. Okay. Once I start seeing stuff like that on my 15-minute, for sure. Yep, I can go ahead and I can get in right here if I wanted to. Okay, stop loss underneath this low. Okay, and then take it all the way up here. Okay. Yeah. For it's a 15-minute time frame. So yeah, this could be like overnight. Could be a couple days. Yeah, for sure. A couple days at max if it's choppy. But a lot of times it'll be like a couple hours. So yeah. And then you just take that structure and you just keep taking your trades. Just keep taking your trades. Okay. And this is a very small stop loss here. It's 37. Let me go ahead and log into my paper trade here to break down the math. Okay. So boom, you'd be playing for about 108 ticks. Okay. So this is a really, really good trade. Okay. So you're only risking, okay, let's say you're on the micros. Okay, you'd be risking $45, right, to make 135. Okay. So that's over double your money. Okay, and this is a pretty small take profit. You could definitely take this take profit up here as well too, if you feel comfortable holding a little longer, for sure. Okay. So if you wanted to take the take profit up here, okay, that would be playable up here as well too. Okay, so you'd be risking $45 to make 180. Okay. And just wherever market decided to fall down from, it'll want to return to. It will want to return to almost every single time. As long as you're trading, whenever market is making higher lows, okay, understand that market is always going to want to fill in and return and try for vengeance again from where it fell down from. Okay. Wherever market fell down from, it's going to try to recover. Okay. It's going to try to recover. And keeping that perspective is really going to help you. Okay. After market makes its low and falls down, okay, let market make its own area of support. Okay. And we can see on the 15-minute here too, once again, areas of higher lows being formed. Okay. I have this area right here. Okay. I like this candle a lot. After that, price went all the way up. Okay. Fell all the way down and then made this low. Then price went up. Okay. Came down and then made this low. We got two 15-minute candlesticks chilling in the same place here. Amazing, amazing area. Okay. So I wanted to stop loss underneath this area of support since we look like we're trending here. Okay. And then take it up to this area of resistance. Okay. For the whole formation fill. Okay. And it's about just waiting for pullbacks, taking the trade. Wait for pullback and then take the trade. Okay, and being as patient as possible is really going to be the determining factor versus profitability and just unprofitability. Okay, and buying during trending times. Okay, because you can't just live on your 15-minute time frame and try and do things like that. Okay, it's still important to do the whole top-down analysis. Because we did the top-down analysis, I was able to understand the 15-minute time frame structure a lot different. Okay, because the 15-minute, if I just pull it up, it could be a whole different story. Okay, but when we're on our higher time frames, we can see everything for what it is. We can see that this is a bullish asset class year after year after year, and all we got to do is buy the dips and catch the sweeps back up. Okay, and that's it. So get ready to rumble, traders. Okay, if you guys want more help with futures trading, okay, whether it be education, technical analysis, or anything, head over to stackmode.net. You guys can book a free call with me. I got free courses, free ebooks for you guys, and there's just too much information out there, okay, that I really try and give you guys to help you get profitable, inshallah, if God wills. Okay, and let's break down these things. Okay, understand that leverage gives you a lot of power. Okay, but you gotta be in control of this. This could be a really good thing or a really bad thing if you don't have it down packed. So make sure you study yourself as a human. Make sure you're aware of your emotions and don't crash out and make irrational bad decisions. Okay, and liquidity gives you speed. Okay, when everyone is buying, okay, you're gonna start seeing price action flood in a upwards direction. When everyone's selling, you start seeing price action flood in a downwards direction. Okay, and risk management is the thing that's gonna keep you alive. Okay, and your risk to reward. Okay, so if you're risking $50 a trade, you need to be at least trying to make 100 to 150. Okay, if you make 100, that would be a 1 to 2 risk to reward ratio. If you make 150, that would be a 1 to 3 risk to reward ratio. Okay, and focusing on your risk to reward ratios is how you're going to become profitable. It's all in the math. So if you're making more than you lose consistently, you will become profitable. Okay, and start with paper trading and start with mentorship first. Okay, so head over to stackmode.net. I love you guys so much. Keep grinding, stay prayed to God, and I'll catch you in the next one. Peace.
Class, let's go and let's jump into why you have to be disciplined, especially if you're going to be on a funded account, on a prop firm account, or trying to get any type of withdrawal. And let me tell you guys something. There's been times where I've lost a withdrawal on day 4 out of 5 of my payout. Okay, due to what? Due to me being undisciplined, due to me being greedy, due to me having too much ego. And I don't want you guys to go through the same things. Okay, there's no reason to be going through that. There's no reason to be that disgusting and sloppy. And I want you guys to learn to just be consistent. Okay, there's going to be a lot of cost that come when you trade without your rules, when you let your ego get to you, okay, when you don't humble yourself, okay, and there's a reason why God tells us to be humble and have humility, okay, because you can really destroy yourself. Even when you're running up that big bag, okay, I was excited, okay, running up that big bag, posting P&L on social media, and this was before I was even Stack Mode Chris, okay, like super duper excited, overzealous, over trading, and guess what? Destroyed it all, okay, ended up getting no payout and lost the account at day 4 out of 5 out of my withdrawal. Okay, what was I doing? Okay, and I was up way over the amount than needed to crash out the account. Okay, and it was just completely my fault. I realized I had too much ego. I needed to humble myself, and I realized that I just couldn't believe that I was wrong on that one trade, especially after one streaking to earn the account in the first place. And prop firm can kind of screw up your head and screw up your whole mental realizations. This is why I personally do recommend, even if you're on a prop firm account, even if you guys are good at getting withdrawals, okay, start a real account. Okay, do these two things. Take the prop firm profit, okay, and reinvest it into account A. This is going to be your long account. Okay, your long accounts are either going to include your cryptocurrencies, your stocks. Okay, make sure you guys are trying to buy shares. So this way, you guys' money is always going to be making you money. Okay, because don't forget, prop firms can shut down. Certain things like that are possible. Okay. So just make sure you guys are taking your time, putting everything into perspective, and really just reading through the lines of absolutely everything. Okay. So account B. Okay. Replicate whatever you're day trading on wherever you're day trading on your prop firm. So if you're day trading futures, for example, on prop firm, then start a real account and copy trade on there. Okay. The same trades that you do on your prop firm account, just do it on your live account, even if the size doesn't correlate. So this way you're always going to have your money in your hand. So even if the prop firm shuts down, whatever happens, whatever correlation decides to go within a downward spiral, okay, you're always going to have your income there on the side. So you got account A, always making you money. Your money's always making you money. Okay, instead of indulging in consumerism. Okay, a lot of reasons why people can't pay their rent and stuff like that is because, one, they're not stacking up. And you can't only stack up. You got to make sure your money is being used as a tool. It's being utilized. Okay, then rent's not going to be nothing. Bills aren't going to be nothing. But you got to sacrifice. If you don't sacrifice, you won't get wealthy. Okay, and once again, getting wealthy is not for everybody, and that's okay. Okay, but if you're a person who wants to get wealthy, you have to learn how to sacrifice. If you don't do that, you'll never get to where you want to be. Okay, so when you have account B, make sure that you're keeping your profits in there. Okay, use your prop firm account as your income engine. Keep your profits in account A and B and keep stocking it up. Keep stocking it up. If you get to the point where you do find consistency on the prop firm, okay, you do have discipline and you found yourself a consistent edge to where you can constantly withdraw, that's amazing. Okay, alhamdulillah. Now, account A and B, don't touch them. Okay, just keep funneling money into them. Keep funneling money into them. Keep going, keep going, keep going, keep going. Okay, until either the A, the prop firm shuts down, or B, you just want to get off a prop firm entirely and just start focusing on account B and playing with your leverage and not playing without any rules or anything like that. So you can really use prop firm to get ahead and generate some income. So discipline is going to be the gateway to success and capital in general. So proprietary trading firms are not testing your strategy. They get paid based off of knowing the fact that you're going to be someone who's not disciplined. Okay? So prop firms only make money whenever you lose. So once again, whenever I didn't get a withdrawal on day 4 out of 5, right? I couldn't believe that I was taking a loss, right? Prop firms will kind of gas your head up. You know, they'll give you the nice fancy certificate, you know, after you guys went through all that hard work. Okay, so you start feeling like a good trader. You might start thinking you're better than you even are. Okay, then from there, they gate your profit behind certain days. Okay, so this is going to be a psychological game they play, because don't forget, unlike brokers like Robinhood, Webull, etc., where you invest your money, okay, the brokers get paid off of whether you put the trade now. So whether you click sell or buy, they make money. So it doesn't matter. They're not really betting on whether or not you win or lose your trade. They don't care, because they already get their fees as soon as you click enter. Okay, they get their fees. And everyone pressing enter, the conglomerated fees turns into their capital and their income as a company. Okay, so a broker is a really good business to start, honestly, as long as you just set up the software and get all the approvals. It's a really, really, really strong business, since you just get paid based off of fees. Okay, you just need participants. So, but prop firms, for example, okay, prop firms, they only get paid when you buy an account. Okay, so they're going to psychologically change everything, and they might put into retrospect like it might be easy to go ahead and get a withdrawal, etc. But behind the thin lines, behind the challenge rules, etc., they're hoping that you fail. Okay, so winning 5 trades is not normally how it goes in order to get your money on a real account. Okay, and they know that, so they're trying to take advantage of giving you the quote unquote capital. Okay, even though it's really a tenth of that. Okay, say if you have a 50,000 account, it's really like a $5,000 account, especially with the drawdown, etc. Okay, so don't get tricked by the numbers. Don't get tricked by certain things that are just in your face. You got to really read between the lines. And the reason why a lot of prop firms get successful or enforce a little more rules, like having to send proof of you taking the trades and stuff like that, or breaking down your trades, stuff that you just don't really have to worry about in a real account. Okay, so if you want to trade prop firm, that's going to be you. But if you want to stay down, stack up your bread, run it up, and then invest, that's a highly recommended option. Okay, but if you master prop firm, you master the rules, and you found yourself able to get withdrawals consistently, use it as an engine to fund your real accounts. Okay, so preserve your capital, especially once you guys start winning. Certain prop firms like Top Step, for example, the drawdown likes to catch up with you. Okay, so even when you take a loss, you have to make sure that you're keeping everything inherently in perspective. Okay, keep up with your drawdown. It's not going to work like a normal account. And being a reliable steward of your money is going to come to whether or not you want your account to be alive. Okay, are you chasing money, or do you want your account to be alive? Okay, because if your account's alive, the money will always be there. Okay, I just checked my Webull portfolio today. You know, thank God, up a really nice percentage. Okay, entered and just been stacking up, not looking at it, investing over and over and over and over again. Okay, but you guys have to learn how to sacrifice, have to stay down. I've been wearing the same clothes every single day. Okay, haven't been buying anything new, just been paying bills, taking care of what I've been doing. But I go look in the stash and I'm happy. I'm cheesing. Okay, So don't worry about whatever anyone has to say in real life. Okay, you know what your stash looks like. Okay, you can go and put in the stash. You can go pull out 100K. You can go pull out 10 bands whenever you want at any time needed. You can get up. You can go swap cribs whenever you want, anytime needed. It's not a lie anybody can tell you. Okay, you're good. So just focus on yourself. Focus on putting that money in the stash. Stay down. Okay, you don't need the newest phone. You don't need the newest shoes. You don't need the newest this, and that. Okay, right now you're probably broke. If you don't have at least 10K, you're broke. Okay, so you don't need to be buying none of that. Some of y'all have the newest phones and not 5,000 in the stash. And it's time to really change our mindset. Okay, because I noticed when I was silly spending, I sat back and realized, wow, if all of this was invested properly, I wouldn't even be having to work as significantly hard in the future. Say when you're 60 years old, you have $2 million in ETF account. That alone will give you 70K a year. And that's just $2 million. Okay. Then you could have another M and some cryptocurrency generating you equity there. Okay. And that's by 60 years old. At 60 years old, it's $3 million. It's not that much by 60 years old. Okay. That's many years. Okay. A lot of people become millionaires like 23 to 28. So it's a lot of years, a lot of time you have to stack up M's. Okay, so once you do that and you stay down and you invest, you'll never have to work again. Okay, you'll pretty much just be able to live for free. Investing is how you live for free. There's no such thing as free, but investing is how you live for free. Once your money is making you money infinitely, you live for free. And then you don't have to stress about anything. So it's about how you put in this mental perspective into your own account. And you got to just ask yourself, like, do you really want to be wealthy? Do you want to get to where you want to be? Because if you do, you're going to follow your rules. You're going to do what needs to be done. You're not going to be over trading. You're going to be trading between your risk parameters. Okay. And if you go over that, that's on you. You're just telling yourself that you don't want to get to where you want to be. So the discipline is really going to ensure that you stop yourself from destroying your account and just stop trading before you just hit the drawdown limit and you destroy your account without even realizing it, or you just blow up profit that you've been working really hard and consistently to grind. Okay, just because you have one bad day, that doesn't mean just crash out the whole account. You shouldn't be hitting maximum daily drawdown at all. Okay, take your one loss, hop off, plot an even cleaner setup, come back and get back in your bag. You're good. So true trading discipline, especially when it comes to futures, forex, etc., your mechanical execution is really going to need to be on point. Your technical analysis and the way that you fundamentally look at the chart, it has to be in a logical perspective, especially when you're trading stocks and crypto. Understand that's a left to right chart. Okay, just like us as human beings, we start from babies and we grow older. Okay, everything in the world works from left to right. Okay, everything has a start to finish. And understanding that, putting that into your technical analysis, you're going to understand, okay, this is why price is dipping here. This is why price is making a high here. It's finished at this point. It's going to go down and try and break that finish line again and continue, make a new finish line, okay, making new highs, etc. So have a really good fundamental, logical understanding of the chart before you even try to boot up even a prop firm account, okay, especially before you put your own money into a live broker. Okay, and don't forget too, prop firm accounts, you're still spending your own money. Okay, I know you guys are playing with the quote unquote like prop capital, but you're still swiping your card to buy the account. Okay, so all that money that you're using to swipe your card to buy the prop firm, you got to really ask yourself, like, okay, would this be more worthwhile in like an ETF or a profitable stock or something that's just going to passively make you money pretty easily, maybe like a long option? Okay, so ask yourself that before you make any decisions. So enter trades only when the exact setup becomes present to you as well too. Okay, if it's not the setup that you want, don't be taking that. Don't be fiending for money. Don't be desperate. Okay, relax. Okay, especially when it comes to the market, go work harder at your business, and you can't force trades. If you think you're going to force trades, and if you think you're going to be right at the market, okay, you'll learn. Okay, you'll learn that the market is right. And if you're wrong, you're just wrong. And you have to be okay with that. Okay. You'll plot on another trade, and I promise you guys, if you just stay disciplined, you keep studying the charts every single day, you'll start placing right trades consistently. Okay, stick to the course, even when it's hard, even when you're frustrated, you just crashed out, you just destroyed your setup, whatever. Okay, relax, you're good. I promise you, you're good. I've been through all of that, and I'm telling you guys, once you get to the other side of profitability, once you start just checking your account, cheesing, You just start seeing green, money making you money. Okay, it's a real blessing. Okay, it's a real blessing that God even put this in your mind. Okay, so you're good. Stick through it. I promise you. Just stay down, and I promise you, everything's gonna make sense in a couple of months. So trading without emotion. So think of that kind of like smart contract in the cryptocurrency world, right? That's like a machine without executing the code. So you can't really do that. You got to become a robot when it comes to trading and investing in general too. You got to become a robot. You can't be emotional. You can't be panicking when price is going up or down. Okay. And even when you are smiling at P&L, you can't be excited. You can't be quick to withdraw everything. You can't be like, I'm going to just go withdraw everything and go ball out. Go buy a car, relax. Okay. That's your future money invest in for your family. Okay, you can make real deal plans with that. Go buy some land, go buy some houses. You can make real boss moves with that. Once you get your capital to a certain percentage, it's so easy to just turn your money into more money, whether doing a lucrative amount of things, whether it be real estate, stocks, stock options, shares, crypto, whatever. Okay, so take that prop firm account money and siphon that into certain long-term investments and you'll be good. And your plan is really going to dictate everything. Okay, your discipline is going to ensure that you follow that plan. Okay, and once again, whether you're feeling like you want to do it or not, like if you want to take that FOMO trade, go ahead and do it. But if your portfolio isn't looking like how you want it to be at the end of the year, you can only be mad at yourself. Okay, you can only be upset at yourself. But if you're sticking to each setup over and over and over and over again, you'll get to where you want to be. Okay, that's the real difference between the people who are successful in this world and who aren't. Too many people are too focused on emotions, like, oh, this is boring, this is whoop-de-whoop, this is etc. And that's why people just aren't anywhere. Okay, people don't know how to sacrifice. Okay, if you want to live in pleasure, if you want to live in leisure all the time, that's okay. You'll get that. You'll most likely have late bills. You'll most likely be driving a car that's not nice. Okay, and you just won't be doing the things that you want to be doing. But I promise you guys, if you sacrifice for a couple of years, you'll be living in extreme leisure. Extreme leisure. It doesn't even matter your income level too. You could be making 30K a year, 40K a year. If you're saving and you're investing constantly, stacking up every single dollar and using it as a tool, you'll be good. You'll be good. There's janitors who's retired as millionaires, okay? Just by making the right decisions. It's all about decisions. Life is about decisions. And if you want to make the wrong ones, that's fine. But if you see someone flying down in their Rolls Royce, don't think that they got gifted that. No, I'm telling you, it's not many people who can give somebody a Rolls Royce. That person probably stayed down, stacked up for many years, many months, went through many struggles in order to get that. Okay, so make the choice. Do you want to be disciplined or not? So emotional trading is going to be your biggest threat. All right, if you want to be a pansy, that's fine. That's fine. But I'm telling you, if you want to come onto these markets, you have to be ironclad. You have to be structured. There's some serious people you guys are playing against. You guys are playing against people like me. You guys are also playing against other competitive players like Warren Buffett even. People who want it bad. And it's trading. Okay, don't come on here thinking that it's about to be light. You're coming into the arena. Okay, trading is very serious. Okay, it's called trading. This money isn't flying out of thin air. You're trading with somebody. Whoever's losing, you're taking their money from them. And when you lose, somebody's taking your money from you. Okay, you have to understand, why am I getting my money taken from me? Who's taking my money? What better players are taking my money? Whenever you're losing, someone is taking your money from you. I want you guys to really let that bake into your brain, especially my competitive people. Somebody's taking your money from you because they're more disciplined than you, because they're more patient than you. Are you good with that? I'm not. And that's why I had to humble myself real quick and get it in order, because I'm not good with people being ahead of me. Okay, I'm here to be the best. I'm here to win. And if you're here to win, it's time to be patient. It's time to be more disciplined than everybody. It's time to be more structured than everybody. Okay, while everyone is being loose and doing everything and being emotional, let them do that. Let them do that. Okay, but if you want to be pull up in your palace, pull up, driving whatever car that you want to drive, living how you want to live, eating what you want to eat, inshallah, okay, it's because you sacrificed. You stayed ironclad. Okay, you weren't worried about the pleasure. You knew the pleasure would come later. So don't be revenge trading too, okay? Some of you guys revenge trade because your mind goes into survival mode. Survival mode happens when you think you're about to just not eat, not have a roof over your head, etc. One, if you go into survival mode after you lost a trade, you're probably trading in a mode of desperation. Is this prop firm account like something that you're betting on? Okay, right? because you should be fine without, whether or not trading works, okay, you should try to have income generated so that you can be fine until it gets to a point where trading can completely over dominate everything and by just your passive investments, okay, like ETFs, for example, okay, then that's fine. But until then, okay, you should be fine. Okay, whether or not your trades work out, you should be fine. And if not, you're investing too much. You're investing way too much. And you're probably over leveraging as well too. So don't increase your position side after a loss too. Don't lose $500 on your account, right? And then put on $1,000 worth of size trying to make that up, trying to make that loss back up, and then profit after that. Just stop. Okay, come back to a completely fresh trade, completely new day, and start over again. And don't move your stop loss. Okay, the automatic order that closes out your trade for a reason, don't move that. Keep that there. And don't exit prematurely. All right, God put this in your brain for a reason. Don't panic. Don't be closing that take profit too early. Okay, relax. Set your alerts and let take profit hit. If you close that take profit, if you close before take profit hits, okay, you're ruining your risk to reward. So if you're supposed to make $400 on that trade and then you only make $220, and then your next loss you lose $310, okay, instead of you still having $90, right, instead you're just down. Okay, you're down to $310 minus $220. Instead you're just down. Okay, so take your time. Okay, and don't micromanage a trade that's moving in your favor. Okay, set your alerts. Don't look at it. Get up. Go do something else. Go get some more money. So having a funded trader mindset, focus on the process, prioritizing executing the plan amazingly every single day. Okay, study what you want to do, study how your setup should look, and get some data and evidence, especially month after month after month. You should understand how the market works, and results are going to be secondary. Consistency and execution is the only metric that matters to the firm, and you'll have a long-term view. A funded account is a career, not a single trade opportunity. And discipline smooths out the equity curve, turning random results into predictable income over months. Why? Because you're sticking to the same risk parameters. You losing the same amount consistently. Okay, your wins are pretty much calculated, especially when it comes to futures and stuff like that. Okay, and don't worry about the risk. Okay, so don't worry about the risk. One, you have to know that not every trade that you're gonna win. Okay. So you can't just be thinking, what if I lose? What if I lose? What if I lose? Get that out of your head, okay? But understand that you need to calculate your risk though, okay? In order to get that feeling out of your head, you're probably too leveraged in. You probably have too much money in a trade, and calculate your risk though before calculating the potential profit. So instead of worrying about, oh, am I gonna lose? Am I gonna lose? Or worrying about how much I'm gonna make, how much I'm gonna make. Just calculate, okay, this is how much I'm gonna lose. If I lose, I'm okay with this. So even if the trade works out or not, you guys are going to be okay. So discipline is your only true form of edge in risk management. All right. And discipline is really going to be the separator between passing your test. Okay. It's pretty simple to pass most of the prop firmer tests. Okay. You can go ahead and just gain some consistent rules, and a lot of times you'll get your account. Now, keeping the account, this is a completely different deviation. Keeping the account is a different ball game. It's about staying on this course of action year after year after year after year after year. Okay, not a single ego-ridden day. Okay, mistakes just aren't going to be tolerated for, and if certain mistakes are made, your account will be punished. So if you want to keep the account, I really recommend you guys just pray to God. Okay, keep your ego in check. Stay humble. Even when you guys start withdrawing big amounts, stay humble, stay humble, stay humble. It's really going to help you guys just stay focused on the process. Okay, and don't look at your P&L too much. Don't be looking at your money too much. Just wake up every day and grind. Okay, don't look at your money too much. Wake up and grind. Just keep going. And funded traders understand that rules equals money. Inshallah. Guys, stay prayed up to God. Keep grinding. Head over to stackmode.net for all trading education. Peace. Let's master technical analysis the easy way. Charts isn't going to be that difficult, and once you learn how to run chart, you know how to read everything. So I'm going to give you guys the best sauce and the best strategies in order to read this chart and make the crypto markets pretty simple to trade. So one, starting off on the main thing, you're going to be needing to use your higher time frames. So your time frame is going to depict on the amount of candlesticks and how much candlestick price action you're seeing. So if I'm on the daily time frame, for example, each one of these candlesticks will represent 1 day worth of price action. Okay. If I'm on the 4 hour time frame, each one of the candlesticks will represent 4 hours worth of price action. If I'm on the 1 minute, each one of these candlesticks will then represent 1 minute worth of price action. The reason why we're using a higher time frames is because we want to be seeing the overall trend on the higher time frame scale. Okay, so year after year, and you have to understand that everything from the left that happens on the chart reacts with what we see to the right today. So everything correlates, everything works together, and we're going to be able to mash it all together. Okay, so now that we know that information, if we use our daily levels, okay, and we put the levels from the left to the right, we can go ahead and put out some trades. Okay, so let's talk to you about some different models, some different stuff I'm going to talk about, and how we're going to be able to introduce them into making profitable trades on the chart. So areas of resistance. Okay, so when you see me mark areas of resistance, it's going to be an area where sellers are going to come in from. Okay, understand that the chart is a left to right chart. Okay, so price action, let's say price action started all the way over here. People are going to take profit eventually. People are going to want to make their money. They're going to want to sell. Okay, so whenever you see price have periods where price dips down after making a high, that's going to be called an area of resistance. Okay, so resistance is going to be an important key factor to knowing where, okay, this is where sellers came in. Okay, so opposite of resistance, there's going to be support. Support is going to be an area where price decides to bounce in an upwards direction from. Okay, so this is going to indicate an area where buyers step in. Okay, so buyers are going to be trying to buy here, so then price can go up in an upwards direction from here. Okay, buying is stepping in since price is going in an upwards direction. Okay, and then when you see price making sharp downturns, that's going to go ahead and signal an area of resistance. Okay, so both of these things are going to be extremely important to go ahead and keep note of. Okay, so resistance has to be broken in order for price to progress in an upwards direction. Okay, so we know the goal of the cryptocurrency market a lot of the times is for cryptocurrencies to go up in price. Okay, so people are trying to gain APY, annual percentage yield, percentages on their dollar. Okay, I know I definitely am. Okay, by buying and holding and investing in something with value. Okay, so when you do that, you're going to be able to progress a lot faster, inshallah. So noting that, we can determine that, okay, the goal of cryptocurrencies is to go up in a certain value. Okay, so if price starts at $100 one year, maybe the next year, price might head over to $10,000. Okay, so let's go and let's check out the chart, for example. So if I check out Bitcoin, I can check price is currently at 113,104 as of right now, today. Okay, so price is all the way up here. If I check 2 years ago or 3 years ago, I can see price all the way down here near the 15,000s area. Okay, so price is at 15,000 all the way down here. Okay, and price is now at 113,000 in just 3 years. Okay, price has increased that much value exponentially within an upwards direction. Okay, so now that we know that, okay, the goal of the tokens and cryptocurrencies are to go up over time, we can go ahead and put that and plot out some really solid, good trades. Okay, so let's go and let's check it out. So back to the drawings here before we jump into the chart. Areas of resistance, once again, have to be passed in order for price to progress with an upwards direction. So resistances have to be broken and turn into support. And then price can go ahead and blast up in an upwards direction. Okay, so once again, resistance can be broken and turn into support. It's not going to happen every time, but when it does happen, that's going to be a really good solid way in order to play a pullback. So let's say price is currently above and it goes back down to an area of resistance, it can turn it into support. Okay, so then price can go ahead and sweep up and you're going to be able to buy a low at the right time. Okay, or you're going to see price decide to bounce at an area of support twice. Okay, so if price decides to hold an area of support twice, then that's also going to be a valid way in order to determine, okay, you know what, price wants to head up in an upwards direction. Okay, so it really just determines on what you're looking at, okay, and the certain type of trades. Okay, so even if price is still going up here, price makes an area of resistance right here. If it comes down, turns resistance into support, I'll go ahead and swoop up and show up. Let me show you an example of this on Bitcoin. So I'm on the daily time frame here. Let me go ahead and zoom in. So I can see price decides to create an area of resistance here. Okay, the major area of resistance that there's always going to be is all-time highs. Okay, so all-time highs, also known as ATH, it's going to be when price is at the highs. Okay, it can't go any further. Okay, and this is the furthest price that it's at. Okay, so it's when the highest area of resistance is created. Okay, and price is trying to break it in order to continue further. Okay, so check this area out here. So check out this area of resistance here. We'll go ahead and zoom in. So you can see that this is an area of resistance due to the fact that price wants to fall in a downwards direction, okay, from this area. So price decided to meet up with the top of this candlestick here and fall within a downwards direction. Okay, price went all the way up from this low. Okay, went all the way up from this low. Okay, 2 candlesticks bounce at the areas of support on the daily. Okay, 2 separate days. Price decided to bounce all the way up, stop here. Okay, once it stopped here, this price decided to get broken over here. Okay, so an area of resistance isn't going to keep getting tapped over and over again a lot of the times. Eventually, price is going to attempt to break the area of resistance, turn it into support. Okay, and then price is going to try and head up in an upwards direction. Or price is just going to break the area of resistance and just break out. Okay, and just head up in an upwards direction. Or price is going to head in the breakouts direction. Okay, it'll happen. It'll break out a tiny bit and then pull back all the way down. Okay, that's going to be called a fake out. Okay, in order to avoid fake outs, you're going to, for breakouts, you're going to play break and retest. Okay, a lot of the times break and retest, you're not really going to get faked out. Okay, especially if you wait for your 4-hour close, which is when you're waiting for the time that you can see over here to the right. Okay, to finish. So let's say we entered at this black line. I would not enter at this candle here because it's in between the black line. And I would not enter at any candle that tests the black line. I would enter at a candle up here, okay, above the black line. So this way, if price decides to burst down below the black line, I'm not going to be upset that I lost. Okay, I'm going to go ahead and just take the closed candlestick, okay, and take the trade this way. This way I know that, okay, you know what, price might want to go ahead and sweep up. Okay, so the earliest entry might not always be the cleanest time to buy a lot of times. Sometimes it's better to just trade the confirm entry, okay, and just wait. So this right here would go ahead and be a good example, okay, of a close that I'd be waiting for. Okay, and then when I take profits, I'm going to go ahead and set it for either A, all-time highs, depending on what I'm playing. If I'm playing cryptocurrency or shares, I'm playing for all-time highs. Buying at dips, and I'm playing for all-time highs. Okay, I'm going to be waiting for price to sweep all the way up, okay, and to do its thing. Okay, so you're just waiting for price to do its thing. Okay, and once again, areas of resistance like these up here, okay, are going to be your take profits. If you're playing along and you're waiting for price to go up, okay, your areas of resistance are going to be your take profit. So up here is an area of resistance. Okay, up here is an area of resistance. Okay, and both of these areas of resistance are going to go ahead and be able to be played. Okay, so make technical analysis simple when it comes to trading cryptocurrency. So I pray up to God. Keep grinding. And head over to Stackmode Network for all trading education. Peace.
Most beginners lose money trading futures, not because the market is hard, but because they start wrong. Today, I'm going to show you the right way and the simple steps to your first profitable futures trade. By the end of the video, you'll know exactly how to pick the right contract and how to avoid the traps that wipe out new traders, and the exact setup professionals use to stack consistent wins. No fluff, no complicated math, just a clean, actionable beginner framework that actually works in live markets, prop firms, and even if you've never traded futures in your life, inshallah, if God wills, you'll know how to trade it by the end of this course. Let's jump into it. Okay, so this is going to be how to trade futures and catch dips and certain lows. Okay, so we're just going to go ahead and jump straight into it. So what you want to do is start off doing top-down analysis. Okay, top-down analysis is when you're going to be starting from your highest time frame
and scaling down to your smaller time frames. So what we're going to go ahead and start off with is our weekly time frame. Okay, our weekly time frame are going to be our eyes. Okay, you're going to be able to see absolutely everything you need to see on the screen. You got to start on a higher time frame. Especially on futures, you cannot sit there and tunnel vision on things like the 5-minute and the 1-minute and not understand the true directional bias. Okay, we're also going to talk about some logical things and some logistics of why it's better to play certain directions within the US market. Okay, and futures is going to be a US market. Okay, we're going to talk into everything, and this is going to be the full futures guide. Okay, so we're going to go ahead and have the weekly here, right? Weekly time frame is going to be our eyeballs. Okay, we're going to be able to see everything we need to see on the higher time frame basis. That's going to be pretty relevant. Then from there, you want to go ahead and head down to your daily time frame. Okay, you're going to go down to your daily time frame. It's going to show you a little bit more candles than you would see from your weekly. Okay, and each one of the candlesticks that you're going to see is going to determine the amount of price action that's happening within a certain time frame. So if you're on the weekly time frame, each one of the candlesticks that you see will represent 1 week. If you're on the daily, each one of the candlesticks will represent 1 daily. Okay, so that's how things fluctuate and change. Okay, so it's just about knowing when to use certain time frames and how to use the flow. Okay, and once again, the flow is going to be going from your highest time frame to your lowest time frame. Okay, highest time frame to your lowest time frame. So we're going to go from the weekly to the daily to the 4-hour time frame. Okay, the 4-hour time frame is going to be extremely important, and we're going to talk about why. So if I get on the 4-hour time frame, we're going to see here in the bottom right of Trading View, okay, you're going to see the words ETH. Okay, so look in the bottom right here, you'll see the words ETH. ETH is going to stand for extended trading hours. Okay, it's going to stand for extended trading hours, and what that is going to show you more candles that would be hidden than if you didn't see. So market is open normally from 9:30 a.m. Eastern time, okay, to around 4 p.m. okay, Eastern time. Okay, that's going to be like the basic stock market time. But with extended trading hours and with futures, market is also open on Sunday. It opens at Sunday at 6 p.m. and is open until I believe Friday at around 6 p.m. as well too, Eastern time. Okay, so extended trading hour is going to show you the Sunday hours, which you need to see. Okay, if I turn off extended trading hours, okay, the chart is going to look a little different, and you're going to see little areas like this, okay, where you're going to see gaps in between certain spaces. But if I turn on electronic trading hours and I go back to the same place, I'm going to see price have a filled in area there. Okay, so that's why extending trading hours is extremely useful to use, and why you can't just live completely on your higher time frames. Okay, all your time frames are going to be useful. Okay, you got to use all your time frames. Got to. Okay, all your time frames are going to be important to use. They're all going to help you out, and it's about knowing when to use what, once again. Okay, so that's going to go ahead and be that. So you're going to go from your weekly to your daily to your 4-hour to your 15-minute. Okay, weekly, daily, 4-hour, 15-minute. Okay, that's how your futures flow needs to go. Do not just tunnel vision on the smaller time frames. Yes, the futures income is nice. Yes, you can scalp and make some money, but it's not just about that. It's going to be about the discipline. It's going to be about catching your nice big trades, okay? You don't want to be just trading for pennies, okay, especially on futures. This is why on futures, I recommend be on the live account, okay? Because when you're on the live account on futures, things are a lot different, okay? You can hold your trades overnight, okay? When you're on prop firm, you cannot hold your trades overnight, which hurts your profit significantly, okay? The extended trading hours time is going to be when a lot of price action decides to occur. So when you get a good entry and you see which way price is flowing in, you can make some nice money and turn a small account to a lot. Okay, fairly fast with futures. Now it's going to be a lot of power in your hand. Okay, when it talks about futures, it pretty much just means make or break. Okay, you can make or break all your profit. Okay, so let's talk about some certain things when it comes to futures before we get into the chart. Let's talk about margin. So margin is going to be an important thing when it comes to the futures market. Margin is going to be the amount of money required in order to open a contract. So in order to outplay this, right, thank God we have the new micro futures accounts. So micro's futures accounts cost less than normal's futures contracts. So let's say you're trading the NASDAQ 100, also known as the NQ, okay, which mirrors the QQQ, okay, stock or ETF. So index. So NQ, right? Let's say it costs $1,000 to open up one contract of NQ. Okay. On most brokers, it'll cost you like at least $1,000 to open one contract of NQ. Thank God, though, we have something called the micros, which helps us trade more efficiently. And this way we can trim and get more value for what our account size is. So now we have micros. So now you could play something called MNQ. Okay. And instead of spending $1,000 on a contract, you can then spend $100 on a contract. Okay. And you could flip that fairly simply. Okay. Let's say you're on YM. Okay. Which mirrors the US 30. Okay. It might cost you $500 to open one contract. Okay. And if you're trading MYM, for example, it will go ahead and cost you just $50 to open one contract. Okay. And you could still make some great money. And instead of buying one contract of YM, you could buy multiple contracts of MYM and be in a much better position. Okay. So you can think about that. So the micro contracts are going to be new contracts. I believe they came out like 2021, something like that. Fairly new. Thank God. And now we have the ability to trade with less money. So even if you do have a big account, you could trade a bunch of micros and trim and trade how you want and hold your trade as long as you want. And as well, when you trade the micros, they're going to have lower overnight margin. Okay. So OVM, overnight margin. Okay. So it might cost $50 to open a micro contract during the day. But if you want to hold it past 5 p.m. Eastern time, then the margin might go up to like $400 a contract. Okay. So you got to make sure you're having the overnight margin and the day margin if you want to hold overnight. Okay. So pay attention to that. And every broker is going to have its own different amounts. Okay. It's a lot of important things to know before we just jump into trading futures, because you can get what's called margin called, where if your account goes underneath the amount that required, let's say MYM, okay, let's say it requires at least $50 in your account. If your account goes underneath $50, let's say it goes to $48, it'll go ahead and just wipe all of that and put it straight at zero. Okay. And if your price action goes against you too fast, you might even owe the broker money sometimes. Okay. So you want to make sure that your dollar amount is a pretty good amount over the amount of margin. So if it requires $400 to hold overnight, then try and have at least like $800, $700 or something like that. Okay. This way you're going to have some wiggle room and things like that. So the things outside of futures are going to be really important too. And how long you hold the trade is also going to go ahead and be limited. So how long you hold the trade is going to be based on the certain month too. Okay, you can't sit there and hold futures forever because they do expire and have certain expiration months, which the broker will tell you a lot of the times. So now let's go ahead, and which is why you'll see on your broker sometimes they might ask you to roll over your contract. Okay, so once again, starting on our higher time frames is going to be our bread and butter. Okay, it's where we're going to succeed at. We want to see the higher time frame trend. Okay, let's talk about some logical things too as well before we jump into the chart fully. Okay, I want you guys to pay attention to this. This is going to be MYM, right? Look at how this chart trends. Okay, year after year, even with certain dips, we're trending in an upwards positive direction. Okay, we're trending once again in an upwards positive direction. year after year after year after year after year after year. So personally, I don't think it's smart to trade futures to the downtrend. Okay, the Forex community has spread over to US traders, and now US traders think that they should be shorting a market that goes up year after year after year after year. There's also certain laws in place called the short sale restriction, okay, SSR. And the short sale restriction prevents stocks from just flash crashing to 0%. Because if they don't forget, definitely remember this, but don't forget, futures are just indexes. They're just a bunch of stocks put into one big giant conglomerate, and then you can trade it like that. Okay, that's all it is. So if stocks crash, futures will crash. Okay, that's just how it is. So you want the stocks to be up and afloat. And same thing for the US government. It's beneficial for the world, okay, the global economy, okay? The more money the US has, the more we can look better and help other countries out, etc. Okay? So, if the stock market goes within a positive upwards direction, right? If futures goes in an upwards direction, okay, that's going to incline more companies to be able to hire more employees, okay? And the more employees that are hired, the more taxes that are going to be paid. The more taxes that are being paid is going to equal a richer White House. A richer White House is going to give the country more credibility, recognition, and ability to do more things. Okay? So, there's logical reasons why we want the stock market to go in an upwards direction. Okay, logical reasons why you don't want the market to crash down. So don't fear crashes whenever you're trading. But in futures, I recommend to buy lows. Okay, there's going to be two things we're going to be looking for in futures. We want price to already, and let's talk about support or resistance. So support is going to be an area where price is bouncing in an upwards direction. Okay, so if you're on your higher time frame and you see price made a certain low going in an upwards direction, okay, that's going to indicate an area of support. Okay, it's going to indicate an area of support. Then the opposite of that is whenever you see price falling in a downwards direction. Okay, whenever you see price falling in a downwards direction, then that's going to be called an area of resistance, indicating that sellers are coming into place. So resistance is going to be when price is falling in a downwards direction. And then we're going to have support when price is bouncing in an upwards direction. Okay. And that's just going to go ahead and be the difference between the two. So putting this into perspective, we have to go ahead and realize, like, okay, support and resistance correlate with each other. Market can only go in two directions. Okay. But I can see on my weekly time frame, year after year after year after year after year, market's going in upwards direction. Okay, so my US futures traders, please do not have that Forex mindset. Okay, I want you guys to look at the Forex chart real quick. A lot more sideways. This is why Forex traders short. Okay, there's a reason why they short. Okay, because you can get off with things like this a lot easier, a lot cleaner, and a lot better. Okay, this market is not meant to go in an uptrend. Okay, as we can see, futures goes in a consistent uptrend. Okay, due to the fact that it's going to help the US in a lot more cases. Okay, so we have to keep that in mind. That's why price is going in upwards direction. So let's talk about once again how we can go ahead and trade. We want to be buying two things. Okay, you want to be buying when price makes an area of support. Okay, because all your setups are going to look the same. Your setup should always look like a V. Okay, so market will always make the left side of the V, and we'll talk about this in a second. And then you're going to catch the remainder of the right side of the V, because price always wants to try and break all-time highs. So as we can see on the futures market here, we're always constantly making new all-time highs pretty much. Okay, and that's due to the fact that, once again, it's most beneficial for the world, the economy, and the global infrastructure of everything. Okay, so price is always going to be hunting towards all-time highs, which means price is always going to be hunting to go in an upwards direction. So even if price is in a downtrend, I personally don't like to short. I like to just wait for price to make a low, and then I'll go ahead and I'll take my trade. Okay, so let's talk about how you know when price is ready to make a sweep up. Okay, there's going to be two things we're going to be looking for. So you want price to be, once again, A, just bouncing at an area of resistance going in an upwards direction, okay? And then you want to close at an area of resistance or support above current price. That's because price has an ability to reject at an area of resistance multiple times, okay? And one day it might break, but you don't want to eat the reversal, okay? You want to catch your formation and structure completion. Think of trading as a puzzle piece. Everything should click and form together. So resistance areas can short within a downwards direction twice, okay? And then we're also going to go ahead and have an area here where resistance gets broken, turns into support, and then price goes in the upwards direction. Resistance here getting broken, turn into support. Okay, this is going to be another example of the V formation too. Okay, and in this instance here, you would have bought at this area of support here, okay, and catch it up. Because you know price wants to mirror or at least reach the area of resistance. You don't know if it wants to break out immediately, okay, but price at least wants to go ahead and reach it, and that's what matters, okay? Catching your resistance gap fills. So let's go and let's keep talking about it here. So I like to go ahead and start on my weekly here because it lets me know, like, okay, am I at all-time highs or not? Okay, because if I'm at all-time highs, then I know I'm going to be needing price to dip down, make a certain low, and then I'll be able to go ahead and catch my sweep in an upwards direction. Okay, so let's go and let's go to daily here. Okay, now I'd like to go ahead and wait for certain formations. Okay, so take an area like this on the daily. Okay, I see price made an area of support down here twice. Okay, and even if I wanted to go ahead and just take it up to like this area of resistance, you know, that would have been solid. And as you can see, just based off this tiny support here, went ahead and caught the whole gap fill, and this would have been around 669 points within a couple of days. And on futures, that's disgusting money. Okay, that money is nasty. So what I'm looking for, especially on my, so I like to see my weekly here, make sure I'm not at super all-time highs, because I'm looking to long the market. Okay, and I'm waiting for price to make a little base on the daily. Okay, so I need price to make a little base. So right now I can see price making the left side of the V. Right now we're heading straight down. Okay, we're heading straight down, and then I need price to form a low, and then I'll be able to catch the right side of the V and catch it back up. Okay, so that's what we're going to be looking for. But in order to do this, we got to be patient. So right now I wouldn't short, okay, because people are going to be fiending to buy any low opportunity. So I'm going to wait for price to go ahead and create its low. Okay, I'm going to show you a good example of what that looks like. I'm going to go to my 4-hour again. Okay. When you start seeing price make that nice curl, especially with 4-hour closes, then that's when you know you're going to go ahead and catch your nice trade. Okay, take this little sweep curl up right here, right? Even if I decided to close the trade at this area of resistance up here, that's still a really, 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 really nasty futures trade. Okay, this is 862 points. Okay, just catching the V. Okay, catching it to this area of resistance up here. Okay, and as you can see, price decided to go ahead and fill the V. Okay, and you're just going to go ahead and be able to farm money on the micros, farm money on whatever. Okay, let me go ahead and just log into the paper trade here and just show you how much this would have made, for example. Okay. Go ahead and close that. So boom, even right here, right? So let's say you opened a trade right here. Okay, and I like to play with like 100 tick stop loss. Let's say I'm trading YM. Okay, 100 tick stop loss, right? And we're risking $50, and my take profit would be this resistance all the way up here. Okay, 473 ticks. So I'm risking $50 to make 236. And as you can see, price decided to continue forward. So as soon as price starts to make that nice V, so I'm looking for multiple 4-hour candles, and then I'm waiting for price to sweep in a upwards direction. Okay, I'm waiting for price to sweep in an upwards direction. So I can see price making an upwards V, even if I entered right here on this candle, okay? Because I want price to go ahead and make the formation of the bottom for me. Okay, I don't know where price is going to bounce at. Okay, it's too many people try to predict the ultimate bottoms. Okay, but you know that price at least wants to try and mirror areas of resistance. Okay, before it gets broken. So take advantage of the V. So even if you entered right here, right, you'd be able to enter right here. Okay, 100 tick stop loss. As you can see, stop loss just didn't get hit. And then we decided to go ahead and take profit all the way up here at this resistance. So here, 484. Okay, and then you can go ahead and catch nasty trades over and over and over again, waiting for your V formation. Okay, so what I'm going to be waiting for is for price to make a certain low. I'm waiting for price to nosedive down. After price makes a low, okay, let's say maybe about this much on like the 4 hour at least, okay, then I'll be able to catch the remainder up until the previous resistance or support that it stopped at. Okay, and then I'm going to go ahead and close there. I'm not going to play for the breakout. Okay, I'm just going to go ahead and catch the V fill. All your trades should look like a V for the most part. Okay, so right here, I'm waiting for price to go in a downwards direction. Okay, I'm waiting for multiple 4 hour candles. I don't like to just go off of one 4 hour candle. I can't just see price make this one wick area here near this area of support and be like, oh yeah, this is going to be the best trade ever. Nah, I want to actually wait. This is where the 15 minutes going to come into. So I can see on this area here, I have a previous area of support over here. And then I have an area of support over here too. Okay, price going in an upwards direction, starting to curl. Okay, but I'm going to wait for more 4 hour candles. Okay, maybe even some more daily candles to form too. Okay, and then I'm going to go my 4 hour here or 15 minute. Let me find myself a good take profit. Okay, so take profit here, even if I want to close at like this resistance area up here. Okay, so let's say I get like one more 4 hour candle or something like that. Okay, I might be able to go ahead and take this V formation up until at least this area up here. Okay, and then I'm gonna go ahead and put a 100 tick stop loss. Okay, and then I can see if this area actually wants to go ahead and fill and catch it up to this area of resistance either here, or I could try and catch it up to the, yeah, I mean, honestly, I wouldn't be greedy. Try not to be greedy when it comes to futures. Just take your nice trades and just wait for redips and just do it again. Okay, because the greediness can really get you nipped in the butt. So I would really just take like your 15-minute take profits like this, catch your nice sweep, catch your nice V, close at this area of resistance up here. Boom, close out the area of resistance right there. Get on my 5 minute here, you're gonna see the resistance here. You know, price might want to mirror that, and then you can go ahead and close your trade up there. Okay, very simple, very easy, and just go ahead and take your money. Okay, so even if price is in a downtrend, okay, price still has to go up to come down, and price has a better chance of going in an upwards direction than it is just falling in a straight downward direction. Okay, especially when it comes to futures. Okay, use your higher time frame, look at your bias, and put everything into perspective. Does it make sense to short something that continuously goes up in an upward direction year after year after year after year, regardless of inflation or anything? And the answer logically would just go ahead and be no in every single scenario. Okay, so when you're reading your futures chart, it's really just about taking your time, getting in your bag, and really just making sure you understand and can read what you're looking at. Okay, it's about taking your time. And when you take your trades, you got to take your profit. Okay, you got to be closing at these areas of resistance or support above current price. You got to. Okay, I wouldn't hold past up here. Okay, we also have this take profit up here too as well. Okay, if you wanted to take something like to up here. Okay, and this would be for like a 1-to-1, and then price decides to continue to go up in an upwards direction. Over and over. This area of support could be a take profit as well too. Okay, and then that's the cool thing about futures. As each take profit gets hit, you can go ahead and keep dragging your stop loss if you want, or you can go ahead and set your final take profit at a certain area, have your stop loss, and just buy at certain logical areas and just pray that you win. Okay, because price most likely wants to reach these areas of resistance again. Okay, even if price wants to fall straight down from these, that's fine. At least it went ahead and touched it. That's okay. Okay, it's not just going up for no reason. It might want to go ahead and touch this. Okay, and that whole window of it going up, is just money sitting there waiting to be farmed. So collect your income. Okay, whole sit there, whole bit of money just sitting there waiting to be collected. Okay, so sit there and collect your money. Okay, even at this area of support right here, because as we know, just like resistance can be broken, turn into support. Support can be broken, turn into resistance. Okay, so that's why a take profit right here would be reasonable as well too. So if price goes up, okay, let's say it does this, breaks this, okay, price might want to fall down here. Okay, or price might want to fall here. Okay, so that's why these are all going to be different take profits due to the fact that these are areas of resistances and supports above current price. And I can see price is trying to recover here. Okay, so you can see it on your smaller time frame. Price really trying to recover certain areas. And it's about making sure you know when to close. Knowing when to close is going to be the most imperative and important thing. The trend already started. Okay, the chances of the trend just reversing here super duper hard, it could be pretty low. Okay, so it at least go ahead and touch this resistance. If it breaks this, then try the support. If it breaks this, then try the resistance. And it'll keep trying each leg until it finds a place it might want to reverse that, find a super low, then break that previous high and do it over and over and over and over and over again every single year. Okay, so it's about playing logically. So if you're a futures trader, if you're going to trade some futures and you want to make some quick income, okay, because futures, you only got to deposit one time. Okay, and it's about waiting for the right setups too. But after you deposit that one time, you can go ahead and you can get in your bag. Okay, you can run up your bag super duper duper hard. Okay, and it really just depends. Okay, so do some practice. Stackmode.net for all trading mentorship. If you guys have any questions, stay prayed to God and keep grinding. That's how you guys are going to be able to trade futures.
To survive volatile markets, discipline is essential, more so than strategy or indicators. Volatility punishes bad habits, not just bad trades. When a trade moves against you, or price runs, an undisciplined trader panics or chases entries, making them unpredictable, not the market. Discipline distinguishes consistent traders from the gamblers. It means that you stick to your plan, you manage your risk, and you wait for confirmations and wait for the right entries, even when your emotions urge you to break the rules. Long-term success requires self-control, as the most dangerous factor in a volatile market is an undisciplined person trading. And it doesn't matter how much you've made either. A season of having low self-control can wipe out months of progress. Let's talk about how we can train our mind to make the right and righteous decisions in the market, inshallah, if God wills. Welcome. This session will not focus on charts or indicators, but on the single greatest detriment of long-term trading success and success in general, whether it be in business, on the charts, wherever. Discipline is the separation factor, which is going to separate from who's successful and who's not, who's going to be sticking to their stop loss, who's going to be adhering to their risk management, and who's going to be able to take the setups that they said that they're going to stick to. Self-mastery and emotional control, whether in the business world, on the charts, is going to be the separating factor between who's successful and who's not, and who's going to be winning within this world. Let's go and let's jump into the presentation. So the volatility trap, right, where most traders fail and fall in a downwards direction. Volatile markets, like cryptocurrency, amplify human emotional biases. Same thing with futures, leading to impulsive and destructive decision-making that quickly can drain capital. But it doesn't have to be that way, I really promise you. When the market is volatile, it's extremely bearish, which means markets falling in a downwards direction quickly. Or if market's extremely bullish, which means market's going in an upwards direction quickly, you need to be prepared for either sides. Okay, if you're telling yourself you want to invest into some spot cryptocurrency, right, which is where you're going to be making money when price goes in an upwards direction. So if market is volatile and it's making a certain low, you need to think of that as a positive. If market's dumping down really fast, you shouldn't think, oh my gosh, I'm losing all my money. No, that's going to be an opportunity for market to collect more ammunition and sweep back up further. You have to understand that no matter how low the market's dipping, when you're trading a good asset that puts a smile on people's faces and helps the future, within a couple of weeks, months, or years, inshallah, a lot of the times, and you could check out some old price action to see if I'm lying, you'll see price recover way past where it fell below, okay, and previous all-time highs as well. In order for price to keep breaking into new all-time highs, market has to fall in a downwards direction. Market has to come down in order to go back up. It has to collect ammo and collect liquidity. So don't fall into FOMO, okay? There should be no fear of missing out, okay? The fear of missing out causes traders to enter late.
and buying near the top based on social media hype, ignoring their own analytical framework, and doing things like that, buying based off of hype, is going to destroy your P&L. You should be looking at the chart. You should be knowing what type of economic decisions or factors happen within the world to base your assessment on how much you're going to invest. Okay. Once the SEC laws started getting passed and Bitcoin started becoming a more government-friendly asset, it started going up to new all-time highs. We started seeing 100K plus get passed. So analyze what's happening within the world and on the charts before just making a certain decision, before you just sell everything or buy quickly. And fear, uncertainty, and doubt, FUD. This can lead to panic selling at the bottom during a market correction. Okay, make sure you guys are trusting God. You guys don't need to be panic selling. You don't need to be making yourself lose money quicker than you need to. Sit on your trade and wait for the trade to cook. Wait for take profit to get hit. And locking in losses just before a rebound hits is what keeps people unprofitable. Wait for market to hit your take profit before you close your trades. The majority of you are losing money within the market because you're selling too quickly. You think you're going to hit your take profit overnight, the next day. No, sometimes trades are going to take days, weeks, months. That's why I tell you guys to do everything on your higher time frames. Okay, to remove that cognitive bias from you from the smaller time frame. You need to have your higher time frame bias and understand that the market is going to take months, weeks, years, and days in order to get to where it needs to be. So don't sell off of a quick couple of days worth of price action. Stay on your trade. And 2 key psychological phenomena drive irrational exits and entries. Okay, trying to avoid loss. The pain of a loss is psychologically twice as powerful as the pleasure of an equivalent gain. Okay, so humans prioritize survival mode, but don't just think losses as survival mode. When you're down in your P&L, don't think that you lost. You only lose your money when you decide to close your trade. Okay, when you exit the trade, then you are going to be out of your money. Okay, until then, market can continue to do whatever it wants. Hey, not saying to sit there and hold trades forever, but a lot of you are losing because your stop loss is way too small. So if you're on options, I recommend your stop loss be the contract itself. Try and buy 1 to 2 years out. Okay, buy a leap contract, and this way you can sit on your contract for some time. Same thing for your shares. Try and hold your shares for some years. There's also going to be some long-term tax benefits for crypto and shares when you're holding your trade for over a year, meaning that they want you to hold for a long time. Same thing with futures too. Don't get destroyed by the prop firm cycle. Boot up your own live account, have enough margin, and hold your trades overnight. This way you can play the real structure, and you're not going to be taking any trade on the block, destroying your account much quicker than you would trying to conform to somebody else's rules, or even worse, trying to make some quick profit. That's never how we want to think in the market. Never think quick in the market. Okay, and confirmation bias. Seeking out only the news and opinions that support a trade that you already entered, ignoring clear signs that the market trend has reversed. Okay, not everyone knows everything. Okay, read the chart and do your own economic decision making when it comes to getting in and out of trades. Okay, and you gotta have a plan. Lay out your blueprint. Okay, if you're a break and retest trader, wait for resistance to get broken and turn it to support. Okay, if you're a reversal trader, wait for support to get formed and catch the right side of the V into an area of resistance or support above current price. Okay, have a blueprint. Know what you're buying. Okay, if you tell yourself you want to buy $500 or $1,000 worth of Bitcoin every single month, you got to do that regardless of where the price is, because you're trying to DCA, and DCA means dollar cost average. Okay, stick to your plan. I don't care what you're trading, futures, crypto, options, it doesn't matter. Having your blueprint and developing an ironclad plan that you pretty much never break is going to set you apart from every other trader. Discipline begins before you place a single trade, and an ironclad trading plan removes emotions by codifying exactly when you enter, when you exit, and how much risk you're going to manage. Okay, if you have $1,000 account, for example, right? If you have $1,000 account, you should not be trading with more than 10% of your account at a time, ever. Which means that no single one of your trades should ever be more than $100 if you're trading on $1,000 account. Okay, try and trade between 1 to 10% of your account at a time. This way, you're gonna have a significant advantage in many ways. Okay, make sure you have that advantage. Okay, to stick to 1 to 10% of your account per trade. Do not break this rule. I don't care how much your account is up or down, try not to ever break this rule. And define entry and exit criteria. Your plan must specify clear, objective, technical, or fundamental conditions for both entry and exit, and never enter a trade based on gut feeling or instincts. Make sure you guys have definitive, structured layouts and boxes checked. Be like, okay, market did this. Okay, market did this. Okay, cool. I think I'm ready to get in. And have a rule-based entry. Okay, here's an example. I will only buy asset X if the daily RSI is below 30, for example. Or I will only buy asset B if the V formation is starting to form and curl in an upwards direction on my daily or 4-hour. Or I'm only going to buy asset C if market hits this certain price and I'm going to buy the dip. Okay, see how you want to structure your plan and stick to it. And stick to your time horizon and review your schedule. Define whether you're a scalper, day trader, swing trader, or an investor. Okay, do you like to trade for ownership? Then maybe you need to look towards crypto and shares. Do you like to trade based off of speculation? Then maybe futures and options are going to be based for you. Or you could take that futures income and put it into crypto and shares. That way you guys are going to be able to get that speculative money based off of your skill quickly, and you're going to be able to take that and put that into ownership. This way you're going to be able to leave some crypto for your family if you ever pass, God forbid. Okay, or you'll be able to leave some things down for the future. Okay, so your future you is really going to be happy that you sat on your investments. So make your future self happy and plant your seed. Okay, think of it like a big tree. You got to plant it. Okay, water, sun, water, sun, water, sun. Okay, that's how you have to grow your account. Make sure you guys are getting the proper water and sun every single day. Okay, rather in real life too, you got to keep your emotions based. Okay, make sure you guys ground, try and get some outside time if you can. It's not good to live like a rat, especially in today's generation with all this technology and stuff everywhere. If you can, especially before the market, if you're a day trader or something, have some outside time, get some oxygen, touch some grass, touch some plants, take a walk, and really work on your mental health. Getting closer to God is going to be one of the easiest ways to get better mentally. Okay, it's going to give you the full layout on how to be a good person here on this earth. Okay, and keep yourself from being mentally sick. Keep yourself from hurting yourself. So when you lose a trade, you're gonna be like, oh, I'm broke, I don't know, this and that. No, you got to relax. Okay, you got to chill. Even when you lose a trade, understand that sometimes you're going to lose. It's how you handle that loss, and it's how you prepare for the loss too. And you must stick to your chosen timeline and resist checking shorter time frames if you're a long-term trader. Okay, don't be caught up on the 15-minute bias if you're on the weekly and daily time frame. Okay, your take profits aren't going to hit as quick as you think all the time. Give it time, let your trades cook, and take your time. Protect that capital of yours. Okay, what are you trading for? Some of you open up your broker account and just start losing all of your money. Okay, you're not on the market to lose money. And the main reason you guys are losing money is because, one, you're closing your trades too early, especially my futures and options traders. Okay, you're just going to literally delete capital like that. Okay, my crypto and shares traders, you guys are a little more stable. Okay, due to the fact that you understand ownership. Ownership a lot of the times is going to make you profitable, especially when you're owning something that puts a smile on people's faces and helps the future in many ways. And the prime directive, right? Capital protection. Okay, the most important rule in trading is not how much you can make. It almost kind of doesn't matter, but it's how little you can lose and how healthy you can keep you alive year after year after year, month after month after month. Risk management is the mathematical enforcement of discipline. Extremely important to make sure you guys are trading within your 1 to 10% of your account rule. Okay, as you get better, you know, you can increase from 1%, but I recommend you guys even start off with 1% when you're first starting trading. Okay, this is really going to help you guys just get down to the motions of, okay, you know what, take profit gets hit, boom, let me go ahead and do this, let me go ahead and do this. Okay, but as you get better, you can increase it to like 5% and then even 10% at the max. 10% is going to give you 10 trades before you blow your account. Okay, 5 trades, 5% is going to give you 25 trades of your account before you blow it up. Okay, and then 1%, you know, you're going to have 100 trades. So depending on your percent, it's going to determine how quickly you're going to be gaining profit, but also how quickly you'll be losing profit too. So think about that. If you have a higher win rate, extremely high win rate, feel free to go up in your percentages within the 1 to 10% range. And a non-negotiable stop loss, right? Extremely important. If you say you're going to close your trade here, okay, I don't care if it's a stop loss or a take profit. If you say you're going to close your trade at a certain area, close the trade. Some of you guys are literally extremely undisciplined and you're wondering why you're not making money from the markets. Take profit literally gets hit. You got to close at that certain area before you get reversed on. Okay, it's not like you're just, oh, I'm going to close here. I'm going to close at this area of resistance because I want to. Oh, I'm going to put my stop loss here underneath this area of support because I want to. No, If price were to clip past underneath that area of support, price might fall down dramatically. And if you're a long, that's not what you want. Okay, same thing if you're in a long. If you win, you hit take profit, close at an area of resistance or support above current price. Okay, make sure you guys catch your gap fills. Get your money. Some of you guys are just losing your trades since you want to hold way too long. You gotta know where you're exiting at. You gotta know where market wants to temporarily reverse in order for it to continue its flow. Understand the staircase method and head over to stackmode.net. I have a free course for you guys so you guys can understand the charts and market a little bit more, and tons of free videos too. A stop loss order that's pre-planned, right, is really going to help you out. You're going to know, okay, if market goes here, market will instantly close out my trade, or I'm going to close out my trade here. Okay, and it's where you admit the trade idea is going to be wrong at. And in volatile markets, a stop loss must be placed the moment the trade is entered. Okay, because market can make an extremely fast move, and you might not be ready for that emotionally. You might have a $500 stop loss. Okay, but if you didn't set your stop loss, say you were like, oh, you know, I'm going to close manually, and market decides to go down and turn that $500 loss turns into $1,300 loss because the candle was so fast, you might freeze, you might pause, you might panic. And that's not what I want for you guys. Okay, so set your stop loss with a order if you can. This way, when market hits that order, it'll automatically close your trade the best that you can. And it's going to prevent catastrophic loss and help you protect against unexpected flash crashes or major news events, which definitely happens. Especially if you're on futures or Forex, you don't want to be getting what's called margin called. Okay, this is going to be something where you might be owing the broker money if you go below. Okay, and never profit. Okay, you're gonna hold until either one of these, and it's really cringe too. Don't close your trade before stop loss or take profit gets hit, because what you're doing is destroying all of the math. You're destroying the risk to reward ratio. Okay, let's say you're taking a trade, right, and you win a 1-to-4. Okay, let's say you risked $100. Okay, if you risked $100 and you hit a 1-to-4, that means you would have made $400. Okay, so that's $300 in profit. Okay, so hitting your risk to reward ratio is going to be important for growing your account within a mathematically correct way. This is literally how the math of the market works. If you're making more than you risk, you will become profitable. Okay, you will become profitable, inshallah, if God wills. You have to make more than your risk. If you're risking $200, okay, then you should be at least trying to make $400 at the minimum. Okay, and that's going to be a 1-to-2. Okay, since you're going to be doubling your money within an asset. Okay, that way if you take another loss, you'd at least cushion. So try and at least always trade for at least a 1-to-2. You should at least always try and double your money within a trading scenario before it's closed. And once a trade is entered according to your plan, a stop loss is set, you have to watch either take profit or stop loss gets hit. Please don't be touching your trades with your hands, because if you're impulsive, you're emotional, and you're led by your flesh, you're going to destroy absolutely everything. So overcoming impulsivity, impulsive decisions, and moving a stop loss further away, adding to a losing position, right, doubling down, or exiting too early are the quickest ways to violate your discipline. And mental reframing exercise, right? When you feel panic or greed, physically step away from the screen for just 5 minutes. Okay, go pray to God, go breathe. Okay, take a step outside and ask yourself, do the market conditions violate my original trade thesis, or is just this noise right now? And if the thesis is intact, you must adhere to the plan. Okay, you gotta adhere to the trading plan. Why are you breaking your trading plan? You say you want to go put your mom in that big crib. Okay. You say you want to take care of your wife and your kids, or you want to take care of your kids or whatever. You want to take care of yourself. You want to go get the lamb, yet you hop onto the market, breaking your discipline, breaking your trading plan, not taking the setups that you said you were going to take. We don't have time for this. We got to go harder. Okay. We got to go harder. When you feel panic, when you feel greed, you have to understand that that is the enemy. That is the devil. And we have to pray these emotions away. Okay. A'udhu minash-shaytanir rajeem. Okay. It's very important for us to pray this away. This is just the devil trying to attack you guys. So you guys get pulled back away from the goals and dreams that you want to feel and be attached to. Okay. The devil does not want you to be happy. Okay, but understand that God loves us. God wants us to be happy, and this is why God even talks about in Quran about spending moderately. Okay, you have to know how much you're risking, and you have to stick to your plan. And the art of taking profit is extremely important. Greed causes traders to hold winning trades past their logical target, and this is something that's happened to me. Okay, I'm trading straight P&L at one point in time. Okay, looking at the money. Okay, I remember I hit this one really good trade on C3AI, and I've started seeing the bands go up. Okay, start seeing the money go up. I've hit plenty of trades like this, and the next thing you know, instead of me trading based off of the chart, I start trading based off of P&L. And guess what? Since I'm greedy, and since I was trading with my eyeballs focused on the money instead of on the chart and focusing on my discipline, everything was taken away, or my win was not nearly as big as it should have been, due to the fact that I didn't stick to my logical targets. And I don't want you guys to go through that either. Your plan must include defined profit targets. For example, target 1 at 2R or target 2 at 3R. Okay, where you sell a portion of your position to secure gains, ensuring that you never let a winning trade turn into a loss. And make sure you guys also set your stop loss to above break even or certain levels too, to even keep the trade going and flowing.
And only God's perfect. So if you make a mistake and overtrade a certain day, at least care about what you did. Journal down how you felt. Journal down the emotions you were feeling when the trade was in your face. Were you close to take profit, but did you close your trade too early, ruining your risk reward, leading you to take another trade and then crash out your account? Or what type of scenario led to you losing that trade or overtrading in certain scenarios? When you really write it down, you're able to visualize and see your mistakes. It's a lot harder to repeat them over and over again. Discipline is really a muscle that has to be trained, and the trading journal is the feedback mechanism that allows you to objectify your performance and eliminate certain weaknesses, especially when you have your numbers jotted down. If you see certain things that you're doing is leading you to lead certain results that's not making you happy, then you need to change some certain things up. And your journal needs to capture certain things. Make sure you have your pre-trade analysis, how you're feeling before the trade, why you entered, and make sure your criteria is met before you press buy or sell. And talk to yourself. How do you feel emotionally? How did you feel before, during, and after the trade? It's really crucial for identifying certain biases, especially when market changes certain directions. You know how to pinpoint certain issues that you're having. And violations. Did you adhere to your stop loss and your take profit rules? And ask yourself why. And talk about the market context too. Did you take a long? Did you take a short? And note the macro environment. And do your weekly and monthly review. Treat this review like a performance audit. When you're trading, you're your own business. So identify your most frequent violation and need to cut certain things out. If you're constantly moving your stop loss, your issues and strategy, you got to stop being led by your flesh. You got to be way more disciplined than that. If you want to touch that big bag, even when you touch that big bag, it doesn't really matter. It's about keeping it. You're not going to be able to keep it if you keep moving off impulse. Okay. Your loss aversion and lack of conviction in your plan can really lead you to certain areas that you don't want to be led to, such as overtrading. When you overtrade, one tiny loss can lead into a whole destruction series of your account. And it's a lot harder to bounce back from that, just from one tiny loss, especially on things like prop firm, where you're chasing certain parameters. So detach from the money, focus on the charts, and be more disciplined. And trading small is really going to help you in certain areas too. If you notice you're feeling a high amount of pressure, like I have to win this trade, you probably shouldn't be in it. Okay, if you lose the trade, you should be completely comfortable. And just like the previous slides we talked about, staying within that 1 to 10% risk management parameter percentage field is really going to help you out. Okay, it's going to be a lot harder to blow your account when you're not going over 10% of your account per trade. Okay, you could do 5%, have 25 trades, and that's a lot of trades before you blow your account. You shouldn't be that inconsistent, truthfully. You got to wake up, pray to God, and be consistent with every dollar that you generate. You also got to be a little more loose within the markets too. You got to stop being so restrictive. Having super tight stop losses and trying to micromanage every piece and point of price action is a good way to lose all your money and be frustrated.
Okay, play with much bigger stop losses and give your trade some time. Sit on it for some days, some weeks, some years, and really let your money sit. Okay, if you're going to invest, you can't be desperate for income. One thing I recommend you guys do is hide your balances. On all your brokers, you should have the ability to either hold down your number, and this way, even if you're down, you're not going to be tripping. Okay, you could be down 50%. You're not going to be in anxiety. You're not going to be in survival mode, because I can assure you, within a couple of days, weeks, or months, price will reverse and go way past wherever your original take profit was. Okay, market has to go down in order to come up. So you can't have certain emotions, especially in volatile markets. Okay, if market's moving super quick, you can't feel like you have to close your trade instantly, because you're not going to be able to see the bigger picture. Being on the higher time frames, your monthly, your weekly, and your daily is really, really important. Because if you're too zoomed in on your smaller time frames, that fast price action is going to look like the scariest thing of all time, especially when it comes to futures, forex, and things with margin like that. But it's really not that bad. So I really recommend you guys stay on your 4 hour plus, turn on your extended trading hours, of course, but try and stay on your 1 hour on like the lowest time frames a lot of the time. Because when you're on your super small time frames, price action, especially during volatile days, news days, etc., it's going to look a lot quicker than it needs to be. And on the 4 hour, it's going to look like a normal trade, or going in a completely different direction than you might think. On the 5 minute, you might be looking at a bearish scenario, and then on the 4 hour, market's going in an uptrend. Okay, so you can't go off of your lower time frame bias. I truthfully believe it's there just to get your emotions riled up, especially when it comes to future scalpers and things like that. You have to know your higher time frame bias, and don't get tricked about that. Okay, there's plenty of people who are successful within the market who just buy and hold, who never even taken a look at the charts. Okay, so before you tackle volatility, you have to build the discipline to execute your plan, and you have to get those psychological parameters down. It's really, really, really psychological, the charts. You can be really, really good technically, but if you don't close at your take profit, it won't matter. Or if you feel like you're better than closing at your levels, then you'll definitely get punished, reversed on certain areas, and get what you deserve. Market is also very, very fair. So if you're disciplined, you wake up, pray to God, you close at your levels, I can assure you 99% chance, just like my students, you'll see a very, very, very successful upwards equity curve in your account. But if you're undisciplined, getting greedy, even when you've hit your take profit, trying to trade past that, it's not about the money. Okay, if you break your cycle, break your consistency, and start averting from your plan, it's going to build into you, and then that's going to build into bad habits. That's going to lead to you being overconfident in certain scenarios that's not logical, leading you to overtrade. And when you crash out your account, you might be frustrated on the market, but you should just be frustrated at yourself. Okay, I don't want you guys to go through that cycle. That cycle can be really, really hurtful, especially when you've been grinding your business, grinding at work, and putting that money into the market, expecting to make some money, and then you lose everything. Okay, I don't want you guys to be going into debt, going through frustration, losing your account. So please just wake up, pray to God, and plan your trades. Okay, promise me, if you guys watch this video, plan your trades before you put a single dollar into whatever. I don't care if it's Bitcoin, options, forex, futures. Promise me you'll plan your trade. Okay, don't ever just trade thinking that, you know what, I'm gonna get in this making some money. No, have a technical plan. Know when you'd exit, know how much you're going to invest, know how you're going to close your trades as far as take profit and stop loss wise, and have this process repeated, especially once you find your positive flow. Once you find your flow, I don't care if you're taking break and retest. If you're a breakout trader, I'm not going to tell you guys to trade one way, because different things work for everybody on the planet. It's the cool thing about life. Okay, God gave us all individual separate brains for us to do separate things. If you're a breakout trader and that's working for you, you need to stick to that. If you're a reversal trader and that's working for you, you need to stick to that. You can't get on YouTube, see what this person's doing, and then change everything even though something's working for you. Okay, find your process, find your flow, find what you like to trade, and then stick to that year after year after year after year after year. Think of it like working out, for example. You can't get on the floor, do 20 push-ups and 6 crunches and get a 6-pack. It takes days and days and days of eating consistently, eating clean, okay, working out consistently, getting the proper sleep, making sure your bones and your muscles regenerate properly. You have to treat your account, your income, or your business the same way. Okay, you have to be consistent. You can't have $10,000 in Bitcoin and then think $20 is not a lot. Okay, this is why I say you have to detach from the money. You could have 5 million in Bitcoin and still, when you get $5 extra, throw that into some Bitcoin. It's about the habit. Okay, I'm telling you, when you build that habit and you start thinking and planning and doing your actions for the future you, the current you will be a lot more happy and you'll be leveled up a lot quicker. Okay. So head over to Stackmode.net for all trading education. Catch you guys in the next one. Stay prayed up to God. Keep grinding. Peace.
Let's go and let's jump straight into the lesson. This is going to be the differences between stocks, shares, and options. Let's go. And at their core, stocks and shares refer to the same thing, a unit of ownership in a corporation or a company. And the terms are often used interchangeably, and though shares typically refers to the number of individual units held by an investor, and while stock is more of a general term used for the entire collection of shares. Okay, so for example, I own 10 shares. 10 shares is going to be the amount, the percentage of the company that you want to be a hold of. Okay, the amount of shares equals the amount of percentage ownership that you have in the company. Okay, so if you want to own 10 shares of Apple stock, okay, and Apple is going to be the primary stock. Okay, shares is the percentage amount that you own, and the stock is going to be the name. And here's what they represent. Owning a share means that you're a partial owner of a company, and as an owner, you have to represent. Okay, and you also have a claim on a portion of the company's assets and earnings. And this ownership gives you a right to the company's profits, and it's distributed as what's called dividends. Okay, and dividends, especially if you have enough shares invested into, then dividends will go ahead and be paid out to you. And this way you can be able to make money just by being an investor. And say in the corporate matters though, it's also going to give you some voting rights depending on the amount of share that you have. And for every share that you own, you typically get one vote. Okay, so the more shares that you have, the more votes that you're going to have. Okay, so you're going to have one vote per share, for example. Okay, and that allows you to influence key decisions like electing the board of directors and who's going to be controlling the future of the company's growth. And why do companies issue them in the first place? Companies sell shares to the public to raise capital, and this money can be used for expansion. So whenever you guys see millionaires, billionaires, stuff like that, and they're company owners, a lot of the time it's not in raw dollar currency, okay, sitting in a bank account. A lot of the time they're rich through the company they own, and a lot of times it's on the stock market, okay, and then that company generates money, and since they're associated with it, or the leader, they get the money associated with the tag, so then they get to be a billionaire. For example, any creator of, like, say company.com, okay, say they have $500 a share worth, okay, the owner of it, let's say the company does $10 million a year, okay, the owner of it would be classified as a billionaire because he's the owner of it. So that's normally how that works. So they sell shares to the public to raise capital and raise money. And this money can be used for future building expansion on the company, research, paying off your debt, and other business goals. And this process is known as an initial public offering, also known as an IPO. And this transforms a private company into a public one. And this is when shareholders, okay, can invest like me and you if we wanted to. And for a company like Google, for example, a public offering allows them to raise billions of dollars to fund new ventures. And when you buy shares directly from a company during an IPO, you're participating in a primary market. And after the IPO, shares are bought and sold among investors on exchanges like the New York Stock Exchange or NASDAQ, then that's going to be the secondary market. Okay. So when you're buying shares directly from the company during from IPO, okay, that's a primary market. And after the IPO shares are bought and sold among the investors, okay, on exchanges like your New York Stock Exchange, that is the secondary market. So let's talk about equities. The broader view is ownership. So the term equities is a broader financial concept, and it encompasses all ownership interests in a business, which includes common stock, preferred stock, and retained earnings. And it represents the value that would be returned to a company's shareholders if all assets were liquidated and all debts were paid off. And on a company's balance sheet, it's often referred to as shareholders' equity or owner's equity. Let's talk about shareholders' equity. This is a fundamental metric used by analysts to assess a company's financial health. Okay. So, and it calculates it by calculating the assets minus the liabilities. Okay, so what assets are things that a company needs. Let's say like the light bill. Okay, a company might need a light bill in order to run a factory, for example. That's asset, something that's needed, and a liability is something that's not needed. Okay, any business expenses that's just going to be extra. Okay, like giving all your employees a vacation or something like that, for example. Okay, and then that's going to equal shareholders' equity. Okay. So, common versus preferred stock. Common stock. This is what most people mean by stock, and it comes with voting rights in corporate matters, but it's secondary to preferred stock in claims on a company's assets during liquidation. When you're a true owner, sharing in both the upsides and the risk. And let's talk about preferred stock. These shares typically do not come with voting rights, but have a higher claim on a company's assets and earnings than a common stock. And holders of preferred stock receive dividends before common shareholders. And this makes them a hybrid security. And it's often seen as less risky than common stock, but without the same growth potential. Okay. So, stock options, my favorite. Okay. One of my favorite things I like to trade, and it's pretty much when you get paid based off of the direction of a stock. Okay. If you think the stock is going to go up, then ideally you would purchase what's called a call contract, which we'll talk about here. Okay. And if you think the stock is going to go in a downwards direction, okay, then you would buy a puts contract. You can also have expiration dates on your contracts too, to choose how long you want to hold the trade for. And when the contract expires, it's going to automatically close on its own. So you either sell the contract before it expires, or it'll go ahead and just close on its own. Okay. So stock option is a contract that gives the holders the right, but not the obligation to buy or sell an underlying stock at a predetermined price. Okay. And that's also going to be known as the strike price. So let's say a stock is at $32 a share currently. Okay. Let's say a stock is at $32 a share. You think it's going to go to $34 a share. Okay. Then you could buy a strike price contract of $34. Okay. Or even $33, since that's above $32. Okay. So you could buy any number above your prediction, but below your take profit. Okay. And that's going to be a good strike price in order to purchase, inshallah. Okay. So when you do that, you're going to go ahead and get paid based off of your prediction. Okay. Say, for a put example, let's say share price is going to be at 20, for example, right? And you think price is going to go down to 15. Okay. So if price goes down to 15, you could buy a 19, 18, 16, or $15 strike price contract. Okay. Because you're going to get paid based off of your prediction. So just focus on what you're doing. All right. Just focus on what you're doing. You're going to get paid based off of your prediction. Okay. And it's also going to be within a specified time frame that you purchase. Okay. And the higher the expiration date that you go, the more expensive that it's going to be. And it's a derivative instrument, meaning that its value is derived from the performance of the underlying asset. And they're a popular form of compensation for employees and a powerful tool for investors to leverage their positions. So a call option, it's the right to buy stock at the strike price, okay, which is going to be the pretty much price that you're wanting price to go to. And an investor would buy a call option if they believe the stock price is going to rise above the strike price and you're betting on the stock's upward movement. Let's talk about a put option. And it's the right to sell a stock at the strike price. And an investor would buy a put option if they believe the stock's price will fall below the strike price. And this is betting on the stock's downward movement, often used for hedging. Yeah. And also sometimes companies often grant stock options to employees as a form of non-cash compensation. Okay. So it simplifies them to work towards the company's increasing value, because as the company keeps innovating, putting smiles on people's faces, okay, creating more product, generating more revenue, then inshallah the share price is going to increase, making their options worth more. And most of the time, inshallah, they're going to be getting paid in like some long-term cost contracts, I assume. So risk, reward, or purpose. So while all these terms are related to company ownership, they serve different purposes. Okay, so stocks. Okay, stocks are going to be the name. Okay, stocks are going to equal the name. Okay, stocks are the name. So let's say I open Stackmode. Okay, let's say I open Stackmode on the market. Okay, if I put Stackmode Network on the market, okay, inshallah will happen one day. If I put Stackmode Network on the stock market, that's going to be the name. So if you just hear the term stocks, that's going to be talking about the name. Shares, the term shares is going to be talking about the percentage ownership that you're trying to purchase within the company. So you can own 1 share, okay, or you can own 50 shares. And the share price is going to be determined on the current price. So if the current price of a stock, okay, remember the stock is the name. So if the current price of Stackmode is $32 a share, for example, okay, and I think it's going to go to $600 a share, okay, or $700 a share, okay, then whatever the current price is going to determine what the share cost is. So if price is at $32 a share, one share will cost $32. If price is at $700 a share, one share will cost $700. Okay. So inshallah, try your best to get in at a dip or a low and then catch the sweep up. And that's how money is made. Okay. That's how growth equity is created, by trading shares. Okay. And stocks and equities. Okay. The primary goal of these are going to be long investment. Okay. There's going to be also a lot of tax benefits when you hold your trades for over a year. And the primary goal is going to be long-term investments when it comes to shares and equities as well too. And the reward comes from dividends as well too, which is going to be quarterly money that's going to be spread out to everyone who has a decent amount of shares. Okay. So you'll get paid by dividends and capital appreciation. And the risk is that the company's value could decline, leading to a loss of your initial investment. But no risk, no reward. We're only here one life. Okay, just trust God, take a risk, keep going. Let's talk about some options. The primary purpose is speculation or compensation, and the reward can be much higher due to the leverage they provide. And it makes you control a large number of shares for a small upfront cost. And this risk is that if the stock price does not move in your direction that you purchase, then the stock price could tank on the contract. Okay, but it's going to be fine. If it expires worthless, you just try again. Don't lose hope. Trust God. Keep going. Okay. And you could potentially lose your entire investment, but you could also play into that. Okay. Whatever your stock option cost is, you could use that as your stop loss. So if it costs you $70 to open a contract, that could be your stop loss. Okay. Instead of buying a $500 contract, trying to play with the $70 stop loss, that might not always work in stock options as cleanly as you might want. Let's explain leverage. And with the call option, you might only pay a few dollars for the right to control 100 shares with leverage and the time expiration. And if the stock price goes up by just $1, you've made a significant percentage gain on your small initial investment, far greater than you would have buying the shares outright. Okay. But it also has time expirations on it. Okay. So this is why the longer the time you're going to buy on a certain play, it's going to be the better. Okay. Give your trade time to work out. Okay. But the longer that you go trying to buy out, the more expensive that the contract is going to be. Okay. So for practicality, for example, if an investor wants to build a retirement portfolio, okay, you could buy stocks. Okay. So you'd be buying shares of those stocks for long-term growth, for long-term tax benefits, and just holding trades year after year, keeping money in the stash, keeping stack mode, okay, implemented into your portfolio. Staying down, not touching the bread, okay, staying down. And if a trader is looking to profit from a short-term market movement, then stock options would be able to amplify your return. So you can use the stock options profit to buy some more shares, but stock options in general is just going to be better to go ahead and generate some more income. Okay, so it's going to be time to just start going harder, get more education, and really understand what we're doing before we put money into the market. All right. Market capitalization, valuation, how a company is priced in general. So understanding that a company's market cap, okay, also known as the market capitalization, is pretty much how much a company is worth. And the valuation is crucial for making informed investment decisions. Now, market cap's not going to be everything. You could do your research and catch a good trade at the low, and then the market cap turns huge later. Okay, but market cap is just going to be a good decision to see if something's going to be a strong value play. And market cap is going to be the total value of all the company's shares, and it's a key metric used to determine a company's size. So here's the market cap formula. The calculation is pretty simple, but does a lot. It's quite advanced. So market cap, okay, the calculation concurs of it's the current stock price. Okay, so Stackmode is worth $700 a share. Okay, then it's worth $700 a share. Okay, so you take the current stock price, $700 a share, times the number of total outstanding shares. So whatever that would be. And that's going to give you the market capitalization. Okay. So this tells you what the market currently values the entire company, and it changes every minute as the stock price fluctuates. People are always going to be putting in orders, selling and buying, and especially something that has a high market cap, there's always going to be more orders flowing in due to the fact that it's popular. So there's some different market cap categories. Companies are often categorized by the market cap, which influences their risk growth and their potential. Once again, it's not going to be everything, but it's something to look for. So a mega cap, it's going to be something worth over 200 billion in market cap. So for example, big giants at the time, like Apple, Microsoft, for example, they're generally seen as stable, mature companies. And let's talk about large caps. It's going to be 10 billion to 200 billion. Okay. And they're established leaders in their industries. You got mid caps, 2 billion to 10 billion. That's companies with solid growth prospects. And small caps, 300 million to 200 billion market cap. There could be a bit higher risk if they don't decide to grow and have some future innovation, but with the potential, they have a bunch of high expectations, certain companies, and they could explode super duper hard. Okay, let's, for example, Palantir and microcap and nanocap and below $300 million. And they're the riskiest category once again, because it's fresh, new startups, new ventures. Sometimes it could be people with a bunch of money investing into it and then it doesn't go anywhere. So make sure it has some future value. So let's talk about valuation versus price. So it's important to distinguish between a company's price and its market cap and its intrinsic valuation. Valuation is a more complex process that attempts to determine a company's true worth based on its assets, earnings, future cash flows, and growth prospects. And a savvy investor is going to be looking for stocks where the price is lower than the company's estimated intrinsic value in the first place. So we'll talk about valuation methods. There are many methods for valuation, including the discounted cash flow, the DCF model, and a company's price to earnings ratio. Comparing that to its others ratios of other companies is going to be a good way to determine if what company is making more money than others. Okay. And these are essential tools for a fundamental analyst if you want to be an investor. So let's say, for example, let's say company A has 10 million shares outstanding. Okay. Let's say Stackmode has 10 million shares outstanding. Okay. And its stock is trading at $50 a share. Okay. And its market cap is going to be $50, okay, because that would be the current price. Okay, you're going to be multiplying the current price times the number of outstanding shares. So let's say Stackmode has 10 million outstanding shares. You're going to multiply that by the amount of outstanding shares. So 10 million. So $50, the current share price times the number of outstanding shares, 10 million. And that's going to equal 500 million. Okay. And that's how the math is done. That's how you find out market cap. Let's say company B, for example, let's say it has 5 million shares outstanding and its stock is trading at $150 a share and its market cap is 750 million. And even though company B's stock price is higher, company A might have a higher intrinsic valuation based on future growth projections and its expectations. So the differences at a glance. So to summarize, it's essential to recognize the distinct roles of each of them. So shares and stocks. Stocks represent actual ownership in a company and they're tangible assets that can be fractional and traded on exchanges. Okay. Any stock exchange is going to be a broker where you can put in your bank account, your card, and buy some stock for yourself. Okay. That's what an exchange is, also known as a broker. So let's talk about equities. Equities are a broad term for the total ownership of a value of a company. It's an accounting term that includes all forms of ownership interest, and equities is the larger category, which includes stocks and stock options. They're a contract and a right to buy and sell shares, not the shares themselves. Okay, and you get paid based off of the direction that you think price is going to go into. And they're a tool for speculation or compensation and are not an ownership stake until they are exercised, until someone's to fill in the contract. So think of the company as a pie, okay, also known as the stock. A fraction of the pie, okay, is going to be known as a share. And let's say you're about to deliver pie. Let's say you project to sell 4 slices of pie. If you think that, you could buy an option based off of that. Okay. So put all of that into retrospective and understand. Okay. So if you think you're about to sell 4 slices of pie, then you buy an options. Okay. But the pie in and itself is going to be the shares. Okay. And the store name, let's say it's Stackmode Pies, is the stock. Okay. So that's how it all works. So by understanding these core concepts, you're just not a spectator anymore. You're getting informed, understanding the market, not a gambler, and you're becoming an active participant with the knowledge to navigate the complex world of finance. Alhamdulillah. So while the terms may seem confusing initially, their distinct definitions and functions are critical to building a robust financial vocabulary. And remember, stocks and shares equal ownership. Okay, they equal ownership. You can hold them for however long that you want. So use that money Don't go buy clothes, stay down. Don't go buy drip. Don't go buy the best whip right now, paying the high monthly payments. Stay down, invest, and go ball out later. Let your money make infinite money and then go buy what you want. And equities are going to be a broad ownership value. And stock options are going to be the directional bias that you can get paid based off of. You can use all of these to create future value, provide for your family, and provide for yourself. Stay prayed to God. Head over to stackmode.net for all trading education and business education. Love you so much. I'll catch you in the next one.
Quantitative tightening has officially ended, and trust me, this changes everything for investors. For the past few years, the Fed has been draining money out of the system, shrinking its balance sheet and putting pressure on stocks, real estate, and even crypto. But now, that pressure valve just opened, liquidity is flowing back in, and whenever liquidity comes back, asset prices don't just react, they move. But here's the truth that nobody tells you. The end of quantitative tightening doesn't automatically mean a bull run. It does mean volatility though. It means opportunity, and it means that the smart money is already positioning while everyone else is still confused about what quantitative tightening even is. So what does this shift actually signal for you? Expect easier borrowing, potentially higher stock valuations, stronger risk on sentiment, and most importantly, a window of time where early positioning matters more than ever. So let's figure out how we can plant our seeds, what quantitative tightening even is, and how we can learn how to invest. Inshallah. Let's go. Quantitative tightening has ended. All right, let's go on this breakdown how it's going to affect investors and the future of everything. So what was quantitative tightening in the first place? So quantitative tightening is the reverse money printer. Okay, so you know quantitative easing, right? QE. And that's when the Fed prints money to buy bonds. Quantitative tightening is going to be the exact opposite of that. Okay, for the last few years, the Federal Reserve has been destroying money to fight inflation. Okay, printing more constantly over and over and over and over and over again. Okay, and the mechanism. Okay, so it's when they let bonds that they own expire and don't replace them. Okay, and the result of that is cash disappearing from the economy. Okay, and the goal of it all is to slow the economy down to stop prices from rising. Okay, so quantitative easing is turning the water hose on to fill the pool. Okay, and quantitative tightening is sticking a vacuum in the pool and sucking the water out. Okay, so let's head over to the next slide. So the Fed cannot suck money out forever, or the system would go ahead and just break completely. Okay, so they're stopping or tapering quantitative tightening because inflation is cooling. Okay, the job is pretty much mostly done. And let's talk about the liquidity risk too. If reserves get too low, then banks will start to fail. Okay, and that cannot happen. The whole United States economy and infrastructure is based off of banks, companies, and money flowing through business owners. Okay, an economic slowdown, okay, they don't want to cause a massive recession for pretty much no reason. Okay, so the danger zone. So imagine braking a car too slow it down. Okay, and if you keep holding the brake after the car stops, you don't move. Okay, but if you brake too hard, you skid and crash. Okay, so right now, the Fed is releasing the brake. Okay, that's all it is. So imagine braking a car to slow it down. Okay, if you keep holding the brake after the car stops, you don't move. Okay, and if you brake too hard, you skid and crash. So right now, all the Fed is doing is releasing the brake. Okay, that's it. All right, into the market. Okay, because money's no longer being deleted pretty much. Okay, so liquidity is the lifeblood of the market. It's easily how money moves around. Okay, and risk on. So historically, the end of tightening is a green light for risk assets. Okay, letting us know that there's going to be more money circulating in the economy, giving us a higher chance for our assets to head in an upwards direction, since A, more people will be investing into something with value, okay, or B, people will have more money to purchase things with value. So valuations. So with less pressure rates on PE ratios, okay, stock prices can expand and head in an upwards direction. Okay, and tech and growth. High growth companies like tech or AI companies usually benefit the most when money becomes easier. Okay, because then they're going to have more money to invest back into their company and circulating instead of having to be tight and restrictive with the advancements and innovations, especially tech and AI companies, because the whole point of tech and AI companies is to profit off of future innovation and psychology involved into it, right? Investors then stop fearing the Fed and start fearing missing out. Okay, they're like, hold on, quantitative tightening is, hold on, it's pause. What we got to do is put some risk on, put some money down on the table before market heads up to all-time highs without us. Okay, so
when the Fed was selling, okay, you sold. Okay, so now the Fed is stopping. Okay, so the headwind is gone. Okay, the headwind is gone. Make your decisions. Plant your seeds for your asset classes. Okay, so you don't have to struggle in the future. Okay, the market can do two things: go up and go down. It goes up and it goes down. That's it. Okay, you're not playing an intricate math problem that you have to solve every day. All you have to do, for the most part, is invest in something that has future value and hold and be disciplined with your money. Okay, fight your flesh. You can't be indulging in things that you want to buy every single other day. Okay, stay down. Should be putting majority of your money away into asset classes. Okay, I'm not saying don't enjoy life. We are here only once. You know what I'm saying? Enjoy life. Do your little thing. Okay, get you some little food, buy you some little clothes, live your life, do your thing. But it can't be that week after week after week after week after week. A lot of the time, you should just be staying down, planting your seeds for your family. All right. So over to the next slide. Supply and demand. So during quantitative tightening, the Fed was a massive seller or non-buyer of bonds. Okay, and this forced interest rates up. So quantitative tightening ending leads to less supply of bonds flooding the market. Okay, and bond prices should stabilize or go in an upwards direction. Okay, and yields should stabilize or go down. Okay, so the real world effect of everything is that mortgage rates are tied to bond yields. Okay, if quantitative tightening ends and yields drop, then mortgage rates could finally come down, making real estate and real life a lot more affordable. Okay, so the fact that quantitative tightening is being ended is a really, really good sign for the future of the economy. Okay, and this is really going to help the housing market, get a lot of people off the streets, okay, and really just help a lot of people out in the world, making life more affordable again. Okay, because we shouldn't be stressed out every single day, you know, just trying to live our life, especially when we're already grinding hard. So let's head over to the next slide. Okay, the biggest risk of stopping quantitative tightening too early is that inflation has a chance to creep and come back up, God forbid. Okay, so the mistake that happened in the 1970s, for example, right? The Fed stopped fighting inflation too soon, and it came back double the strength, ready to bite everything in the tail. Okay, banks crashed, companies crashed, CEOs crashed. A lot of CEOs and a lot of companies ended up selling their companies to other major companies to make up for the fact that they couldn't keep up with that recession crash. Okay, and the market bubble. So if market ends up going up too fast, okay, it creates a bubble that might pop later. Okay, it might pop later super duper hard, and the economy will face its consequences for that. So the currency risk. Okay, the dollar might weaken if they print too much. Okay, if it's too much of something, it's no longer valuable. Okay, if something is everywhere, it's not valuable. Okay, so just think of it logically. If something is everywhere, it's not valuable. Okay, but if something is scarce, it's rare. Okay, it's valuable. Okay, so though we aren't printing, okay, just stop the shredding. Okay, so watch the CPI, Consumer Price Index reports. That's going to be one of the most important reports that come out. That's going to determine how cryptocurrency and the stock market wants to move. Okay, and if inflation ticks up, the Fed might have to restart quantitative tightening, and that would be super duper bad for stocks. So cash yields might peak. Okay, try to lock in rates or move your cash to assets. Okay, keeping your cash in that asset river, especially if the dollar weakens, then that means assets are going to become more valuable. Okay, because people have to have some type of value in something. Okay, so once again, if cash gets weaker, then assets become more valuable. Okay, and the quality growth of everything. So look for companies with low debt that grow regardless of the economy. Okay, and it might be a good time to buy bonds before yields drop as well too, if you'd like. Okay, so review your cash position too. Okay, see how much cash you have and see what you can plant within your asset classes. Okay, don't be scared of the market anymore, and keep an eye on inflation data is ending. Okay, money is back. Okay, it's trying to get healthier. It's trying to flow back into the markets properly. Okay, and liquidity stabilizes, which is really, really good for the market, letting us know that there's going to be more money available, which means more money could be flowing into asset classes such as the stock market or the crypto market. Okay, and this gives us a chance for rates to likely stabilize or drop. Okay, and risk shifts from the Fed fear to inflation watch. Okay, so stay invested, stay alert, keep up with the reports, stay prayed up to God, keep grinding. Make sure you guys aren't buying any assets at all-time highs. Okay, I don't even care if it's real estate. Okay. Even if it has nothing to do with the charts. Don't buy any assets at all-time highs. Okay. Wait for the dip, buy, and catch the V sweep up. Okay. Stay prayed to God. Keep grinding and head over to stackmode.net if you guys want to learn how to invest. Peace. When a company drops its earnings reports, it's like opening the result envelope on award night. Traders, investors, hedge funds, everyone is waiting to see if the company beats expectations, meet them, or completely miss the mark. And depending on that reveal, price action can turn into a calm wave or a full-blown tidal surge. During earnings, companies reveal how much money they made, how much they spent, and what they expect for the future. And here's the twist. Sometimes the company posts great numbers, but the stock still tanks. And here's why. Because Wall Street wasn't impressed, or the expectations could have been higher than reality. And other times the results are just okay, but the stock still shoots up because traders were expecting something a lot worse. In just a few minutes, spreads widen, volume spikes, and algorithms fire off like fireworks. And this is why many traders either love earnings season or avoid it like a thunderstorm. A lot of the times though, in order to avoid gambling, it is better to place your trades after the earnings report has released. So let's go on the jump into what earnings is and how it affects the market. Inshallah, God wills. So we're going to go ahead and cover earnings. So what happens when financial earnings release? Okay, so every quarter, okay, every couple of months, financial earnings are going to be a report that determines the amount of money that a company made, okay, and the amount of expectations that they were trying to arise to. So if a company was projected to make $500 million, but they only made $300 million, then in that case, they would go ahead and lose earnings. Okay. But if a company was projected to make $500 million and they made $800 million, then that would go ahead and be a positive earnings beat. Okay. So earnings are going to go ahead and determine the price action too. Now, just because earnings gets beat or earnings loses doesn't mean that a stock will head up or down. Okay. Stocks will do whatever it wants. Do not try and use the earnings releases to try and gamble and make trades. Okay. Try and trade after earnings releases if you're going to put down a brand new position. Okay. Wait for the price action to kick in. And then after the earnings release comes, then feel comfortable to make your trade. But never trade like a day or a couple of days before earnings. Wait for earnings if you're a couple of days before earnings. Okay. Wait for earnings to come out and then take your setup. Okay. Because otherwise it could be gambling. Earnings causes stocks to make giant moves quickly. Okay, so the moves that happen during earnings are going to be extremely instant, and it's going to be like a flash move based on the report. So let's jump into it. So the quarterly report, right? 10Q. Okay, every 3 months, public companies are required by law to reveal their financial health to the public to let them know how they're doing. Okay, it's going to go ahead and let investors know if they want to keep throwing money into the company or not. If a company is not beating earnings, then that means that they're not making any type of income. Okay. And a lot of the times we don't want to be invested into something that's not even making income in the first place. So every 3 months, public companies are required by law to reveal their financial health to the public. Okay. And let's talk about the revenue. So revenue is going to be how much money came into the door. Okay. How much money did that company make during that quarter? And the net income is going to be the bottom line. It's how much profit is left after expenses. So certain companies might have to pay for building power, warehouse cost, employees cost, etc. And the EPS, it's going to stand for earnings per share. And it's the profit divided by the number of shares that are going to go ahead and be available. Okay. So EPS, net income, and revenue. Those are going to be the 3 factors and the 3 things that are shown on the quarterly reports. Okay, so let's keep jumping into it. So the expectations game, right? The actual numbers don't matter as much as the expectations. Okay, so once again, let's say a company was projected to make 100 million, right? Expected, but then they actually made 170 million. Okay, that would go ahead and give them a beat result. Okay, so whenever you hear the words beat, that means that the results that actually came out were going to be better than what was projected or speculated in the first place. Okay, so priced in. If everyone expects Apple to make $1 billion and then make $1 billion, the stock might drop. Okay, why? Because the good news was already bought weeks ago. Okay. So to see a stock pop, a company usually needs to beat company earnings, okay, and beat the analyst consensus estimates based on the company's averages is how the estimates come out too. So it's not just going to come out with random numbers. If a company is making around like $50 million a year, okay, the earnings might be around like 60 or $40 million expectations. Okay, it'll be around where the company is performing as of recent years. Okay, so don't just expect the numbers to just be some random inflated numbers. These are all numbers that are going to be based in and baked into averages for a reason. Okay, earnings come into play. But once again, don't try and just hop in a contract the day before earnings trying to trade like that. Please don't do that. Okay, please don't do that. Now, sometimes there's going to be little rumors as well too. You'll see like, oh, this company is going to be earnings. Nobody knows what's going to happen until the earnings report actually comes out. So please do not lose money gambling for no reason. Okay, wait for the earnings report to come out. Unless you're in a hefty swing already, please wait for the earnings report to come out. Okay, let's keep going into it. And understand that guidance is going to be king. So stocks trade on the future, not the past. Okay, so guidance. Guidance is going to be the company's prediction for the next quarter, how much money they're going to be making. Okay, it's pretty much going to be giving the company a trail and letting them know how they should be performing in order to get to the next level. So in any scenario, company reported its record profits, okay, but let's say next quarter looks slow, okay, then that'll be the future. And results, okay, the stock would go ahead and crash if that's the case. So we're lowering our outlook due to supply chain issues would equal an instant sell-off, since that means they're pretty much letting us know, hey guys, the company can't expand right now because of financial issues. Okay, so guidance in the future of the company is also going to be really, really important too. There might be times where a company might lose or not beat their financial earnings, but then end up making a pretty profitable couple of next quarters. Okay, so one quarter is not going to go ahead and determine a company's entire worth. It's the consistent stream of quarters and reports year after year after year after year. If a company is consistently losing earnings, then that tells you about the company. Okay, so we'll talk about the implied volatility crush. So IV is going to stand for implied volatility. So before earnings, options prices can get very expensive. This is called high implied volatility. So it's like buying insurance right before a hurricane, okay? Or driving your car and then you just put insurance on it, you know? So before the release. So uncertainty is high, so options get more expensive in this case, okay? So if you are going to buy a contract before earnings come out, okay, make sure you sell it before earnings come out too. Don't gamble and sell your contract after earnings comes out, because then the uncertainty would go ahead and vanish. Okay, unless you're playing for a way bigger take profit that's going to be way further out than you think. Okay, then try and sell your contract before the earnings comes out, because it's going to be worth the most expensive then. Okay, so buying options right before earnings often loses money, even if you guess the direction right. So if you buy a calls contract and the company beats earnings, and even if price goes in an upwards direction, okay, you might notice that your contract didn't even make you that much money. Okay, that's because price has to get rebaked into what it actually is supposed to be. So do not buy earnings before expecting you to catch the right direction. Okay, because even if you do catch the right direction, you're probably not going to make as much money as you would think. Okay, especially depending on the contract that you buy. Okay, the reasons why contracts get expensive like that before earnings is because they don't know what the number is going to go to. Okay, that's why. So implied volatility makes things more expensive. So understanding this really helps us. Let's head over to the next slide. And let's go ahead and let's talk about the gap. So earnings are usually released after the market closes. So it's usually after 4 p.m. Eastern Standard Time. Okay, or it's going to be before market opens. So it's going to be before 9:30 a.m. Eastern Time. So you cannot trade standard stocks during the release unless you have extended hours access. So a lot of the times, once again, just like I talked about earlier, you're going to see that instantaneous price action. So the stock price will teleport, so it instantly gap up or down. Okay, and stop losses do not work against gaps. If you hold overnight then you're going to be taking the full risk. So just know that even if you have a stop loss placed during the day, if price decides to run through wherever your stop loss is, then what it's going to go ahead and do is decide to not validate and just ignore all of those orders due to the fact that the price action is happening pre-market and after-market. Okay, and you can only maneuver your options contracts. If you have shares, you can close a little before or after. Okay, but if you're on options, you've got to only get what you get when you wake up to the contracts. Okay, so even if you see price going in an upwards direction and you had some calls, don't expect money all the time. It really depends on a lot of things such as implied volatility, etc. Okay, so expectations matter. Okay, so beating estimates are required a lot of the time for a stock to go in an upwards direction, okay, in order to start seeing a rally. And guidance is going to be critical. So the future outlook is a lot of times going to go ahead and overshadow the past results. And volatility crush. Options lose value instantly after the news. Okay, so you might notice a contract might be $500 before the news, okay, and then after the news it might go down to $200, even if the number were to go ahead and hit. Okay, so options lose value instantly after the news, and the gamble between everything. So holding through earnings has a high risk, okay, just a high risk factor. I'm not even going to say high reward, okay, because the reward that you were to get is not even worth it, and you wouldn't even get it as properly as you would. Now, if you're holding a super swing, okay, you're trying to hold a trade for months, weeks, some years, etc., okay, then I do understand. Okay, do your thing and hold your trade as you need, but a lot of the times, make sure you're closing your trades before earnings come out, okay, unless you know exactly what type of swing that you're holding. Okay, head over to Stackmode.net to learn more about anything stock related, investing related, or trading related. I'll catch you guys in the next one. Peace.
Investing, trading, all of it is forever, guys. So I want you guys to think about plants for an example. What do plants need? Water, sun, good soil, consistency, and you'll get the plant that you want. Whether it be a beautiful rose bush, a giant oak tree, a blueberry bush, whatever you want. It comes through consistency. Investing is forever. It's forever. Don't think you're going to hop in this game, run up a couple of bands, and then hop out. That's for the quitters. Investing is forever. When you guys hop into this journey, when you guys start hopping on these charts have been around since before I've been alive. I'm 22 years old right now. And before I've been alive, people were trading Forex. People were trading certain stocks, etc. And I assume, inshallah, if God wills, that after I'm gone, people will probably still be trading the markets if the world is still going and flowing. So investing is forever. Don't think so quick, so instantaneously, so fast. When I was a day trader, I got consistent. It took me some time, lots of failure in the beginning. And that's why I thank God I'm able to come on here and coach. I'm so passionate about it. And I'm thankful I get to make some money in the process. Of course, I'm here to be fully transparent. Yes, I make money in the process coaching. Yes, I make money selling my trades. But I'm also really, really humble to the fact that I get to help another person learn a skill so they can feed their families, so they can help somebody, so they can pay their bills on time. So yes, I get to thank God. All due to God. Without God, I'm nothing personally. So thank God. Thanks to doing this, I get to coach you guys, make some money in the process. But I also want you guys to avoid a lot of hardship that I've gone through. And one of my students on a call that I was just on the other day, actually really told me that. Well, he laughed. He was like, I'm thankful you went through it. And I'm like, I'm thankful too. Like, for real. Like, it sucked going through it at the time. But now being able to tell you guys certain things like, hey, you might not want to get in at all-time highs right now because you're probably going to get dumped down on. So being able to tell you guys little tidbits and stuff like that, or, hey, market's dumping right now. You might not want to be in along. Let's wait till buyers step in. Being able to analyze certain emotional factors based off of anxiety, rushing. And I understand why people want to get in and rush trades. You're trying to touch some money on. You're trying to touch some money on. I'm trying to touch some money on. We're all trying to touch some money on. Okay? You're not alone. You are not alone. I promise you are not alone. You're trying to touch some money on. I understand. But in order to touch some money on, one, we got to pray to God so we can be healthy. Okay? Mentally and physically, so we can even think, so we can get some money on. So be humble to God. Really, really, really important factor. No matter how much money you start touching, stay humble to God. Don't change your ways. Don't change your ways as a person. Don't start treating people badly. Don't start disrespecting people. Even if they hurt your feelings, break your heart, whatever, there's no need to disrespect people. You know, I'm not perfect. There's times I've definitely made mistakes, but don't let the money change you, even when you do start touching that big bag, because it is easy to start thinking, well, you know, whoop-de-whoop, or I'm better than people, or why aren't people doing X, Y, and Z? And everyone's going to live their own life, but if you want your network to be full of grinders, full of investors, full of people who care about taking care of their families, stay around that. Don't try and change your whole life, start investing, and think you can hang around the same people. Because I'm telling you, it's going to be frustrating. Okay, and when you start changing and leveling up mentally, you don't want to be disconnected while you're there presently trying to enjoy yourself, but you're not going to be on the same mental space. Instead of you guys going to McDonald's, you're going to think, well, I got food at home. Why not just buy some Bitcoin or some shares? Why not buy this options play? Why not load up a futures account? You know what I'm saying? Your mindset changes when you start investing. So the people around you, if they're not on the same wavelength and journey, it will and it can frustrate you. But don't let it get to the point where you just start disrespecting people. But yeah, you know what I'm saying? Sometimes people are broken spirited. Like, if people are broke, they're broke spirited. Like, for real. That's really what I think. Because it's not even about money. It's just, you're waking up every day. And I think it's just abusing the body that God has gifted us with. Because how are you not waking up every day and grinding? How are you not putting some money away for your family so they can eat? So how are you not trying to get a bigger home for your family and a safer home for your family so they can live in a better environment? You know what I'm saying? So I do understand the frustrations, but if you're an investor, if you're a hustler, you're a grinder, and you're ready to change your whole life around, your whole life is going to change. You're going to be a really consistent person, okay, inshallah, especially when you start praying every day. Working out Monday through Friday, 5 days a week is a really, really good way to build consistency, let off a lot of stress, and really just stay mentally focused. And investing constantly. As soon as you get some money, buy some shares. As soon as you get some money, buy some crypto. As soon as you get some money, buy an options play or whatever that you planned out. Boot up your account. Okay? Do what you need to do. Try not to waste your money on prop firm, because ownership is really the main priority. You can sell your shares whenever and put it right back in your bank account. Prop firm, they have little parameters that are set up for you to fail, because prop firms only make money when you buy a challenge. So, of course, they're going to make things very difficult and hard for you so you fail. On the other hand, we're going to go ahead and have your actual live account. You can pull out your money whenever, whether it be your crypto, shares, futures, whatever. You can just pull out your money, okay? You can pull out your money whenever. So, think about it. Ownership. Ownership is the reason why you want to trade. Okay, you don't want to just have money to have money. You want to throw your money into the asset river so you can have ownership, so you can have more houses, so you can own more percentage of a company or an ETF, so you can get paid more dividends maybe one day. Okay, you want to have more ownership of more Bitcoin. So when Bitcoin goes extinct, Bitcoin is not infinite, if you didn't know that. And when Bitcoin goes away, you're going to have Bitcoin. Ownership is what we're investing and trading for. Okay? Ownership. Think about it, guys. Okay? You have money just chilling in your savings account. Why? What is that doing for you? Ask yourself, if you have money sitting in the savings account right now, what is that doing for you? Or your checking account. Why is it there? Because once I turned on my brain, I personally try and just live off of the credit card. Okay? All money goes into assets, and then take the money out, pay off the credit card with the assets or income that's flowing in, pay off the credit card. And when tax time comes, take money out the assets, pay your taxes. Why is money sitting in your checking account when houses get more expensive year after year after year after year? When food costs more year after year after year after year after year? There's no more dollar menu at like McDonald's and stuff. Okay? Not everywhere. Prices fluctuate per city. Because of why? Inflation. So why is your money just sitting around? People like to complain. Stuff is just getting more expensive every year. Do something about it. See, and that's broke to me. It's not even about money. It's just don't hang around complainers. Investing is forever. So you're the one who's going to do something about it. Inshallah, you're the one who's going to take care of your family. If you're watching this right now, you're the one. Okay? And you can't fail. Inshallah, you got to keep going until you die. Don't stop. Don't let any relationships affect your mental. Don't let any people around you affect your mental. Don't let any loss of any funds affect your mental. Okay? Stay focused on God and stay strong. Because this journey is going to be a long one. You're setting up right now to be the provider, whether it be for yourself or your family or your loved ones. If you're investing, you're probably doing it to give your family or yourself a better life. So be ready to be a provider. There's going to be days where it's going to be frustrating. It's going to be days where you're going to check your P&L. It's going to be red. It's going to be days where you're not going to be making some money. And that's okay, because it's forever. It's about staying consistent. It's about staying resilient. It's about coming back every single day and not giving up, no matter what. Because I'm telling you, whoever doesn't give up wins. The people who stop, the people who quit, the people who think it's a scam, the people who don't have self-control, who don't pray to God, okay, all going to be failures. All going to be failures. Because until I started praying to God, that's when I started winning. As soon as I started praying to God, I started winning. Okay? Until I started praying to God, like, I just wasn't winning. Okay? But then as soon as I started praying, started winning, started getting healthy. Was able to lose 100 pounds in 8 months. I just privated the short just because it had some explicit pictures. I don't think it's very, halal content. But yeah, I'll stuck for Allah. I don't want to be showing myself like that on the internet. Also, watch how you guys present yourself too. When you guys start running up money, because whoever's watching this right now, I know you guys will go far, inshallah. So if you're watching this right now, watch how you present yourself too. Watch how you present yourself on the internet. Don't just be out here balling and flexing on everybody. Motivate. Motivate. Okay, because we're all on this earth for a reason. So whatever keeps you going on this earth, do that. And try and inspire the next person so we can all just be happy on this planet. All right, because that's really what it's about. Yes, we're here to get some money, but I'm telling you, investing is forever. The big plays will come as long as you stay consistent, you stay focused, you keep taking the same type of setups, you keep putting the same money away. I don't care if you have $1 million in shares, $1 million in Bitcoin. As soon as you get $20, if you put $15 into it, that mindset is the reason why you got to that $1 million. Keep stacking it up. Don't get that big ticket and then blow it and then go back to zero. Don't do that. That's something I had to learn from. Okay? Run it up. Stay consistent. Stay prayed up. Keep your mental straight and keep what you got. Don't lose what you got. Whether it be relationships, whether it be your money, whether it be your plays, don't lose what you got. Don't lose what you got. Okay? I love you guys so much. Head over to Stackmode.net for all trading education. Stay prayed up to God. Keep grinding. Free ebook and course there too, if you guys want to check that out for free. You guys can book a call with me for the first time for free. Let's break down whatever you're going through. Let's break down an investment plan for you. I want to get you guys focused. I want to get you guys set up with a full financial parameter and a full financial system so you can be successful in this world, inshallah. The stuff is only getting more expensive and they don't want you to suffer. Love you guys, for real. Peace.
Class, let's learn. Today we're going to be talking about Mono Zero, Zcash, and the evolution of the unlinkable value. and the quest for digital anonymity. And this class is going to explore cryptographic foundations and real-world implications of the leading privacy-focused cryptocurrencies. Let's jump into it. So the transparency trade-off in cryptography. Traditional cryptocurrencies like Bitcoin operate on a transparent public ledger, also known as the blockchain. And while this offers unprecedented security and verification, it fundamentally compromises financial privacy. So let's talk about anonymity versus pseudo-anonymity. Bitcoin transactions are pseudo-anonymous, meaning that they're linked to public wallet addresses. With enough data, these addresses can be de-anonymized and linked back to real-world identities, especially when funds move through centralized exchanges, which have know your customer rules, also known as the KYC laws. So this is how big scammers get caught and things like that too. So when people get off and finesse millions of dollars worth of Bitcoin, etc., and stuff like that, especially if they do any type of withdrawal to any type of bank account or Cash App or anything like that, it can be traced. Okay, so as far as the whole decentralized section and the space to where everything is anonymous, things with enough tracking, and since everything is on the blockchain, which is pretty much going to be the history of every single transaction that happens on the cryptocurrency market, things can definitely be tracked back. So keep that in mind. So sophisticated chain analysis firms can map the flow of the funds, inferring balances, spending habits, and commercial relationships. And this compromises business secrets and personal financial health. So if certain coins can be tainted or flawed due to their history, for example, association of illicit activity, for example, then their value and acceptance can be diminished, which is a key failure of fungibility. And fungibility is where all units of a currency should be perfectly interchangeable. So let's say for analogy purposes, right, let's talk about the glass vault. So imagine a Bitcoin has a glass vault, right, the blockchain, and it's where everyone can see exactly how many coins are in every single box. All right, and let's say the box refers to the addresses. And one of the most routine boxes, even if they don't know the owner's name initially. So that's kind of just how it is. Things can still be traced and tracked with enough data, but for the most part, it's not going to be as vulnerable as far as the sensitive information exposed. Like you're not going to see your last 4 digits of your card number and stuff like that. It'll be your Bitcoin address, which can't really do anything for you. If somebody gets it, if they see the address of the transaction that was done, it'll just show how much the transaction was for, the fees in the transaction, etc., stuff like that. But it can't really trace you back to your own personal wallet, but it will have an address for the transaction. So mandatory privacy by default, the Monero protocol. So Monero launched in 2014, and its design is to completely fungible and private by default, which makes all the transactions appear the same to external observers, and it achieves this trio of mandatory privacy features. So we'll talk about them. Let's start off with the ring signatures. So this hides the sender, and the actual spender is mixed with several non-spenders, and that's the ring, making it computationally infeasible to determine which key is actually signed to the transaction, and the transaction is proven valid, but the source is going to be obfuscated. Okay, so keep that in mind as well too. So ring signatures hide the sender. Now let's jump into stealth addresses. Stealth addresses hide the receiver for every single transaction, and for every transaction, the sender generates a unique one-time destination address on the blockchain for the receiver. And the receiver can scan the blockchain and identify the funds belonging to them without revealing their true public address. And let's jump into ring confidential transactions, right? Referring to ring CT. And this hides the amount. And ring CT uses the Pedersen commitments and zero knowledge proofs to cryptographically verify that the inputs and outputs of a transaction balance, right? Which is going to refer to the fact that no new coins were created without revealing the actual value of a transaction. And Monero's core philosophy is that privacy shouldn't be optional, all right? Should be secure, and people should be having high conviction between sending money from one person to another. They shouldn't feel like they are vulnerable within sending information. And Monero's core philosophy not only thinks that privacy shouldn't be an optional factor, but it should be non-negotiable. And it's a feature that's baked into the protocol, guaranteeing a high level of fungibility for all DEX arguments. So let's talk about selective disclosure via ZK snarks. So Zcash. It introduced a groundbreaking cryptographic tool called ZK Snarks, and that stands for Zero Knowledge Succinct Non-Interactive Argument of Knowledge to the mainstream. And this allows a user to prove that they know a piece of information, like ownership of funds, without revealing the information itself. So, what is a ZK Snark in the first place? I know it's a crazy name. So it's a proof system that verifies the validity of a transaction without needing to see the addresses, the amounts, or any other identifying data. And this allows for shielded transactions where the public blockchain only records that a valid transfer occurred, just to make sure that, if someone says, yeah, I sent you your million, and they can actually go check to see if it happened, so you can't get robbed and finesse. You can actually see if the transaction occurred. So don't be foolish. And let's talk about optional privacy. Unlike Monero, Zcash offers both transparent T addresses like Bitcoin and shielded Z addresses. Okay. So it offers both of those type of transactions. And this optionality is often cited for compliance purposes. And compliance is pretty much going to be government laws, things having to be in place so people can send, buy, and sell cryptocurrency. And it's often cited for, once again, compliance and law purposes, which allows users to selectively disclose information if required by a regulator or auditor. So companies, a lot of the times, have to have privacy laws, so all your information can't just be exposed. So viewing keys and memos. Zcash provides mechanisms, like viewing keys, that allows the Z address owner to reveal the transaction data to an authorized third party. And this controlled transparency is a key differentiator from Monero's absolute privacy. So let's jump to an example here, guys. So using ZK Snarks, a company could prove to an auditor that it holds a minimum balance, let's say for over $1 million in a ZEC wallet, without revealing the exact balance or any other transaction history. And they prove to meet the condition, but nothing more. So comparing Monero's mixing versus the Zcash Zero Knowledge. So Monero's approach, let's talk about the mixing here. Okay, so the mechanism involved in Monero's approach. Okay, it's using rigged signatures, and rigged signatures obfuscate the sender by creating plausible deniability among a group of signers. Okay, and they're going to be in the ring. And the pros of it: it's simpler to implement, and it relies on time-tested cryptography. So once again, ring signatures obfuscate the sender by creating plausible deniability among a group of signers. Okay, making it a hidden circle. Okay. It's a lot simpler to implement, relies on time-tested cryptography, and it's absolutely mandatory for all users, ensuring network-wide privacy, so everyone can be safe who's trading within the circle. So, and some cons of it. Transaction sizes become larger, and that could also lead onto the blockchain network and make people have potentially slower transaction verification times due to the complexity of ring verification. So it would just take a little longer for you to receive your money within your wallet if you were to receive money, or if you send somebody to somebody, it would take a little longer for the funds to actually be spendable in their wallet. And that's okay. So Zcash's approach, right? This is going to be a different approach to it. So Zcash, the mechanism of it. So ZK Snarks prove the validity of a transaction script without revealing any of the underlying inputs or outputs. So the pro of this, it's a higher level of cryptographic anonymity, okay, and it's zero knowledge, okay, so it's pretty much when the transactions are done, can't be tracked as easily, okay, so that's going to be a big pro of it, especially for people who want to use cryptocurrency for just certain other purposes. Okay? And smaller transaction sizes compared to Monero, so it's going to mean faster processing. Okay, so you're going to get your money faster. Good thing. And let's talk about the cons though. So it requires a complex initial setup known as the trusted setup. And though newer versions aim to minimize this, privacy is going to be optional, leading to less adoption of shielded transactions. Okay. So Zcash's original trusted setup was controversial. And the initial parameters, if compromised, could allow someone to counterfeit ZEC. And Monero's design avoids the centralized point of trust because privacy is not optional within the Monero world. So yes, it's a little slower, a little clunkier, not as quick, but safer. So beyond Monero and Zcash, let's talk about the layer 2 protocol innovation. So the quest for digital privacy is not limited to dedicated coins. New innovations are integrated privacy into existing chains and layer 2 solutions. Let's talk about layer 2 privacy solutions. So, Tornado Cash Mixers. They use smart contracts and ZK Snarks on Ethereum to break the on-chain link between source and destination addresses. and CoinJoin and CoinSwap. And there are going to be protocols where multiple users combine their transaction inputs and outputs into a single large transaction, making it impossible to map individual transfers deterministically. And at advanced zero knowledge, ZK Snarks, right? It's a newer version of ZKPs that removes the need for a trusted setup. It's trustless, making them more decentralized and mathematically pure, though computationally more intensive. But we got to remember, just like I just talked about on the last slide, security is going to be optional. So the encryption, right? So the homomorphic encryption, right, also known as the HE, it allows computation to be performed on encrypted data without decrypting it first. And this is still highly theoretical for fast decentralized currency. So ZK Snarks, once again, a lot quicker, but still raises a lot of concerns due to the fact that privacy is going to be optional. Keep that in mind. So regulatory focuses, right? Laws, governments got to have their piece of the pie and got to make sure things are safe too. Anti-money laundering companies and governments, the SEC, etc., got to make sure cryptocurrencies are being managed within a safe way so people aren't just getting rug pulled on, getting scammed and getting their money duplicated, etc. So regulators globally are increasing scrutinizing protocols that offer strong privacy, viewing them as potential tools for money laundering, right? And the future balance will be between innovation and compliance, likely favoring optional, audible private solutions like Zcash's viewing keys, okay? So as long as certain government entities get behind it, the anti-money laundering entity, SEC, etc., are all monitoring it, then we could have a pretty safe, decentralized world. Although, even though it's being monitored by regulators, it's truly decentralized. Okay, let me know in the comments below. So let's talk about adoption, compliance, and the fungibility imperative. So primary use cases. So journalism and activism, right? Used to protect donations to whistleblowers or political dissidents from oppressive regimes. Okay, so journalism is being implemented, trying to spread the worldwide spread of cryptocurrency. Okay, spreading how people can do their transactions and just making it more known to the government. And the government itself has been buying cryptocurrency recently as of 2025, and TradingView has now implemented as of October 10th, 2025. You can actually start seeing some cryptocurrency news being linked. So government's really adapting it. Its future's looking strong as far as the cryptocurrency space. So let's talk about some privacy. All right. So e-commerce privacy. Preventing competitors or data miners from tracking suppliers, sales volume, or customer bases. Extremely important for privacy, and know your customer laws are going to be extremely important to implement on brokers where we put our cards in order to buy some cryptocurrency. And salary protection. Individuals who don't want their employer's treasury balance or personal wages publicly visible. Super duper important for anyone who wants to stay safe or stay anonymous. Okay? You don't got to flex and pop it on everyone if you don't want to. So corporate secrets. Hiding internal fund transfers and merger acquisition activity until legally required disclosures. Okay, so pretty much not exposing deals until things are fully done. So some key challenges: exchange delisting. Many major regulated exchanges, let's say Coinbase or Binance, for example, refuse to list privacy coins due to compliance pressures, limited liquidity, and adoption. And there's going to be some regulatory classification. The lack of transparency often leads to classification as high risk by financial authorities, creating friction with traditional banking rails. And when things are classified as high risk, people aren't going to feel as safe to invest into it, and leading to less liquidity, since now it's going to be, once again, investing into it. And let's talk about the scalability and computation. The advanced cryptographically required, especially for ZK Snarks, can increase transaction processing time and costs, though this is actively improving. As laws get passed, governments start to analyze cryptocurrencies, regulate things, consumer sentiments start coming out, and things just start getting talked about. And the ultimate success of privacy coins depends on their ability to prove that the financial privacy is a fundamental human right necessary for a free society, and while demonstrating that the tools exist to meet legitimate law enforcement needs. So they're trying to keep everything safe because, once again, a lot of big scammers and stuff like that within the cryptocurrency world, but able to get caught. People are able to return money and stuff like that too. And the cryptocurrency world just really progresses over time. There's been some things I've talked about in previous other lessons too, where there's been instances where, let's say, like a certain amount of Bitcoin Cash, right, got hacked, and people were able to reverse the transactions, giving all their money back, right? And certain things like that just being implemented just to keep the safety protocol of everyone's money flow. Things just get better as people start to, one, come up with more scams, and as people come up with more scams, people can come up with a stronger defense in order to fight it. So thank God for everything getting more secure, locked down, so we can have a safe crypto trading environment. And privacy isn't about hiding bad deeds, right? It's about protecting individuals with autonomy in a financial system where every transaction can be linked and analyzed. So Monero, XMR, it's absolute, and it forces mandatory privacy rights through the ring signatures, stealth addresses, and ring 16. And it favors fungibility above absolutely everything, regardless of the transaction time. So it doesn't care about that. It doesn't care how slow a transaction time is, as long as it's safe, making sure that it's locked down, and it's mandating privacy. Let's talk about Zcash, right? The SECC. So optional privacy using Zk snarks, offering the highest cryptographic guarantee with control disclosure, right? Viewing the keys and the future of everything. Moving toward layer 2 and modular privacy solutions that integrate ZKPs across multiple blockchains. All right, guys. So let me know what you guys think about the future of cryptocurrency. Stay prayed up to God, keep grinding. Head over to stackmode.net to learn how to trade, how to invest, and how to grow your business. Peace. All right, so we're gonna go ahead and talk about the bear market, okay? So pretty much whenever cryptocurrency starts heading in a downtrend, okay, sometimes that's gonna induce panicking, okay? It can induce a couple of emotions, such as like panic selling, okay? Certain things, whether you wanna feel like you might wanna dump your entire portfolio, okay? Because of how many negative trades that you've taken within a certain bear market cycle, right? Or if your portfolio's down. Okay, but we don't want to do that. Okay, let's not think of the market that way. Let's think of the market logically. Okay, so just like we always cover and talk about, there's benefits to making sure that these markets go in upwards direction. Okay, cryptocurrency included. This is something that governments hold, many people hold, hedge funds hold, and just people with large quantities of money hold. Okay, so cryptocurrency, it's not going to be something that's going to be useless. Okay, it's going to be something that's going to be instructing and providing power back to us, the people, okay? So it's something that people are investing into due to the fact that people can easily send money from one person to the other, okay, without having any bank intermediaries in the middle of it, okay? So if you want to send a wire transfer, for example, okay, from $1 million from one person to another person in China, a lot of times that transaction might not easily go through, okay, without being first approved by the bank. Cryptocurrency removes the whole bank in the middle, okay, and works on its whole blockchain system, okay, letting people make their transactions on their own accord. So if someone wants to sell $1 million in cryptocurrency to a person in China, they can go ahead and do that and easily and instantly using the decentralized space. Okay, so let's jump into it. So cryptocurrency has many uses. If you see market going in a downtrend, all it is people selling as well too. Okay, just like we see this chart right here. Okay, this is a left to right chart. So if people got in at this low down here, okay, and market starts going in upwards direction, of course, when market decides to fall down and correct, okay, people call it a bear market, but of course it's going to fall down and correct though. People got in way back here and they're going to go ahead and take profit. So when people are taking profit, getting their money out, that's going to cause the shares to fall down. Okay, so all the crypto supply will fall in a downwards direction the more people sell. Okay, so whenever we see market going in a downwards direction or a bear market, okay, that just means market's going in a downwards direction, which also means people are just selling. Okay, but these are going to be opportunities where market's also going to go on discount. Okay, so if something is $50 right now, okay, and it's something that you want, and then it goes on sale, and you see it on sale for $20, okay, you might even get 2 of those things, okay, due to the fact that it's on sale now. Okay, so think of crypto market dumps like that. Okay, think of things going on sale. Okay, market has to go up in order to come down. It can't just go up in a straight line forever. Okay, it has to work in a staircase formation. People have to buy, people have to sell. Hence why it's called trading. Okay, When you're winning, somebody's losing. When you're losing, somebody's winning. Okay, so let's cover the mindset and really just understand how we can prepare for when market's going into downtrends. Okay, so let's define the bear market and root causes. So a bear market is generally defined as a decline of 20% or more, okay, from the recent highs, marked by widespread pessimism, low confidence, and a sustained decline in prices and trading volume. Okay, and key definitions. So the 20% rule. So why subjective? A 20% drop from the all-time highs signals market distress. And in crypto, drops of 70 to 85% on certain things like meme coins and stuff like that can be common during major bear cycles. So that's why you don't really play meme coins and things like that. It's not really worth it since they just don't have enough value, okay? And they can easily just go ahead and fall in opposite directions without much of a backbone behind it, okay? Versus something like Bitcoin, where that's a lot less likely to happen. And the more actually it dips, the more people are gonna buy, okay? People are putting in $300 million orders plus, etc., okay? Anytime Bitcoin dips down, okay? So it's way different. So it's going to be sometimes too where certain cryptos go cold, okay, and they start consolidating. So what consolidating means that it starts going in a sideways direction, okay, not much price action up or down, and you want to stay away from those, okay. So you want to trade something that goes in upwards direction year after year and is gaining percentage year gain, okay, making your money more money, making it a stable investment. So watch what cryptos we invest in, okay, and primary catalyst, right? Let's talk about it. So some macroeconomic factors. So global inflation that can affect crypto prices, interest rate hikes by central banks, and traditional asset market declines often correlate with crypto downturns. Okay. Excessive leverage cleansing. Okay. Overly aggressive market buying. Okay, with borrowed funds. So there's going to be times where people can trade Bitcoin with borrowed funds, right? With something called leverage. So just like, futures, there's going to be things called crypto futures. Okay. And on crypto futures, you can trade with the same leveraged amount, okay? And any leverage amount, depending on the broker, goes up to like 500x and stuff like that, okay? And sometimes when market decides to go down, okay, it creates instability. And bear markets, meaning markets going in a downwards direction, it purifies the market by liquidating these highly leveraged positions. Since the more leverage that you're playing with, the smaller that your stop loss is going to be. Okay, meaning that your trade has to close at a certain area automatically versus if you're playing with no leverage. Okay. So regulatory uncertainty. So major government crackdowns or unclear legal frameworks in key jurisdiction can trigger broad market fear and lack of trust within certain cryptocurrency markets. Okay, so we saw in 2022 COVID area during the SEC, okay, the government exchange for securities, okay, they were having some problems with the crypto sphere, but since then things have been passed, things have been regulated, and as we can see, crypto is now shooting into new highs constantly with tons of optimistic future ahead of it. Okay, and let's talk about project failure and exploits. So the collapse of large projects like major stablecoins or exchanges lead to contagion and a severe loss of investor trust. Okay, so if you see certain things like certain exchanges fall down, or certain brokers where a lot of people invest in just shut down randomly, that could put some fear into the market. More fear into the market, less people are going to be investing. Okay, but that's just things that can happen. But just like a bank, banks have random maintenance where you can't pull out your money. Okay, so anything has its cons, anything has its pros. Okay, only thing's perfect is God. Sometimes things are going to shut down, just is what it is. So psychological game, right? Conquering FUD. So investment success during a bear market is going to be 80% psychology. Okay. Really 80%. I'll say like 90% plus, okay? Because you can have really the best levels on the screen, okay? And I've done some tests with certain students, okay? You can give somebody the best levels, but they don't close where they need to close, okay? Due to the fact that their analogy or how they process it in their head might be completely different, okay? So trading is really going to be psychology and how you look at the market, okay? So mistake number one, okay? So mistake number one that people make, this is the main reason why people will remain unprofitable, okay? Their stop losses are going to be too tight, okay? Way too tight, okay? Causing them to panic sell, okay? So selling assets at low prices locks in permanent losses. And the single best way to lose money in a bear market is to sell everything when despair is the highest, okay? Sometimes you got to sit and you got to hold through certain periods expecting price to sweep up. Now, I'm not saying hold every single trade just certain past the worst dump of all time or past your stop loss. But if you have a calculated trade that you have planned and it starts going in the red, it's part of the game, okay? And the game is really about who can survive when market's in drawdown or your account is in drawdown, okay? And who can't, okay? Because whoever's going to sell all the positions when market's in drawdown for a loss, their account is never going to grow, okay? You have to be able to sit there and stomach through it. There's times I've had tons of time. This is why time is going to be one of the biggest factors in trading. This is why crypto is really amazing, okay? When you're trading cryptocurrency, you have time. Okay, cryptocurrency, as soon as you buy, you can hold it forever until the end of time. So you have time. So if you sell, okay, that's going to be on you. Okay, there's no time running behind you. As soon as you buy some spot cryptocurrency, okay, when you just buy crypto on a normal broker, okay, and you can just buy and hold without any leverage, okay, and no leverage buying cryptocurrency, just being the normal way, it's called spot. So when you do that, okay, you can decide like, okay, I'm going to sell in a couple of years. Okay. It's not as easy to do that with other instruments. Okay. Other instruments can be time gated, such as like futures, for example. Okay. Futures, each contracts, they have expiration dates. Okay. So things can be a little bit different. So let's talk about tactic number one, right? The zoom out. Okay. We got to zoom out. We got to get the whole long-term perspective. This is why we use our higher time frames. Okay. Time frames we're going to be using. Okay. Some great notes here. Time frames that we focus on. Weekly. Okay, we're going to use our weekly time frame. We want to see everything on the larger, higher time frame scale. Okay, after we check out our weekly, maybe for take profits. Okay, and take profit is where we close the trade out. Okay, say you got it at an area of support. Okay, and you close at an area of resistance above current price. You can go ahead and do that. Okay, so you're going to have the weekly. You're going to have the daily. Okay, and then you're gonna have your 4-hour time frame. Okay, then you're gonna have your 4-hour time frame. Okay, so using those time frames all together is really gonna help you put your trade into perspective and be like, okay, this is the type of setup I want to be taking from now on. Okay, and these are the type of trades that I just take. Okay, so that's what you want to focus on, okay? Weekly, daily, and the 4-hour. So let's talk about zooming out. So the HODL view. So we're going to focus on the long-term vision, okay, of 3 to 5 years plus. And all major crypto bear markets have been followed by new explosive bull market cycles, okay? Look at the monthly or the yearly charts, okay? Not the 5-minute charts. Okay, tactic number 2, okay, reduce obsession, okay? We should be grinding in real life, stacking up some bread, okay, putting some money away, okay, and just growing our capital in the real life so we have more money to come put into the markets, okay, but constantly checking P&L, seeing how much money you're up and down, it's not what we want to do, okay, focus on the charts, okay, you could look at the charts, see where it's at, but even that, don't turn it into unhealthy obsession, okay, take your time, check your charts out, maybe once a day, a couple times a week, okay, but don't sit there, stock on the position every minute, okay, constantly checking the price feeds, lead to anxiety and they lead to impulsive behavior. So set clear rules and limits and then step away from the daily chart fluctuations. So it's really about a battle of just you versus you at a certain point. So quote for perspective, right? Be fearful when others are greedy and greedy when others are fearful. Okay, so when everyone is scared, price is going in downwards direction. As soon as it starts making a curl on your weekly or daily, you can go ahead and get in, buy that, and then you buy the low where everyone's fearful. And then by the time it's at all-time highs, that's when you're going to start seeing the posts like, oh, everyone, and then everyone's going to start buying at all-time highs. Okay, it happens constantly every single cycle. So when we know how to sit through the bear market cycles and buy certain dips, we're going to be able to prepare and be a lot further ahead than other people due to the fact that we can analyze something so simple. Okay. So accumulation through DCA. So let's talk about DCA. So DCA stands for dollar cost averaging. Okay. So DCA, it's dollar cost averaging. What is that? Okay, it's one of the most powerful tools for risk mitigation and capital deployment in volatile bear markets. And it needs the need to time the bottom. Okay, and let's talk about the DCA mechanism. So fixed schedule. So investing a fixed dollar amount, let's say for example $100. okay, at regular intervals, let's say weekly or monthly, okay, that's going to be DCA, okay, when you're just regularly putting away a certain amount of money, okay, that you can, okay, pay your bills, get some groceries, and then you can invest. If we're going to say you're going to invest $1,000 in Bitcoin a month, okay, then go ahead and do that. Okay, if you can do more, then do more. But DCA means just take a percentage of your money, okay, break it down and put it into some cryptocurrency or whatever investment. Okay, I don't care if you get $10. Okay, go ahead and break it down, put 7 of it into crypto. Okay, just having that type of stack mode mindset is going to help you grow your currency and help you stack way, way, way faster. Okay, and your portfolio will flip in no time. And shalom. So reducing the timing risk. So, and also keep yourself broke. Okay, so if you keep yourself broke, it's a strategy I notice a lot of people do. Okay, it's something I definitely do. Okay, I don't keep any money in my checking account. Okay, after I pay my bills, I get my big lump of groceries. Okay, I do what I need to do. Okay, I buy what I want to buy. And then from there, every dollar that I have the rest, okay, I'm going to pay my credit card. Okay, and then after that, I'm just going to invest. That's all I do. I put every single dollar into investments and I just keep myself broke. Okay, I paid my rent. I got groceries, so I'm not going to starve, thank God. Okay, and I did everything I need to do. So I'm good. So I can keep myself broke and I'm going to survive. Okay, so keeping yourself broke, whole time you got money stacked away in investments, is going to be a really, 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 really good thing to do. Okay, just changing the whole mindset. Just, you know what? I don't need to go get this coffee today. I'm going to bring some coffee from home. I'm going to take this money and I'm going to invest. Okay, so it's something personally my wife really helped me out with. Okay, just changing the whole mindset of everything. Okay, changing the whole mindset of everything and really understanding like, okay, you know what, let's not eat out today. Let's stay down, groceries, and the rest of this money is investment money. Okay, because this stuff, it adds up quick. It's easy to spend $40 on a DoorDash meal, $50 on a DoorDash meal for 2 people, okay, quickly. Okay, but $50 worth of groceries, it really goes a long way. Okay, so it goes a much further way. Okay, so it's about just staying down, making the right decisions, and then we can go ahead and ball later. Yeah, so the compounding effect, right? So this strategy becomes exponentially more effective when asset prices are depressed, okay? As your fixed investment buys a larger portion of the supply, okay? So when market is in a downtrend, okay, and market's about to make that curl in the upwards direction, okay, and then we have cash to just stack and throw in there, and you buy, okay, even if you don't have all the cash in the world to buy at the low, as it curls up, you can keep adding, okay, and that you hit your trade, okay, and it's just about mindset. Then from there, take that capital, and then you can go ahead and deploy more cash into there and just keep stacking your wins over time. Nice. So thriving the strategy. All right, so let's talk about some fundamentals there. So bear markets separate speculative noise from real technology. Okay, so this is the time to ignore hype, okay, and focus exclusively on fundamental analysis and your technical analysis. Okay, so when market's in a heavy downtrend, let's say there's a speech from a president or something like that that has dropped the market. Okay, we want to be looking once again on our weekly and daily time frames primarily. Okay, and we're going to be looking for that V curl up. Okay. We want market to make an area of support, okay? And then we want to see market start to curl up, either after a couple of days from the daily or a couple of weeks from the weekly. Preferably, weekly curls are going to be really, really nice, okay? Because that means price really wants to reverse. Okay, if you start seeing 2 weeks in a row, price action, price filling in the V, okay? A lot of the times that's going to be the setup you would like to take. Okay. So, and we're going to ask ourselves too, if something is going down, why is it going down? Okay, was there any bad news behind it? Okay, did something happen? Okay, and let's think about utilities and use cases. So does the token or protocol solve a genuine, tangible problem? So we'll talk about Solana, for example. Okay, Solana, you need it to trade meme coins. Okay, so that point alone, Solana has value. Okay, if people want to create their own cryptocurrency coin, okay, they got to generate some Solana first if they want to make their own meme coin. Okay, but then we'll take something like a random meme coin that's just a joke. Okay, it doesn't have any community behind it, no nothing. Okay, just a random meme coin. If it goes down to 0, okay, a lot of people wouldn't be surprised. Okay, because does it solve any genuine, tangible problems? But then you're gonna have something like Ethereum, for example. And Ethereum was created due to the fact that Bitcoin is limited. Okay, so one day Bitcoin will be gone. So people still want to trade cryptocurrency, so that Ethereum was created. Okay, so Ethereum has its purpose there. And instead of using power to create it, like Bitcoin's using power to create it, Ethereum is created using computers and smart contracts. So it's a lot more power efficient for the earth and it's healthier. Okay, so Ethereum actually has real uses compared to certain other things like random just joke meme coins. Okay. So, because if something has a real use and it dips down, people are going to be hounding to buy that dip. Okay, the second something valuable dips, people are hounding, buying tons of it. Okay, the second Bitcoin dips, people putting in hundreds of millions of dollars worth of orders, whether it be governments, BlackRock, any type of companies, anybody. Okay. So, talk about the cryptocurrencies team. So, is the development team public, experienced, and actively building during the bear market? Okay, and you could check certain GitHub commits too. So certain cryptocurrency coins, okay, even though they're dipping down, they're working on tons of stuff on the back end, okay, looking to progress the future forward. And the community and governance behind it. So does the project have a vibrant, resilient community and a clear decentralized government model? Okay, so just like Bitcoin has tons of community behind it. You got companies such as MicroStrategy, also known as MSTR, okay, big representative of Bitcoin. Okay, things like that. Okay, and also have, once again, governments, US government, other governments, etc., participating in buying Bitcoin and other tokens as well too. So the tokenomics of everything. Okay, so analyze the supply schedule, vesting periods, inflation and deflation mechanics, and allocation of the team versus the public. Okay, and blue chip versus speculative asset, right? So blue chip cryptocurrencies, they're going to be our big heavy hitters. Okay, our Bitcoins, our Ethereums, XRPs, etc. Okay, and these assets, they have the deepest liquidity. Okay, and liquidity is going to equal money. Okay, and money equals the amount of people. Okay, the more money something has, the more people are trading it. The more people are trading it, the higher liquidity it has. Okay, so liquidity is going to mean money. So they have the highest and deepest liquidity and have proven recovery patterns over multiple cycles. For example, Bitcoin's 80% drop in 2018, followed by new all-time highs. Okay, so people, once again, if something's a valuable resource and it dips down, people are going to be hounding and fiending and hungry to buy the dips, because I know I definitely am. Okay, I just bought some Bitcoin today. Okay, so speculative meme coins. So assets with high returns during the bull run are often the first to lose all liquidity in a bear market, okay, making them highly dangerous accumulation targets. So focus on protocols with established ecosystems. Okay, for example, layer 1 networks and major DeFi apps. Okay, so let's get assets with high returns. Okay, during the bull run, the first to lose all liquidity in a bear market. Okay, so focus on protocols with established ecosystems, things that have been around for a couple of years, okay, and has some value. Something you can sleep on your investment. So that's one thing we want to think about in trading, you know? So sometimes we hop on the markets, we think about money. You know, that's the right mindset. We're trying to run up a bag, but sometimes we got to play it safe. So the safest trades, a lot of the times, what people don't know, the safest trades, a lot of the times, is what's going to make you the money. Okay, focusing on discipline, being as safe as you possibly can with your money inside of your account. A lot of the times that'll lead you to running up that big bag. Okay. So people are going to claim that market's going into a bear market when all it's doing is going in a downwards direction. Okay. It's people who think that market's going to run up infinitely, going up forever. It's extremely unreasonable. Okay. Market's going to obviously fall down, correct, even if it's a hard correction. You have to understand that there's people who've been invested in years, months, and many more days before you even thought about it or even got in. Okay, so we have to think about those players and how long they've been waiting to close. Okay, so that's why quote unquote bear markets happen. Okay, markets just selling off due to the fact that there's too much supply. Okay, people who got in way in the beginning of time are holding so much of it. They're like, all right, I'm going to take my money and do something with it. Okay, and hence, and then a succession of everyone doing it at the same time, okay, leads to a bear market, leading price to go in a downwards direction. So staking. Okay. So we'll talk about this in a second. But understand that the goal is really to increase your total asset count while the prices are low. So this is why I really promote the V. Okay. So market, it's going to fall by itself. Okay. Market's going to do its thing. And the left side of the V is going to be market falling. Now, once market makes a bottom of the V is when we want to look for a setup. Okay. Look on the weekly or the daily, look for the bottom of the V, and then catch the rest of the V gap fill. Okay. That's what you're going to be looking for. Okay, catching the rest of the V gap fill. So you want to buy something at a low ideally and catch a sweep up. Okay, buy something at a low and catch a sweep up. Okay, because if you buy something a lot of the times, okay, especially if you like an options trade, if you buy something at super all-time highs, okay, you can expect to get pulled back on. Okay, but understand that, yeah, certain positioning, it really does matter. Okay, especially if you're gonna buy certain things that you're not expecting to hold for years and years, especially if you're trading something like leverage crypto. Okay, then we want to go ahead and think about that. Okay, so yield farming. Okay, so providing liquidity to decentralized exchanges to earn trading fees and governance token. Okay, so that's going to be one of the things that some people do too. Okay, and that's going to be something that's just involved, but we don't really have to worry about that. Okay, as well as staking and then stablecoin allocation too, allows you to earn low risk, low yield while maintaining purchasing power for potential market dips. Okay, so there's going to be certain things you can do. Yield farming, you can pretty much kind of like the bank, get APYs, annual percentage yields on your money. Okay, if you invest in a certain cryptocurrencies. Okay, so you can do that. That's a potential option. I don't really recommend that. Buying spot or just buying normally in a normal broker is going to be just a lot safer too. Okay, because certain of these yield farm coins can go down and then you're not going to get certain of your returns that you expect back. But some of them do provide nasty returns like 40% per year and things like that, okay, on your money. So yeah, that's some things in the cryptocurrency space. So, okay, and then, but market will always recover. So even if market decides to go in a downtrend, okay, if something's a valuable asset, it's putting a smile on people's faces. Inshallah, if God wills, it'll hit a sweep back up. Okay, so following every 70%, right, major drawdown in Bitcoin, for example, people were thinking, oh, it's the end of the coin, it's the end, like it's over. And Bitcoin has not only recovered, but has gone on to achieve significantly higher all-time highs every single time. Okay, and the bear market is not the end. It's simply just the consolidation phase where people are just getting a opportunity to buy in. Okay, so it's just an opportunity. So bear markets are an opportunity. Hence why a large amount of millionaires were made in the 2008 recession, for example. Okay, how were millionaires getting made in one of the worst times for people? Okay, but it was really just the worst time for people who weren't investing. Okay, if you were investing during that time, you would have been able to make some really, really, really great money. So yeah. So this is why we take advantage of any dips now. Okay, any dips, we're going to go ahead and buy the lows, and then you can catch the whole sweep back up. So the bear market, it's just not the end. Okay, it's not the end. Especially if something is valuable, inshallah, you could expect to sweep up. So essential risk management and security. Okay, so self-custody is key. So let's talk about some crypto things right now. So let's talk about keeping our crypto safe. Okay, so keeping your crypto safe is gonna regard in a couple of things. So if you keep your crypto in a broker like Cash App or Coinbase, Kraken, or things like that, okay, they're safe, but if these brokers happen to shut down, then you lose access to your cryptocurrency, okay, or something like that. Okay, so you're not gonna have access to certain things. Okay, so what you can do eventually, okay, you can keep it on a broker like these for now as you stack up, but I advise once you get past like 4 figures to the 5 figures range, then go ahead and start. You can still buy on these exchanges, is what they're still useful for. But after that, I recommend moving your coins to what's called a cold wallet. Okay, so you could either use it's going to be a hardware wallet where you can actually physically plug it into a computer and then you can get access to your crypto. So those can be destroyed. That's the only bad thing about that. So again, we talked about certain things like the guy clearing the landfill, okay, looking for his cryptocurrency. Okay, so things like that are going to come into play. So you can actually just use a seed phrase. There's going to be certain things like Phantom, okay, Phantom on the Apple App Store. It's really, really good. It's just going to be like a ghost icon, okay, with like some eyes. And there it's going to be backed up by a seed phrase. And the seed phrase is going to be a 12 to 24 word seed phrase. And yeah, you can go ahead and just either write it down on pieces of paper, email it to yourself with a secure key, and just keep the code, spread it out somewhere. Okay. So you can do things like that. Okay. So cool. So now we're gonna be good. Okay, so we're gonna focus on bear markets and we're gonna be waiting for curls. Okay, we're not gonna think of bear markets as bad. We're gonna eyeball them. We're gonna see opportunity in that. Okay, we're gonna see the good in it. All right. So cool. So that's gonna go ahead and be that.
Trading options can really be crazy. You could be right directionally and still be losing money, and I know that can be extremely confusing. So I want to break down the Greeks for you guys. They're the factors that control your options P&L and your contracts. And if you don't understand the Greeks, you just aren't trading. You're donating money to Wall Street and the people selling you the contracts. So here's going to be the cheat sheet to the engine that actually drives your contracts. I'm going to explain delta, gamma, theta, and vega, and understand that you can't control the market, but you can control your risk and the math. Let's go and let's jump into it. Inshallah, if God wills. Before we even think about throwing $1 into options, we gotta understand the Greeks. Inshallah, if God wills. It's extremely important. You don't want to just be in a trade, seeing it go up, and you have some calls purchase, and you're like, why am I not making any money? It can be heartbreaking. It can be confusing. And I'm telling you guys, the science, the math behind these Greeks, once you understand them, you're going to be able to avoid a lot of things. So before we get started, let me go ahead and just tell you guys a quick little cheat code to help you with Greeks. Your time that you have as far as when your contract is going to expire on options is the most important thing. Stop trying to buy 0 DTE contracts and have extremely far take profits. Okay, that's not making sense. Okay, if you're going to play on the higher time frames and have further take profits, then you need to have more time on your contract. Okay, ideally, one of the best ways to play options is via leaps. Okay, you guys might have heard me talk about leaps before, but what leap contracts are contracts that expire in 1 to 2 years. Okay, when you give yourself years on your contract, you have so much time to sit and wait for price to reverse, because you have to understand that the United States stock market, it's meant to go in the upwards direction year after year after year. Okay, Amazon, Google, Microsoft, Apple, these are all global companies that are implemented in the whole world. Okay, but these are American companies. So the US stock market, which is based off of stocks, okay, which options derive from, has to go up year after year after year after year. So you have to understand that. Okay, you can't be closing your trades early because you're like, oh, it's just going down for a couple of days, couple of weeks. If you have time on your contract, because your risk on options is how much the contract actually costs. So if your contract costs $200, the max you could lose is going to be that $200, but the max you could win is going to be infinite. Okay, so putting everything into perspective like that really does help you. So your stop loss on options should be exactly how much you purchased the contract for. Okay, if you purchase a contract for $200, then on options, that should be your stop loss. Okay, don't close your trades early. Purchase time on your contracts. Okay, and use your stop loss as the full value that you purchased the contract for. And I'm telling you guys, watch how your trading will change. Let's go and let's jump into how these Greeks actually work though. So trading options is going to be kind of like driving a race car. You're going to have 4 main gauges on your dashboard. They're going to go and have your delta. Your delta is going to go ahead and determine how fast that you're going. Then you're going to have your gamma. Your gamma is going to determine how much your contracts are accelerating. Your theta is going to be your fuel tank leaking. Okay, for example, think of it as time. And your vega is how bumpy the road is. Okay, the fear, the intrinsic value baked into it.
understanding these Greeks are really going to change everything. Okay, let me go ahead and tell you guys a quick story. There's been a time where I was trading SPX. Okay, I was trading a 0 DTE, and what DTE stands for is date to expiration. Okay, so whatever the day is before you see DTE is how many days before the expiration. So if it's 0, that means that the contract will close on the same day. Okay, so the stock market is open from 9:30 a.m. Eastern to 4 p.m. Eastern. Okay, so in each time market comes up to 9:30 a.m. Eastern, that's another day that goes by. Okay, but if we're going to play a 0 DTE, then the contract has to be closed by 4 p.m. Eastern. So what I did was open up a SPX contract during a Jay Powell speech. I'm sure you guys have heard of Jay Powell, and was up around $930. The reason why I didn't win that trade is because of greed, pure greed. What I did was trade with P&L instead of looking at the actual chart and understanding Greeks, so I got burned anyways. So I didn't close the trade, one, because I was P&L trading, and I didn't understand the Greeks. Two things. Okay, so the first reason, I was on like $930 and didn't close it because it wasn't $1,000. I was trying to make 4 figures a day. Stupid mindset, I know. I was young. But thank God I learned. And another reason why I lost is because I just didn't understand the Greeks, truthfully. Okay, so SPX, I told myself, you know what, if I'm up $930 right now, but you have to understand that things work off of acceleration options. If you have a bunch of price action bursting really, really quick, happening fast, your contracts are going to be going up. But as soon as that contract slows down, starts consolidating, if you don't have enough time on your contract, okay, then your contract value is going to go down immediately. Okay, so if it's bursting in a certain direction that you have a contract based in, so let's say you have a calls contract, okay? Calls contracts mean that you're preparing for market to go in an upwards direction. So let's say you have a calls contract, right? If market's pumping up super duper fast, okay, even if you have an out the money contract, and what that means is, let's say a contract, let's say a stock is at $30, right? And you think it's going to go up to $35. Okay, if you buy a $35 contract, which is out the money, okay, it's not there right now, okay, then if price is bursting really fast, even though it's not near $35 yet, you're still going to see some profit. But once again, as soon as that price action starts consolidating and going sideways, your profit can instantly be wiped away from you if you don't have enough time on your contract. So having time on your contract, theta, is going to be one of the most important things. So try and buy contracts that are 1 to 2 years out. Okay, this is going to give you guys a lot of more flexibility and purchasing power to really do what you want with your contracts and how you want to trade on the markets. Okay, so let's go and let's break it down. So delta is going to go ahead and be the speed. Okay, so here's a definition. So if the stock price moves up $1, how much money would the option make? Okay, so if the stock price moves $1 and the delta is 0.50, then that means the option price would move 0.50. Okay, so 0.50 per dollar. Okay, so that means that every time the stock moves $1, okay, the options price would go ahead and move 0.50 cents. Okay, and remember, you want to go ahead and multiply everything by 100. Okay, so the options price 0.50 is going to go ahead and equal $50. Okay, that's going to go ahead and equal $50 once again. So you want to grab whatever decimal number you see on options and multiply that by 100. Okay, so 0.50 times 100 is going to be $50. Okay, if you're going to have 2.70 times 100, that's going to go ahead and give you 270. Okay, if you're going to have 4.50, you got to multiply that times 100. It's going to be 450. Okay, so whatever one of these decimal numbers that you see, you got to multiply it by 100. You have to. Okay, multiply all decimal numbers that you see in the options world by 100 in order to get the actual currency value of that. So think of delta as the concert ticket. So it's going to be the coupon, right? Imagine you have a coupon to buy a concert ticket for $50. Okay, and let's say the price rises. If tickets are sold out and scalpers are selling them for now $100, your coupon is now very valuable. Okay, that's high delta. And let's say the price drops, right? If nobody wants to go and tickets are $10, your $50 coupon is now worthless. Okay, that's 0 delta. So you want your delta to increase, because the more that your delta is increasing, the more that your contract is going to have more value behind it. Okay, but if price is dropping and your contract isn't working out in your favor, or it's not going in the direction which you have purchased, okay, so if you bought a calls contract and market's not going up, okay, then that means that the delta is going to help destroy your contract because your prediction is not right. Okay, but if your prediction is right, then the delta is going to go ahead and go up, deeming your contract valuable, making your contract more expensive, meaning you'll make more money. And gamma is going to go ahead and equal the turbo boost. So think of it as acceleration, right? Delta tells you your speed, and gamma tells you how fast your speed is changing. So think of gamma kind of like the nitro button. A super fast acceleration, okay? Think of this rocket ship. Boom, the turbo is behind it. So gamma is going to be like the nitro button in a racing game, okay? So you're speeding steady, and then you got to just burst, okay? That's what gamma predicts. So gamma makes your profits explode faster as the stock goes in your favored direction. So if you're on a calls contract, meaning that you're waiting for a price to go in the upwards direction, then the acceleration is going to help your contract make a lot of money, even if it's out the money once again. So let's say the current share price is going to be $30, okay? If you think price is going to go up to $40, okay, you don't buy a $40 contract, okay? What you're going to do is buy a $31 contract, okay? So always buy the number one above or below current price in order to have your Greeks move the best, okay? If you guys don't want to get destroyed by Greeks, do this. Buy contracts 1 to 2 years out, okay? Buy contracts 1 to 2 years out, and buy contracts, if you're buying a calls contract thinking market's going to go up, I don't care where your take profit is. If the share price is $40, the contract you should be purchasing is a 41 call contract, okay? That's just what you should be opening, okay? You should be opening a 41 call contract, okay? And if you're going to buy a puts, then you should be opening a $39 put contract, okay? So understand that in order to have the best Greeks as possible, you need to have the best contracts. You need to make sure that you have as much time as possible on your options contract. And on top of that, you need to make sure that your prediction is going to be hit fairly quickly or very likely to be hit. Even if it's more expensive, it's worth it. You don't want to just throw money into the void just because contracts are cheap. They're cheap for a reason, and they're plotting on you and preying on you for your understanding to not kick into your brain so that they can make some money. It's trading for a reason. These options contracts aren't just spawning. You have to understand that somebody is creating these options contracts behind. All right. So theta, it's going to be the melting ice cream, ticking time bomb. All right. Theta is extremely important. So time is money. And every day you hold an option, it loses a tiny bit of value. So once again, this is why I really put on emphasis on, if you're going to play options, try and buy contracts that have 1 to 2 years out. This way, you guys are going to be able to sit on your contracts with confidence. You're going to be able to hold it, and you're going to be able to do your thing. Okay. So theta is the time decay. So let's say day one value of a contract, right? Let's say you have a weekly expiration. So let's say you have a 7 DTE. Okay, 7 DTE. Let's go and let's break this down. So DTE stands for date to expiration. Okay, so the DTE tells you how much time is left. Okay, then the number tells you how much time is left. Okay, so if you have 7 days before expiration, then in 7 days, the options contract will disappear and it'll go ahead and be expired. Okay, and whatever you get, you get. Okay, if it closes in the money, which means that you're up some profit, then you'll get that. But if it closes worthless or down, then you'll just get the remainders. Okay, so understand that theta is going to be the time decay. So here's how our options contract works. So day one value could be $100, and theta decay could be -$5, right? And let's say the day two value could be $95, even if the stock didn't even move, okay? But because on options, you're getting paid based off of time and prediction, you could lose money during a chop. Okay, so if the market is sideways and it's not going in a direction, it's not like shares or crypto where your money will just sit there. Your option could be deemed worthless because you're getting paid based off of how fast and how right you're going to be. All right, so here's an example of theta, right? Think of it as a rental pass. So theta, let's say you have a 30-day pass. Say, imagine you bought a 30-day pass to a theme park. Okay, so day 1 versus 29. So on day 1, the path is worth a lot. It's jumping. On day 29, it would pretty much be almost worthless because the time ran out. The pass was only good for 30 days. Okay, so your options contract is only good for the amount of time that you purchase it for. So you want to be able to have as much time on it. Try and have some years on it. This way, if anything goes wrong, any type of speeches, with any type of government shutdowns or anything that affects the market, that would make the market move in a negative reaction from whichever way that you purchase, okay, then you'd be able to survive that. Okay, you wouldn't just be getting destroyed. Okay, so when you have time on your contract, instead of having a 30-day pass, imagine having the 3-year pass or the 2-year pass. Okay, the 30-day pass is not long enough. Okay, so the lesson, don't hold on to options that are worthless. Otherwise, pretty much they're going to just melt away anyways. Okay, so buy your contracts 1 to 2 years out. Okay, try and buy them 1 to 2 years out, and make sure you have your take profits too. Okay, so that's also what I mean by don't hold them too long. You should know exactly where you're going to close. Options is extremely strict. It's not like crypto and shares where you can just sit there and hold it forever. Please don't do that. You need to have a strict place exactly where you know you're going to exit. Okay, you need to know where you're going to go ahead and exit, get your money, and close and hit take profit. Okay, once you do that, it's going to be a lot easier to go ahead and progress. Okay, do not sit there and try and hold your options forever, especially once you start seeing profit. Horrible mistake I've made in the past, and inshallah, if God wills, that's not something I want you guys to experience. Okay, so please have an exit plan, know where your take profit is, and please close your trades. And Vega is going to be the fear index. So think of Vega as hurricane insurance, right? Vega measures how expensive options get when people are scared and horrified. So on a sunny day, insurance is going to be cheap, right? That means that the Vega is low. But when a hurricane is coming, okay, whether it be earnings coming, a big news event, whatever, the insurance is going to be expensive. It's going to raise, and that's going to lead to high Vega. So even if your house is fine, the price of insurance goes up because of the storm. Okay, so you guys might have heard of the term implied volatility. Okay, so when earnings come up or when big events come up for stocks, the options value could shoot up due to the fact that people are preparing for a big move. Okay, so there's a lot of cool plays you can make in options too. So instead of actually playing earnings with certain stocks, if you buy a contract before earnings, you might make a lot of money, but then after the earnings, it might go away just because of the hype and expectations. So people are preparing for the future, and that's why options are even a thing in the first place. So certain times when people are preparing for the futures between a big hurricane event that's going to change a lot, your price of the contract could change regardless if it's in the money or out the money. So very cool things you could do with options. So think of Vega as the earning party, right? So before the party, everyone's excited, right? The price for tickets go up. It's a lot of high volatility. Everyone's hyped. It's jumping. It's good music playing. Everyone is getting turned. Okay, but then after the party, the event is over and the excitement is gone and ticket prices crash instantly. Everyone was like, all right, that's it. We already went. It's not lit anymore. Forget it. Okay, so don't buy options right before a big news event. And if you do, make sure that you sell before the big news event. Okay, you do not want to be in a short-term options plays during news. Okay, this is why I also say try and buy contracts 1 to 2 years out. Okay, because if you're playing on your higher time frames, like your daily, your weekly, or even your 4-hour, okay, right, you're gonna have bigger take profits, right? And there might be earnings in between that, which is gonna be amazing, just fine. Because a lot of the times earnings will benefit you if you're playing the right direction. But if you have 1 to 2 years out, you're not going to be getting destroyed by things like news and certain events like that as easily. Why? Because you have so much time on your contracts. So having time on your contracts kind of wipes out all the negatives of options. Have some time on your contracts and buy reasonable contract too. If the current price is 40, contract you should be purchasing for calls is 41, for puts is 39. Okay, you should always buy the number 1 above or below. That's going to be the best way to avoid these Greeks destroying your profit. I don't want you guys going through any of that weird cringe anxiety or anything like that. Okay, you guys got it. So let's go on this recap. Let's jump into it. So Delta is going to be the speed, right? And it moves with the stock price. Then you're going to go ahead and have Gamma. Gamma is the nitro. It's the thing that accelerates your wins or your losses too. And Theta is going to be the melting time. Okay, it's the time that eats your money. Okay. And then you're going to go ahead and have your Vega. That's the storm. And fear makes prices expensive. Okay. So if it's about to be a big news event and you notice your contracts shoot all the way up, try and sell before news events. But if you're playing a higher time frame setup, you know what you're looking at, whether on your weekly, daily, or 4-hour. And if you don't, head over to Stackmode.net. I'm here to teach you guys. Okay. Whether you guys want to learn how to trade options, futures, crypto, or whatever, I'm down to get into it. I love you guys so much. Stay prayed up, stay high. Keep grinding. I'm gonna catch you guys in the next one. Peace.
Dividends. Let's talk about it. How can you guys pretty much live off of just your money, infinitely making you more money in retrospect? Let's talk about it. Dividends decoded. The path of income. So the quest for passive income. Let's define financial freedom. So income without labor. So passive income, and I know you guys have heard of it. What is passive income in the first place? Passive income is money earned regularly with little to no ongoing effort. This is distinct from actively trading stocks or working a job. Dividend investing focuses on making your money work for you. So the challenge of inflation. Inflation erodes purchasing power, and a successful passive income strategy must aim to generate income that not only covers living expenses, but also grows fast enough to outpace rising costs over the long term. So why do dividends matter within the first place? So they give you reliable cash flow. Dividends are regular payments that are paid and made by companies to their shareholders, and they can provide predictable cash flow, which is crucial whether you're reinvesting or funding the current expenses. And let's talk about the compounding effect. When you use dividend payments to just buy more shares of the dividend, the next payment will be even larger, inshallah. And this is the magic of compounding, exponentially accelerating your portfolio growth over decades. So for example, imagine receiving a $100 dividend payment. If you spend it, the growth stops. But if you use it to buy more shares, let's say a dividend costs $50 a share, a dividend ETF, right? Let's say hypothetically, for example, you invested into Stackmode ETF, right? Let's say it existed. All for example, okay, Stackmode ETF costs $50 and you make $100 on the payout. You could buy 2 more shares of Stackmode ETF because it costs $50 a share and you got $100 from the payout. Okay. So stack it up, stay in Stackmode, stay down. Keeps it fun, keeps it fresh. So the corporate distribution of profits. So definition and source. A dividend is essentially a distribution of portion of a company's earning, decided by its board of directors and paid out to its shareholders, and it reflects the profitability and financial stability of the underlying company. So let's talk about the dividend yield. The yield is the annual dividend payment divided by the current stock price, expressed as a percentage. It is a key critical metric for income investors, showing the return on investment purely from the dividend income. So the payment frequency. So in the US, most companies pay dividends quarterly, all right, let's say for 4 times a year. However, some firms pay monthly, which provides smoother income, and others pay annually, okay? So if you're getting paid monthly dividends, then you could budget out your bills, for example, based off that income. Some dividends only pay annually once a year, and some dividends pay quarterly, okay? So every couple months. So the dividend safety. The most important factor is the company's ability to sustain and grow the payout. Investors often examine the payout ratio, dividends paid by dividend earnings, to ensure the payment is covered by current profits and is not at risk of being cut. So a high yield is going to be attractive, right? But a growing upwards dividend is generally better than a high but stagnant one. And companies with long track records of increasing dividends are often referred to as dividend aristocrats or dividend kings. Okay, so you want to be playing a dividend that's increasing in size. More people are investing into it year after year, and it's making good consistent investments, and it has a good bundle of stocks within the ETF. So key dates and dividend types, let's talk about them. So 4 crucial dates: the declaration date. So the day the company's board announces dividend payment, specifying the amount, record date, and the payment date. And we'll talk about the ex-dividend date. This is the most critical day. To receive the dividend, you must own the stock before the market opens on this date. And on this day, the stock typically drops by the amount of the dividend. And the record date. The company list of shareholders eligible to receive the dividend is finalized. And this is generally 2 business days after the ex-dividend date. And the payment date. It's the day the dividend is actually accredited to your brokerage account, so you can actually go spend it, withdraw it, and put it in your bank account. And types of payouts. Cash dividends. The most common type. This is a direct cash payment deposited in your account, either in US dollars or the local currency. And stock dividends. The company pays shareholders in additional shares of stock rather than cash, and this increases the number of shares you own, but reduces the per share value. I want to talk about special dividends. It's a one-time non-recurring payment, usually much larger than a regular dividend, often resulting from a major cash windfall, a asset sale, or extraordinary profits. So for key distinction, the ex-dividend date is what truly matters for investors in the long run. If you buy on or after this date, you miss the current payment. If you sell on or after this date, you'll still receive the payment, for example. So let's deconstruct the exchange traded fund. Okay, once again, ETF stands for exchange traded fund. So class, it's an instant diversification tool. It pretty much gives you a basket of assets. So an ETF has a collection or a basket of dozens, hundreds, or even thousands of individual stocks, bonds, or other assets. When you buy one share of an ETF, you gain ownership in tiny pieces of all the underlying assets. And it trades just like a stock. So unlike traditional mutual funds, ETFs trade on stock exchanges throughout the day, just like an individual stock. This gives them greater liquidity and pricing transparency. And the low cost and transparent. And the expense ratio. So ETFs are generally low cost vehicles. The expense ratio is the annual fee charged by the fund, expressed as a percentage of your total investment. The lower, the better for long-term returns. And passive management. Most ETFs are passively managed, meaning that they simply track an index, like the S&P 500, for example. Or Bitcoin. Some ETFs track cryptocurrency as well too. And these keep management costs low comparatively to actively managed funds, which try to beat the market. So there's going to be crypto ETFs, tech ETFs, ETFs that focus on power companies, etc. And a focus on diversification. The greatest benefit of ETFs is diversification. If one stock in the fund performs poorly, the impact of your overall investment is minimal because it's balanced by hundreds of other holdings. And this significantly reduces risk. It doesn't always have to be hundreds, it could be however amount the ETFs has in their basket. So the powerful synergy, right? Dividends plus ETFs, crazy. So check it. Safety in numbers. So mitigating payout risk. If you invest in a single high dividend stock and the company cuts its dividend, your income stream is severely damaged. And a dividend ETF holds dozens of these companies. So if one cuts its payout, the overall effect of the ETF's dividend income is negligible. Okay. And reduced volatility. So dividend paying companies are often more established and financially stable, leading to less volatile stock prices compared to high growth, non-dividend stocks. Combining these steady stocks into an ETF smooths out the ride even more. And we'll talk about the ease of income generation. So simplify management. To create a diversified dividend portfolio manually, you would need to buy 50 to 100 individual stocks and manage all their dates and tax paperwork. Okay, so that's how you would have to do it normally. An ETF pretty much does it all for you, simplifying the investment process immensely. So it gives you a nice monthly income stream, especially once you have enough money invested into it. And each ETF pays out a different dividend amount. Do your research before you invest. So many dividend ETFs are structured to pay out monthly rather than quarterly, providing a more consistent and easier to budget income flow for those relying on the payments in order to live off the what's called passive income. But a lot of times you have to do something active to get the passive income. Okay, so it's like you get to retire by making the right decisions, inshallah, if God wills. So think of an ETF as a pre-made high quality soup. Instead of spending hours buying and preparing 50 different ingredients and hoping the recipe works, you buy the ready-made dividend soup with proven ingredients and a consistent flavor. Okay, so making it a lot simpler. So accelerating growth, dividend reinvestment plans. So automating the compound process. What is DRIP? Okay, a DRIP automatically takes the cash dividend you receive and uses it to purchase more shares or fractional shares of the same ETF. This happens automatically, removing the need for a manual intervention. So long-term wealth accumulation. Then reinvestment phase is critical during your accumulation years. And by automatically buying more shares, you are increasing your share count, which means the next dividend payment will be significantly larger than it would have been otherwise. And the power of fractional shares. Most brokerages allow ETFs to be bought in fractional shares through a drip, and this ensures that every penny of the dividend is put back to work immediately, maximizing compound from day one. The transition to income. When you enter retirement and need the income, you simply turn the drip feature off, and the dividends will then be paid out to you as cash, providing a regular passive income stream. So here's a crucial tax note. All right. So even if you reinvest the dividend using a drip, the IRS considers that dividend income to be income that you receive. You must still pay taxes on it the year it was paid, unless the investment is held within a tax advantaged account like a Roth IRA or 401k, which also have limited amounts that you can put into it per year. So keep that in mind. So dividend ETF categories, tools of the trade. So let's talk about dividend growth ETFs. So the focus of them. The companies with long history of increasing their dividends, and the goal of them is to increase the total return and have an inflation-proof thing that people can invest into safely. And the benefit of them, you sacrifice high current yield for faster dividend growth, protecting future purchasing power. For example, funds tracking companies that have raised dividends for 10 or more consecutive years. And high yield ETFs, they're stocks with the highest current dividend yield and the maximum immediate cash flow involved with them is going to be super duper heavy compared to the other ones. And they have a higher yield, which often means higher risk, and these companies may be in declining industries or struggling financially. And these funds are concentrated in real estate investment trusts or certain utility sectors. Now let's talk about the sector-specific ETFs. It's concentrated exposure to sectors known for high payouts, and it's targeted income and diversification within a specific sector. And it reduces broad diversification, yields higher returns, but has a higher risk specific to that entry. Okay, so if you're in a crypto ETF, for example, okay, and crypto's in a downtrend in a bear market, you would go ahead and fix that. Okay, but that's just how trading works in general. So for example, you're gonna have utility ETFs, consumer staples ETFs, financial sector ETFs, crypto ETFs, etc. So figure out what you want to invest in. So building your income portfolio, let's talk about it. So one, some step-by-step implementation. So identify your goal. What do you guys want to do? How much do you want to make? And what do you want to do in the first place? Okay, determine how much annual income you require for retirement. How much do you need to pay your bills? How much is your rent or mortgage, right? How much is your internet, your car, etc. Okay, and use the 4% rule or similar withdrawal strategy to estimate the portfolio size needed. So select the ETFs that collectively provide a realistic, sustainable dividend yield, typically between 2% and 5%, and avoid extreme yields unless you fully understand the underlying risk and what you're investing in. And automate contributions. Set up automatic monthly contributions from your bank account to your brokerage account. Okay, if you want to do automatic, or you guys can do manual, up to you. Just put yourself on a consistent schedule. Keep putting money away and get into stack mode. So consistency is the most important factor in long-term success. And activate the drip if you can. And ensures that all dividends are automatically reinvested to harness the power of compounding until the day you need to rely on the income. So a portfolio example, right? Some hypothetical allocation. Okay, so let's say 50% core dividend ETFs. You could do 30% a high yield dividend ETF, and then 20% like a global real estate ETF or a crypto ETF. And that's just for example. Do your own research, but that's just how someone would break down the portfolio. So your job is only to contribute regularly, get into stack mode, wake up, pray to God, stay humble, put the money away, don't look at it, hide your balance even, okay? You can actually put your balance on all dots, hide your balance, just deposit, keep stacking, okay? Stay down and live off a minimal amount, okay? Make it fun, make it hard, make it challenging, okay? And periodically rebalance the portfolio to maintain your desired allocation. And the ETFs manage hundreds of underlying stocks for you, or depending how many the ETF holds. And some tax implications, right? Let's talk about where to hold your assets. Taxable accounts, right? Brokerage accounts. So qualified dividends. These are taxed at a preferential long-term capital gains rate, which is 0%, 50%, or 20%, which are typically lower than ordinary tax and income rates. And non-qualified dividends. These are taxed as ordinary income at your current marginal tax rate. This includes most dividends from real estate investment trusts, REITs, and foreign companies. So we'll talk about some tax advantage accounts though. Roth and 401ks, okay? They can be ideal for dividends, but keep in mind that Roth and 401ks are gonna be limited. So Roth IRAs, as of when this video is gonna be recorded, is gonna have around a 7K limit per year that you can invest in, okay? And then when you're 50 years old, Plus, then you could do 8K a year. Okay, and then you're gonna have the 401k. And 401k, you're gonna be able to invest, I think it's around like 23,500 if I'm not mistaken, and then it increases to like 31,000 once you're 50. Let me know in the comments below, but pretty sure that's it if I'm not mistaken. But some traditional accounts, tax deferred. So dividends grow, right? Tax deferred. It's where you pay no tax on them until you withdraw the funds in retirement, at which the entire withdrawal is taxed as earned income. Keep in mind, these numbers could change, and this is just as of 2025 when this video is being recorded. So strategic placement. It's highly recommended to hold your highest yielding non-qualified dividend ETFs like REIT's funds inside your Roth accounts to shield the highly taxed income from the IRS forever. So conclusion, the dividend blueprint, right? So the combination of dividend income and exchange traded funds creates a powerful, simplified, and resilient passive income engine. So you can diversify. Use dividend ETFs to gain exposure to hundreds of dividend paying companies instantly, mitigating the risk of a single company cutting its payout. And reinvest, right? Harness compounding by activating dividend reinvestment plans, also known as DRIPs. Okay, not talking about clothes. Until you guys are ready to transition from the accumulation phase to the income phase. And optimize your taxes. Prioritize saving for retirement with a Roth account, as all dividend income and growth within it will remain permanently tax-free. So the combination of dividend income and exchange traded funds creates a powerful, simplified, and resilient passive income engine. Decide what you want to invest in, do your research, and if you need some help deciding what you want to invest in, you can head over to stackmode.net. Stay prayed up to God, keep grinding, and I'll catch you guys in the next one. Peace. Hey class, today we're going to be talking about exactly what a hard fork is within the decentralized finance space. Let's go and let's jump into it. So, code consists in chains, and at its simplest, a fork in the blockchain technology refers to a change in the network protocol. This change usually involves updating the software used by nodes to validate transactions and blocks. A key distinction must be made between a simple software fork, and that's copying open source code, and a protocol fork, which changes the consensus rules. So, a software fork, code-based copy. So the definition of a software fork is it copies an open source code base, for example, Bitcoin Core, to start a new, often compatible project. And the impact of it does not affect the original blockchain's history or consensus rules. It creates a new independent project. And for an example, Litecoin. It was originally a fork of the Bitcoin code base, but now it operates on its own chain. Let's talk about a protocol fork. Consensus change. And the definitions of a protocol fork is it modifies the rules that govern which blocks and transactions are considered valid on a single blockchain. And the impact of it directly affects the chain's integrity, leading to a split in the network's block history. And the outcome of it is it requires all participating nodes to update their software to maintain network harmony. And the core difference lies in the shared history. A protocol fork shares the entire history up to the point of divergence. So, the critical distinction. Let's talk about soft forks versus hard forks. So understanding the difference in compatibility is paramount to grasping blockchain evolution. And this dictates whether the upgrade creates one chain or two chains. So a hard fork, non-backward compatible. So as far as a rule change, it introduces new rules that are incompatible with the old software. And the mandate of it, all nodes must upgrade and old nodes will reject blocks created by new nodes. Okay, so all nodes must upgrade. The old nodes will reject blocks created by any new nodes. And the outcome, if the community is divided, which is gonna be caused by lack of 100% adoption, the chain will then split permanently into two separate blockchain, A and B, each with its own currency. And as far as the hard fork, the non-backward compatible system, both chains share the same history up until the block of the fork. And let's talk about soft fork. Soft forks are gonna be backwards compatible. And the rule change implemented into it is that it tightens existing rules, making a previously valid block invalid under the new rules. And mandate, only a majority of nodes need to upgrade, and old nodes will still accept blocks from new nodes because the new blocks satisfy the old and stricter new rules. And the outcome of it, The network effectively remains one chain, and the old chain slowly dies out as the new blocks are not recognized by the majority, forcing compliance into it. For an example, Bitcoin's SegWit, and SegWit stands for Segregated Witness, and that was a classic soft fork implementation. So a lot of these things that we do know were actually fork implementations that just stuck around. So let's talk about this case study here. Bitcoin Cash, for example. Bitcoin Cash, also known as BCH, okay, the scaling schism. So the split that created Bitcoin Cash, BCH, on August 1st, 2017, it's the most famous example of a contentious hard fork rooted entirely in a debate over scalability. And the problem is Bitcoin block size. The original Bitcoin protocol restricted the block size to 1 megabyte, limiting transaction throughput to about 7 transactions per second. Okay, transaction per second can also be abbreviated as TPS, which leaded to high fees, also known as gas. So the term gas equals fees, leading to high fees and slow confirmation times. So that was way too slow. Okay, wasn't quick enough, and it had to get quicker. So the division, the two scaling facilities, so core devs at Bitcoin, preferred off-chain solutions like SegWit, also known as the soft fork system, and Lightning Network. Okay, BCH proponents preferred on-chain scaling via an immediate increase in the block size limit. And the outcome, a permanent split occurred. Since changing the 1 megabyte limit was non-backwards compatible, the minority group implemented a hard fork to increase the limit to 8 megabytes, later to 32 megabytes. Okay, so as technology increases and technology gets more powerful, the whole decentralized space changes. And it results in two chains, Bitcoin, also known as BTC, and Bitcoin Cash, which is going to stand for BCH, and the technical impact between the two. The hard fork ensured that any node running old Bitcoin software would consider BCH blocks, which were greater than 1 megabyte and invalid, physically separating the two chains and their stories post-fork. So let's talk about case study number 2, the Ethereum classic, the ETC, the ethical split. So the Ethereum fork that created Ethereum Classic, ETC, on July 20th, that occurred in 2016, it was not about scaling, but about philosophy and dealing with an economic exploit. So let's talk about the DAO incident here. So the DAO incident, which occurred in June 2016, and a decentralized autonomous organization, also known as a DAO, is built on Ethereum, and it suffered a hack/exploit. So people got into it, breached the database, and it drained roughly $50 million worth of Ethereum at the time, okay, worth of Ether, due to a vulnerability in its smart contract code. So the smart contracts are going to be the autonomous system that controls the whole decentralized system. So in a centralized system, banks control everything. They can confirm whether or not transactions go through or not, and they control the reserves. Within the whole smart contract decentralized blockchain system, everything is done autonomously on a smart contract system, kind of like a vending machine. So, but hackers were able to get into that due to the fact that the security system was a lot weaker about 10 years ago from this video dropping, and it's only increasing as developers, AI, and coders notice more exploits and prevent them. Alhamdulillah, God is good. So, proposed solutions. The Ethereum community largely voted to implement a hard fork to roll back the chain history and return the stolen funds to their original owners. Okay, so they were able to roll back the history and roll back people's funds back to them. So extremely nice. God is good. So the principle of it, code is law. A minority group of community members rejected the fork on the basis of immutability and the code is law principle, arguing that interfering with the chain, even due to undo a theft, set a dangerous precedent. And we'll talk about the split. The majority moved to the chain, called Ethereum, ETH, and the minority remained on the original unforked chain, which was renamed Ethereum Classic, also known as ETC, preserving the hack history. So, this case illustrates that hard forks are not just technical. They often involve deep ethical and philosophical debates about decentralized governance and immutability. And once again, the decentralized space is going to involve no superpowers. Everything's going to be done by pretty much AI, computers, and smart contracts. So why hard fork? Let's talk about the rationale and objectives of it. So while often continuous, hard forks are sometimes necessary for the survival or significant evolution of a decentralized protocol. They're generally triggered by three main factors. Let's talk about the first one. So they introduce new incompatible features, okay? And when major changes are needed that fundamentally alter the way transactions or blocks are structured, for example, changing the hashing algorithm, introducing a new scripting language, or integrating privacy features, the old software simply cannot interpret the new data structure. So number two, fixing critical security bugs, extremely important to keep our money safe, okay? Inshallah. So if a critical vulnerability is found that could compromise the entire network, causing a catastrophic bug, a scheduled hard fork might be the fastest way to implement a necessary fix that prevents further exploitation, often involving a protocol reset so people can get their money back if anything was lost in the first place. And they reverse malicious transactions. Controversial, okay, but could be necessary in certain cases where, once again, people are trying to take people's money unfairly. And as seen with the Ethereum ETC, Ethereum Classic, a fork can be used to bail out a network after a significant loss of funds, effectively rewriting the history of the chain to reverse the malicious transfer. And this always raises governance questions because, people can just reset and roll back transactions. But if it's used in a responsible way, I can see how it could be safe. But then again, would this be centralized? Let me know in the comments below. So hard forks that are planned and implemented with full community backing, like Monaro's regular updates, are often called non-contentious hard forks. So implications for users, exchanges, and developers. A contentious hard fork like Bitcoin or Bitcoin Cash, it has massive downstream effects on the ecosystem, requiring coordination across various entities. And the user impact of it, free coins and confusion. So coin duplication. Holders of the original coin automatically receive an equal amount of the new coin on the new chain. So for example, Bitcoin holders got BCH. And wallet management. Users must ensure their wallets support coin splitting and replay protection to safely access the new coins without losing the old ones. And market volatility can also be a factor. The value of both coins often experiences extreme volatility immediately post-fork as markets decide which chain to support. And the impact of the ecosystem, let's talk about the exchanges and developers. So exchange listing. Exchanges, which is pretty much places where crypto tokens and stocks can be listed, exchanges must decide whether to list a new coin, requiring significant technical work to ensure stability and implement deposit, also known as withdrawal infrastructure, okay? And replay protection. Developers must implement measures to prevent a transaction validated on one chain from being replayed and validated on the other, and that's crucial for security purposes. And development resources. The talent pool is going to be split, potentially weakening the development resources and future progress of the original chain in the first place. So, hard forks, while disruptive, they represent the ultimate form of decentralized governance, and they're the mechanism by which communities can execute fundamental disagreement, allowing different ideological and technical visions to coexist. So, some key takeaways. A hard fork is a non-backwards compatible protocol that change based on the results, and it results in a permanent chain split unless 100% of the community upgrades. And they're often driven by three factors. 1, feature upgrades. 2, security fixes. And philosophical disagreements. Okay, for example, scaling or immutability. And some key examples of a hard fork are Bitcoin Cash, okay, over scalability, and Ethereum Classic over immutability, following the decentralized autonomous organizational hack. And they forced the entire ecosystem, users, developers, miners, exchanges to make a binary choice and adapt to a new reality and choose what's best for them. Stay prayed up to God, keep grinding, head over to stackmode.net for all trading education. I'll teach you how to trade cryptocurrency. Peace.
It's 2026. What's going on? We're back in the Stackmode community, and first week, I just wanted to go ahead and recap and let you guys know what the business is. So we're up about 6% so far in the first week of 2026. I'm going to start doing a recap kind of once a month, just updating you guys on my P&L. Sometimes twice a month, showing you guys like the first week what my plan is, and then showing you guys like the end of the month result and showing you guys progression on how to start an account from nothing and grow it into something. So here, focusing a lot on AI stocks, tech stocks, and
stocks that really have stuff to do with the future is really what I'm going to be going forward with this year. So a lot of people like to invest in stocks that have been around for decades and years and stuff like that. Me personally, I like to invest aggressively. This year, I'm going to be really focused on shares as well too, pretty heavily compared to options and futures like I have in the past. I'm really going to be just trying to go hard on shares this year, scouting out good companies, finding good buys, purchasing them, and just holding and sitting on my trades. That's noticing it's been working out for me really well. Been able to grow my account at a relatively fast pace. Been really happy with the profit. And one thing I really like about swing trading shares compared to options trading or futures trading is whenever you're swing trading shares, you can just sit back and chill on your trades. You don't have to worry about time, no expirations, no getting margin called. You could just buy your shares, sit and hold, and that's it. That's all you absolutely have to do. And taking your time on shares, trades, and scouting out the companies that are going to be making the most ample progression within our societies, getting rewarded for that, getting rewarded for your research, for your knowledge, for knowing to not buy at all-time highs and to buy at certain low areas. The reward that you get from shares compiled with the risk factor that's pretty much taken off, because say options, for example, I've changed my whole mental mindset. When it comes to options, people can pretty much sign a death contract. Your contract is pretty much locked in. It has to hit or it's going to miss. Okay, that's 100% just what it is with options. With shares, as soon as you buy, your money will fluctuate over time. But one thing about it is that you 100% do own. If your options is not going towards your directions, you're going to be losing. Okay, even with shares, if it's sideways or moving slowly towards your direction, you're still going to have all your capital. If you put down an options trade with not enough time and it's moving slowly towards your price direction, but it's still moving, okay, either A, your price is going to go negative on the contract due to theta and time decay, or your profit's going to be moving extremely slow and not how you want it. Also, another reason why I'm focusing on shares instead of options this year too is that at a certain point, when you get too rich, you can buy all the options contracts for most stocks that you're looking at. Okay, so that's why billionaires have to play shares. So I'm trying to get to the financial point to where I'm one of the best traders. Okay, so personally this year, I'm going to be focusing really heavily on shares. Got Bitcoin, of course, and in order to generate income, maybe later down the line towards this year, first couple months within the year, I look forward to playing some futures as well too. Okay, so I look forward to playing some futures within that. And I'm just going to be fully transparent with you guys at all times. I want to just show you guys stats, show you guys what I'm holding, and show you guys how I plan to continue to go forward. So let's go and let's jump into some performance, inshallah. So jumping into the stats here. So compiling an account, guys. Okay, I want to show you guys what it looks like starting an account from 0 to 4 to 5, 6, 7 figures. I want to just be fully transparent with you guys and show you guys how it's done. So starting here, you could see just have this account here, kind of restarted it July 2025-ish. Okay, started growing it throughout this time, just reinvesting income from business, winning trades, adding over a single time. Okay, and as you can see, P&L is just heading in an upwards direction month after month after month after month. Okay, so your work income, your business income, or even your options and futures income should be funneled back into your account. Funnel it back into your account. Say your business, for example, if you're doing 5K a month in your business, okay, try and take 4K a month of that, okay, and invest it. Okay, you could put maybe 2K in the crypto, 2K in the stocks. Just try and break it down and invest what you're making. So your P&L is always going in an upwards curve. Okay, every time you guys get some money, try and invest. And then as you win trades, okay, there's going to be times where you may lose, okay, but then you're going to win more trades, get in different seasons, and continue to uptrend. Okay, if you feel like you have to invest every single time you get some money, then do that. Do that. Okay, I'm absolutely addicted to investing. I'm going to keep it 100%. Okay, shares is not something that I played past 2-3 years. Yeah, shares is not something that I've
played or really looked at. It's really just been a lot of options in futures. I played options on Robinhood, TradeStation as well too. So I have some stats just spread across everywhere. But as far as Webull, I want to just use it for my shares portfolio. And I just want to be just fully transparent with my portfolio and how I plan to upscale it. Okay. So when you guys are growing your account, right, patience is going to be the number one thing. Okay. It's going to take time for you to know how to identify the setups you need to take. I recommend you guys go to stackmode.net so you guys can get with my trading mentorship, so it doesn't have to take you a long time in order for you to understand what a decent setup looks like. But I went through a lot of unnecessary losses early on within my trading career due to the fact that I was just being uneducated and being impatient and being stubborn. Okay. So completely my fault while I was struggling in the beginning, but once I started getting my foot, I was able to go ahead and progressively increase my P&L year after year after year after year. Okay. So all your business income, all your work income, okay, after your bills are paid, of course, and make sure you guys are reinvesting the profits from the trades that you win. So your income vehicle generating skills are going to either be your options or your futures. Personally, I'm going to go with futures this year. I've played options for a few years and I like just the stability of futures and how you can just turn dirt into diamonds. Same thing on options too, but the time decay factor and stuff. But I don't know. I'll see even this year if I'll even touch futures or options at all, honestly. I might just stick 100% on shares, find little small caps, and just really try and turn up like that. And just continuously do my research on these stocks and these companies and try and catch some stuff at the lows. I'm really having fun doing that, finding the best companies and playing shares. Just really been having a blast. Options, it's really funky with options. Options has a lot of derivatives built into it. Price could be going in your direction and you could still be down due to multiple factors, due to like how much volume a contract has, etc. And all that stuff is just really ghetto, especially when I'm trying to protect and provide for my family. I don't really want little random factors determining whether or not I'm going to get paid. So I like shares a lot, even when if I, inshallah, God wills, if I cross into like the 10 million plus range, 50 million plus range, I can comfortably trade shares, even as a 100 millionaire into billions of dollars. Okay, due to the fact that shares are going to be pretty much always available for the most part. So shares are really just my favorite instrument. This year, I'm focusing completely on shares. 2023, I played a lot of futures. 2024 was a lot of options. Same with 2025, was a lot of options as well too. 2026, let's swap up the game. Going to be focusing on shares. I've been finding some success recently in just investing in little tech stocks and stuff like that. And just, I want to just break down and give you guys full guides on what I do to find the stock that I want to play, why I'm getting in said stock, and what I see in said stock within their future, right? So is this stock even going to be half decent in the first place? And as you guys can see, this is completely live. P&L, you can see it moving up here. Market is closed right now though. So yeah, that's going to go ahead and be that. So keep all of that in mind. And let me head over to the positions here. So this is what I'm currently holding. Okay. We got some Path right here. Path is a stock that is been in the works in the limelight recently. I bought some more at like 16, but I sold some a couple of days ago. So we got Path. That's one thing that I am holding. Once again, bought it at around 17.75. Let me get on my higher time frames here. So on my higher time frame, I could see we IPO'd all the way up here at around 90. So I liked that a lot. So I can see a lot of upside room, at least to this 30 area here. They've been getting a lot of funding. I see higher lows being put in. So Path, really happy there. Excited to go ahead and take that
up as well. Let me go ahead and open up NVTS. So we got NVTS here as well too. NVTS, this is one I'm really excited for. So we're currently at 10.31 right now. We got price trying to head up. I bought around 9.89 right here. Okay, and once again, we got price heading in upwards direction. We IPO'd. IPO stands for initial public offering, which is where the stock decided to open at. So we IPO'd at around 22.19, and it looks like price just made this high resistance at around 17.82. So yeah, we're gonna go ahead and wait here, and wait for price to go ahead and catch up, do its thing, and then we should be able to make some good profit on this as well too. So I like this a lot. Big fan of NVTS here. They collabed with NVIDIA, and that NVIDIA collaboration, of course, helped it a whole bunch. Whenever we're collabing with NVIDIA on certain things, of course, that's going to be, pretty successful for us to be looking forward for the most part. So NVIDIA is going to be one of the biggest stocks, and I personally sometimes like to look at stocks that NVIDIA is collaborating with, or say Apple or something like that. Any big world-leading stock, if they're making collaborations with other stocks, I like to look into those too, and then I like to see if profit can be made. So EOS as well too. This is an energy enterprise stock, about around 14.22. Price is trying to push up here. Let me get on my monthly time frame here. So I can see price decided to IPO at this 31 area up here, 0.95. And we just recently created this area of resistance here at this 19.91 area up there. Okay. So just waiting for price to go ahead and go up. Feeling this area here. And I could see here, even on the weekly, I could see higher lows being put in constantly. Okay, constantly. We got constant higher lows being put in. Okay. And it's really just taking heed, noticing price how it goes up, goes down, goes up, goes down, and continues to just spam that. Goes up, goes down, comes up, comes down, and it'll just continue to spam that over and over and over again. Inshallah, especially since this seems like a half decent stock that people will care about. And once again, this is an energy enterprise stock, so I like this one a lot too. Price looking to swoop up. Let me head over to IONQ. Big dog right here. So IONQ, one of the leading quantum stocks. We just had a burst to this area of resistance at this 84 here. So as soon as I saw this higher low get put in, I was like, oh yeah, let me go ahead and hop in those. So that higher low, I loved it a lot. Was a big fan that I put in right here at this area. So as soon as I saw that, I was like, okay, price is looking to progress. And even after that, it came up, made new resistance, it came down, and then made some new support. So I like that a lot. Even if I head over to my 4-hour here, let me turn up the poo-poo time frames. Get on my 4-hour here. So even if I hop on the 4-hour here, boom. Could see price decided to come all the way up here, fall all the way down here, bounce up, create a new resistance wall here. As you guys can see, we have one push down here, another push down here, and then we got price falling down, making a higher low here. So this low is higher than this low. I like that a lot. Super big fan. And then from there, we can go ahead and wait for price to come up, smash past this area of resistance, and then after that, inshallah, we should be able to go ahead and catch price upwards right after that. Okay, so it's really just about taking your time, being patient, and waiting for the setup. Okay, remember, you want your gap to be filled to the right. You want market to make the left side of the V, let it fall down, let market make the bottom of the V, and then we catch the right side of the V. Okay, we catch the empty right side of the V. Okay, that's what I want you guys to be doing. Catching the empty right side
of the V, okay? Like this, okay? This is what we're catching. All of this whole empty space between this resistance and this area of support, right? This whole area is nothing but profit, right? Nothing but profit, all up here, okay? So 40, plus 40 points left between this area of support and this area of resistance up here. So a very, 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 very long way to go. Intel, check this out, up crazy on this one here. All right, Intel, I got it at around this 35 area. I'm go ahead and hop up on my higher time frame here just to show you guys why I got in here on Intel. So Intel, I decided to get in this area. Kind of the same reason, even if I'm on monthly here. I could still see price making upwards progression for the most part. Yes, we did fall down and make this low here. Although after this low, I put that into combination with some fundamentals. Since all the tariff stuff was going on, the United States needed their own AI chip making company to make AI chips for them, and Intel decided to partner up with other companies. I believe NVIDIA is included. And as you can see, we're starting to get a lot of bullish reaction looking to fill in this V. So we first had price falling down from this resistance here on the weekly. And then we could see price deciding to come up and fill in this gap area up here. Okay, so just go ahead and let price do its thing. Let it fill up. Okay, and just give it its space, give it its time. Okay, let market do its thing. So that's going to go ahead and be that as far as Intel. This trade was super duper simple here, and I bought after this little higher low area here too. After I analyzed this higher low area, I was like, okay, cool, yeah, super duper bullish after this. Check on the daily here too. Even after this resistance, we came down, made another higher low. After this higher low here, saw 1, 2, 3, 4 green candlesticks, bought in. So you can see you're getting a nice V fill here. And on my monthly time frame, we can go ahead and head up to this resistance up here and head up to this 40 area up here to all-time highs. I'm praying. Okay, so that's gonna go ahead and be a flip from, let's see, I opened here, so it's about 28 points here. Very great flip. And then Webull here, you know what I'm saying, Webull, they're hating on Webull. We're waiting on this, I'm not gonna lie, waiting on some Webull here. I just keep adding into this. This is gonna be a huge play. Webull is my favorite broker. I'm using this right now. If you guys are wondering what I'm looking at to look at the charts and do all this at once and see the price right here, Webull is going to be my favorite thing to analyze my stocks on. Well, I use TradingView, but honestly, I might just use Webull itself from now on, because I think it's a cooler interface and you guys can actually see some specifics of everything too, which I really like. So yeah, that's going to go ahead and be that. I pray it helped. That's how I'm opening this year. All the stocks I'm watching, that's the profit I'm up. And yeah, I'm just going to be fully transparent going forward. Just want to show you guys absolutely everything. Not going to be one of these mentors being cringe, making things uncomfortable, and just not trying to be truthful. I always want to show you guys the truth. All right, love you guys so much. Stay prayed up to God. Keep grinding. Catch you in the next one. Peace.
Discipline, discipline, discipline. I know you guys have heard of it, and it's time to stop struggling with it. Let's improve our discipline, okay? Let's stay humble. That's going to be the #1 rule in order to stay disciplined. Stay humble. Even when you achieve your goals, when you start making the amount of money that you want, when you get the house that you want, when you get the car that you want, okay? When you start doing what you want to do, you still stay humble, okay? You still wake up every day. You pray to God. You work out. You stick to your trading plan. You stick to your budget. You keep putting money in the stash and you stay in stack mode. Don't lose yourself. And discipline in trading just refers to the ability to follow your predefined set of rules. If you're a break and retest trader, then you're going to be waiting for an area of resistance to be broken and turn into resistance, or an area of resistance to be broken and turn into support. Okay. Or if you're a short trader, you're going to wait for an area of support to be broken and turn into resistance. And if you don't see what you want, then you don't take your trade. Discipline ensures that traders stick to their plans, avoid impulsive decisions that lead to losses. So losses can come from a quick emotional stint within you. Okay, you might see a candle stoop up really fast, especially if you're on your 1 minute or smaller time frames. That can make you extremely emotional. I highly recommend you guys get off of your smaller time frames, such as the 1 minute and stuff like that, as far as planning out your whole trades. Make sure you guys are doing your high time frame research first, okay, such as your daily 4-hour. Plot out your trades there first. Then if you're going to enter in after seeing your levels and seeing where the market wants to go on a higher time frame scale, then feel free to go down to your 1 minute time frame. Okay, because 1 minute candlesticks can be extremely fast, spiking up and down, might making you do emotional things that's not even the trend whole time. So check your higher time frames first to avoid making emotional decisions. So discipline also involves psychological control, risk management. Okay, psychological control just ensures that you're not crashing out. Okay, even if you take a loss, you know to hop off the trades. Okay, you're gonna hop off the charts. You're not gonna destroy your P&L that you've been grinding hard for. Okay, and you're gonna come back stronger. Okay, you're gonna be like, okay, what could I have done to make sure that loss into a win? Was that setup clean? Was that entry clean? Talk to yourself, journal. Profitable traders treat trading like a business. When you sign up to trade, you are a business. You are no longer an individual, okay? You're a business. And a business is trying to use money to make more money. Okay, that's pretty much what a business is doing, okay? And providing value to people, okay? So you're gonna be trading. So when you're making money, somebody's losing. When you're losing, somebody's winning, okay? It's a very strategical system, okay? It's not gambling, okay? And you can definitely make some money if you stick to your rules. Stick to things like your stop loss, where your trade is gonna automatically close, and continuously learn, okay? Always learn, see how you can get better, see what you can change, okay? And if you're on a hot streak, if you notice you're profitable, stick to it, okay? The only thing that should change is your contract size, okay? Stick to your setup, don't lose your discipline, okay? And just don't trade for P&L. Trade from areas of take profits from your entries, and set your stop losses if you are trading like Forex or futures, for examples. Keep it simple. And we'll explore why discipline is crucial, common pitfalls, and how to build it step by step. Step number 1 is going to be just waking up, praying to God every single day, being grateful. Okay, gratitude is going to help you be disciplined. Okay, it's going to help you stay focused. You're not going to lose yourself. You're not going to get emotional, whether you're winning or losing. Okay, you're going to be fine. And consider a day trader who sets a daily loss limit. Discipline means stopping when that limit is hit, no exceptions. Okay, and why discipline matters. Studies show that over 90% of retail traders lose money in the long run. Okay, so say someone puts in 5 bands, even if they make 2K their next trade, if you check in at the end of the year, they might be down like 8K. Okay, and that's because primarily their lack of discipline comes in. So even if you start making money within the market, you have to know how to control it. Okay, withdraw, especially if I'm on my day trade account and I win a day trade. Let's say I make $500. I'm going to keep 50% in my account. I'm going to go ahead and put 50% back in my bank account. Okay, so if I make 500, for example, I'm going to keep 250 in the trading account. This way my account's going to keep growing. My contract sizes can increase. Okay, and I'm going to go ahead and give myself 250. With that 250, what I'm going to go ahead and do is take 30% of that off, put that away for taxes. That's going to go ahead and give me the ample opportunity in order to keep stacking up, keep growing my portfolio over time. And discipline turns your real life from a game to really just a skill-based profession. And you're going to be able to stack up, take yourself serious, make certain power plays, and start building some long-term investments for your family. Okay, leaving some growth, leaving some wealth, and leaving some assets that are going to be important for people to potentially turn money into more money. Okay, so it's living an easier time. The more disciplined you are, the more of an easier time you'll have for yourself and loved ones around you. So it's worth it, trust me. And according to a report by the Financial Conduit Authority, disciplined traders have a 40 to 50% higher success rate. So trust me, wake up, pray to God, work out, okay? Create your routine, hop on the charts before market opens, okay? Or even plot your trades on high time frames before they come. Utilize things like alerts so you're not sitting there staring at the charts all day, and keep grinding more income. Grind your business, do whatever you need to do, get more income, set your alerts by the time your trade's ready. You're gonna have bread ready, put it back into the market and come dominate. Inshallah. So long-term profitability is going to require patience too. Don't expect things to happen overnight. Sometimes you get to hold trades for a long time, especially if it's shares or crypto. Okay, don't expect to see profit instantly. It's going to take time. Keep keep your portfolio separate, try not to touch it, and try not to overtrade as well too. Overtrading is going to be when you're taking multiple trades over and over and over and over and over again, not learning your lesson. Okay, if you want to stop that, okay, one, think about your future. Okay, is your family gonna eat like this? Are you gonna eat like this? Are you about to pay rent if you keep losing money because you want to be emotional? Okay, you can't afford to lose money like that. Okay, take it serious. Okay, so you can go ahead and use discipline within your real life, and how you do one thing is how you do all. When you wake up, you work out Monday through Friday. Okay, your brain muscles are going to get trained over time, and you're going to realize, okay, I can do this, I can stay consistent. And your brain's going to pretty much be disgusted if you're not being disciplined. Okay, and once your brain makes that switch, it's going to be a lot easier to go ahead and just dominate. You're going to know what your setup criteria is, and you're going to refuse to take anything else that's not it. Okay, if it's not your setup criteria, you just don't take it. Okay, and that happens by being disciplined. So I promise you guys, be as disciplined as possible for 90 days, okay? And watch how all of these things turn into habits. Okay, it might be hard at first, okay? Waking up, okay? Pray to God every day, have a gratitude mindset, okay? Work out every day, even when your muscles are sore, when you feel like you can't do it, okay? Monday through Friday, okay? Or at least just 5 days a week. Choose a schedule that works for you, okay? And flow with the market, preferably Monday through Friday, because that's when the stock market's open. Okay, do your research. Make sure you guys have some hours in order to study the market. Okay, have some study chart time. You got to be checking the chart every single day. It's about discipline. You guys have to understand the type of individuals that you're playing against. If you want to call yourself a trader, you got to change it all. I've had to really look at myself internally and change everything. I had to improve in every single way possible. I realized where my faults were. I realized I need to be more patient. I realized I need to have more of a long-term mindset. Okay, and this is helping me improve, become a better trader, have more of a positive portfolio, lose less money, and increase my portfolio over time. Okay, so some common pitfalls from lack of discipline. Without discipline, traders and human beings just fall into traps that erode your capital, your soul. And let's go and let's dive deep into these issues. So overtrading, okay, this is going to come from greed. Okay, God talks about this. Don't be greedy. Okay, this is something I used to be. I used to be extremely greedy when it came to my trading. I would make some good money, especially when it came to prop firms, for example. Okay, let's say I made $1,000 on my prop firm 50K account. Okay, I would try and go ahead and trade again. Okay, try to make like 1.5. Then I would go down to 600, right? Trying to make it back up. And then, I might end up break even. Okay, destroying everything. Because why? Because I wanted some more profit. Okay, once you take your trade, you be grateful. Okay, you be grateful. Okay, have a gratitude mindset. Okay, be grateful for every loss or W that you take on the charts. It just is what it is. You're making bread on the screen. Okay, and I'm disgusted at myself for even not taking advantage of that. But it's okay. I learned, and this is why I come on the charts and come on here to tell you guys not to make the same mistakes I did, because it hurt emotionally. Okay, times where I was like, oh man, I could have used those bands. I could have used that money to do X, Y, and Z. I could have just reinvested that profit to make some more profit. Okay, but it didn't happen at the time. Okay, so don't overtrade, especially if you're a futures or forex trader and you can just spam buy and sell. Be careful with that. Okay, options, you got to be a little bit more strategic. You got to know what contract you want. You got to know what strike you want. Okay, it's a little bit different when it comes to options. It's harder to overtrade. But when it comes to futures and forex traders, make sure you guys are just, please humble yourself. Okay, humble yourself. Don't let that buy and sell button, don't let that instantaneous impulsiveness destroy your whole portfolio. Take logical trades. Okay, take your time too. Market's not going anywhere. Take your time. And trading too frequently can lead to high commissions and emotional burnout. You might feel like trading is not for you. Okay, take your time. You got to keep going. You got to keep grinding. Okay. For example, let's say a novice trader buys and sells 20 times a day. You'll be losing money on fees alone, depending on the certain brokers. Okay, the more trades that you take in a day, you're going to be subject to fees, bro. And that fees is going to be hitting at your P&L. So you're not even going to be making as much money as you think you are, even if you are hitting some profitable trades. Okay, so try and do 1 to 2 trades a day, max. No more than 1 to 2 trades a day. Okay, I like to trade a couple times a month, a couple times a week. Okay, personally. Revenge trading, don't do this, man. This is going to be one of the worst things you can do. When you take your L, You got to be grateful. You got to be grateful. Because if not, you're going to get mad and you're going to think that you're right. You're going to think that the charts are doing something wrong. And it's absolutely not true. If the trade's not happening, it's just not happening. You can't chase losses with bigger bets. You can't take a L, put on double your size and be like, you know what, I'm going to make up that loss and I'm going to go ahead and make some money. Putting on double size, next thing you know, you lose again. Next thing you know, you're super down and then you're emotional. You're upset at yourself. You're angry. Okay. You're like trading, you know what, I don't know if this is for me. All because you got emotional. Blame yourself. Don't blame the markets. You got to wait for the cleanest setup that you can possible. Okay. And if it doesn't work out, it's fine. This is why you manage your risk. You shouldn't even be tripping if you lose. If you're tripping when you lose, you're oversized. You're not trading within good risk parameters. You're way oversized if you're tripping if you lose. So chasing loss over bigger bets is not going to be the play. And this stems from ego. Okay. Whenever your ego gets hit, you got to understand, okay, you know what? I'm not going to win everything. It is what it is. I took a loss today. Don't double down and try and get back at the market. That's just going to lead to wipeouts, destroying your account, destroying your P&L. There's been times on prop firms, I've been day 4 out of 5. Okay. About to get a withdrawal. And I blew day 4 out of 5. I blew it. Okay. Up like 3 bands on a 50K account. Boom. Destroyed it all in pretty much a day or two. Okay. Hit the daily drawdown. And then day afterward, boom, destroyed it again. Okay. Okay. All because of ego. All because I was trading for P&L. Not trading out of discipline, not trading out of consistency. Okay. Ignoring my stop loss, thinking I was more right than the market because I just had a little hot streak. Okay. I had to humble myself. I had to realize, you know what, I can't keep taking losses like this. I want to get better. I want to improve. I don't want to keep being the same type of person that I've been. I'm not going to keep holding positions and hoping for a turnaround. I'm going to play logically according to my plan. This violates your risk rules. This violates your soul rules. Whatever you're trying to do for yourself and your family, you can't do it when you're losing more money than you're expected. You got to stay down. Stay in stack mode. If you took a loss, come back stronger. Try again. But don't destroy it all in one setup. Take your time. Plan an even cleaner setup and win that one. Start over again. Get in stack mode. Restart. Okay, you're good. God got you. Even if it's your last dollars, God got you. You're trim. Okay. Restart. Run it back up again. Try again. Plenty of times I've had to do that. Okay. FOMO. Don't let FOMO get to you too. If you just see candlesticks bursting, you just took a win, for example, don't be like, oh, it's a good opportunity to make some more bread. Relax. That's not the mentality. That's very greedy, extremely greedy, very ungrateful. And take your time. Discipline counters this with rules-based trading. And relying on rumors instead of analysis, okay, can be bad. Don't be social media trading. Do your research. Check out the TA, the technical analysis, and make sure everything just lines up together. Okay, don't be going off of what he and she says. Do your research. Put it all together. Make sure it makes sense with your trading plan. Your trading plan is not going to be the next person's trading plan. Okay, figure out what works for you, and then you go ahead and you dominate with your plan. Okay, figure out what works for you and dominate with your plan. That's all you can do.